Are weeks away before the Supreme Court rules on the legality of the Trump tariffs, and importers now have to register on a new customs platform in order to be able to receive any type of refunds. Details on the new digital payment system were announced on January 2nd, and importers have until February 6th to register. If they don't, customs specialists tell CNBC importers could have delays in refunds. The new system is called ACE and was part of an executive order signed by President Trump back in March. It's designed to modernize the government payment system, which originally was manual. A decision by the Supreme Court on tariffs could come as early as Friday. CNBC has reported earlier importers have pushed back on President Trump's claim that the tariff payments would be messy because the tariff bills the importers have been paying are itemized. If the Supreme Court does rule the tariffs or part of the tariffs are illegal, the Court of International Trade has the legal authority to decide how the refunds are paid to U.S. importers.
Well, 2026 is shaping up to be a defining year for the global order. According to Eurasia Group's president, Ian Bremmer, the single biggest risk is not China, Russia or AI, but the US itself. Now, in an exclusive chat with CNBC-TV18, he spoke about the looming Supreme Court tariff ruling and Donald Trump's political agenda. Listen in.
The IEEPA clause, which is meant to be applied in a national emergency by the president, is clearly not the intention to be used against 90-plus countries for political purposes, against Lesotho. I mean, there's no national emergency in many of these cases. So I do think that the Supreme Court, at a minimum, is likely to constrain the use of IEEPA in some of these purposes. That doesn't mean that they will overturn everything. The Supreme Court is not going to give him a rubber stamp and say, you have all of this control, the president can do whatever he wants, even though most of the tariff powers are meant to reside in the hands of Congress, the legislature. In the near term, Trump's consolidation of power is leading to a number of wins for the United States. You just saw that in Venezuela, of course. You've seen it with the way that a lot of the trade negotiations have asymmetrically benefited the U.S. because the U.S. is the most powerful country. But even though the U.S. is the most powerful country, Donald Trump is not the most powerful leader. Xi Jinping is. And that's because Xi Jinping doesn't have term limits. He doesn't have checks and balances internally. He doesn't have an independent judiciary. He doesn't have a professionalized military that reports outside his structure. Trump has all of those limitations. And of course, the purpose of the political revolution is to end that. It is to ensure that the president is above the rule of law and that the U.S. political system can be weaponized against Trump's political enemies the way that he believes that it was weaponized against him in the Biden administration. I suspect he will fail. I'm not completely confident of that, but I think it's likely he will fail. There are three reasons that I think he'll fail in increasing order of importance. First is he's not very popular. He's likely to lose the House to the Democrats in November in midterm elections. And as a consequence of that, there are more Republicans that will start to think of him as a lame duck and will move away from him as president.
We'll take a short break. Here's from the commodities market on the other side. Stay tuned. Welcome back. Before we get to commodity updates, the most important stock to watch out for today is going to be IEX, and that is because the Electricity Appellate Tribunal is scheduled to hear the market coupling case today at 10:30 this morning. Ashmit is here with more details on this. Ashmit.
Well, the APTEL is all set for a hearing in the IEX case, the Indian Energy Exchange's challenge to the coupling order that had been passed by the CERC in 2025. Now, a large part of the hearings we've seen a lot of back and forth with essentially the exchanges alleging that this entire order, this entire exercise is tainted. The exchanges have been citing a SEBI report which suggests that this coupling order was nothing but, in fact, a ruse, a scheme, an insider trading ring which led to illegal gains of over 170 crore rupees in the hands of CERC officials. They point out that the very author of the coupling order is in fact mentioned in the SEBI report. Now, this was also taken note of by the APTEL. The APTEL said that the theatrics, the drama with which this order was passed has raised questions in the minds of the judges, and also going on to say that if there is foul play found, APTEL will not be shy of taking action. On the back of all of this, we had a very interesting revelation by the CERC lawyer. The CERC lawyer said that they wanted this entire exercise to be fair, to be transparent, to be consultative, and that keeping that in mind, they are now going to get a formal opinion from the Commission on whether the coupling order can be withdrawn. Now, this is critical. Now, just this comment from the lawyer led to a nearly 12-13% spike as far as the IEX share prices are concerned. We're yet to get clarity whether the Commission has decided to withdraw its coupling order. We'll get clarity in just moments from now when the APTEL takes up this case for further hearing.
Ashmit, thank you for that update. Keep an eye out on IEX in today's session. And Manisha Gupta now joins in with all the updates from the commodity space. Manisha, good morning. There's some rebound in oil prices this morning.
Yes, a 4% of a gain in the overnight markets, and with that, the crude prices are now trading at a 2-week highs. We've seen crude heading for a third weekly gain. It is about investors assessing developments in Venezuela, also the supply concerns coming in from Russia, Iraq, Iran. All of that seems to be supporting the crude oil prices. As been said earlier as well, the markets will be watching out for the U.S. non-farm payroll data. Further direction for the markets would come in from that one. While there is gain in the crude oil prices, there is also profit-taking that we have seen come in for metals. So gold and silver slightly weak ahead of that U.S. Payroll data. We also are looking at copper prices coming off its all-time highs that we saw on Monday itself. So whether it's on LME and COMEX, a bit of a decline onto that one. But gains also have come back in case of rubber prices. 9-month highs onto this one on the back of speculative buying one, and positive Chinese economic data seems to be supportive.
Manisha, thank you for all of those updates there. Rubber prices at 9-month high levels. Flashes on your screen from Donald Trump telling Fox News that they could be taking trillions of dollars worth of oil from Venezuela. So keep an eye out on all of that as well. Take your leave on this edition of Power Breakfast. Bazar Morning Call on the other side to set you up for what promises to be an action-packed trading day.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. Finally, we are on Friday. And what a week it has been. Started with an all-time high on Monday and, is looking a little despairing now as we close this week out. It's an important one, especially after market hours. Two triggers, which I think will dominate how we trade on Monday morning. We'll discuss all of that. We're coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Nigel and Rima. Guys, good morning.
Hi, good morning. It's been a near 500-point fall on the Nifty just in the last 4 trading sessions. The big fall, of course, came yesterday before consecutive session of losses. And not just the global triggers that we're watching today, the jobs report and the Supreme Court verdict on tariffs. Next week is such a big week in terms of earnings, whether it's tech, it's banking names, Reliance Industries. It's, will be mark time today is the question ahead of that.
Well, that's right. What a start to 2026, right? I mean, so many cues for the equity markets as well. And on a personal front, when I wrap up this week, I'll be just, reflecting on a couple of losses in the start of 2026. Mr. Anil Agarwal's son, as well as Sid Bhaiya. Just tells you how fragile life is, right? And uncertain. So I think today it's not going to be about the party or about the end of the week. I think I'll reflect a little bit because... that's something that really has put me a little bit off at the start of 2026. But we've got markets to deal with, so let's get straight
absolutely. And I think, the theme seems to be uncertainty and a very uncertain environment everywhere out there. Let's just take a quick look at what you need to know as we begin this fresh trading session. What do you have, right? I mean, U.S. equities are mixed. Actually, it's not so much price action once again from last night. The S&P flattish, NASDAQ is down about 0.4%. And there are two big cues. I'll sort of, come back to what happened last night once again, but I just want to start and address what is most important right up front, right? So you've got Trump tariff ruling, which is number one, and you've got the U.S. jobs data, which is number two. So the Supreme Court ruling on Trump tariffs will come our time later tonight at about 8 o'clock. We should have it, most likely. And the U.S. jobs data, of course, comes around U.S. market opening time. And there the consensus is for about 70,000 jobs. I'll come to that. Now, consensus also is, if you look at prediction markets, they're saying that there is a chance in the high 70s that the U.S. Supreme Court will partly strike some of these tariffs down. So all tariffs, no tariffs, some tariffs, but, perhaps there will be some action and most likely perhaps a partial kind of rollback. Now, these are the emergency powers that President Trump used to impose all these tariffs. So far, all these tariffs, right? These are the IEEPA tariffs. And that is what we're talking about here. Now, I said this yesterday as well. If it were to come to that, the Supreme Court partially strikes down these tariffs, expect President Trump to come out strongly and, of course, say, well, the decision from the courts is wrong and that he will find a way to put these tariffs back on. Tariffs have been central to the Trump administration's policy from day one. And don't expect them to back off. So if there is a decision, don't think, well, tariffs are over. They're not over. They will find other ways. There are other sections to do it. The IEEPA tariffs are the section under which all these tariffs were imposed over the last year, were the most convenient, fastest, quickest way to do it. There are other sections. They are more cumbersome, may take more time, but they can do it. So I think that is what we are looking at. Now, the question for us in India, especially us in India, first of all, just in an absolute headline tariff level, we are one of the worst hit. So in that sense, right, can the Supreme Court striking down at least even part of the tariffs be at least a short-term, can lead to a short-term risk rally when we come back on Monday? And I think the answer perhaps is in the yes, if it does come to that. Because, for at least a few days, even if we hear from President Trump, there will be confusion. People will start to look at these sections. How long will it take? It will certainly take longer than just a stroke of a pen like he's used the IEEPA ones. So does it provide a window? Some breathing space is the question. And I think perhaps as I said, the answer is yes. Now, the other one, which has not been talked about at all, right, is the fact that U.S. Ambassador Sergio Gore will be in India U.S. ambassador to India, will be taking charge, will be here starting Monday, this coming week. He was here, remember, on that flash visit, met many leaders, Prime Minister Modi as well. Now he's back here permanently. The reason that is important is that, several people like Ashok Malik, etc., have said that Sergio Gore has got direct access to President Trump. He's in the inner circle. He's he's not a typical career diplomat. Him being here, he can cut through the bureaucracy and get President Trump on the line. So at the margin, it is a positive. Will it lead to something? I think we'll just have to wait for it. But at the margin, that is one more point which I think the markets will be paying attention to. Okay, so that's the US bit, right? Now, just from going back to last night's action, oil prices were up 5%. So there's a big pop, $63 a barrel. No specific reason. Down and up, but from 60 and 63, that's been the range for the last 1 week or so. Two largest mining companies are saying, well, they may merge. Glencore and Rio perhaps are in talks to form the biggest miner in the world. In the same vein, in terms of commodity, silver was down sharply, 5% or so, but it kind of sort of recovered and ended down about 1%. Defense stocks, I think the one enduring theme from everything which is happening, all these uncertainties, the fact that everywhere defense spending is going to go up. Remember, defense stocks all sold off the prior session. They were up last night. Lockheed was up 4%. Trump essentially is calling for a 50% increase in military budget as far as the U.S. is concerned. Trump also gave an interview to the New York Times, and he said, well, he's made up his mind on the Fed chair pick. Besant basically was also on the record saying that, current interest rates are far above neutral. And when he asked where should rates be, he said, 3%. He said consensus is 2.5 to 3.25%. So that's the other one. And this is again going to be a big factor. How much pressure, how much influence can the executive branch in the U.S. put on the Federal Reserve to lower interest rates? The Fed pick, etc. It's something we will have to talk about. Now, just to tie in the levels here, yesterday, of course, was a very, very bad session. From the highs on Monday, all-time highs on Monday, the Nifty is down about 500 points. Bank Nifty is done much better. It's down about 1.25% or so. The small cap index, the mid cap indices, small cap closed exactly at the 20-day. The mid cap index closed below the 20-day. So these moving averages are all under are breaking, straining, have broken. And I'll just leave you with those levels once again. The key 20-day moving averages, as I've done for the last many days, 26,044 is that level. We are under it. And of course, the Nifty Bank is 59,409 or so. GIFT Nifty up on your screen gives you a quick sense, about 12 points. So very undecided going into those important events later today. Nigel has walked across to the wall with the F&O positioning. Nigel, over to you.
Well, yesterday the session belonged to the bears, right? No two ways about that. The Nifty ended way below the 20 DMA and the broader markets as well sold out. So yesterday, in the sense, was a bit of a backbreaker for the bulls because still yesterday, actually, they would still have their hopes up. But let me get to a couple of data points that actually they could be banking on. The problem now is that the FI net sell number, well, that's perked up. Remember, their participation was low. As their participation is picking up, the sell number as well is picking up. So at around 3,400 crores odd, that's getting to be a bit of a worry. In trade yesterday, besides the FI selling, that appeared that there were shorts that were getting accumulated into the Nifty, on the futures segment. While on the Nifty Bank, actually, the open interest was down, telling you there was some unwinding of long positions out there. Yes, the structure is weak on the Nifty, but there are a few technical factors that the bulls will be banking on. First up, in terms of the short positioning yesterday, it went up big time because the shorts that the FIs added were close to around 31,000 contracts. I'll tell you what, this is the highest FI net short build-up in the last 7 months in absolute terms. More than 30,000 contracts in a single trading session. And the short positioning now moves to around 91%. So you have shorts in the system, but we need that good news to come for this, in fact, for the shorts to get covered out. So that's point number one. FIs aggressively net short. The clients, they're doing the reverse of what the FIs are doing. So in yesterday's trading session, they added some long positions. More than 12,000 contracts is what they added. And if you look at it in absolute terms, the FIs are aggressively net short, as that is telling you, while the clients, the long positioning is at the highest we have seen in the last 3 months or so. Normally, this combination actually is good, and that's when we see a bit of a bounce. On the options data side, which is the second data point I'm making, the first one was the FIs and net short. The second data point is that the PCR has come to the lower end of the range. Remember, the start of this week, it went to around 1.5. Now it's come to around 0.66. At around 0.6, 0.63, we have seen a bit of a bounce. That's the other data point. Then if you look at the Nifty and the gold ratio, that's come to sub 2 times. Remember, in the past, whenever we have seen this, more often than not, you've seen a bit of a bounce from these levels. So either this is the new normal, closer to around 2, but otherwise at around 2 times, you do see a bit of a bounce. While at around 3 plus, that's when the returns get a little bit subdued. And at around 4 times, it doesn't turn profitable from a bullish perspective. Moving to the options data, called writers, well, they are having a gala time. 26,100, 26,000 call, 26,050 call. Aggressive writing is what we have seen. So they believe that these upper levels are going to get protected. To put in a few levels, well, the support zone is around 25,500 to around 25,700. I say this because even in December, we visited this zone, and from there, we did see a bit of a bounce. While the 20 DMA, that becomes the crucial resistance mark. The two big constituents of the markets will have to come and, bat for the bulls. Because, yes, the Nifty has broken that 20 DMA, but the Nifty Bank, that's still a little bit away from the 20 DMA. You don't want that level to break. And Reliance Industries, the big boy, has corrected from the top. It's getting closer to around the 200 DMA, so you don't want this level as well to break. Both the Nifty Bank as well as Reliance Industries will have to play well from here on to defend the Nifty. And as I said, select factors are suggesting we're getting into a bit of an overstretched zone on the downside.
Thank you very much for that. Reliance Industries numbers are next Friday, post-market hours. And then on Saturday, that's 17th, you've got HDFC Bank and ICICI Bank reporting numbers. And through the course of next week, lots of IT names, whether it's TCS, HCLTech, Infosys, LTTS, many mid-caps will be reporting numbers between Monday and Friday. But post-market hours next week, you'll have Reliance and the two large private sector banks. But let's get you the equity calls then. It's Rupal Agarwal of Bernstein who believes India is presenting a balanced risk-reward setup, warranting a neutral stance. So she says, while stretched valuation, potential risk, a potential rise in risk premium, challenging stock picking environment, lack of macro recovery, and even the valuation earnings support does create some near-term challenges. She sees positive tailwinds from strong earnings recovery cycle heading towards upgrades, reasonable relative valuations, low long-term earnings growth expectation and potential return of foreign capital, resilient domestic flows and likelihood of a US-India trade deal offsetting the negativity. But in a nutshell, I think the call is from Rupal Agarwal of Bernstein that the setup appears to be neutral. But let's invite Neeraj Sheth, founder and chief investment officer at 3R Investment Management, now joining in. Thank you very much, Neeraj, for joining in. Top of mind is the uncertainty swirling around the US trade policy, the Supreme Court potentially ruling on the legality of Trump's emergency tariffs later today. So the question is, how will the market react in the various scenarios? One, there is a partial strike down. Two, in case there is a full strike down. And in that event of any strike down, what is the market assuming on how quickly and effectively Trump can impose alternate tariffs? What are the legal avenues? And then in the event there is no change, how should markets react on Monday?
So I think overall you will not see a significant reaction with the exception of maybe the immediate knee-jerk. I think two aspects you have to think about. One, from a tariff perspective, if anything, you've seen the tariffs getting watered down over the last 6 months. In fact, post-April, if any, the tariffs have been obviously seeing exceptions to obviously manage inflation and other supply chain aspects. So it's not as if the headline tariff, what it was expected to be, is where we are. We are way below that. The second thing is from the standpoint of the Supreme Court verdict, I do think the administration has ample avenues through the different sections to re-put whatever if they want to. So I think there will be a knee-jerk reaction, but I would expect the markets to actually look through that because some of those tariffs that the administration wants to keep will come back through a different channel. So I'm not sure it actually changes the path from the broader fundamental perspective here.
Not even for a Neeraj, hi morning, and wishing you a better 26. Happy 26. Good to see you. Not even for in a short-lived sort of near-term way for a badly hit market like India in terms of relief.
So I think there will be a near-term reaction. There certainly will be an immediate, as I said, knee-jerk on the back of the ruling you will see. From an India perspective, I'm in a more positive camp just by virtue of the changes we have seen, whether it's in terms of tax cuts flowing through some earning recovery that you would expect this year, as well as, I would say, the max tariff uncertainty behind us and the rupee seeing signs of stabilization. So I think India is a slightly broader discussion on what drives 2026 from a calendar year perspective. But from a tariff side, yes, it will see. But the broad tariff uncertainty around the trade deal, I think that still has to get out of the way.
Hi, Neeraj. Morning. Good to see you, Ben. Plenty of worries, right? Uncertainty on tariff. Don't know what Trump's going to do next. And now suddenly geopolitical issues again are creeping back up. How big a risk is that?
So there is obviously pockets of geopolitical uncertainty, but markets have been looking through it. To some extent, obviously, the markets have gotten a bit complacent because nothing is at an individual level that big. I do think the impact of that, even though you have a broad positive backdrop from a fiscal and monetary policy standpoint globally, is the geopolitics risk will lead to higher volatility in 2026, but not necessarily a turn in the market direction.
But just the knee-jerk reaction on the US markets, Neeraj, because on one hand, they will be losing the tariff revenue that they have collected so far, and it's quite sizable. There will be refunds, reimbursements to do. But on the flip side, it does open up global trade, the tensions between US and various other countries. So how will US markets react in the event of any sort of a strike down or a slowdown?
So I think it's obviously it varies by the asset class. It's negative for the treasury markets, the US rates, because obviously a part of the fiscal financing market moved towards calculating the tariffs as a part of the fiscal financing, which is running at around close to $2 trillion of deficit right now. What are rate tariffs for the full year? And I think markets will reprice that, which means it's negative for the treasury markets. Equities will be mixed based on the sectors.
Yeah, I mean, what has happened so far, it's all upside down, right? Middle of last year, there was expectation that it's bad for growth, so hence bad for equities. None of that played out. And all of this is, equities are having a great time. So if this throws everything into a bit of a confusion, I guess it is bad for equities, near term at least. That's the, if something is going well and it gets interrupted, it changes direction for a little bit. But I guess long-term yields go up again, because of those fiscal calculations, fiscal fears returning.
I do think the long-term yields go up. You will see potentially a further steepening of the US curve. Which again, depending on the levels, is beyond a point is not great for risk assets if you see a significant backup in the long end of the curve. So to your point, I think the immediate reaction, the equities might be negative. And then you have obviously a mixed picture under the hood in terms of which sectors take a bigger hit based on the interest rate sensitivity.
Neeraj, is good conversation. It's a bit near-termish, but it's all near-termish right now. I hope you'll join us once we have the decision from the Supreme Court in terms of the shape, size, form on tariffs as it comes later tonight. Thank you very much for being here on CNBC TV18.
Thank you.
Okay, let me just quickly run you through the interactions which are lined up here on the program. 8:30, we discussed the government's plan to scrap curbs on Chinese firms bidding for government contracts. We have Prabhudas's Amit Anwani joining us for that. 8:40, management of P.N. Gadgil. A phenomenal run in some of these stocks, jewelry companies lately. 9 o'clock, we have Prabhu Sen of ICICI Securities. It's all been about oil, but more about oil politics more than anything else. But what are implications? Stocks have sold off. 9:20, Gautam Shah will talk technicals, charts with us. Markets, of course, in focus. 9:30, we have the big Bharat Coking Coal, the Coal India subsidiary IPO, which is opening for subscription. So we have the chief from BCCL and Coal India, both joining us to talk to us about that. 9:40, Yogesh Agarwal of HSBC India, head of the IT sector's third quarter earnings. Vikash Kumar Jain is the market conversation from CLSA, Outlook 26. And towards the end of the program, Lada speaks with Goldman Sachs' India economist Antanu Hussain Gupta on the just released GDP numbers on rates, rupee, and more.
Time to slip into a short break. A lot of stock-specific action to track for you. Get it in just a bit in our special Top 10 segment. We look at ONGC, Oil India, Reliance Industries, BHEL, Power Grid, Astra Micro, Power Mech, Sagar Cements and Andhra Cement. They'll all be reacting to positive news flow. While on the flip side, you have Velicon Engineering that will be reacting to negative news flow. Take that break, come back, into further detail on all of these names.
Welcome back. Let's get the GIFT Nifty up for you on the screen. In the last 4 trading sessions, the Nifty's lost 470 points, 4 consecutive sessions of losses, and we closed below the 25,900. And this morning, there isn't any big recovery afoot, at least for now. 1.7% lower on the benchmark indices this week. Our research team is standing by with CNBC-TV18's list of top stocks for the day. And big moves seen in crude prices. Brent crude is at $62.50. So Sonal is joining in now to tell us the impact that we could see on some of these oil and gas names.
Good morning, Rima. Well, we've been seeing a lot of volatility, but Nifty Oil and Gas, that index is down 6% in last 1 week itself. Oil prices overnight rose 3%. There have been a lot of focus on Venezuela, what happens with supply in Russia. Now, there are talks of more sanctions, Iraq and Iran as well. On the back of that, crude prices surged overnight, and this has come in after 2 days of minor declines that we saw as well. Jefferies has put out a note today that they say despite all that is happening globally, the market is still oversupplied by 2 million barrels per day. And by the end of calendar year 2026, it is projected to rise to 3.5 million barrel per day. So yes, the crude rise is good for Oil India and ONGC, but we'll have to see whether that continues or not. Additionally, Reliance is in focus because they put out a statement that they are awaiting clarity on access for Venezuelan oil by non-US buyers, and they will consider buying the oil in a compliant manner. If that does happen, it could be positive because Jefferies last week had indicated that the company earlier used to buy 20% of their oil needs from Venezuela, and if they continue to do so, it could be at a $5 to $8 per barrel discount, which will aid their GRMs. So these stocks will be on our radar today.
Okay, all right. Thanks a lot for that, Sonal. Hopping across to Vinny. She's here to tell us some stocks in the news. Vinny?
Hi, good morning. So talking about some of the order wins that have come in, one is BHEL. Now they've received an order for around 5,400 crores. This is from Bharat Coal Gasification Chemical Company, which is a joint venture that they have with Coal India. BHEL is one of those promoters of this company. They have 49% stake as well. And obviously this is a related party transaction. It's taken place at an arm's length price. And the project has to be completed in 42 months. Other than that, they have operation and maintenance service contract with them as well, which will be for a period of 5 years. So an important order there for BHEL. Powermac, that's the next one. They've been awarded a BESS order from West Bengal State Electricity Distribution Company. This is overall 1 gigawatt BES, and additional there's a green shoe option of 1 more gigawatt. So totally, including the green shoe option, the revenue potential would be 3,126 crores. Excluding it, it is around 1,500 crores. Lastly, we have Power Grid also. They have been declared as a successful bidder to establish interstate transmission system in Karnataka. This is a project of a 400 kilowatt of DC transmission line. All these stocks are going to see some bit of a green because of the order wins today.
Thank you very much for that. BHEL was down more than 10% yesterday, but that overhang on allowing Chinese imports in the sectors that they operate, which could increase market competition, still looms on that. But moving on to Ria on Astra Micro. Ria?
Well, good morning. Astra Micro has received an order today. In fact, the JV company called Astra Rafael Comsys has received this order worth roughly 275 crores from the IAF for the integration and installation of software in aircraft. Now, this includes the integration of software-defined radios on MiG-29 aircraft, as well as the installation of network-centric application on MiG-29. And this also includes the procurement of 24 SDRs for the LCA Mark 1A aircraft as well. The execution period for this will be 12 months. Just looking at the order book status for Astra Micro as a whole, at the end of quarter 2 of FY26, the standalone order book was roughly 1,900 crores. And going forward for FY26, the company is targeting 15 to 20% revenue growth. And in quarter 3, they are expecting an order inflow of in excess of 400 crores. And for quarter 4, they are expecting the order inflow to cross 600 crores.
Thank you very much for that. Elecon Engineering's Q3 numbers. Vinny, how did they look?
Q3 numbers not that good, right? Revenue saw only a growth of around 4.3% on a year-on basis, coming in at around 550 crores. EBITDA is down by 23%. Margins have seen a sharp contraction, 19.8% versus 26.9% last year. Profits are down by 33% as well. Even segment-wise, the transmission segment, that's seen a very muted growth of just around 1.5%. And material handling equipment, that saw a better growth of 21%. But transmission division, that's a higher portion in terms of the total revenue. Now, order book, that came in at around 1,372 crores. The company has maintained its FY26 guidance, which that's spoken about. Actually, slight bit of a reduction there is what they've done. They've lowered it by up to 5% in terms of revenue guidance. Adjusted EBITDA margins may be lower up to 2%, around 2% is what the company has mentioned in their PPT. They said that overall order book is healthy, but yes, as of now in terms of revenue as well as adjusted EBITDA could be slightly lower. Margins obviously this time mainly were impacted because revenue was one flat. Other than that, increase in employee costs as well as change in product mix overall impacted the margin. So we could see some bit of a red coming in for Elcon Engineering.
Got it. Thanks a lot for that, Vinny. Well, I'm looking at two cement companies. There is Sagar Cement, which is the parent of Andhra Cement. Now, yesterday, post-market hours, they have disclosed on exchanges that they're looking to sell close to an 8% stake that they hold in Andhra Cement. That's around 75 lakh shares. But via this, they'll be able to raise close to around 54 crore rupees. Sagar Cement, what's good for them? Well, they'll get close to around 55 crores or thereabouts for this 8% stake. And they still will have another 6% to come down to that 75% odd level. For Andhra Cement, interesting because yesterday the stock closed at around 69 rupees, but the pricing that they have come in at a base price of around 72 rupees. So because it's at a bit of a premium, going with green on both these two stocks, Sagar gets some money. The OFS is priced at at a bit of a premium to yesterday's close. For non-retail investors, well, that opens up today. While for retail, it'll open up on Monday itself. The reason that Sagar Cement is doing this is because currently the holding is 90%. It needs to come down to 75%, and they'll be looking to fulfill that. My gut is that they get it done in the next 1 month or so, come down to 75%. Post this OFS, it'll be at around 81% or thereabouts. So we'll keep an eye out on both these two stocks, moving with a tinge of green on both of them.
All right, let's quickly recap then. The top stocks on our radar, stocks with positive news flow are ONGC, Oil India, Reliance Industries, BHEL, Power Grid, Astra Microwave, Power Mech, Sagar Cement and Andhra Cement. Stocks with negative news flow are Elcon Engineering. And keep your eye out on oil marketing companies too, with the rise seen in crude prices. In fact, Manisha is now joining in, talking about crude to get us all the action that's happening in the world of commodities. Manisha, big news on crude overnight.
Oh, yes. It's trading at 2-week highs right now, and the crude prices have gained up by nearly 4% in the overnight markets. With this, we are heading for a third weekly gain. This is after crude closed 2025 down by 18%. So January, in that sense, has started on a positive note for the markets. It is about investors assessing developments in Venezuela. Reports of Chevron, ConocoPhillips, and Exxon are expected to play constructive roles in Venezuela. And it's not just about Venezuela, because there are supply concerns also coming in from Russia, from Iraq, from Iran as well. The only reason that the markets have not run up has been because 2026 crude surplus is estimated anywhere between 500,000 to 3.5 million barrels per day going forward every single day. So that is what seems to be bothering the markets right now. With the gain in the crude prices, we also have seen support come in for the crude products. So whether it's about natural gas, heating oil, gasoline, we've seen a gain come across energy basket in the overnight markets therein.
Okay, all right. Thanks a lot for that, Manisha. For the time being, though, we'll slip into a short break. On the other side, we have PL Capital's Amit Anbani, who's waiting by to help us analyze the reports that suggest the government plans to scrap curbs on Chinese firms bidding for government contracts. Stay tuned to that conversation.
Welcome back. There is some significant information that is coming through on Vodafone Idea, where Vodafone Idea has disclosed to the exchanges about the relief on AGR. They're saying the AGR dues from FY7 to FY19 has been frozen. Just trying to get those numbers up for you on your screen. The AGR dues as of 31st December 2025 are frozen. And payable as follows: a maximum of 124 crore and to be paid annually over the next 6 years. So that is not significant. 124 crore is what the company needs to pay. 100 crore annually over the next 4 years thereafter. March 2032 to March 2035. And after that, from March 2036 to March 2041, the remaining AGR dues have to be paid. So basically, in a nutshell, for the next 10 years, the company does not have to pay much by way of AGR dues. Otherwise, the AGR dues were very sizable, exceeding more than 30,000 crore rupees on an annual basis. The company's cash flow did not support that. And now the company is saying that they've received official communication from the cabinet. Ashmit has been telling us that how on 31st of December, which was the last, the cabinet meet in the last trading day of, 2025, the cabinet had met and they had discussed the relief for Vodafone Idea. So now the takeaway is that for the next 6 years, the company has to pay 124 crore. After that, for the next 4 years thereafter, the company has to pay 100 crore on an annual basis. So next 10 years, the outflow from the company, the cash outflow, will be actually quite negligible. Thereafter, the company has to make good its payments. We'll try and connect with an analyst, but it does seem like at least for the next 10 years, there is sizable relief for Vodafone Idea, and we'll wait to see how the market connects. So this is official communication, what has come through, and it is a big relief for almost 10 years now. And we'll wait by to see if this leads to the debt funding that has been on hold in abeyance because of lack of clarity on the kind of relief that the company is going to get. So the company was seeking to raise some debt, which will help in kickstarting its capex plan in full gusto. So, FPO money fundraise was done around the same price of about 11 rupees, but the company wanted to also additionally raise money, 20,000 crore via debt. And now with this official release, the official communication coming in from the government, let's see whether the company and the bankers can get that debt funding in place. So important relief coming in for Vodafone Idea.
Got that, Rima. We'll let you ponder on the numbers a little bit more. For the time being, let's turn our attention from telecom to the capital goods sector. Well, that's in focus. A Reuters report suggests that the government is planning to scrap a 5-year-old restriction on Chinese firms bidding for government contracts. Vinny joins us first to set things up, and then we go across to Amit and Vani. Vinny?
Hi, so yes, absolutely. Yesterday we had this report that came in from Reuters. Like you mentioned, the Finance Ministry is planning to scrap that 5-year-old restriction on Chinese firms. This restriction was placed in 2020 on power, railway and other sensitive contracts. These are government contracts. So yesterday we saw all these stocks fall in trade. Now, obviously, what came in today as an update furthermore, brokerages seem more divided in terms of the timelines, actual implementation if this actually takes place, and given that these are sensitive sectors that are involved in these contracts for the government contract. Now, what is the view for Bernstein? Bernstein said the relaxation may be more segment-based with prior requirements on part of Chinese firms, so approval coming on that front, but more segment-wise. They said the negative impact could come in for players like L&T, equipment players, while beneficiaries of this, if actually takes place, then they would include asset owners like Power Grid and NTPC. What is Jefferies' view? They said the highest impact, if this actually takes place, would come in for BHEL, L&T, Afcons, ABB as well as CG Power, while lowest impact would be defense companies followed by Cummins. Other than that, we have impact that came in on T&D companies also is what Jefferies is highlighting. So we could see impact on Siemens Energy as well as Hitachi Energy. What is IIFL's view? They said that the Chinese company TBEA is likely to participate in Power Grid tenders for these reactors, and restriction will be on a case-to-case basis, and other specific products will be specifically mentioned, not for everything as a whole. It will be case-to-case basis. Philip Capital is saying the Chinese players have mostly kept out of these grid, railways as well as metro signaling tenders, and headline policy has created uncertainties. Obviously, that could weigh on sector valuation in the near term. Even Macquarie is saying that this move will help supply chain constraints in import as well as dependent critical equipment speed up project execution, as well as lifting these import curbs will be gradual and calculated. ICICI Securities is saying that easing will allow Chinese companies to set up factories in India and compete as well. So quite a divided view coming in, but important to see if this actually comes through. But impact surely comes in for some of these players in this industrial sector.
Thank you very much for that. We saw the impact yesterday as well, 3 to 10% lower on many of the stocks. Amit Anbani, research analyst at PL Capital, is now joining in. Amit, give us your analysis. If this does come through, who would benefit and who would be negatively impacted? Break it down sector by sector and by how much?
Yeah, thank you so much. Good morning. So I think this is the analysis, and if at all this comes, there's a lot of clarity which is required. But if I just throw some light pre-2020, there's a lot of probably orders, imports raised by the private sector and the utility side to, these private, the Chinese companies, including Shanghai Electric got order from Reliance Power, and there were a few notable orders in this space. If you also notice, there was a period when there was kind of 50% of all the capacities were coming from the private sector, which went into tailspin during 19 to 22 period. And if I really see the data after 2020, the private sector is literally kind of narrowed down in terms of the new capacity addition. And considering that this is highly vulnerable sector in terms of critical technologies where government may not really allow the blanket entry of Chinese firms. So one really have to understand, but if at all this happens, then there's also a notable data that the NTPC orders typically do not install the Chinese BTGs. So if I see that the government sector is probably much higher in terms of proportion versus pre-2020, I think the scope should be, as you said, in some kind of requirements and very specific where we might be facing serious challenge in terms of execution. And probably it should not be a blanket. But if this happens, obviously BHEL is something which is very prominent in this space, and this market has a limited supply. L&T, BHEL, and few guys are supplying this already massive tenders, which has been raised in past 2 years. So probably that is one area where this can happen. In terms of transmission space, we saw impact yesterday happening to many firms, including ABB, Siemens. So obviously few firms did highlight it in their commentaries, including ABB, that if there's some relaxation, there could be possibly an impact on the margins. But I think my understanding is that in terms of impact, there's been a massive capacity creation and capex done by the sector. So I really doubt that it will be a direct blanket entry in this space. And we're talking about at least 40 to 50% capacity addition in the sector over the next 2 years. And even when this notification came in 2020, and reports suggest that the decline was only 25% post 2020, which indicates that the Chinese imports were still happening at the lower end, and except the critical and strategic areas where government was really concerned. So I think we have to really understand in what form this is going to come. But I'm pretty sure the government has been focusing a lot in terms of localization and this massive domestic capacity creation which is happening. I'm really doubting the scale at which this can come. Yeah.
Okay, all right. Hi, Amit. Good to see you, and thanks for a quick insight out there. But do you think the worst case scenario plays out? How would you approach a stock like BHEL? Yesterday, the stock was down 10%. What's your view?
Right. So if you see BHEL, in terms of ordering, past 2.5 years has been massive. There's been a massive addition in terms of order book, which is over 2 lakhs. So I think the key area to look for BHEL is really to ramp up the execution, where now they have the book, and execution, margins, and health of the balance sheet will be in key focus. And they were already we were talking about that the orders in proportion they came in past 2 financial years probably have peaked out, and even going forward, there could be some moderation once probably next 12 months, whatever order comes in versus F24, F25. So definitely BHEL might have some impact if there's anything coming on BTG. They have been quite active in this space in terms of order inflows. But I think in near term for me, what is also equally important is they have already had a very strong order book in last 24 months. The market is looking for execution, margins, and health of the balance sheet also in case of BHEL.
Amit, which segment is, if this comes through, this China bit, right? Most supplies from China. For which sector is the most? It's power, right? Which is most impacted?
Yeah. So if you see, I think the duration when it came, we were talking about Chinese spying and Chinese control on critical power assets, and that led government to, along with the China clashes which happened that time, that led government to take this step. So I think apart from power, it was telecom and few other sectors where this was also probably implemented. So I think the strategic sectors again will be kept out of the ambit, and my understanding probably could be at the lower end of, let's say, transformer or other transmission sector products, which are probably not highly strategic, which we're already seeing.
So there has to be, Amit, in your opinion, there has to be specific notification to this regard, right?
Absolutely.
And
yes.
we don't have that yet. I mean, so
yes. It's
so
just
we are talking in the realm of possibility in that sense. Because for BHEL and all, I remember back in the day, in the in the early 2000s, right? Chinese imports were a big bane for them, because there used to be boilers, etc. used to be much cheaper, right? And that used to be tracked very closely. And of course, I mean, the power sector went into a funk in the 2010s. So there wasn't that much chatter. But if it's coming back and now Chinese imports are also back, then it'll probably need to be watched. But isn't it? You said only strategic sectors will be kept out. But what is strategic? Strategic is defense, right? You'll have, there is power generation mainly, EMS. There could be renewables. These are all areas where China is a big producer.
Yeah. So strategic plus sectors where government sees any security concern, which was notable when this notification came, and particularly to BHEL, as I said, the sector has changed. So pre-2020, there was a lot of private orders, and there was a lot of private ordering going to this Chinese firms. So I think now that scenario has changed. There are a lot of government plus state orders which are there when we speak in past 24 months. And it has been very rare that they have ordered to the Chinese firms. So that's why I said there's many questions around this, and the exact quantum probably once all this unfolds will make it more clear.
Okay, thank you very much for that. Just a thought, is there any geopolitical angle to it? I guess, maybe India is creating a strategic hedge, maybe by aligning with China, but will it complicate, if it's easing ties with Beijing, but will it complicate our trade relations and negotiations with US by doing it?
That's second order, third order implications. But I think it's not as if you're replacing US equipment, right?
Yeah.
I mean, for especially in these sectors, larger messaging, will it sour ties? Who knows? But specifically with this regard, I mean, to buy stuff to import stuff from US, comparatively does not make sense. The other bit which we want to talk about, of course, is there are two things now leading up to 9:15 we want to talk about. One is, of course, Vodafone Idea in a bit more detail. And the other is IEX, which should also be in focus because there is the hearing today. And we'll talk about both Voda Idea, some perspective on this in terms of what it means, and IEX as well in a bit. Okay, I think let's actually bring in Ashmit, who's now with us, to just run us through the contours of what's at stake. Where did we leave off first off last time? Because that day stock was up almost 10% by close. And will we get a ruling today? Ashmit, take it away.
Well, the APTEL is all set for a hearing in the IEX case, the Indian Energy Exchange's challenge to the coupling order that had been passed by the CERC in 2025. Now, a large part of the hearings we've seen a lot of back and forth with essentially the exchanges alleging that this entire order, this entire exercise is tainted. The exchanges have been citing a SEBI report which suggests that this coupling order was nothing but, in fact, a ruse, a scheme, an insider trading ring which led to illegal gains of over 170 crore rupees in the hands of CERC officials. They point out that the very author of the coupling order is in fact mentioned in the SEBI report. Now, this was also taken note of by the APTEL. The APTEL said that the theatrics, the drama with which this order was passed has raised questions in the minds of the judges, and also going on to say that if there is foul play found, APTEL will not be shy of taking action. On the back of all of this, we had a very interesting revelation by the CERC lawyer. The CERC lawyer said that they wanted this entire exercise to be fair, to be transparent, to be consultative, and that keeping that in mind, they are now going to get a formal opinion from the Commission on whether the coupling order can be withdrawn. Now, this is critical. Now, just this comment from the lawyer led to a nearly 12-13% spike as far as the IEX share prices are concerned. We're yet to get clarity whether the Commission has decided to withdraw its coupling order. We'll get clarity in just moments from now when the APTEL takes up this case for further hearing.
Got that, Ashmit. We'll stay tuned and we'll come across to you for that, the outcome of that hearing. Stock has ended mildly lower, but as Ashmit said, had spiked up big time early this week. Take a short break, come back. Our technical experts will be waiting for us. Don't go anywhere. Welcome back. It's that part of the show when Hormuz joins us to tell us about some big movers yesterday, those backed with volumes and some with delivery as well. Hormuz, take it away.
Morning, Nigel. And yesterday's theme over the last hour or so were the capital goods names that saw a very, very sharp sell-off in those final few minutes of the trading session, be it BHEL, ABB, L&T, Siemens, all of them seeing losses of anywhere up to 11% for BHEL. And if you take a look at the volumes as well, significantly higher in comparison to its 20-day average. BHEL had close to 5 crore shares that were traded. ABB had 7 lakh. Siemens also had around 6 lakh shares traded. All of them were higher than their 20-day average. But the delivery delivery volumes though, for BHEL, out of those 5 crore shares traded, 1.5 crore were marked for delivery in terms of the delivery-based selling. For ABB as well, around 3 lakh shares were marked for delivery, and for Siemens as well, almost close to 3 lakh shares were marked for delivery. So anywhere between 40 to 50% of the trading volumes were marked for delivery on these capital goods names. TCS was one such name that was underperforming right from the start of the session, even before the sell-off began towards the later part of the day, and it was among the top contributors to the Nifty fall. Volumes on Thursday were the highest in a month. We saw delivery-based selling worth over 750 crore yesterday. 42 lakh shares were traded. The 20-day average of 20 lakh shares, so around 2x its 20-day average. And on the delivery front as well, 23 lakh shares marked for delivery, twice the 20-day average of around 12.5 lakh shares. And the stock is now back to its very important support levels, which is at around 3,200 rupees. And lastly, the exporter names, Gokaldas, Avanti Feeds, Apex Frozen, all of them seeing losses of anywhere between 8 to 9% yesterday. Backed by volumes, yes, because the volumes were higher. Not so for a lot of those shrimp feed names, because Apex Frozen's volumes were less than its 20-day average, but the delivery volumes were higher in comparison to the 20-day average. So Gokaldas fell on strong volumes, but the other two had not so significant volumes despite the fall that they saw in yesterday's trading session.
Got it. All right. Thanks a lot for that, Harmas. Slip into a short break. Come back pre-open rates. We'll have our technical experts and also Prabal Sain of ICICI Securities will be joining in to analyze the impact of crude oil prices as the geopolitical issues rise. Stay with us.
Okay, welcome back. I think, 3 minutes to go for the pre-open session, so just about kicking off things. Shrikant Chauhan of Kotak is with us. Mitesh Thakkar of Bonanza is with us as well. Gentlemen, morning. Good to have both of you here. Near-term moving averages broken. General kind of gloomy mood all around. Mitesh, what would you do this Friday?
Morning, Prashant. So I think, yes, there is some negative in the sense that, we have kind of broken below the short-term averages, but the support pivot of 25, 850, 900 is still holding out. Two, I think the PCR is now getting close to the level from where typically markets see a rebound. So I think it's around 0.67 or 0.66. And therefore, there could be some respite in the short term. So markets, the structure is weakened. Slowly, turning slightly negative, but we may not be looking at a big immediate drop. It can be a case of a pullback to about 25,950, 26,000. If we fail to sustain above that, then I think we should come back and retest possibly 25,750 to begin with, and then maybe slightly lower.
Okay, got it. Got it, Mitesh. Shrikant, coming across to you. How are you feeling about the markets? Yesterday's clearly the blow was not great at all from a bullish perspective, but there's no signs of recovery. But a couple of technical indicators will give hope. Your view?
Good morning, Nigel. Good morning, Prashant and Rima, everyone. So for Nifty, yes, it has broken its all important levels. We were of the view that 26,000, 25,900 should be the next major support, and there the market should halt. But it has broken that level and it closed below the same. So which clearly indicates that now the market has changed its trading range in the short term, and any pullback close to 26,000 will be an opportunity to reduce some long positions, because I'm of the view that the market will take some time to rebound from lower levels. And on the downside, we may see the levels of 25,600 or maybe 25,500 in the worst case scenario. So now the range has changed from 26,300, 25,900 to 26,100 and 25,500 on the downside.
Got it. All right. Let's get to individual stocks then. Mitesh, coming across to you. What do you have for us on this Friday morning?
Yeah. So today I have a mix of buy and sell calls, 2 buys and 2 sells. On the buying side is Havells, which I would recommend buying. Mine dips at 5-7 points lower from the closing price, around 14.75. Buy with a stop at 14.50 for targets of 15.25. Then a buy on Apollo Hospitals with a stop below 7,300 for targets of around 7,500. 2 sell calls. One is Suzlon, which is a sell with a stop at about 52.5 for targets of 48, and Indian Hotels is the next stock, which could possibly see some more price decline. So keep a target of 680 and under stop at about 716.
Shrikant, what about you?
The overall breadth of the market is extremely poor. And whenever we see such type of activity, I'm going to say extreme oversold sort of activity, we see some rebound in the market. And in that case, we can expect rebound in stocks like Lupin Laboratories or I can say IDFC First Bank. There we can see furthermore upward activity. For IDFC First Bank, we are of the view that it is heading for the levels of 1991. We can keep a stop loss at 84.50 for the same. The other stock on which we discussed, Lupin Laboratories, there also we are of the view that it is heading towards the levels of 22.50 at current levels, or on dip around 21.80. It's a buy with a stop loss at 21.60 on the downside. 2 stocks have broken their important levels, like Keynes Technology as well as Trent. Keynes has broken its important level at 3,800. The next level to watch out for would be 3550, 3500. So there we need to be careful, and we should look for, in fact, adding some short positions at current levels. For Trent, it has broken the important level at 4,000. It closed below the same. So the next level to watch out for would be 3,800 or 3,750.
Got that. Thank you very much. We will track some of these calls with from both Mitesh and Shrikant, and we'll have them back on a little later. Okay, the rupee is at about 89.87 compared to yesterday's close of 90.1. Equity market, though, I think, although pre-open has started, is not showing up in any significant way, but there is some strength in the dollar rupee. So 0.8 lower. Let's wait. I mean, it's just 2 minutes or so as far as the pre-open session is concerned. Well, a spotlight in the oil and gas space as geopolitical tensions are rising. Prabal Sen is energy analyst at ICICI Securities. He's with us. Prabal, good morning. Great to have you with us here. Thank you for joining us. Oil is at the center of all of it, and not just oil prices, but oil politics, Prabal. And of course, what rattled markets was this entire up to 500% threat in that bill, which of course has to be cleared by, the US Parliament, etc. I don't know how long that will take, but apparently it's bipartisan support for the bill. What is your sense? I mean, has that come up as a big point of worry from investors when you speak to them, Prabal?
Absolutely. I think the last couple of sessions has clearly showed up that, this concern is obviously something that is, worrying investors. Frankly, very difficult to take a call today on what exactly the tariff would be or what the actions are going to be of, the companies with respect to their Russia sourcing. The extent of Russian crude that is being sourced by players like Reliance, as per their official pronouncements, is close to nil. Even HPCL in its Q2 briefing did mention that Russian crude had come down very drastically to less than 10% of its overall requirements. And obviously, what this move will spur probably is a reduction to even lower levels or maybe to even negligible levels going forward. In any case, I think what is of important is that the discount that Russian crude was actually getting effectively after accounting for all the additional costs that are involved today in importing Russian crude, that discount had anyways come down to about $3 to $4 from what we understand. That is at least what the companies have been briefing in the last couple of quarters. So from a numbers perspective, the elimination of Russian crude is not necessarily going to impact the GRMs to a huge extent. Whether the sourcing can be reduced drastically and whether alternate sources can be found quickly enough that no disruption occurs in refining throughputs is something that I think we'll have to sort of wait and watch at this point of time. But on the face of it, prima facie, as a sentiment, obviously, if actions are taken, that will be a negative.
On a numbers basis, Prabal, as you said, right, doesn't make that much of a difference anymore. But that is the other point, which is kind of unknowable. It may not all be about just numbers, right? The point is that Russian oil, China is a big buyer. We've been buyers. And India, Russia have long-standing ties. So if you cut off and stop buying Russian oil, I mean, there's a 50, 60-year history, right? I mean, and Russia is embattled and all of that stuff, right? So I'm sure all that, it's not just the numbers, not just about the $2, $3 discount that you're able to buy oil at. Would you agree?
I would leave the discussion on the political implications to people who are better qualified. I can only comment on what the impact is going to be in terms of the companies that we track. I don't want to, necessarily comment on what this would mean from a geopolitical perspective. The issue really is that if you look at the Brent movement also, I think the concern really is that if all of the Russian crude that is still finding its way to the markets actually goes out, then suddenly the huge amount of supply surplus that people have been projecting, that actually does tighten a lot. So from a demand supply perspective also, taking out the entirety of Russian crude from the markets, I don't even know whether that is practical or that will eventually happen. But if a significant chunk of what is being imported, about 0.3 to 0.4 million barrels probably still finds its way, rather 1.2 to 1.3 million barrels still was finding its way to India, and probably much more was going to Russia. So if that is sort of
Let's go to China.
Yeah, China was obviously more than that. So elimination of that kind of volume will have a huge impact. The entire supply surplus that people have been talking about can go away if Russian crude is entirely blocked. As I said, I don't know if that is even practically possible, but I think that is the fear that is there in the markets. Whether politically, how India handles its relationship with Russia, that is out of my purview, I'm afraid. I don't want to comment on that.
Yeah, it's all geopolitics now, isn't it, Prabal? So maybe we need to become oil plus geopolitics. I mean, one more beat to track.
That has always been the case, but yeah, unless we can write officially on it, I wouldn't want to comment.
I know. You said it practically possible. You don't mean... I mean, the decision to do it, if it comes to that, is I'm assuming in the manner of speaking, a 30-second decision, right? I mean, everything after you've gone through everything, after you take... So, what you mean by practically is whether, I mean, all those factors align to be able for the government to take that decision.
If I can interject, what I mean is very simply, Russia exports close to about, even today, probably exports close to about 5 million barrels of oil per day, right? 4 to 5 million barrels. Taking out 4.5 to 5 million barrels of supply from the global markets, despite all what you have heard in terms of supply surplus, is just not feasible. If you look at most estimates of the excess supply that is there in the market, and I'm right now building on basis of what OPEC is producing currently, yes, they can maybe over a period of time bring an additional even 2 to 3 million barrels a day of supply that they've held back. But barring that,
today to take out, 5 million barrels is simply not feasible because your surplus itself is not really more than 1.5 million barrels, depending on who you ask. So how do you actually manage that without bringing in additional supply from anywhere else? Whether Venezuela can fill the gap somewhere down the line, that's a different question. In the immediate term, what can be brought on stream from Venezuela, even if all the blockade is removed and sanctions are loosened, is hardly about 0.2 to 0.3 million barrels a day, based on whatever we read. Get it above that requires a significant amount of investment over a decade to really bring meaningful supplies back from Venezuela. It's not one-on-one.
Your interaction suggests we are still getting about a million plus odd barrels out of our 5 million imports every day.
So I think if we look at the percentages that have been mentioned in the 2Q briefings by the OMCs and some of the other players, it is about 20% of our portfolio of imports is probably still 15 to 20% is still being made by Russia. So if you look at our overall imports of 4.5 million barrels a day, that would translate to something around 0.9 to 1.1, 1.2 million barrels. That's what I'm basing. There's no definitive data.
Got it. This entire, the other point is Venezuelan crude, right? I mean, back in the day, Reliance used to be a very large importer before all of this, of course, right? I think it used to be at one point the single largest buyer of Venezuelan oil, and I think they've said that provided they comply with all rules, regulations, etc., they'd be happy to receive oil shipments from Venezuela. You think? How do you read that development from a company-specific perspective?
So, from Reliance's perspective, Reliance is one of the few refineries that are in Asia that are capable of processing the kind of heavy oil that is there in most of Venezuela's production portfolio. If they can actually manage to start obtaining that heavy oil, that does two things. One, of course, it fills the gap that may open up if Russian crude has to be eliminated. And two, obviously the heavy light spread in Asia, I think, is probably going to widen. And that is obviously good news for any refinery in India that can manage to procure this heavy oil. The challenge for Venezuela, however, is that to actually be able to make it possible enough to even export it through pipelines, you need a large amount of diluents, what are called. You need to dilute the kind of oil that it comes using naphtha or other elements, which also are in short supply. So even to ramp up heavy oil exports, there needs to be some work that needs to happen. And, as of now, we have no clarity. But any crude that starts to flow from Venezuela to Asia, Indian refiners are actually some of the few that are there in the region that can actually process these heavy oils, including Nayara and Reliance, of course.
And yeah, no, absolutely. Thanks very much, Prabal. It's an interesting conversation. And thank you for joining us here this morning on CNBC-TV18. Well, 9:10 calls. Mitesh is with us. Mitesh, what do you have?
I'll go with the sell on Suzlon for targets of around 48.
Okay. Suzlon, a sell on Suzlon is Mitesh's call right now. Well, what are the brokerages saying? What are the top calls, ideas? Sudha's gone through a lot of them. So what do you have?
So I have on NHPC, CLSA maintains high conviction outperform with a target price of 117 per share. It believes that 2026 should transform NHPC's size of capacity and it should increase by 64% and can see visibility of 90% EPS growth over FY 25-27. It has also mentioned few catalysts. First, final tariff of its Parvati 2 project. Second, full commissioning of Subhasini Tower Hydro project by Q4 of FY 26 and award of 4 hydro projects and 1 pump storage in 2026, and these 4 hydro projects to improve visibility of growth in FY26 as per CLSA. Next one, Macquarie has written on hospitals. It says Apollo and Max Health have lagged Nifty 50 performance by 14% in 2025 and expect more consensus earnings downgrades to weigh on the stocks in 2026. And the 8 listed hospitals chains guided to add more than 6,000 beds before the end of FY27. That's the largest annual capacity addition in the last 8 years. So EBITDA drag from new hospitals is not reflected in current consensus estimates, and Macquarie maintains underperform rating on both these names, Apollo Hospitals and Max Health.
Thank you very much for that. Sonal joins in on Petronet.
Well, we did see a note 2 days back on Petronet about a possible regulatory risk. Today, there is a note where the stock has been upgraded by JP Morgan to an overweight. The target price has been raised to 335 rupees a share. They expect the earnings momentum to become better on a couple of reasons. Better volumes because of the expansion that's happening in Dahej in March. They're expecting a 5% tariff escalation in terms of their transmission, and lower impairment costs, which would come by in this quarter and the following quarters as well. All of this would lead to better earnings or consensus estimates rising in FY28 as well. But yes, there's a potential of renegotiation of Dahej tariffs, the risk from the large petrochemical complex that the company had spoken about earlier. These are some of the key valuation issues according to JP Morgan, but these are something that would continue for a bit and they will remain unresolved for a couple of quarters. But better earnings are something that should be watched out for Petronet LNG. That could keep stock higher. That's the word coming in from JP Morgan.
Thank you very much for that. Just quickly pull up Vodafone Idea, that's one. And the other one is Indus Stars, because the relief for Vodafone Idea is fairly sizable. The key takeaway is for the next 10 years, the cash outflow on the back of the AGR burden is very, very light. It's 124 crore each for the next 6 years, followed by 100 crore for the next 4 years. So at least for the next 10 years, till FY35, the outgo for Vodafone Idea is very, very less compared to what it would have been in the absence of any sort of a relief. And it's a long 10-year period. Earlier, the market was speculating it could be 5 years, which the street said perhaps is too short for a turnaround in Vodafone Idea. But this is a long rope of 10 years, gives the company ample breathing space. So that's the key takeaway, a lot of breathing space on the cash flow. And it's a long 10-year period. Secondly, as of now at least, there is no reassessment, no liability reduction. But the release says the committee is constructed to reassess the dues whose decision will be final. And I think that is important because if we finally get a decision on AGR, no more court battles, no more AGR overhang, it will be important for the company. So Vodafone Idea and Indus Tower should be on your radar.
Absolutely. 6% higher on Voda and 4%, 5% on Indus Tower at this point in time. What do we have? First rates starting to come through. The Nifty is absolutely flat, 25,884. So at least in the green, right? For what it's worth. Small mercies. So the Nifty Bank is absolutely flat as well. The mid-cap index is up about 0.25%. The small-cap index will come up as well. And I think there as well is going to be pressure, about 25 odd points lower, 0.18% in the red, 0.25% lower at this stage. So it's a tentative start, but it's, let's see if you're able to claw back to the 20-day on the Nifty at some point during the day. But there's so many unknowables, and all of it, of course, hit us only after US market, after markets close here. So the only chance to respond to all of that, what will happen later today, is going to be on Monday morning. But ONGC, Power Grid, BEL, Asian Paints are some of the gainers up there. On the downside, you've got ICICI Bank, Adani Ports, Apollo Hospitals, which are starting lower. And I think it's a clean split right down the middle, about 25 up and 25 down, maybe a little more. Gainers outnumbering declines a little bit more on the Nifty. 20 points now on the index. Rima.
Well, BEL is your top gainer, up 1.5%. So rearmament defense is a big theme globally, and that is playing out in India as well. And particularly in the case of BEL, there is also an order win. So that's keeping the stock excited. On the oil and gas front, you've got strength in ONGC. We should pull up some of these oil marketing companies because they could be negatively impacted on the back of the increase in crude oil prices. And Reliance Industries has lost 7.5% in the last 4 trading sessions. And today, Reliance Industries has opened up absolutely flat. But ONGC is seeing some green on the back of a rise in crude prices. IT is also making a bit of a bounce back. TCS was the one which got punished yesterday with a 2.5% fall. Maybe the street was fearing some weak numbers come Monday. Stock has bounced back, but along with that, HCLTech and Infosys both have a gain of nearly 1%. L&T also deserves mention because that got hit quite sharply yesterday. I think L&T was also down nearly about 3.5%. But there was this note which Bernstein came which said that the fall in L&T was actually a bit of an overreaction because they got a minimal benefit from the 2020 ban. And the Bernstein note also went on to say that only 5 to 6% of L&T's total EBITDA is directly vulnerable to Chinese competition. So the Bernstein report argued that the market reaction in L&T when the stock was down 3-4% could be an overreaction. And today you are seeing some green on L&T. Pull up a BHEL, a Thermax, and the other capital good names. So on the way up, we spoke about BEL, we spoke about L&T, IT names, Power Grid, Asian Paints is some green to begin trade with. Bharat Airtel. There is a recovery across all the telecom names. Vodafone Idea emerges stronger, and maybe the street will watch for any sort of a hike in the tariffs. On the way down, ICICI Bank is correcting a tad bit. It's had a fantastic run-up over the last 4 days, outperforming all the other large banks. So ICICI Bank is down, and you've got some red when it comes to NTPC, Max Healthcare, Ultratech Cement too, but just down about 0.5%.
Well, Petronet LNG, that's one of the frontline names, is doing well. Sonal just told us about, Sudarshan told us actually about JP Morgan. They're gone ahead and they've upgraded the stock to overweight. They've raised the target price to 335. So that's clearly exciting. The stock up close to around 3%. Top volume winners out there. Nalco, well, that's pulled back a little bit. Remember, yesterday's trading session, most of the metal stocks were under pressure. But if this bull run is still there, for metals from year on, which has been a consensus call, then maybe these stocks could see a recovery after yesterday's dropping that we saw. So you have Nalco up, Hindustan Copper as well, which is higher in today's trading session. What's down? Elcon Engineering posted its numbers. Slam dunk, stock down 10%. You have, I think, transformers and rectifiers as well. The stock actually had started off in the red. Yesterday it was down close to around 8-9%, posted its numbers. It started off in the red, but I think it's pulled back a little bit. Let's get transformers and rectifiers up for you on the screen. Now it's up close to around 0.5% or thereabouts. Power Mech, that's another company in there that's gone ahead and won a decently large size order with it over a longer duration. Power Mech, a stock that's fallen from 3,500 all the way to around 2,400. Well, that one is seeing some kind of green post that order win. What else is doing well? Cupid is up 2.5%. That one moves on very, very large volume. So keep an eye out on that one as well. And all in all, as we do this 2-minute market check, the markets are up close to around 60 points. There is a reason to see a bit of a bounce. But let's see whether or not this bounce is sustainable, because yesterday's session clearly will be plaguing the bulls. 20 DMA still 100 points away from the Nifty, but a bit of a relief start is what we're seeing. Prashant?
Absolutely, and we need relief. God knows we'll need relief. Well, I think, what do we have, right? I mean, there's bounce across the board, and 1,200 stocks are higher, and I mean, actually, it's 1:1 advanced decline ratio at this point. Gautam Shah is with us, founder Goldilocks Global Research. Gautam, good to have you here. Markets at an all-time high on Monday and down 500 from there on Friday. And so just technically, I mean, how do you reconcile all of this? It's just 9 days into 26, and it just seems like it's a whirlwind of news flow and new stuff thrown at us.
Good morning, Prashant. Before I talk about India, let me just highlight that we are in the middle of a raging global equity bull market. So if you look at US, which is at lifetime highs and still doing well, if you look at Europe, if you look at many markets in Asia, with what Korea has done last year, Taiwan has done last year, China at a multi-year high. So the bigger point that I'm trying to make is that the global equity market bull trend continues. And in this, India has been quite an underperformer, in terms of the last year returns. And I don't think India is going to do anything special this year, at least on a relative basis. On an absolute basis, you don't need too much analyst acumen to say that we've been in a range for the last 6 weeks. I think 25,700 on the downside, 26,300 on the upside. It almost seems as if the market is not prepared to break out. And there is this too much happening on the economy and Trump versus the domestic liquidity that seems to be keeping our market afloat. But I wouldn't be too bearish. I do believe that there is scope for some downtake. But on an index level, with two pillars of the market, which is technology and Reliance, not firing in, there is just too much responsibility on the bank Nifty to keep the market safe. So I think the Nifty will keep you interested. It will continue to behave like a pendulum, but I don't see it break out or break down immediately. But there are still a lot of stock-specific opportunities, and I think this year is going to be about stock picking and theme picking. So while the Nifty continues to trade in the range, my case is that we will eventually break out on the upside. But before that, we need to deal with a lot of news flow, and hopefully the government does something in the budget that propels this market.
Do you have a target? Gautam, hi, morning. Rima here. on the Nifty, say, for the next 12 months? And you spoke about this being a stock-specific market, given that overall we could be in a bit of a range. What would your top ideas be?
Well, there's a very clear move from growth to value. Why do you think PSU banks did better than private banks? Why do you think non-ferrous did better than ferrous? Why do you think the entire PSE space has made such a good comeback in the last couple of weeks? So anything that was very richly valued has been a big underperformer in the last 3 to 6 months, because the market does not want to discount any more into the future. Market does not want to discount into Excel sheets anymore. It wants to discount actual earnings. So keeping that in mind, we want to be in pockets where valuations are comfortable, relative strength charts are good. Metals have been my favorite. I think every time I've been on your channel, I've spoken about it. I do believe that the metals index can appreciate another 15% from here. So all dips are a buying opportunity. I do believe that the entire PSU pack is the opportunity of the year with across the board strength, apart from defense and railway. So X of defense and railway, I think the entire PSU space looks good. And I'm still pinning my hopes on the bank Nifty. I know it's surviving around that level of 60,000, but the way PSU banks are placed and the way some of the private banks are placed, this sector is also likely to make a comeback.
Okay, all right. Hi, Gautam. Good to see you in. Gautam, on the Nifty, what are the targets?
Well, as I said, this is not a market where you focus too much on targets. I think the range is very clear, 25,700 on the downside and about 26,300, 350 on the upside. Eventually, we do believe that the Nifty will break out on the upside. And if that happens, my working number for the next 12 to 18 months is 28,400. But it's going to be a very hard-worked move up. And as I said, the bigger opportunity is in the mid caps and small caps and not in the Nifty and the large caps.
Coming back to the equity markets in a bit, but what about precious metals? All that glittered was gold and silver in 2025. Do you think both those two have run their course, or is there more to go?
I think they've run their course. I think that's been the view for a month now.
Yeah,
we have seen a parabolic move. The studies are not supportive anymore. And I do believe that both gold and silver are likely to see a large price and time correction. And if that were to happen, I think the focus will go back into the equity markets. I would rather be very bullish on the base metals. I think that's really the trend of the year. You have seen what's happened to copper, aluminum, zinc, lead, nickel. I think base metals is probably the story of this year. And I think the proxy stocks in India and world over are likely to stand out.
Okay, all right. You want to give us a view on the big boy Reliance Industries? I was looking at it on the charts. That one was actually one of the leaders for the last few months. And very quickly, it's corrected from a high, the 52-week high, closer to around the 200 EMA. Now, that's an important stock from a Nifty perspective as well, more than 10% weightage. How is that looking?
Yes, so we don't have a recommendation, but I think Reliance being 10-11% of the Nifty is obviously a very important stock. Just 3 days back, it was at lifetime highs of 1610. From there, we've seen a bit of a collapse, and it does seem as if Reliance has also run its course at the recent high. So I think it's just going to trade in a range with possibly a negative bias. So that's not going to help the Nifty and the entire market. So that's a problem area. And the entire technology space, I've been maintaining this view for a while now, that technology versus Nifty or versus the rest of tech in the world, I think Indian tech is going to see a big phase of underperformance, maybe by not falling too much, but not rising. It's just going to be in a range with a negative bias. So these are the two pain points of the market right now.
Yeah. No, they are. What about the entire defense space? Thematically at least, Gautam, there is one, अगर मैं हिंदी में बोलूँ एक सारांश जो भी कुछ हो रहा है उसका ये है कि defense, everybody is going to spend a lot more on defense, right? I think Trump last night basically saying 50%, they want to increase defense. By the way, US spends more on defense than the next 5 countries put together. They want to increase defense spending by another 50%. So everyone, Europe is remilitarizing. Defense stocks, by the way, global defense stocks, BAE, Lockheed, so many of them, they've all done phenomenally well last 1 year. You think in India that is a theme which will make a strong comeback?
Well, I think defense is still a global theme because the valuations are still comfortable and I don't think they've gone out of hand. So globally, defense is a theme, but I don't think Indian defense is a theme. You know, we all believe in the concept of discounting, and I think the next couple of years, all the positives are already in today's prices, and many of the top defense stocks are trading at very, very rich valuations. So I don't think defense is an opportunity. As I said, I don't want to do any sort of adventurous investing at this point of time. I want to be in brick and mortar companies which don't get impacted so much with foreign policy, and that's probably the reason I'm very comfortable with banks, metals, and PSU.
You know, maybe slightly leaning on into the fundamental territory. Budget is around the corner, right, Gautam? Any plays out of there? I mean, matching expectations with technicals, Gautam? Anything at all?
See, firstly, I think our market has been supported completely by domestic money. And I'm sure the government realizes that with 30,000 crores coming in every single month. So the Indian investor has showed its confidence. The government has done a lot in the last 1 year with GST and the income tax measures. The RBI governor has been firing in for the last 6 months, doing all sorts of positive measures, which is great. Now the economy needs to show up. And I think capital market participants need to be awarded. So possibly the government might just want to do something on the capital gains, because you want more investors in this market to stay committed for the long term, with FIs unlikely to return anytime soon, given the relative strength elsewhere and opportunity elsewhere in the world. It's important that our economy and our market participant survives. And for that, I think the government needs to keep delivering. Hopefully, they will deliver on 1st of February.
Yeah, they will deliver, hopefully, right? I mean, and it's a Sunday, Gautam. So we'll be, of course, I mean, in office and reporting. Markets have turned, by the way. They've completely turned. Just look at the NSE advanced decline. I know it's still early to look at the market breadth, but it just swung the other way violently. We were 1:1, and now it's 3:1, declines to advances. Some 1,900 stocks are lower, and about 700 stocks are higher. So on your screen now, the Nifty is down about 30-odd points or so. At this point in time. If you can just look at Reliance Industries, I mean, RIL is still in the green, but it's also come off the highs by about 6-7 rupees. What else? So the index is not down that much. Maybe you can just look at the indices, mid-cap and small-cap indices. Mid-cap index is down a third. Mid-cap index sold off 2% yesterday. The small-cap index, of course, has been an underperformer anyway. It was also down 2% yesterday. Small cap index is losing another 1% this morning already. So, yeah, I mean, things are not lasting. Things are not holding, at least at this point. You know, these, look, pull up Hitachi if we can. Hitachi is selling off now, 3.5% on this one. So, it's so sharp sell-off, right, yesterday on Hitachi. And it's down another, from the highs, by the way, the high today was about 18,540. And about 17,860 now. The other one is GT&D, 3.5% lower here also. Balaji Amines was a big mover yesterday on the upside. That's down 4%. And the other one is Panacea. Panacea Biotech was up 10% yesterday. And I was saying, this thing is, the dengue vaccine could be substantial, very meaningful, but it's 2 years away. Panacea went up 10%, is down 5% right now as we speak. A bunch of other names, Force Motors, huge outperformance, just a pullback. Thangamile Jewelers recently, sharp up move, down about 5% right now. Godrej Properties is down about 3%, and so on and so forth. So a bunch of names coming through in the broader space that one is looking at. Gautam, just one last question to you. One name that you'd be happy to hold positionally and sort of accumulate through the course of the next few months.
Well, as I said, I think markets are in a difficult space and don't expect the kind of rally that we saw in the last 3.5 years. I think we all used to seeing India being the poster boy in the global basket. That's not happening anytime soon. This will be a theme pickers and a stock pickers market. And I think the entire PSU space is something that we really like. So the top names there, the top 3 or 4 names there stand out for us. And I think that's where our commitments are right now.
BI, I'm assuming, right? Top is one of them.
That's correct.
Okay, fair enough. Gautam, we'll leave it there. Thank you very much for joining us. Good speaking with you and chat again soon. But there is a big, and Gautam was talking about PSUs, right? There's a big PSU IPO which is opening from the coal space. Coal India subsidiary coming to the market. Najal, take it away.
All right, well, let's get straight. Bharat Coking Coal's 1,070 crore rupee IPO. Well, it opens up a subscription today. The company is a wholly owned subsidiary of Coal India and is also India's largest coking coal producer. To help us out with details with regard to how the company progresses from here on, we're joined by Mr. Manoj Kumar Agarwal, the CMD of BCCL, and also we're joined by Mr. Mukesh Agarwal, the Director of Finance at Coal India. Good morning, gentlemen, Mr. Agarwal, and welcome to the stock market. Well, we're looking forward to another entity. I recall years ago when Coal India listed, there was a lot of excitement out there and the big pop that you saw on the listing day itself. The street will be hoping that BCCL does the same. That said, let's understand a couple of aspects of business. Mr. Agarwal, coming across to you, Mr. Manoj, you plan to increase production to around 50 million tons, right, by 2030. As of now, you're ballpark around 40 million tons. Could you tell us this incremental volume, what is it dependent on? New mines starting or the ramp up of the existing mines?
Good morning. Actually, you have to understand BCCL, Bharat Coking Coal Limited. Presently, we are doing 40.5 million tonne and 29-30 we will go up to the 56 million tonne. And as you asked, our main focus will be by increasing the underground production by applying new technologies like high-wall mining, continuous miner, and likewise, we are also monetizing our old stopped underground mining. We have awarded 5 old stopped underground mining, and one of them has already started production. And second thing, our 80% production comes from the open cast mines. We are operating in BCCL total 34 mines, 25 open cast mines, 4 mixed mines, and 4 underground mines. And in open cast mines, you have to understand our geological condition of the BCCL having headquarters in Dhanbad. We are having 16 seams, and due to less area to operate, as we are facing, there is some space constant. We are amalgamating our small mines into a large mine. And last year, one of the mine, NTPC Lodhana, has started with 6 million tonne plus, and now onwards it will go up to the 8.5 million tonne.
Okay.
So in this way, our production will improve up to 56 million tonne in 29-30. And one thing more, our production is directly attached. Coking coal is directly attached with the steel industry, and they want vast coal. We are having washeries, 5 washeries having 13.65 million tonne per year capacity, which will also go up to 29-30, around 27-28 million tonne.
Mr. Manoj, we have this detail, sir, with regard to this, and you have mentioned that as well. So let's get a couple of other aspects that are going out. Since the focus is obviously going to be on washed coal, which in turn then can be used by the steel industry. So let's get a few parameters out. Tell us what is the EBITDA per ton difference for washed coal as well as what you're currently selling. How does it differ with the blended EBITDA per ton? How much better is it?
After washing of the coal, the price rises like anything.
Okay.
And we are having 39 to 40% as content coal. And after washing, we will reach up to the 18 to 19% as content coking coal. And with imported coal by steel industry having 8 to 9% as content, they blend their coal with our domestic and imported coal and desired rate 12 to 13% as content coking coal. With this coking coal, they produce steel. And around 17 to 1800 rupees per ton, it will increase after the washing. That is, rate will be from the 10,500 to 14,000 rupees per ton.
And all this incremental realization, most of it will flow to the EBITDA per ton, sir? This 3,500 rupees per ton, most of the realization gain?
In a simple word, delta becomes 3 delta in terms of the EBITDA. and it goes to the entirely to the P&L.
So just Mr. Mukesh Agarwal, since you're going to give us some numbers out there, in simple terms, the blended EBITDA per ton for the company is how much, of BCCL? And
it becomes,
yeah.
Normally it is 400 to 500 rupees. When it will be washed, it will go to 1700 rupees per ton.
Okay, EBITDA per ton, right?
Yeah.
Got it.
Okay. Gentlemen, good morning. This is Reema here. Mr. Agarwal, Mukesh, if you could just talk about the dividend policy, because that is something that, the street gets very excited when they hear about a PSU. So from BCCL, what is the mandated dividend policy?
Madam, in the Coal India, all the companies are following the DIPAM guideline for the dividend. Though those are unlisted companies, but they are following the policy of the DIPAM. That is 30% of the PAT or 4% of the net worth, which is the minimum. That all subsidiaries are following. And in the coming days, Bharat Coking Coal will also follow the same policy of the DIPAM, minimum dividend. Maximum they can go as per the availability of the cash.
Got that. So that's on the dividend policy. And one more question, Manoj, since we were talking about the increase in the EBITDA per ton with more contribution coming in from washed coal, etc. When we last spoke, you gave a top-line target of 20,000 crore by 2030, which is when your expanded capacity comes on stream. What would the absolute EBITDA look like, or the margins?
Actually, presently we are giving steel industry around 1.7 million ton clean coal. Up to the 29-30, our production of clean coal will be around 9 to 10 million ton. And also we will supply 10 million ton of the raw coal to our nearby washeries of Tata, like that, in Jindal. So production of the clean coal, washed coal will be improved, and that way EBITDA will also be improved, and it will be very much beneficial for our investors. And in this continuity, I will also like to mention that our reserve is around 8 billion ton, and it will last more than 100 years. So there is every benefit for investor in every sense.
Okay, all right. Just to clear the point, sir, at that 20,000 crores of revenues, what could the margin look like? Since the EBITDA per ton is going to go up by such a vast proportion, your contribution to the steel sector's demands as well is going to go up. So how much higher can the margins go?
Actually, in the 2030, we had projected net profit of around 2,900 crore rupees.
Okay.
And if we will convert into the EBITDA, it will go around 5,000 crore rupees plus.
Oh, all right. So that you're talking about a big jump in the EBITDA number. As of last count, you're doing close to around 1,200 to 1,500 crore rupees of PAT. But now you're saying that by 2030, what will the number be, sir, on PAT?
2,900 crore rupees around.
2,900 crore rupees. Got that. All right. The one fear when you have a PSU, and I've seen various issues with Coal India for the last 15 years as well. What is the trajectory on the employee cost and the number of employees from here on? As we know, employee cost as a percentage of the total expenditure is around 50 to 55%. And the last count I have, total number of employees you have is around 31,400. Employee cost is around 650 crores. But both those numbers have been gradually coming down. So how do you see both these two move?
In terms of BCCL, what is the projected employee is around 22,000 employee will be there by 2030. And with the natural attrition of the employees cost will go down. But simultaneously, wage revision is also due from June 26. So it will be almost decreased by 10% because of the wage revision. The corresponding reduction will not come. But 10% we are expecting the employees' cost will come down in the near future.
Okay, and what is the proportion, sir, of this employee wage revision? Because various times you've seen that the employees go on strike, the demands are not met. You've given us a timeline later in June, but normally what is the quantum?
Normally the wage hike will be around 15 to 20%.
15 to 20%. Okay, all right, got that. So 22,000 employees, the employee cost comes down. But then there's another element, right? The contractual coal. That's a contractual cost that you have as well in your books. So how much contractual coal was mined last year? And in that mix of around 56 million tons, what will it be like?
Our production by contractual means will be around 75 to 80%. By MDO means or hiring of the coal and OB. So it will be around 80-85% in 29-30 of the contractual production. And we are also expanding our mines through contractually. So it will be in the limit of the 80-85% of the contractual production.
All right, Mr. Agarwal, before we let you go, just throwing this out to you all, just for some closing comments. This year, you're going to end with a degrowth. That's a well-known factor because of the flooding and various other factors. But you have a longer trajectory ahead. If you were to give a message to the investors that are looking to subscribe to this issue, what would that be? There'll be a lot of them who are watching this interview and want to know whether or not they should be subscribing. So what do you tell them?
Just you have to know, mainly our Bharat Coking Coal Limited is the strength is our coking coal and washing, and importing from the Australia, our production will increase, then our import will decrease, and it will improve our country mission of the Atmanirbhar Bharat, and investing in this company will be beneficial in every sense for every our investor, as our coal reserve is more than 100 years and it is a 50 years old company. There will be no any doubt about the investing in our company.
Got it. Okay, all right, Mr. Agarwal. Appreciate you all joining in, Mr. Manoj as well as Mr. Mukesh. Wishing you all the best. Valuation-wise, it appears pretty much in line with what the street was working with. And I believe there's a lot of interest as well. So subscription could very well be oversubscribed. And maybe, in fact, there'll be some listing gains as well. Thanks a lot for educating us on the business. On listing day, we request you to join back again and educate us about the near-term as well as the medium-term outlook. All the best for this issue.
Thank you. Thank you.
Time to slip into a short break. On the other side, Reema will be waiting for us. She's going to be taking us through our special segment, Quarter Se Quarter Tak, and we'll be focusing on the tech space. Stay tuned.
Okay, welcome back. It's our special segment, Quarter Se Quarter Tak, where we get your earnings expectations from a sector every day. And what else but IT, which is going to be kicking off the earnings season in right earnest. Reema has walked across to the wall with expectations. Reema, over to you.
Thanks so much for that. So as the December quarter earnings season kicks off for Indian IT, expectations are fairly anchored because Q3 FY26, that's the December quarter, is generally a seasonally weak quarter. There are furloughs, holiday, year-end, client shutdowns. So let's now begin with the top line, the constant currency revenue growth expectations on a quarter-on-quarter basis. For large caps, it's going to be very modest, but mid caps is actually going to be much better. So this is what the CNBC-TV18 poll throws up. It will begin with TCS. That's the first one to report numbers on 12th evening. A CNBC-TV18 poll throws up a top-line growth of about 0.5%. Then you've got HCLTech also on 12, and that is going to lead with a top-line growth of nearly about 3%. And that is largely on the back of strength in its products business. For the other two, as you can see, it's a very low single-digit kind of a top-line performance. Now, mid-caps, once again, are expected to outgrow the large caps. And the two stocks that the investors are very keen on is Persistent and Coforge. And these two are likely to see about a 3.5% constant currency revenue growth. Now, at a broader level on the demand front, it's not positive, nor are there any negative surprise. The demand environment has not materially changed in the last 3 months, though JPM recently flagged of some improvement in the auto tech spends from the OEMs, which is positive for ER&D companies. But other than that, we haven't seen any sharp increase in discretionary spending. Cost takeout deals continue to dominate, and the AI discussions are active, but large monetization still remains very limited. Now moving on to the FY26 guidance. And I think the headline here is that the guidance is narrowing, but it's not upgrading. So Infosys guidance was about 2 to 3%. It could come to about 2.5 to 3%. For HCLTech, the guidance was 3 to 4%. It could come at 4 to 5%. And both these companies are likely to maintain their margins despite the INR tailwind, on the margin front. On margins, while the rupee depreciation, the FX helps, but margins are still likely to remain structurally range-bound. So here's how the currency moved in the quarter gone by. The USD-INR pair moved from 87.3 towards the end of Q2 to 89.1. And that is about 2% quarter-on-quarter rupee depreciation. And if you look at it on a year-on-year basis, it's about a 5.5% rupee depreciation. Yet, despite that, margins are still likely to remain range-bound in Q3 because some companies have wage hike, there is the furlough impact, and AI-led pricing pressure. I think the key question investors will ask and listen for is calendar year demand commentary, tech budgets. Are we finally seeing budgets improving, AI monetization clarity beyond pilots and a productivity talk, and discretionary spending recovery still remains elusive. Finally, let's put the stock price and the valuation in context. Now, the Nifty IT index did well in the October to December quarter. From 1st October to 31st December, the Nifty IT index was up 14%, outperforming the benchmark by nearly 4%. Despite this, the index is still underperforming. In the last 1 year, it's down close to about 12%, and this is the valuation. For large caps, as you can see, it's between the 20 to 24%, largely 24 times, largely within the long-term average. Mid-cap valuations are superior, but then they are growing faster in a softer demand cycle. Back to you guys.
Okay, all right. Thanks a lot, Rima, for that. Well, let's hop across to Yogesh Agarwal, Head of Research, HSBC India, who joins us on the show. Hi, Yogesh. Good morning, and good to have you on the show, Yogesh. Help us out with the top 3 points that you're looking at from these IT companies in this particular earnings season.
Nigel, look, this quarter is usually a seasonally weak quarter. And therefore, it's not going to have a significant impact on the numbers or the outlook. However, we do expect a little bit of positive commentary from the management. I think the last year, if you see the second and the third quarter results in the US were particularly positive, almost blockbuster results. But the IT spending remained weak. And there was a lot of uncertainty around macro tariffs, and customers held on to the spend also related to AI as well. We are seeing that relaxing a little bit. We may not be back to the March sentiments last year, but we are certainly closing into the March sentiments. And therefore, we do expect a little bit of positivity in the management commentaries this quarter.
Okay, so management commentary in the current quarter will be better than what it was in the prior quarter. Yogesh, hi, Rima here. So growth expectations are well anchored. We know it's going to still be an improvement in growth for this year versus last year, but not a runway growth. Maybe for large caps, it will be about 3, 4, 5%. Mid caps a little bit better. But are there any stocks or pockets where you are seeing a valuation mismatch, where one can actually, take a tactical or as an investment idea because of a mismatch in valuations?
Yeah, Rima, look, first of all, I think big picture, I don't think this sector can grow double digits on a sustainable basis. We are just too large. Just to give you a context, we think at least 1/3 of the global IT work is done through India today. Okay, so at that scale, gaining market share to grow double digit is just not possible. So we are quite linked to the global tech spend growth, which means that on a sustainable basis, larger companies probably can grow mid-single digits. And therefore, it is very tough to see a very high double-digit compounding in the stock prices as well. So where investors could see more value is smaller companies, because what has happened 10 years back and now, scale is no more a significant advantage when you go bid for a larger deal. and therefore smaller companies are getting the same place on the table as a larger one. And hence, at their scale, they can grow faster on a sustainable basis. Some of them can grow high single digits. Some of them may actually grow double digits as well over the next 3 to 5 years. And market craves for growth. So as they grow double digits, I think the stocks can compound as well. And despite the premium valuations of mid-tier, they may still compound. So I think that's where there could be a lot more value than top tier, if you're looking at from a long-term compounding perspective.
So when the IT index did well in the October to December period, we saw that relief rally, recovery, outperformance. Yes. When you spoke to investors, both domestic and foreign investors, what was their reading of that outperformance? And what is the holding now or the view?
So, Rima, last year we were overweight on the sector purely because we believe that IT growth outlook will improve this year, and stocks, therefore, at the bit of a reasonable valuations could outperform the market. In fact, this quarter in our preview report, we have downgraded the sector to more market perform inline performance this year, because the stocks have run up 10 to 15% already. So I think what has happened is through the year last year, there was a realization that AI is not is negative. Obviously, in the near term, there is a deflationary impact, but not as negative as what people thought earlier in the year. And secondly, there is a lot more comfort around tariffs, and the corporates are a lot more comfortable to increase the spend this year on an overall transformation and overall tech spend. So both these factors led to a little bit of a better confidence for this year, and then hence the stock prices reacted to them.
Okay, thank you very much, Yogesh, for joining in. We hope you can join once we start getting the individual companies and the earnings results from them. Vikash Kumar Jain, India strategist and head of India Research, CLSA, is now joining in. Vikash, thank you very much for joining in. You believe that the reduced relative premium to peer markets after India's record underperformance in 2025 should improve the acceptance of India. So lay out for us, how do you see 2026 to play out, and what your big bets and themes would be?
Hi, Rima. Thanks for having me. So 2026 is a little different from 2025 because we have this, I would say, divergent forces for India. Firstly, the relative valuation has become more palatable. And what that has done is maybe foreigners can start looking at India. But at the same point of time, despite record underperformance of the market last year, we find the market actually slightly higher on PE than where it was at the start of 2025. So from that perspective, absolute valuations do not leave a lot of room for re-rating. So the way we think about it is, if during the year, due to global fears on consolidation in the AI space, on the AI global bull market, or fears of a yen carry trade, leading to some kind of a need for defensiveness, that's where India becomes an acceptable portfolio hedge globally. Within our domestic setup itself, I think 2025 saw a lot of large policy announcements in the form of income tax cut, in the form of GST cut, in the form of even several rate cuts. 2026, from that perspective, will be less about announcements, because I think a large part of the fiscal and monetary room for the government is gone. I think they will continue on fiscal consolidation. So they would want to wait and see what these measures finally, what is the impact of that, and whether that they wait for the growth push that these measures would provide. And therefore, less of a top-down noise, other than, of course, the trade deal thing, which I think is an early 2026 event, perhaps a trade deal with the US as well as EU. Beyond that, I think there will be a little bit of a lull in terms of announcements, and then the wait of when the announcements of last year pushes up growth in 2026. So broadly, with that, not expecting any fireworks, relatively muted performance is likely in 2026. But the focus would be in areas where lower for longer rates, a big push towards consumption. So consumption and rate sensitives, along with, trying to play the headlines on trade deal, basically India's relationship with the US eventually improving, all of that should help certain sectors. And that's where we have our favored overweights are consumption, real estate, and IT.
Real estate, consumption, and IT are the three areas where you think you want to be constructive on. Vikash, hi, morning, and I wish you a good 2026 for you personally, and of course, I mean for markets as well. Within these three, I mean, in terms of what you've published out there, which are the top 2 or 3 ideas in each of these 3 sectors? I mean, talk about what you've already published, so it's out there.
Oh, so I think, see, you possibly, you guys have our reports, and we did make a few changes to we doubled down on consumption. We added a few retail names to our portfolio because we believe that after the recent, our relative sideways movement, risk reward had improved in some of those retail names and quick commerce names. So those are some of the names that we recently added. Clearly focused on consumption, overweight on staples slightly, overweight on autos very clearly, overweight on discretionary. So, and real estate is the other other sector that we like.
Okay, all right. Hi, Vikas. Good to see you, Vikas. So in terms of moderate returns for this year, you think on the Nifty we should get high single-digit returns?
Yeah, I think that should be the best case. See, I think the setup that we have is perhaps we continue with the global bull market. And in that setup, there is no real requirement for us to, maybe the chances of a sharper correction in India goes away. So we are in this gradual derating period where multiple keeps coming down, and, that's where returns will be perhaps lagging earnings growth. And that's where the gradual derating kind of plays out.
Okay, all right.
High single digit could be a good case.
All right, so that's on the Nifty. The other, big factor, and I think the voices that I hear are actually split with regard to crude. What's going to happen to crude oil from here on? Because we're talking about US going in there, ramping up production in the Venezuela. It'll take a few years, obviously. But then there's a geopolitical risk as well. So from around this $60 per barrel mark, what are you all working with in terms of the movement of crude oil prices? End the year closer to around 70 or dips towards 50?
So it's the former. So we believe that, see, on the face of it, if you were to look at just simple like Excel numbers, crude oil market looks oversupplied. That oversupply, if I were to look at, what demand and supply numbers are being talked about, is in the range of about somewhere around 400,000 to 500,000 barrels a day or so. So looking at that, I think any kind of geopolitics, political risk, I mean, say some kind of stringent action for people buying oil from Russia and some of those other things can easily take away that kind of a supply and make the market, balanced. Since an oversupplied market is the nervousness that is baked into the stock price, a more balanced market, which could happen due to these geopolitical risks, either in Iran or in Russia, could easily allow crude prices to recover. So we are more in the range of that 70 plus as the year passes. So a recovery in, from the lows of the start of the year is how we think of crude prices.
So just to close the loop on that, Vikas, you'll be more moving now towards, I think, Oil India and Reliance Industries rather than the OMCs. You'll play it as a tactical bet earlier, right?
That's right. So we like the upstream more. Upstream stocks more than the downstream ones.
Got it.
Got that. Vikash, we'll leave it there. Thank you very much for joining us. Good speaking with you, and appreciate your time here on CNBC-TV18. So that is the conversation with CLSA's Vikash Jain. I just want to quickly put out a small plate with what is coming in just now, and I think it's pretty startling. So this is the U.S. Commerce Secretary speaking in a podcast. It's called the All In Podcast. Howard Lutnick, the Commerce Secretary of the U.S., with regards to the India-U.S. trade talks. I mean, actually, we are just putting out a small portion of it. We're still getting more detail of what he said. There is more. He explains how all these trade deals got done. But for now, let me just read this out, right? He says, let's be clear, it's his deal. That's President Trump's deal. He's the closer. He does it. It's all set up. You got to have Prime Minister Modi call the president. They were uncomfortable doing it. So Prime Minister Modi didn't call. That Friday left. In the next week, we did Indonesia, the Philippines, Vietnam. We announced a whole bunch of deals because we negotiated with them and assumed that India is going to be done before them and negotiated with them at a higher rate. Basically, the assumption was that India will get a better rate than all these countries, and the other countries essentially were done at a higher rate. So now the problem is that the deals came out at a higher rate, and then India claws back and says, oh, okay, we are ready. I said, ready for what? It was like 3 weeks later, I go, are you ready for the train that left the station 3 weeks ago? So that is the US Commerce Secretary on the India-US trade deal. As I said, there is more. And, there is a portion where the Commerce Secretary explains how these deals got done. And in their minds, the Commerce Secretary explains the way this was going to be done is that the country which approached the US earliest got the quickest and the lowest best deal, which in this case was the UK, and then that became the floor, and so on and so forth. I mean, the Commerce Secretary describes it as a staircase in terms of countries who came later, perhaps got higher rates. I mean, at least that was how they were thinking about this. So I think this is important, and I think provides backdrop and context, of course, to these prolonged negotiations, which have, of course, been underway. At the bottom of the screen as we speak right now, what we'll do is we'll put out more, the thinking behind how these deals got done, because that will provide the full context of what I'm talking about. We take a quick commercial break here. We'll have Balaji Subramaniam of IIFL Securities to discuss the Vodafone, the relief that has come through for Vodafone Idea. Stay tuned, coming up.
Welcome back. Let's put the spotlight on Vodafone Idea, Industars and the entire telecom space. Significant relief coming in, AGR relief coming in from Vodafone Idea for DOT. And now we've got official communication from the company when they intimated it to the exchanges. Balaji Subramaniam from IIFL Securities is now joining in. Balaji, thanks for joining in. First, outline the cash flow relief for Vodafone Idea versus the earlier situation.
Hi, good morning. Thanks for having me on the show. The big relief has been that if you look at what was mentioned in media reports last week, it said that the relief is primarily for the next 5 years or 6 years. And from FY32 onwards, they will have to make the payments in 10 equal installments. But actually what the company has notified today is that the relief is for is until FY35, and the payments will be only from FY36 onwards. Not only that, they have also quantified the payments that they will have to make in the next 10 years, which is a maximum of 124 crores per year until for the next 6 years, and subsequently it's about 100 crores per year for the subsequent 4 years. So all what that means is that their cash flow payouts on the AGR matter will be not more than 125 crores for the next 10 years, which is a significant relief versus what the original payment schedule was, which is like 16 or odd thousand crores for 6 years from FY26 to FY31. So I think as far as the AGR matter is concerned, of course, we will have to see whether there is any reassessment of the dues after the detailed audit that the DOT conducts. But all that is for, a period which is 10 years out from here. And I would argue that, if the liability is frozen at today's level for the next 10 years, so effectively in PV terms, it's about a 65% relief because basically, the company doesn't have to bear the time value of money. So net, I think the AGR matter is, more or less settled as far as, the cash flow implications and the stock price is concerned, at least for the next 10 years.
But Balaji, morning, Prashant here. Does it change your per share value for Vodafone Idea?
So the thing is, one has to look at that versus what is already priced in. So I think the thing to note here is that AGR liabilities were only about 40% of the government debt of Vodafone Idea. The remaining 60% or 1.2 lakh crore rupees pertains to their spectrum debt. And that is, that is a big issue because while the payments are not that meaningful, I think they have to pay about 6,000 crores next year, followed by 15,000 crores in FY28. And from FY29 onwards, for the next 5 or 6 years, they have to pay a sizable 26,000 crores per year. So I think that is also something which needs to be taken care of. One way that might happen is some fresh investor coming in, equity investor coming in, and the government, getting diluted because of that investor coming in, and subsequently the government converts more spectrum debt into equity. So that can be one way of that happening. So, the thing is, even though the cash flow will significantly improve, and based on that, if the fundraising goes through debt, equity and all, then I think the equity value creation will be meaningful. But of course, the catch here is that there will be meaningful dilution, and it depends on at what price the fresh equity issue happens and the government converts.
No, Balaji, the government may dilute its stake. It doesn't have to be fresh equity, does it?
No, but from where will the company get the money to?
No, that is the whole point. My only thing is, does Idea, the bigger question is, with this AGR matter, as you said, now settled, does the company become investable? Can you imagine a scenario where this once again becomes, market cap is already 1,30,000 crores. Can it generate, will it become a healthy, robust third player in that sense? With this review, can you imagine a situation such as that?
I think that is still far out because there are many things that need to fall in place for Voda Idea. And, this is a good first step, a meaningful first step in that direction. But after that, as we spoke, some of these measures have to come in. through a combination of debt and equity, they will have to raise enough funds so that they can do the capex. And once the capex is done, they will have to ensure that that really translates into execution on the ground in terms of stemming their subscriber losses, and also and also ensuring that when the tariff hikes happen, they will have to contain the extent of down trading and churn. So I think so many things have to fall in place before one can say that Vodafone will be a reasonably competitive number 3 player. So I think based on where the stock price is today, I think a lot of it is actually priced in. And if there is going to be more equity dilution, even if we assume that someone really comes in and puts equity into the company, I think a lot of it is actually in the price. Especially,
you do believe to meet the spectrum liabilities, which stand at 1.2 lakh crore, the company will require equity funding. That is your base case scenario as of now. Balaji, the street is now banking that with this AGR relief, the company will be able to raise that bank funding of 25,000 crore rupees. But there is still some uncertainty on the overall quantum of AGR dues. It's frozen at 87,000 crore, but there is a committee which is going to be formed which will reassess the dues, which means there is still a possibility that the AGR dues may come down further, providing relief. So till we get the clarity, do you not think investors will want to wait? Even banks may not want to wait. I mean, bank funding may not happen till we get clarity on the overall quantum of AGR dues. I mean, is that a likelihood or the way it should play out?
I think that is less of a concern, at least to me, because 10 years is a long enough period. And we are talking about FY36. So most bank loans, if you see, there are not too many bank loans which you take for more than 10 years. So at least from an AGR standpoint, I think we are set for the next 10 years. And let us not forget, as I mentioned in my opening remarks, if the liability is frozen for 10 years, that effectively means that there is a 65% relief in the liability quantum, because if you compound something at 8% per annum, which is what the AGR dues were compounding at. So for 10 years, effectively, that if you do the math, it translates into a nearly, 65% reduction in PV terms. So, let us not forget that as well.
And one final question, what does this mean for Indus Stars? Are there any overdue receivables? What could be expected from the Vodafone Idea capex, which boosts Indus Stars?
So it is positive for Indus, and I think that has been getting built into Indus stock price as well, because I think maybe 4-5 months back, Indus was trading below 350 or around 350. And the stock has nearly gone up to 445, 450 on the back of the expectation of a relief coming Vodafone Idea's way. So it is clearly positive, because once Vodafone Idea starts rolling out, especially on expanding its 4G coverage, you will see the tenancy ratio improving for Indus. And Bharti also is continuing to do rural 4G rollouts, even though they may be close to the fag end of that rollout process. So I think the numbers for Indus should improve going ahead, and there are no overdue receivables, because whatever was due, around 5,500 crores, was paid by Indus. Once Vodafone Idea completed its FPO last year. That part is taken care of, and there will be some improvement in tenancy ratio, as I mentioned. But I think at 445, 450, a lot of it is already priced in. Of course, there will also be some support technically, because Bharti has said that they would like to increase their stake in Indus by up to 5% during FY, or rather, during the next 12 months. That will be a support for Indus, but I think most of the rally is clearly done.
Thank you very much, Balaji, for joining in. Need to slip into a break. On the other side is our special segment. It's the economy. Lata will speak to Goldman Sachs economist Shantanu Sen Gupta. Stay tuned.
Fly Emirates, fly better.
Welcome to It's the Economy. The Indian economy starts 2026 on a mixed note. The MOSPI, that's Ministry of Statistics, sees the current year GDP at 7.4%, but it is indicating slowing consumption in the second half. Now, separately, President Trump still seems unyielding on tariffs, making rupee still the worst performer among major economies. The budget has run out of space to stimulate, and long bond yields, if you look at them, have been rising despite 5 rate cuts. To get a handle on how growth, capex, rupee and rates will pan out in 2026, I have with me Shantanu Sengupta, Chief India Economist at Goldman Sachs. Shantanu, good morning and thank you very much indeed for joining us. First of all, a happy new year to you and yours and to all in your team. For starters, this MOSPI indication that consumption actually is slowing to 6.6% in the second half, if you do the math. Does that come as a bit of a negative for growth prospects in the coming year?
Thanks, Lata, and Happy New Year to you and the whole team at CNBC-TV18. Look, we are actually, as we head into 2026 or FY27, we feel pretty confident about consumption growth. You've had a bunch of easing measures from especially the RBI. It's not just 125 basis points of rate cuts. You've had 3% of GDP worth of liquidity injection. The regulatory changes, as we have argued earlier, will just be a slow burn. So you've had the CRR cut already, but the rest of the capital release measures will pass through in FY27. And therefore, we feel good about consumption, especially at the bottom end of the pyramid, along with the monetary policy. You'll also be helped by the GST rate cuts. The fiscal transfers are happening at the subnational level, as you're seeing with every state election. We can argue what that means for fiscal policy at the state level, but you're getting this push towards the consumer. So we feel pretty good about consumer, especially at the bottom end of the pyramid going into the next year.
Let me persist with my doubts for a bit more. The income tax cuts are over 6 months old now, and the GST cuts are also old by about 5-6 months. Plus, you've got these interest rate cuts coming along. It's all been in the system, and yet the MOSPI is not giving a very good picture of the second half consumption. As well, look at real estate. Residential houses actually this year, total million, in terms of million square feet sold, is -2% compared to last year. That was a Knight Frank report. So, is this boost enough? Looks like consumption is still not gung-ho.
Yeah, I think we are talking about two parts of the consumption pyramid, and I was very careful about articulating that this is the bottom end where we are feeling more confident. I think the top end, I think you're absolutely right. The consumer was already over-leveraged. So and this has been our view that the first round of deleveraging would have come from the income tax decreases. So that did not really feed into consumption. The consumer would have deleveraged. And then the interest rate cuts also, especially for the EBLR pass-through loans. If you think about a mortgage loan, in many cases, the EMI would have remained and the tenor would have come down. So you would have seen some deleveraging happening even through the interest rate cuts. What that means, Lata, for next year is that the consumer should go into next year or in about 6 months' time as being less levered than what it was, call it a year back. And that should sow the seeds for a credit growth revival as you head into the second half of the year. If you look at housing, the credit data, and if you look at urban versus rural, the urban is already turning the corner. Overall credit growth is turning, but urban households is also turning the corner with the amount of deregulation measures that the RBI has had.
Okay. Well, let me just pull up one table that I just created. Let's see if we can pull it up. Impact of rate cuts on bond yields. 1 year has clearly shown it is now at 5.47 T-bill compared to 6.5 a year ago. But if you look at 5 year, the difference is just about 30 basis points, 6.35 today compared to 6.7. If you come to 10 year, the fall is like only 10 basis points, 6.62 today versus about 6.77. Okay, 15 basis. 15 year, actually today's yield is higher than what it was before those 5 rate cuts at 6.89. Will this restrict, the kind of growth you're expecting?
And I'll just add, Lata, that if you looked at the 30-year also, the curve is quite steep. No, absolutely. I think there are two things happening, and we have a chart also in our Outlook report. If you look at financial conditions easing in India in the first half of the year versus the second half of the year, that is calendar 25, you would have seen a significant amount of easing coming through both rates, short end and long end, and some FX in the first half. In the second half of the year, your story, the story that you put up is absolutely true, that long end rates have especially gone up. Even short end rates, I would argue, spiked a little after the RBI turned to neutral after the 50 basis rate cut in June. But the long end, frankly, is less to do with the RBI and a bit more to do with what you're seeing in terms of the relative demand and supply in the system for bonds, right? So you're having a bit more of state issuances, especially in the long end of the curve, where the spread is now about 200 basis points, right? I mean, the repo to 30 years is about 200 basis points. That's been subject to two things. One, higher supply from front-loaded supply from states, a bit of supply, and pension and insurance buying less of bonds and a bit more of equities because of the regulatory changes again that came through. Yes. I think we are going through that part of the cycle. This should correct, in our view, in the next year. Okay. The very long end, whether the 10-year point at about 100 basis points, 120 basis points above the repo, how much of correction there is really possible. We have our doubts because we think that the RBI is at the end of the cutting cycle. Yeah. But the extreme steepness that you have in the long end of the curve, we think should correct somewhat.
Yeah, usually in the first half, we should see it of the fiscal year, you should see it fall. But regardless, there is a bit of a fear that, there is no more fiscal stimulus coming. even capex, as your own report says, perhaps will not be rising from the public capex, will not rise. Given that, are you confident of private capex?
Yeah, private capex seems to be the issue over the last 2 or 3 years. Public capex has done the front loading, at least in the last couple of years. So we think this is much more sector specific. Power, both renewables as well as conventional power, electronics, defense, which is again dependent a bit on the order books of the government. So you have to be more probably sector specific rather than a broad-based private capex revival. I'll just point out one thing on fiscal policy, Lada, that remember last couple of years you had consolidated by a total of 1.6 percentage points, 80 basis points each consolidation in the previous 2 years. This year you're consolidating by only 40.
Okay.
Our sense is that next year, as you head into the budget, the government might want to keep a little more room, and instead of going for 4% or below 4%, they might just want to keep it somewhere in the region of 4 to 4.2, the fiscal deficit. And that means a lesser fiscal drag on the economy as you go forward.
Okay. Yeah, actually in my poll, I got 4.3 also, as the fiscal consolidation not being too severe because the government's already done enough. Okay, time permitting, I'll come back to the budget, but the rupee, we've had, I think for the first time since 1991, or at least since I was covering markets, the BOP is a deficit for 2 consecutive years. Is there enough confidence? I mean, should we expect this year, that is FY27, to be a BOP positive year? FPIs are still not biting. FDI is net negative.
If you had BOP negative for 2 consecutive years, the FX adjustment was likely appropriate, right? Okay. So the adjustment that you had in the nominal exchange rate, we think was appropriate. But especially if you look at it from the trade-weighted perspective, inflation adjusted, which is RER, INR was overvalued at the beginning of last year. And some of the correction was due. You've corrected quite a bit. Our sense is that the valuation on FX now is looking more attractive. I mean, I'll also say that, investor conversations we are having, many long-term investors are thinking of the FX valuation adjustment as appropriate. Do we see this kind of depreciation further going into next year? The answer is no, because we don't think BOP will be a 3rd consecutive year negative. We think some flows will come back partly because of the valuation adjustment that you're having, partly because you've had so much of stimulus, as we discussed, go through, and we are looking at like late 6% kind of growth going into next year.
Okay, so I have to finish because we are expecting the IEX order anytime now from the APTEL. But are you confident that we can manage that 6.8% growth that you speak about if the US trade deal got, even more postponed?
Even with the postponement, we think the late 6 handle is possible. If you have a crank up in tariffs, that's when you have the downside risk. Absent that, I would think that our risks are fairly balanced. In fact, you could hit slightly higher going into next year.
Okay. Let me take a rain check from you to speak to you about the budget before the 1st of February. Thank you very much for spending time for us. We have to quickly wrap up on Bazaar. Chartbusters coming up, but I think the big announcement will be the 10:30 APTEL announcement on how it observes the IEX and the coupling order. Very, very interesting. Stay tuned. We are back in a jiffy.
Welcome to Chartbusters. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel. With me is Mangalam. It's a bit of a quiet start for the Nifty itself. Quiet is not too bad. Nifty holding more or less flattish with a negative bias. We're waiting for a verdict in terms of the IEX order. For the time being, the stock has seen a sharp decline, but we're waiting for further clarity on that front. The good news, Mangalam, mid-caps in the green. Mid-cap index.
Yep, take that point, Nigel. You know, we have more mid-caps in the red, though the index is in the green. It's yo-yoing between red and green even for the frontline index, but none more than the IEX stock. This morning opened absolutely flat. Thereafter was a 6%, 7% up move that we saw from those lows and from those highs itself. Now the stock is down about 8%. So it is fairly volatile. We are trying to understand the implications of, what the hearing would be from the APTEL. Sometime very shortly is where we are expecting the verdict to come out as well. As we're keeping an eye out on individual stocks, a good time to bring in Saumil Mehta of, Mirae Asset Sharekhan for a quick technical check on the market. Saumil, the market's been consolidating. Yesterday was a weak day, yes, but at lower levels, we are finding some support now after a big gash yesterday. What is your call on the frontline index?
Good morning to everyone. In the medium-term outlook, if we talk about medium-term outlook, yes, we are still in the range between 25,700 and 26,300. So we are we are trading very close to 26,300 points up and 300 points down. So it's a range. We've seen this in the last couple of months now, and it's been the same situation. So the medium term still remains positive. In the short term, yes, we've seen some correction. We are trading below 20 and 40 daily moving average. That is a little bit of caution to look at. The suggestion would be to stay in the large caps. That's what the suggestion would be, and to stay with the sectors which are positive, which are showing strength on the upside. On the downside, crucial supports around 25,700. Very crucial. If it closes below 25,700, the next level on the downside would be 25,300. So I'm not hoping that. I'll be expecting markets to take support around these levels and again start the up move for a target of 26,300 and 26,600. So these are my two targets. Positive in the medium term outlook. Short term, be a little cautious and stay in large caps.
Okay, all right. Stay in large caps, and in the medium term, you continue to hold on to that positive bias. What about individual stocks?
Two stocks have selected. One is BDL. BDL looks great to me. A small flag pattern has broken on the upside today. Good positive momentum. Stop loss would be 15.20 and target would be 16.30 for a short-term trade. Even the medium-term trade looks great to me for BDL. The second stock which I've chosen is Eternal. Eternal has broken out of an ending diagonal pattern on the upside, trading about 200 daily moving average. Great momentum today. Stop loss would be 281 and target would be 310.
All right, so that's the view on Eternal. Saumil, since we have you with us, do you have a view on Meesho? Last two trading sessions, it was down, 5% lower circuit. Today it's breaking that and it's higher. It's found some support at lows after falling below the listing price of a little over 160. The stock's now, back. Do you have a view on Meesho?
There's not much data on the charts, but if I have to give you a support, there'll be 164 as the support, and the next support is 152. So these are the two supports I'm looking at, and I'll be expecting a range-bound movement around 200 daily moving average, which is 173. I'll be a little positive here, to be very frank, because it has completed. It has taken support at a trend line here in the very short term. Target would be 188, 190 levels.
All right, got to ask you, since you're speaking about large caps, Asian Paints, it's been a big mover from the lows, now very close to its 52-week high. Currently, in this market as well, it's at the high point of trade. Do you like it?
Absolutely. Asian Paints, we've mentioned Asian Paints in one of our reports this month. And I think from here, the support would be 2,730, 2,700. So that will be a support, and my targets would be above 3,000 levels, 3,000, 3,100 would be my target. So absolutely positive in the short term. In the medium term, you can have a fresh entry with a stop loss around 2,700.
All right, we take that point, Saumil. Thanks a lot for that. Meanwhile, before we take that short break, as we are awaiting the details of the Aptil hearing, just look at the IEX stock. Just from a stock standpoint, it's been a big volatile move that we've seen. Currently down about 12% from the highs, down about 2.5%. It's a sharp note that we've seen. The street is awaiting the verdict on what the outlook on market coupling will be. But as we do that, let's get you some ideas for profit. Our colleagues at Money Control Pro join in. Anant Chaudhary has a stock.
So today we are once again discussing Syrma SGS Technologies Limited, a leading player in India's electronic manufacturing industry, with capabilities across PCB assembly, PCB boards, RFID, and telecom and industrial electronics. So far, the consumer segment remains the largest contributor for the company, accounting for 1/3 of the revenue. However, over the recent quarters, Syrma has steadily diversified its business, increasing exposure to industrial, automotive, and medical electronics, segments that have offer better margin stability and longer product cycles. Syrma SGS is strengthening its margin profile through focused capacity expansion. The company is investing around 800 crore in a new PCB manufacturing plant in Andhra Pradesh with a South Korean firm, Shinyap Electronics, alongside backward integration into copper-clad laminates manufacturing. With around 1 to 1.5 times asset turnover, this expansion is expected to deliver robust growth over the medium term. In addition, approvals under the electronics component manufacturing scheme for camera modules manufacturing should further improve the product mix. Despite these positives, the stock is currently down more than 15% from its recent high. The company continues to enjoy healthy order visibility, supported by strong demand across industrial, automotive, and export-led programs. At current level, the stock trades at around 32 times on FY28 earnings, which appears reasonable given its growth visibility and improving business quality.
All right, thanks a lot for that. Well, we'll slip into a short break. Come back, we'll continue to track the IEX case, and we'll also get you the latest in terms of market action. Stay with us.
You want to talk business? Meet me in the On-Board Lounge.
Welcome back. A couple of stocks doing well right now. We have Tata Steel, which has moved to the high point of trade. Decent traction on SBI as well. And Trent, which was one of the biggest losers this week. In fact, the biggest loser all of 2025 as well, is finding some favor currently off lows at the higher end of today's trading range so far. Most of the trade, it was in the red and now has spiked mildly into the green. Some traction on LIC Housing Finance, Mazagon Dock and BHEL as well. An Indian bank from the PSU bank space doing well too. But all eyes will be on what takes place between the US and India when it comes to a trade deal. And on that itself, the US Commerce Secretary Howard Lutnick, speaking on the All-In podcast, has explained why the US-India trade deal has hit a roadblock. We'll hear that out, but meanwhile, we will just monitor the IEX development as well. So here, Howard Lutnick, while we keep an eye out on the IEX verdict.
You did the deal with Europe, you did the deal with the UK. What's sort of out there that's still there? I think India's kind of still out there, although it seems like they are capitulating a little bit. I saw that they just bought a lot of liquefied petroleum gas from the United States in November. What are the big sort of hot button places that you want to...
I'll tell you a story about India. So if you remember, so I did the first deal, the UK deal. And we told the UK that they had to get it done by 2 Fridays from now. That was the date. That the train was going to leave the station by 2 Fridays because I have a lot of other countries doing things. And, you know, if someone else is first, they're first. And President Trump does deals like a staircase. First stair gets the best deal. You can't get the best deal after the first guy went. Everyone says, I want the UK deal. I want the UK deal. The answer is no, they were first. They took the chance. They moved quickest. They're first. Second, up a stair.
So that sets the floor.
Right. And then the next one's got to be higher. And then the next one higher. And then the next one higher. The next one higher. So he does things that way because that way it incents you to come quickly to the table.
Right.
Right. You could have 3 countries who are the second deal. They all get done at the same time.
Right.
But, you know, if you want to wait and see how it goes, that's at your risk. So he does the UK deal, and they had to get it done by Friday. And Thursday afternoon, Keir Starmer's on the phone, the president. They do their deal Wednesday night, and on Thursday we have a press conference, and we announce it. Okay? So everybody asked the president, who do you think is next? And if you look back at the time, he talks about a variety of countries, but he names India a couple of times. Publicly. It's not like a big secret. And we were talking India, and we told India you had 3 Fridays.
You put them on a shot clock.
Well, they have to get it done because what happens is I have lots of other countries, and when those other countries do their deal,
the staircase goes up.
And now the president, during all these deals, he would refer to me as the greatest table setter who ever lived. Okay, because you've never had anybody who was as successful as me as a businessman before, who's just the table setter. That's basically, you know, so, because what I would do is I would negotiate the contracts and set the whole deal up. But let's be clear, it's his deal.
Yeah.
Okay, he's the closer, he does the deal. So I said, you got to have Modi, it's all set up, you have to have Modi call the president. They were uncomfortable doing it. So Modi didn't call.
Wow.
So that Friday left. In the middle of the next week, we did Indonesia, the Philippines, right? Vietnam. We announced a whole bunch of deals.
Malaysia in that period.
So we did these whole bunch of deals. So that's like...
that staircase.
And they were and because we negotiated them and assumed India was going to be done before them, I had negotiated them at a higher rate. So now the problem is the deals came out at a higher rate.
Right.
And then India calls back and says, oh, okay, we're ready. I said, ready for what? You know, it was like 3 weeks later. I go, are you ready for the train that left the station 3 weeks ago? So what happened is they just, you know, sometimes there's that seesaw and people are on just the wrong side of the seesaw. You know, when I was young in business, and I was a trader. So one of my first jobs was as a trader. And when I would start on the wrong side of the seesaw, you know, I'd buy and it would go down. and then I'd sell, it would go up, and then I'd buy, it would go down, and sell. Like when you're on the right side of the seesaw, you can't lose.
Yeah.
You know, you buy, it goes up, and then you sell it, it goes down, and you buy, it goes up, and you sell, it goes down, and you feel like you're the king.
Yeah.
But when you're on the wrong side of the seesaw, what I used to do is I used to put the phone down.
All right, well, let's get back to the other piece of news that's come in. The December mutual fund data is up for you on the screen. The net equity inflow is more or less stable on a month-to-month basis at around the 28,000 crores or thereabouts. The previous month, it was at around 29,000 crores. You have, I think, the ETF data as well that was flashing for you on the screen. If I saw that number correct, it was around 13,000 crores or thereabouts. I think net inflow is what we have got. Waiting by for further details. But, you know, and the total AUM is holding at around 80.23 lakh crore. Anthony Heredia, the MD and CEO of Mahindra Manulife Mutual Fund, joins us on the show. Hi, Anthony. Morning, and thanks a lot for joining in. What do you make of these initial data points that are coming in there with regard to the mutual fund data?
Hello?
Yeah, hi, Anthony. Good morning. Good to see you in. We have the net equity inflow that's at around 28,000 crores. If I look at it on a month-to-month basis, the comparative numbers are around 29,000 crores approximately. What do you make of this initial data point that we have? Okay.
All right, I think we've lost that connection. We'll try and repatch that connection with Anthony. In the meanwhile, we have some more data as well, the kind of flows that have come into the large caps as well. And I think Sonal is here with us as well with all the data. Sonal, what do you make of it?
Well, you know, it is largely stable on a month-on-month basis. This is something that you guys were talking about as well. Now, do remember the last week of December did see slowdown in activity from FIIs, from global mutual funds, and that is something which would have had an impact on the kind of flows that we saw across market caps as well. So equity funds are largely stable. Yes, there's a decline, but this is not something that anybody should worry about. Even in terms of large caps and mid caps, that's been the story, right? We have seen markets being a little volatile. We were trading with lower volumes in the last week, and that is something that has played on the numbers as well. If we talk about the NFOs as well this time, because in last few couple months, we've seen a big activity come by in NFOs as well. And that is the data to track again, because in November, we saw lower NFOs, and that is something that impacted the equity flows as well. What happens with the sectoral funds as well? Because this time around in the sectoral funds, we have seen an inflow of around 945 crore rupees. Now remember, that has been a big driver in terms of flows so far last year, but that has seen a decline on a month-on-month basis, a sharp decline, so to say, as far as the sectoral funds are concerned. Let's actually get back Anthony into the conversation. Anthony, do you believe this monthly blip that we've seen is not something to worry about? Because as I said earlier, volumes were lower and not much participation coming in across the board.
Yeah, I don't think it's something we should read too much into. I mean, at the end of the day, I would say sentiment is kind of tepid. We're still, I think, at a market level waiting for a trigger. And I think that reflects in investor flows as well. So the more you have, you know, the net SIP flow for the month, similar to what the eventual net flow for equities has been, you wouldn't then expect too many changes in the kind of fund choices being made, etc. That being said, at least on the ground, I can see a preference for flexi-cap, multi-cap, and clearly multi-asset funds, which is an outcome of the way gold and silver has moved. But that's the only trend I would say seems to be picking up momentum. Broadly speaking, for the next couple of months also, I don't see this number changing materially.
Sandeep Bagla, the CEO of Trust Mutual Fund, is joining us as well. Sandeep, Anthony mentioned that multi-asset allocation funds, because of the moves that we've seen across different market cycles, has been really good. If I look at multi-cap funds, they've seen an inflow of around 2,254 crore rupees. In the month gone by, we saw inflows of around 5,314 crore rupees. There's been a decline. But other than that, what is the idea as far as demand for a particular category is concerned? Sandeep, can you hear us? Okay, Anthony, what do you have to make of the dip that we have seen, and also the thematic category that had picked up a lot in last year? Do you think that is something which could see lesser interest coming in from mutual fund industry and investors?
So, to that specific point, see, I think there are two things that investors are looking at, and typically investors are impacted by near term, right? So two things that have happened in the near term are obviously we've seen gold and silver prices do extremely well through 25. So that kind of the only product in the diversified space that looks at gold and silver is multi-asset. So you're seeing flows there. The second, more importantly, 25 has seen clearly a outperformance of large cap over small and mid. And so I think that is why you see the multi-cap flows dropping, because multi-cap by definition has 50% in small and mid. Flexi cap probably gives you a better opportunity to be more large cap biased, right? So if you aggregate the flexi and multi, I don't think the flows have changed. But the choice between the two people are making are towards flexi cap simply because I think the sentiment towards small and mid has dropped. And that kind of translates into thematics as well, because a lot of thematic funds in the past were in sectors that typically had a lot of small and mid caps. And we're seeing that as well. I mean, frankly, we have an NFO and we kind of see that sentiment being a little lower, because if there is a theme that has a predominance of small and mid cap companies as the choice basket, you would tend to see appetite lower because that's biased by what people have seen in the near term.
All right, just hang in there. It's been a news-heavy last 15 minutes or so, even as the APTEL is, listening to the case with regards to IEX. Sandeep Bagla is with us as well. Sandeep, we'll come to you in just a moment because our correspondent Ashmit is sending us some lines. He's saying that the APTEL has sought clarity if the CERC is withdrawing the order, on which there is no clarity from CERC on withdrawal of the coupling order. CERC lawyer is asking for more time to respond on withdrawal of the coupling order. So the stock, which had seen a big gash from the highs, now is trying to attempt a bit of a recovery. There is still no clarity on whether the CERC has gone ahead and withdrawn the order or not. The lawyer is asking for more time. Remember, if the CERC does withdraw the order, then the APTEL will say that there is no case. There would be no coupling, and that would be a positive. But we still have no clarity. The stock move tells you that the market is undecided as well. Let's go back to the new data points that came after that. That was the mutual fund data. Sandeep is with us. Sandeep, we're awaiting the SIP number. With the kind of decline that we've seen in the mid and small cap stocks, do you think this SIP number will continue to remain stable? What are the triggers that we're tracking from here on for this number?
See, the SIP number is a testimony to the retail penetration of the mutual fund industry and the new investors which are joining the fray of investing. But I think 2026 has been a year of a disappointing returns from equity markets, and a lot of new investors had come with very high expectations. And that will reflect in numbers in probably in SIP also, because from channel checks, we hear that SIP on an aggregate level is increasing, but there are few stoppages, which means that the next 2-3 months could be a challenge for the mutual fund inflows also. The new NFOs also we are seeing are garnering lesser numbers, and I think the flow into thematic funds also has slowed down.
It has. And that is something which was expected considering the big surge we saw in flows coming in just from thematic funds and NFOs in the last couple of months. Sandeep and Anthony, always a pleasure speaking with you. Thank you so much for joining us with your insights. Just summarizing the data that we got from AMFI, there has been a slowdown in flows across the board, all the asset categories, barring multi-asset allocation funds. And that is a category that is expected to continue to do well. Assets under management, they have come down, they have slipped on a month-on-month basis. That's the same case with equity inflows. We've seen some decline across market caps, large caps, mid caps and small caps. One category which is shining again is multi-asset allocation funds. So we'll keep pouring over the data and we'll get in the SIP number as well. Most importantly, cancellations. But for now, that's a wrap, guys.
That is a wrap. You wrapped it for us. Thank you so much. For the next hour or so, there are two important data points that we'll be watching out for. One will be the SIP number and the second will be what the APTEL says about the CERC IEX case. You don't go anywhere. You stay tuned to CNBC TV18. Trading Hour comes up next.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Good morning. This Friday morning, you're watching us here live from the CNBC-TV18 Motilal Oswal studio. The show is Trading Hour. I'm Manglab Malu. With me, Ritu Singh. Ritu, the market's gradually declining. In fact, the first hour was a little volatile. And now as we speak, the Nifty is at the low point of trade, down 70 points and led lower by the Nifty Bank, which in turn has actually been led lower by ICICI Bank, which is down about 2%. And for the frontline index as well, we are seeing some declines coming in for a few of these FMCG heavyweights. So ITC for one, which has slipped alongside Nestle, and some declines in the auto space as well. Maruti is at the low point. We have Hero MotoCorp, which is lower as well. The mid-cap index, which is marginally in the green, that's just the index, because the broader markets, if you look at the number of stocks which are declining, that ratio is worsened now to 2:1. 1,800 stocks in the red for just about 900 in the green. Does not look like a particularly good Friday start, especially after the decline that we saw yesterday, Ritu.
Yes, it is. And, 4 days of decline, and we're entering Friday also at the lower end of the range. I mean, Nifty testing lows of around 25,800. I think that'll be a crucial point to watch out for if it breaks below that, because I think the lowest that we've seen in the last few trading sessions, Mangalam, is 25,815. So, currently it's trading at about 25,811. Actually, it's just below that level. Will it go below even further? I think that's a cue to watch out for. The banking index, yes, it continues to drag it down. Reversal from what we'd seen in terms of ICICI Bank supporting the index, now dragging it down. Mid-cap is the only one that is bucking the trend, and the market breadth, like you said, very much in favor of declines as we speak. In terms of, the broader indices, PSU Bank as a pack is doing well. We've seen some of the names like Indian Bank, as much as 3% up today. Maharashtra, Bank of Maharashtra, Union Bank, Bank of Baroda, all of them up and about. The IT pack and the metal pack also doing well. But the realty, pharma, media, FMCG, these are some of the ones that are dragging the broader markets lower. Now, we'll get stock specific because that's where all the action has been, away from the broader markets. And Petronet LNG, that stock has been upbeat in trade today on the back of JP Morgan's bullish note. Sonal Butra is joining us for more details on what exactly is getting JP Morgan bullish on the stock. Sonal?
A couple of factors that JP Morgan has mentioned in their note. First up, they have upgraded the stock to an overweight, raised the target price to 335 as well. They say earnings momentum should improve from here on. Couple of factors. One, they are looking at an expansion at their Dahej facility, 5 million tons per annum. That would, of course, improve volumes for the company. There's an expectation of a tariff hike as well of around 5%. The third thing is lower impairment costs, because a lot of their capex is done already. So that would lower depreciation impairment costs on their assets. This should drive upgrades to consensus FY28 forecast, and that is something which makes JP Morgan quite bullish. Yes, there are risks as well. There is renegotiation of the Dahej tariffs going forward, large from their petrochemical complex as well, where the company has spoken about a big capex, and that is something which could leverage their balance sheet. But these are key valuation issues, and they have been happening for a while now, and they will continue. They will continue to create some uncertainty, but earnings are set to improve, and that is what JP Morgan is talking about. And that's why they're quite bullish on the stock. On the back of that, the stock is higher in trade because earnings recovery is something that the market has been waiting for a long time.
All right, Sonal, thanks a lot for that. So that's about Petronet LNG. The stock's doing well. But another stock which is doing well right now is NHPC. A bullish CLSA note coming in. Vivek, take it away.
Well, that's right. So CLSA has actually maintained a high conviction outperform rating on NHPC for quite a while. Today, again, another note coming in from them. Remember, the target price is at 117 rupees a share. They say that calendar year 2026 should transform NHPC's capacity. They're saying that the capacity can increase by 64% in 2026, and they see visibility of a 90% growth in EPS over FY25 to FY27. They highlight three key catalysts, the first one being the final tariff order as far as Parbati 2 project is concerned, also the full commissioning and execution of Subansiri Lower Hydro project in Q4 FY26. And the third trigger, according to CLSA, is the award of 4 hydro projects and 1 pump storage project in 2026. So what they're saying is that these 4 hydro projects improves the visibility of NHPC's earnings till FY35. So positive note coming in from CLSA as far as NHPC is concerned.
Take that point, Vivek. Thanks a lot for that. Meanwhile, the biggest no decision right now is that from IEX, the CERC Aptel case, which is currently underway. Our colleague Ashmit is constantly sending us some lines, and what we know so far is that the Aptel hearing is on, and there is no clarity from CERC on withdrawal of the market coupling order. At the same time, the CERC lawyer has sought more time for withdrawal of this order. And Aptel has observed that the CERC needs to work independently. So there are conversations on either side, no direction yet. We are awaiting clarity here, and that's exactly what the stock is telling you as well. There was a fair amount of optimism going into this, and as the hearing started, we saw a big gash on the stock, and now it's recovered to an absolute flat move, down about just 1 rupee. After the big move that we saw a couple of days ago as well. So more clarity setting in once Ashmit sends us some more lines. But as of now, what we have for our viewers is that there is still discussion which is underway at the court. The IEX has told Aptel the corrigendum has been issued by CERC to turn the coupling order into a direction. Now what this implies and the details on that we'll get just shortly. As of now, what we know is that the IEX has told the APTEL that the corrigendum has been issued by the CERC to turn the coupling order into a direction. Take a short break, come back, focus on markets and get you an insight into the bond market with Manisha Gupta.
Fly Emirates, fly better.
Welcome back. There's some data flashing on your screens that we were waiting from the AMFI, and that is the SIP figure that has come in at 31,002 crores for the month of December, crossing that 30,000 crore mark for the very first time. If you pull up the charts there, I think we've seen about 4 or 5 months of consistent upward movements in the SIP numbers. So no matter the dip and the corrections that we've been seeing in the market, investors have been putting money into their SIPs, and now it has crossed 31,002 crores as of December at some of the highest levels that we have seen. So retail investors buying every dip, cushioning the corrections. Higher income visibility as well is what you get from this. So that's the figure we'll keep an eye out on and come back with more. But a record high for SIPs at 31,002 for the month of December. Let's quickly get you a check of the markets as well. The broader indices now down about 63 points as we speak, and the Sensex down about 223 points. The mid-cap continues to be the only area of green. That index is trading up about 0.15%, up 90.4 points. That's one that we'll keep our eye out on. But as always, we're going to shift focus to the bond street with Manisha Gupta, who's going to join us a bit later. But for now, what we'll do is we will actually toss across to the Mumbai studio to get us a further check on what the cues are telling us right now from the market, Mangalam.
At the low point, Ritu, but the only heartening factor this morning so far is the SIP number, like you pointed out, 31,000. The first time it's crossed the 30,000 mark. Come hail, come storm, the retail investor discipline continues. And that was a fear this time around as well, because we had a spate of underperformance for our market. So the street was worried, especially after September, October, November, where the number was kind of stuck at that 29,000 mark itself. Could we see an uptick from here on, despite the underperformance? Turns out there has been an uptick, 31,000. Now the question is whether that sustains, this growth sustains or not, because the 28, 29,000 mark and 30,000 as we speak is sticky, but growing beyond this would be an important trigger for our markets, especially at a time when the FIs are pulling out money. Let's go across now to Manisha Gupta, who joins in for Bond Street. Manisha.
Well, thank you so much for that. Welcome to our special segment, Bond Street. And we're looking at Muthoot Microfinance CEO Sadaf Saeed, who joins us now to talk to us about bond markets there. Mr. Saeed, hi, thank you so much for joining in. Well, about Muthoot Microfinance business, first of all, where do you see major lendings coming in, the size of it, the book, and of course, the important ratios as we step into 2026?
Oh, thank you, Manisha, for having me here. I think, first of all, wish you all a very happy new year. I think with the cusp of this new year, I can also firmly say that the bad days for microfinance are behind us and things are turning around as far as the industry is concerned, and also as far as Muthoot Microfinance is concerned, we are doing really well. We are growing at a reasonable pace. This year, we are slated to grow around 15%. So our asset under management, which was around 12,200 crore, at the beginning of the year, will clock at around 14,000 crore by end of the year, and our disbursements are going well. Quarter on quarter, disbursements are growing. In the first quarter, we disbursed around 1,700 crores. In the second quarter, we disbursed 2,300 crores. And in the third quarter, we have disbursed around 2,500 crores. So as per plan, we are already at 6,500 crore disbursements. And we are likely to disburse around 10,000 crores in this financial year. So the growth rate is intact and it's back. We are growing at 15%. And the asset quality, most importantly, is improving rapidly. The portfolio that we have disbursed around 6,500 crore this financial year, the delinquency is in that portfolio is 0 plus is 0.5%. There's hardly any NPA. And overall, I think performance of the book is also improving. The collections are improving. So we are very confident that for the year, we will be, as per our guidance, between 0.5 to 2% ROA. We are to be closer to the 2% ROA. The most important ratios to watch out is basically our cost to income ratio. We were at the beginning of the year around 61%. At the beginning of the last quarter, we were at around 59%. It is consistently coming down, and we will close this financial year would be at around 55% cost to income ratio. But most important is the asset quality. So our credit cost, which was for last year relatively high at 9.4%. We had guided this year at around 4 to 6%. We are already at a lower spectrum of the guidance of 4%. This quarter, this is likely to go below 4%. So for the full year, we are likely to close below 4% in credit cost. And our ROA would be in the range of 1.75%, and which will translate into an ROE of 12 to 15%. I think that's the most important factor, and the basic is that we have started disbursement and we are growing at a 15% growth rate in terms of our AUM.
All right. I also want to talk about the bond markets, and you've tapped into the bond market very actively, very recently. Why are bonds now becoming a bigger part of your funding mix, and what are the numbers that you're working with on that side?
I think bond market is a very kind of important source of capital for us. As we grow, we are among the large microfinance companies. We are the second largest in the country. As we diversify our sources of capital and sources of fund, bond becomes a very integral part of it. Largely, if you look at our fund mix, Around 50% comes from term loans from various banks, public sector, private sector, and foreign banks. Around 20% comes from structured products like PTC, direct assignment, which is also directly driven through bank channel. There are 30% of our funding comes from non-bank channels, which includes ECB and which includes NCD. And I think bond becomes very, very important for us as we grow and we are able to raise capital from other channels other than the banks. I think it is very important. We have been doing regular NCD issuance and we have been issuing ECBs, and these are all listed instruments. So it becomes kind of a diversification of our capital. Also, as we are growing, we are diversifying our asset book also. We were largely focused in microfinance business, which is joint liability group format of lending, which was generally 2 years of tenor, and weighted average on the book was 18 months. So bank loans were generally for 2 years. So that was perfect for that kind of lending. But as we grow forward and we grow, we are diversifying into individual loans. We are looking into a LAP, which are long tenor products. So we need funding which is more than 2 years, 3 years, 5 years kind of a funding. And bond becomes an ideal tool for us to borrow a long-term debt because largely when we issue bonds, these are 3-year paper, and when we do ECB also, that is 3 year to 5 years. So that helps us to have a good asset liability mix and have the flexibility to kind of cater to our customer, and it gives us also ability to negotiate on rates better, and we are able to pass on benefit of lower rates to our customers.
All right, so regular NCDs and ECBs are going to become a norm very, very soon. Also, how do you look at the digital bond online platforms? They seem to be really surging right now. Do you think this would also help you reach more investors, raise funds faster as we go ahead?
It's very, very important. I think bond market in India is still very nascent as compared to the global market. Out of like the global market is 140 trillion US dollars. India is around $2.7 trillion, out of which I think majority is the government issuance and government entities which are issuing. Corporate market is around $500 billion or just about a little bit more than that. It is evolving. I think retail participation becomes very, very important for us because it gives liquidity and ability to trade. I think as the bond market develops, more and more participation from retail investor will help the market to develop and allow liquidity to be there for people to participate in the market. I think as our equity market is developed, now you have a lot of domestic institutions who are holding up the market, even though there is volatility around us. I think bond market also needs a lot of participation for it to be liquid and the paper to be tradable easily. I think that is very important. And I think we as a player who are participating in the market, the wider the spectrum of investor we have, the better it is. And I think depth of the market is improving as we go forward. In the previous year, we had raised around 1,000 crores through the bond market. This year, we are looking at 2,000 crores. So every year, I think the market is improving and the depth is improving. I think days are not far where this will become as kind of tradable and liquid market as many of the developed countries have.
All right, so 1,000 crores last year, 2,000 crores as a target via bonds this year. Do you also see an opportunity to aggressively replace higher cost bank loans with lower cost bonds? And what is the target share for bonds in your funding mix going forward?
Yeah, that's the strategy actually. Basically, to replace the higher cost term loans with the bonds and to be able to raise capital as and when you need it. Go to the market and tap the market and raise this capital, and to be having products which are long tenor product, which allows us the flexibility to churn this money a couple of times during the tenor of the bonds. So that allows us a lot of room to negotiate and bring the cost down. Definitely, I think as we have been doing this issuance regularly, we will continue to do that, and the market is evolving. We are in a cycle where policy rates are coming down. Definitely, that will help us to bring the cost of fund down and make bonds more accessible also for retail investor, and at the same time be able to bring in efficiencies, pass those efficiencies to our investors as well as our customers.
All right, those are big bond plans coming in from Muthoot Microfinance there. Saif, as always, thank you so much for joining in, and thank you for spending time on CNBC TV18. But with that, let's go for a short break. When we return, we will discuss market technicals on the other side.
CNBC TV18 and India Bonds presents Bond Street.
You want to talk business? Meet me in the On-Board Lounge.
Welcome back to Trading Hour. The markets continue to trade at the lower range. In fact, the Nifty at some point it slipped below the 25,800 mark, just marginally below by a few points, now trading at just around 25,800 as we speak. In the mid-cap index, which was bucking the trend, that is also now down, trading almost flat, but down, trading with cuts of about 4 points as we speak. The Bank Nifty down 266. But let's bring in Jay Thakkar, the head of quant research from ICICI Securities, for more on his picks for the day. Jay, good morning. How would you trade the Nifty? And it's already slipped, or it's trading at the lower range now. 25,800 is where it's at. and your top stock picks in the current market.
Sure. Hi, very good morning to you, Ritu. Well, we see that yesterday was definitely a very negative day wherein Nifty broke its critical support of 26,000 levels, wherein for this series, if we see, then that had highest open interest, and until those levels were held, the probability of Nifty trading sideways to positive was quite high, but now it's trading significantly lower than those levels, so now that will act as a resistance. And I think that is below 26,000 is again slipping towards this lower end of the range, which is 25,600 to 25,700 range, which was there for the entire month of December. I mean, it just spent the time between 26,300, 25,700. Likewise, I think, January series again is witnessing the same thing. The only difference, Ritu, I would say is the India VIX, which has in fact now gone about the levels of 10, 10 and a half. In fact, it almost reached to 11 as well yesterday. So India VIX was at its lowest levels in December, has bounced back from those levels, and that is what we anticipated as well. Now, something interesting to note is that since last couple of trading sessions, the FI net shorts in the index futures have gone up significantly, and it has increased by almost 40,000 contracts, from 1.27 lakh contracts to now at 1.67 lakh contracts. This is also clearly indicating that the stance or the bias of the FI is still negative. They have been selling in the equity cash segment as well. So the trend now, as of now, would be sideways to negative, Ritu, targeting around say 25,600 on an immediate basis. And if those levels are held, it's fine. It can bounce back or consolidate. But below those levels, we can see 25,300 levels as well to be tested. So we'll wait and watch for that. As of now, 25,600 is the support. So those levels can be tested. Now, within this kind of a move, I have a couple of recommendations. One is a short on Indigo. I think the stock seems to be heading towards the levels of 4,600 in the short term. So for a target of 4,600, one can sell Indigo with a stop loss of 5,000 on the upside.
I heard.
I have a contract on LCAM, so one can buy LCAM for a target of 6,100, placing a stop loss at 5,700. As a disclosure, I would say that we might have recommended these to our clients. They might be having position, but I personally do not have any position in the stock discussed.
Jay, quickly, any view on Vodafone One? Where we saw some up move today on the back of that, very low amounts of money that they have to pay in terms of AGR dues over the next 6 to 10 years, and also on IEX.
Well, both of these stocks, had a significant short build-up, and we have seen short covering happening in both of these stocks. I'm not tracking that closely Vodafone Idea, because we all know the lot size of that is quite huge and is relatively very volatile. But as far as IEX is concerned, I would say that too has huge short positions, Ritu, and we have seen some short getting covered as well in past few days. On the upside, I think that 150 on a closing basis, 150, 155 range on a closing basis is a very critical level to watch out for. Above those levels, you can see IEX probably showing a huge short covering at least until the levels of 180 as well. In the near term, till 140 levels are held on a closing basis, the trend remains positive from the point of view of short covering, targeting 180.
All right, Jay, we'll leave it at that. Thanks very much for joining us with your top picks. We have to slip into a short break, but up next, we're going to discuss fundamentals of the market with Varun Lochab of HDFC Securities.
This is worth sharing. Faster Wi-Fi on the new Emirates, the A350.
Welcome back. The market's lower now, 108 points lower. So if you look at the FNO setup as well, it's off highs. The Nifty Bank is the key drag. And it's the IT index which is saving the blushes right now. Over the last few trading sessions, it's been an outperformer, continues to do so. And it's causing the Nifty to stem its decline, with more ferocity than what the Nifty Bank is suggesting so. The key index draggers, ICICI Bank and HDFC Bank. On Monday, HDFC Bank was an underperformer, but ICICI Bank supported the frontline index, the Nifty as well as the Nifty Bank. But right now, that one's throwing in the towel too. And the advanced decline will have your portfolios look fairly red. Nearly 3 stocks declining, or 2 stocks declining for every stock which is advancing. Almost 2,000 stocks in the red. The FII positioning is on the short side, heavily on the short side. Yesterday, that number went to 92.3% on the short side. But right now, after this big decline, the street believes that maybe around the 25,700 thereabouts, we could see some support. But the way with which the market is falling right now, if this 25,800 put writer gets it wrong, then they will have to cover in panic and the market could test lower levels too. So that's one point that I'll be monitoring very closely. On the way up, however, resistances have come lower. 25,950 is where the next supply comes in for the frontline index. The realty stocks, they're selling off as a pack. We have Godrej Properties, Lodha Developers, Oberoi Realty. The Bombay-based having it worse than the overall realty pack, but even DLF is lower as we speak. And among the power players as well, Hitachi Energy and CG Power continue to be bid on the short side. So that stock, Hitachi Energy, now down about 6.5%, continuing its correction from yesterday. So that's the setup from the FNO standpoint. But we do have with us, Varun Lochab joining in from HDFC. Varun, thank you so much for joining in. The market's trading lower levels. The street believes that earnings are the big trigger for 2026. We did a survey where, nearly 2/3 of the respondents of that survey, the market intelligentsia basically, were expecting earnings to be the big trigger. And that really is the first question. So far, especially from the consumer space, the updates that we've got, they're mixed, barring the sparkling jewelry sector, which was anyway expected to do well.
Yeah, hi. So yeah, you're right. Everybody is looking at earnings very closely now because that has been the drag point entire 2025 when earnings growth was quite tepid, and we were growing at possibly around 8 to 9%, and we believe that FY26 will end at close to 10% for our coverage universe of 250 odd stocks. FY27 bottom up, we are expecting around 200 to 300 bips improvement in growth rate, which means the growth rate will be close to 12-13%. But at the same time, we won't be anywhere close to 18-20%, which we saw post COVID. So I think that is one thing which we have to keep in mind. And the earning expectation, I would say, is still a bit on the higher side. When we last checked, I think consensus is expecting around 16-17% earning growth for next year, which looks a bit of a stretch to us. As I said, 12 to 13% is what we are expecting. But nevertheless, it would be better than what we saw in FY26. And I think more importantly, the quality of earnings will be better in FY27 because in FY26, what largely drove earnings was oil and gas and metals, which are typically commodity sectors and low PE sectors. And the 3 large sectors, BFSI, IT, and consumer, which together are around 60% of the market, they had weak earnings in FY26. And FY27, when we look at each of the 3 sectors individually, we see an improvement in growth rate from FY26 to 27 in each of the 3 sectors. So that way, and these are the higher PE sectors at the overall market level. So that should help, provide downside support to the market. But, as we have been calling out last 12, 18 months, valuations is what caps the upside as well. The moment you get to 26,000, I think the absolute upsides from a next 6-12 month perspective don't look beyond 8 to 10%. So which means that on every fall you have to look to buy, but you can't be buying it at very elevated levels, and you have to be very, very careful with stock picking. It's going to be another year of stock picking, just the way 2025 was.
Okay, financials, consumer and IT, you expect better quality earnings in FY27. But Varun, the other space, metals is one, your view on that. And the second, defense. Do you see some potential upside there, given what we're hearing globally around the world, defense budgets from the US going up, Europe upping the ante? In India, is there potential, some upside there?
See, again, you have to look at it very bottom up. I would not say that, defense sector is a discovered theme now. That theme has been running for last 4 or 5 years. Defense stocks globally have been doing quite well in that period. And it looks like the sort of geopolitical era we are in, that the spending on that space will continue. But again, there are a lot of stocks which have re-rated massively in the Indian defense sector in the last 2-3 years, and even last year they had a good year. So, and there are stocks trading at 60-70p. So you have to look at it very carefully what the stocks are discounting and, which one looks attractive. But at an aggregate, allocation wise or growth wise, the runway for growth still looks fairly decent for this sector among the, the industrial or the capex sort of allocation of the overall government.
Right. Just a final question, maybe a one-word, two-word answer. What is the key overweight sector for you, and what is the key underweight sector for you?
Yeah. So in terms of overweight, we continue to run with financials. Both banks and NBFCs are a big part of our model portfolio. Consumer staples and IT, we have been cutting our underweight and now close to neutral. Underweight is oil and gas is a underweight for us. Cement is a underweight for us. And even metals, we are cutting our weight and now turning neutral to slight underweight. So I think these are the main ones. And consumer discretionary is still a tad underweight.
All right, take that point. Thank you so much. Short, effective chat, Varun. Pleasure as always. Take a short break, come back. We focus on a bunch of individual stocks, perhaps get you an update on what's taking place in Vodafone Idea as well. That stock's surging right now, the AGR dues repay plan. We'll get into the details of that one.
Welcome back. Let's get you a quick check of all the macro signals for the day. Let's start, as always, with the markets. The markets now testing at the lower, at the lowest point of the day almost now. Nifty trading with cuts of 129 points at 25,747 is where it's at. The Sensex also down about 440 points. The Bank Nifty also continuing to trend below the 60,000 mark at 59,369 as we speak. Let's also pull up the rupee. Now, rupee, there's been little change today, still trading above the 90 to the dollar mark. It closed at just a little above 90 yesterday as well. Not much of a movement there overnight, really trading what's happening in the Asian markets as well. The benchmark 10-year yield, though, that fell in early deals today. It's trading now at 6.64. As we speak, it closed at about 6.62 on Thursday, because there's been some concerns. Traders have been selling debt at even the smallest of the price increase that they're seeing in the market because they're worried there's a lot more debt that's lined up. Remember, there's the center and the states are looking to borrow a record 8 lakh crores through bond sales in this January-March quarter. So there has been some bother on that end, and which is why you've seen a bit of an upward movement on the 10-year as well. Let's also quickly pull up the crude prices. Overnight, there was as much as a 3 to 4% kind of a gain on oil prices. Good news there, but that's on the back of supply worries in Russia, Iraq, and Iran. But remember, the overall output is still higher than the requirement, and therefore not much of an up move there. Now the Brent at 62.45, NYMEX 58.2. That's where we're at. We'll take a short break, but don't go anywhere. We'll get you more on the markets on the other side. Stay tuned.
Vodafone Idea, that stock is in focus after the DOT communicated the company with the AGR relief. Rima joins in with an explainer. Rima.
Thank you very much for that. Finally, we've got an official formal communication. Vodafone Idea has heard back from the DOT and they've intimated to the exchanges regarding the AGR dues repayment plan. Now, the key takeaway is this offers the long-awaited cash flow relief. And it's an important milestone for the company, which has been under severe financial stress now for years. So here is the first big takeaway. The cash flow relief is for nearly a decade, 10 years. The repayment structure significantly eases the company's near-term pressure and pushes back the bulk of the payments much further out. So here's how the repayment picture looks. They have to pay about 125 crore maximum annually for the next 6 years. After that, over the next 4 years, the company has to pay a maximum of about 10 years. And finally, after that, it's only March 2036 onwards, over a period of 5 years, the company has to pay the AGR dues. So for the next 10 years, at least the annual payments related to AGR remain very modest. FY36 onwards, of course, the AGR payments could increase very sharply, and analysts say it should be about 14 to 15,000 crore rupees once the deferred payments kick in. The other important development is the DOT will form a committee to reassess the AGR dues and its decision will be final. Now, this opens the door perhaps for a potential recalibration, another relief on the overall AGR quantum, though the timeline and the outcome remain uncertain. Now, going ahead, if you look ahead, the big trigger for the company is a bank fund raise of 25,000 crore rupees. Now, that's been long delayed because of the overhang of the AGR. Now, with this relief that is known, will the company be able to raise that bank funding, debt funding of 25,000 crore rupees, or will the lack of clarity on the overall AGR quantum, the committee, what it decides, will that delay the bank funding? The bank fund raise is important for AGR because without this, the company's capex plans and network expansion remain constrained. And also, when you look at, what next, AGR is only one part of the problem. The company still have meaningful spectrum liabilities which stand at 1.2 lakh crore, and the annual spectrum payouts on the back of this will rise from 6,000 crore next year to 26,000 crore by FY29. Now, according to IFL, the company may need an equity fundraise to meet the spectrum obligation. And beyond that, will there be tariff hikes? That is always the multi-million-dollar question. If so, how much? And more importantly, will Vodafone Idea be able to close the gap with Jio and Airtel when it comes to market share, 5G coverage, and even premium subscriber mix? The question is, will Vodafone Idea emerge as a competitive third player? Now, Industars is the other beneficiary in this entire thing. Now, note there are no overdue receivables from Vodafone Idea to Industars. But Industars does benefit if Vodafone Idea emerges stronger. It reaccelerates on its capex plans and tower rollout. The stock, in anticipation perhaps of things improving, has already rallied 25% in the last 3 months, but it's about now 10% off from the all-time high levels. Back to you.
Reema, thanks very much for that. In fact, picking up on one of the important points that Reema raised on whether or not this relief will lend itself into Vodafone Idea being able to raise that critical 25,000 crore rupee debt. And we've been speaking to some of the largest lenders to Vodafone Idea, and our banking sources have indicated that this AGR relief that they've got and this repayment plan that now becomes clear for the next 6 to 10 years has given banks ample comfort to start working on the process of formalizing this debt or this borrowing for Vodafone Idea for 25,000 crore rupees. Importantly, they said the work starts right away with this clarity coming in, but it is only when the DOT committee gives its final stamp on the proposal will the banks take it to their respective boards for the final clearance. But, the bankers that we've been speaking to have very clearly indicated that within a couple of months, this plan should be approved more or less by, the SBI-led consortium is very much aligned on this 25,000 crore rupee bank loan that they're looking to extend to Vodafone Idea. So a positive development there as far as the important borrowing for Vodafone is concerned. Now, we reached out to our industry sources to understand the kind of exposure individual banks have. SBI, as we know, is the largest lender. We pull up that exposure about 6,200 odd crore rupees, followed by Punjab National Bank at a little more than 1,000 crore rupees. Axis Bank, again, similar number. IndusInd Canara, IDBI, ICICI Bank, Bank of Baroda, and RBL are some of the key lenders. Remember, these figures that we're putting up for you on the screen include both the fund and the non-fund based exposure of these lenders. Some of this is working capital, and some from the large lenders like SBI also includes the term loans as well. So that's as far as Vodafone Idea is concerned. But Mangalam, it's all the time we had today.
That's all the time we have today. Indeed, Ritu, as we speak, the Nifty is taken a sharp leg lower. In fact, when we were talking about it in the F&O space as well, if it wasn't taking support at the 25,800 mark, it would see panic selling, and that's exactly what's happened. We're closer to the 25,700 mark than the 25,800 mark. And the other stock, just before we wrap, on this edition of Trading Hour, look at IEX. Even as the hearing is underway, Ashmit sending us some lines. No direction available, no clarity emerges on whether coupling is happening or not. The stock's down 4%. So from the highs of date, that stock down about 10-11% as well right now. From Ritu, me, the entire team that put this show together, thank you so much for watching. The team of Halftime Report comes up next.
Markets continue to trade under pressure, though the intermittent bounces are seen in the market. The Nifty and the Sensex trade near the day's low, down 0.5% each. Real estate and private banks are the top losers. PSU banks, defense, IT stocks gain. Mid-caps relatively outperform.
All eyes on the United States Supreme Court as it is expected to deliver ruling on the legality of Trump's tariffs. Meanwhile, U.S. Commerce SEC claims that the U.S. struck trade deals on a strict first mover clock where early countries get better terms and later deals were priced higher. India, according to him, did not move within that window and was uncomfortable with a leader-to-leader call to close the deal.
IEX stock saw in trade amid a seesaw in trade amid a lack of clarity from the CERC on withdrawal market coupling order. At a hearing at the Electricity Appellate Tribunal, the CERC lawyer has sought more time to respond on the withdrawal of the order.
And a big relief for Vodafone Idea. The company outlines a schedule for repaying its telecom dues, under which portion of its AGR liabilities will be serviced at a maximum of 124 crore rupees per year over a 6-year period starting March 2026. The stock trades flat after being sharply higher earlier.
SIP contribution hits a record high of 31,002 crore rupees, even as net inflows into equity mutual fund schemes declined 6% to 28,035 crore rupees in the month of December. Now, according to the data released by the AMFI, gold ETF flows also surged at a multi-year high.
Good afternoon. Welcome to Halftime Report live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me, as always, is Vinny Motiwala. Well, markets are in a wait-and-watch mode. The first headline, the outcome of the Supreme Court verdict on whether Trump's tariffs, whether they are legal or not, that is something that the markets will be closely tracking. Other than that, we opened higher, but we have not been able to contain or hold on to those gains. We are at the day's low as we speak. It's a 200-point downtick from the highs of the day. By the minute, we are seeing lower lows on the Nifty as well. The mid caps are lower. They are slightly outperforming the benchmark. That index is down 0.2%, but Bank Nifty, Nifty Sensex, all of them are trading in the similar zone, all of them down around 0.5%. We do have some green shoots in terms of Nifty IT, which is doing well. Nifty Oil and Gas, after that 5% fall over last 1 week, is seeing some gains, some short covering there. And also the PSU Banking Index, that's been one pocket which has done well over last couple of trading sessions. So we'll track what's happening there. But a lot about individual names. On the broader level, the markets are in a wait-and-watch mode.
Absolutely. The markets are in a wait-and-watch mode, Sonal. And good afternoon to you as well. While obviously today we are seeing two sectors which are managing to hold on to some bit of a green. That's the PSU Bank as well as IT. We're seeing 0.5% gain for IT, PSU Bank, 0.8 to 0.9% of bank. That's the green spot there. Other than that, all the sectors are in the red. And for the week, if you look at it, Nifty has actually closed all the days in the red. Today also it's trading with cuts of 0.4 to 0.5% right now that we're seeing for the Nifty 50. So where it goes in the second half of the trading session will be something that one should watch out for. And obviously, Sonal highlighted key points that we're keeping an eye out on from the global political point of view as well. But yes, that's about the market, Sonal. But like we said, we have a lot of individual movers in trade as well. And one of them is Elecon Engineering. Now, this is coming after its Q3 numbers. They reported a bit of a weak set of numbers. While revenue saw muted growth in low single digits, we saw that the EBITDA performance of the company, that has seen a sharp decline on a year-on-year basis. That is down 23%. Margins of the company have just come in at 19.8% versus 26.9%. Obviously, there are factors impacting the margin. One, the revenue was only flat in terms of a revenue growth. Increase in employee costs is what the company saw. Change in product mix also came in, which impacted the overall margin performance. Profits of the company, that is down by around 33% on a year-on-year basis. Segment-wise, transmission segment, which is the bigger part of, with a bigger chunk of the total revenue, that saw an increase of just 1.5% approximately for the year. While material handling equipment, that saw a growth of 21%. But the main segment, that was transmission segment, that's where there was a muted growth. So overall muted growth in terms of revenues, profits seeing a decline and margins also seeing a decline, kept the stock under pressure in today's trading session. Order books stood at around 1,372 crores. While revenue guidance, the company said that FY26 revenue guidance may be lower by up to 5% is what they mentioned in their earnings PPT, and adjusted EBITDA margins will be lower by up to 2%. So that also is a bit of a cut that comes in there, and that is why the fall. As of now, look at the stock, it's now down 16% in trade, Sonal.
Okay, all right, big move on that name, Elecon Engineering, on the back of numbers. But which are the other stocks which are on our radar? Vivek is here to take us through the stocks which are moving around in trade. Big moves in the broader markets, Vivek.
Absolutely right. Good afternoon. And so much volatility, so much news flow, so many individual stocks that we are tracking. But amidst the backdrop of a very weak market where declines are far outpacing the advances at this point of time. Well, in terms of individual names, Idea as well as Industar doing a lot better today, over 2% higher. Any relief for Vodafone Idea, analysts believe, can help Industar resume dividend payouts, which it has halted, especially in the backdrop of the uncertainty. The other couple of stocks on the radar which have seen a bit of a bounce back are BHEL as well as Siemens. Remember, both of these names yesterday fell quite significantly in the last hour. Today, a bit of a bounce back. BHEL also positively gaining from the order inflow that it announced last evening. Star Health, one of the top gainers, especially when you're looking at it from a mid-cap, small-cap point of view, the top gainer there, and Indian Bank too, a sharp bounce back after yesterday's fall. On the other hand, quite a few laggards. Well, you spoke about Telecom Engineering. The guidance cut is something that the street doesn't like, over 15% lower. The entire capital goods pack, last evening a whole host of sell-side analysts have gone ahead and sliced the data in terms of what could be the likely impact in case there is competition coming in from China. GE Vernova, TD, 3G Power, Siemens Energy, Hitachi Energy. All of these names under significant pressure today. From the realty pack, Godrej Properties, the top underperformer, significant fall over, almost 5% lower. And Tejas Networks, one of the top laggards as far as the small cap end of the market is concerned, again, under quite a lot of pressure on high volumes today, over 4% lower.
Okay, all right. Some interesting names in that pack. Thank you so much, Vivek, for joining us with that list as always. That's all the action that we're seeing in individual names. But let's talk about the mutual fund data that came by just a while back. It is a dip if we talk about overall equity flows on a month-on-month basis. A 6% fall at 28,035 crore rupees. But that was largely expected also because of lower volumes that we see in the last 1 week of December. But SIPs, they are at a record high. And remember, in November on a month-on-month basis, it was absolutely flat, maybe a small dip, but it has recovered those losses by a big margin. Number is at 31,002 crore rupees, another record high number. It has crossed the 30,000 crore mark for the first time. We did see a lot of action coming in through gold ETFs as well. Look at that number, 11,646 crore rupees, which compares with just 3,700 crore rupees. And this is on the back of rising gold prices and also the fact that this number is again at a record high. The other category that did well was multi-asset allocation funds. This was another category that saw multi-year high flows into this category, considering the number or the money that flowed into gold again, because multi-asset allocation has allocation to different asset classes, equity, debt, and gold as well. Now, let's talk about the usual names, the large caps, flat on a month-on-month basis. It has been around that 1,500 to 1,400 crore mark. If we talk now about the mid caps as well, there is a small decline around 300 crore rupees, but that is also nothing to worry about so much. Small caps also saw a decline this time around to the tune of 600 crore rupees, coming in at 3,800 crore rupees. But do remember, this time around, while the NFO, the number was large, December saw 23 NFOs. They garnered around 4,074 crore rupees, so not much contribution coming in from NFOs to equity flows overall. This was something that we saw earlier, but this trend has been reversing off late. That's what we are seeing in the trends as well. Lastly, let's talk about sectoral funds. They are losing the sheen, and we have been talking about how sectoral funds is for high-risk investors, and looks like there's not much attention coming into sectoral funds, not many NFOs from the space as well, and that is something that we have seen in the month of December. But yes, record high SIPs and a lot of money flowing into gold ETFs and multi-asset allocation funds as well.
Absolutely. Those continue to shine over there, Sonal. Thanks for the update there on the AMFI front and the mutual fund data for the month of December. But on that note, we're going to sip into a very short break, viewers. But before we sip into the break, just a quick heads up for you all. If you're thinking about where the real opportunity for 2026 lies, Market Forum, the Alpha Generators for 2026 is where that conversation begins. The Alpha Table awaits. Join CNBC-TV18 as we host Ultimate Confluence of India's market movers. Tune in on 13th of Jan, Tuesday, 4:30 p.m. onwards, only on CNBC-TV18.
Fly Emirates, fly better.
Welcome back. You're still tuned into Halftime Report. We've been talking about the impact of what's happening globally. We did see rupee depreciate almost 5% in 2025. UBS now expects a soft dollar in Q1 of 2026 as well, due to factors like job weakness, tariff-driven inflation, rebounds on AI, exceptionalism. They also believe that the risk-reward in rupee is unattractive as yet. To discuss this on the back of so much uncertainty that we're seeing on trade deal between India and US, Rohit Arora, head of Asia FX and Rate Strategy, UBS Global Research, is joining in now. Rohit, good afternoon. Thank you so much for joining in. And we are having this conversation on a day where there's commentary coming in from the US, where they speak about how there was a possibility of India to get a deal at a lower rate in terms of tariffs, but that did not happen. There's still not so much clarity. The talks around 500% tariffs. We have the Supreme Court judgment as well in the US. Do you think all of this will keep rupee under pressure? And what are some of the other factors that could continue to see softness in rupee?
Yeah, sure. Good afternoon, everyone. If we take a look back, the rupee underperformed the peers partly because of domestic demand, which has been weak, partly because of tariffs, and partly, which is quite surprising, but partly because of FX reserves accumulation by the central bank during the middle part of last year. This performance over the last 3 months could have been a lot worse if it were not for central bank's strong intervention in the FX markets. Now, what's happened has happened. We think rupee has missed that window of broad dollar decline. We think the broad dollar gradually starts recovering from this quarter, and that's why we are pegging dollar rupee at 94 for the coming year. Surely a trade deal can help, but we think that kind of support could be temporary. The macro factors, that is a recent deterioration in current account balance, about zero FDI flows, and capital flows in general running at the lowest point or the lowest part of the last 10-15 years is clearly a bigger drag on the currency. So that is why we are pegging dollar rupee at 94 for the year.
Okay, pegging it at 94 for the year, you're saying obviously there are factors like FII flows which are not there. But if they do come back and we see the trade deal happen, which may be positive, if it is positive for the Indian front as well, then what is your target? Or would it still be 94 even with these triggers coming in?
Of course not. I mean, if facts change, we will change our view. Now, surely a trade deal, let's say, I mean, as you rightly pointed out, there were commentaries a couple of hours ago. Now, if there is a surprise and trade deal materializes tomorrow, then INR can rebound. There is clearly some degree of pessimism in the market. It can rebound to 88 to 89, but we are not expecting a lot more gains beyond that, partly because the central bank's large FX forward maturities, more than $30 billion in NDFs in a month, could keep the downside capped. Could keep a floor underneath dollar rupee. Secondly, the historical trend of dollar rupee's higher highs and higher lows seen since 2019, we think likely stays intact due to trade competitiveness concerns. And the central bank governor did mention 3 to 4% annual depreciation is not really a big deal. Last but not the least, growth also needs to recover. As things stand, there are some early signs of stabilization of domestic demand, at least from the bank's lending data. If we do start to see a recovery in growth, then there is a possibility then capital account also starts recovering. But at this juncture, where things are, where valuations and the equity markets are, we are still leaning in the direction of an underweight stance on rupee.
Okay, underweight stance on rupee. Rohit, you spoke about what's happening domestically as well, the growth concerns. But you also mentioned that RBI is okay with 4 to 5% depreciation. Do you think that is also happening because it's helping exporters right now, considering there's already a fear of high tariffs on exports?
Certainly, I think if tariffs remain there for longer, then currency obviously acts as a easy as an easy shock absorber. The fact that inflation in India at 1% is at multi-year lows gives us the policymakers ability to let the rupee be shock absorber. Likewise, the fact that rupee depreciation is not necessarily spilling over to equities performance is another reason from financial markets perspective that this currency that the currency can be used as a shock absorber. Now, many investors tell me, "Oh, rupee has fallen by 10%. Isn't it cheap already?" And my short answer is, if you look at the rupee versus renminbi on an inflation-adjusted basis, it is still sitting in the top quartile of 10-year distribution. Core goods balance in India is sitting at multi-year lows. And if I go by these two simple facts, it's not obvious that something has fallen is necessarily cheap. So yeah, that's where we are coming from. And to your point about shock absorber.
Okay. Rohit, surely point made there, just because something has fallen doesn't mean it's cheap. But now, do you think 2025 rupee was something that underperformed versus peers? But 2026, is that the case? 3 to 4% depreciation is normally something that we anyway see, right, for the rupee, or that's what is factored in. But will this also be a year where, again, rupee would not do well versus Asian peers?
I think what happened last year was clearly very different, wherein dollar went through a big downturn during that Q2 phase when de-dollarization narrative was in the air, and mostly because of that, the rupee's big underperformance was. Then, of course, there was tariffs-related concerns. So I don't think we should get similar amplitude of rupee underperformance like last year. But versus renminbi, we think it can. It would versus euro, probably not nowhere near what happened last year. In fact, we are forecasting euro's performance to be broadly similar to what we talked about in rupee.
So which currency do you think could outperform in 2026, going by the fundamentals, if there is any specific name there?
So renminbi is what we are most optimistic on in the region. That's a currency which is clearly finding some help from hyper-competitive China, their push of AI into the manufacturing sector, external balances at levels unseen since 2009. And on top of that, it is clearly quite cheap. I mean, we just talked about a 10% decline in Indian rupee real, but renminbi has fallen 20% on real effective exchange rate in the last couple of years. So that is where we think there is relative cheapness and clearly a strong pull factor from Chinese equities, which should keep renminbi on the front foot.
Okay, just a last word. What is the best case scenario and worst case scenario for rupee? 94 is the worst case, or is that the best case?
I would say that's the baseline. The best case would be we get a quick deal and a coincidental rebound in the growth indicators. And if all of that happens in the next 2 months, which clearly is seasonally the best part for the dollar supply into the system, then yes, we could see a pullback, as I said, towards 88, 89 range, maybe a lower end of that. And that I would say might be the most optimistic scenario. On a bear scenario, I think if we do see and bear scenario would obviously be above 95, wherein the tariffs on India do not unwind because of, let's say, ongoing Russia-Ukraine tensions and spillovers of that on Indian tariffs. Likewise, at the same time, if broad dollar, which went through a correction lower last year, starts recovering because of a rebound in US labor markets, because of unwinding of that de-dollarization narrative, and of course, a big help from a productivity boost to US economy from AI sector, all of those factors could be a bear scenario, which could keep pressurizing rupee on the upside. Now, thereafter, pinning down a topside level is really difficult because, as you know, it is a managed currency. And as I mentioned in my earlier comments, if it were not for FX management, rupee could have broken 90 at least 3 months ago.
All right, take that point. Thank you so much for joining us with your insights on what's going to be the currency scenario in 2026 and what's going to happen if things change from the current scenario. Thank you so much for your thoughts today. Well, that's the word coming in from UBS Global Research. With that, we'll slip into a short break. But before we do that, a quick note for our viewers. Get ready for CNBC TV18's all-new lineup starting today. Incisive analysis, sharp commentary with CNBC TV18's brand new offerings. Watch our new segment, Cut the BS with Mangalam and Sonal Bhutra. Watch Macro Signal with Ritu Singh that isolates the macro forces that actually matter for the day. And finally, stay ahead of the curve with CNBC TV18's most trusted in-house technical experts.
Welcome back to Halftime Report on CNBC TV18. Nifty continues to be around the 25,700 level. 25,731.32 is what the Nifty is at as of now. But let's move on and also bring on board Manish Hathiramani, proprietary trader and technical analyst at Deen Dayal Investment, joining us now to talk to us about the markets. A quick check on that front as well. Manish, good afternoon. Thank you so much as always for joining in. Now, you know, this today becomes very important in terms of the level that Nifty closes at. 25,700. If we close above that, what will it mean? And if we close below that, what does it indicate for us?
Good afternoon to you and to all our viewers. Well, there are two parts to this question. The first is slightly shorter term in nature, which is more like the next couple of days to a week. The other is more like an expiry to expiry situation. I'll answer them both. Currently, Nifty is sideways, and we have been sideways for the last 4 or 5 trading sessions. We conveniently broke the support of 26,100 after that sideways zone. Then there has been some patches of congestion. The low of 30th December has broken this morning, which should take us to a new target of about 25,600 to 25,650, which is the next level of support. From a macro perspective, we are still sideways. So it is only a break of 25,600 on a closing basis when we will start looking at lower figures. Otherwise, the upside also respects on the upside of the current range.
Okay, and what about individual names, Manish? Because while the headline index continues to make newer lows, are there any individual names you would like to trade on?
Sure, I'm working with 2 sell calls at the moment. The first one is on Britannia, which is for a target of 5,900 and a stop loss of 6,110. We noticed some pressure in the FMCG sector. This particular stock had a support of 6,100 to 6,110, which has been disrespected on the back of good volumes. The second one is a sell on NTPC, which is for a target of 330, stop loss of 350. 350 was a good support for the stock, which also broke on the back of good volumes, and the risk is to reward is also favorable.
You know, what are your thoughts also in some of these capital good names? GE Vernova, we're seeing Siemens Energy, Hitachi Energy, they're seeing a bit of a decline. Anything on the charts that there is an indication or you would look at?
Well, actually, right now, across the board, we are seeing some kind of supports breaking everywhere. The real trigger really is that as long as the index manages to be sideways, these stocks will be like positive 3-4% up or down. It is a proper analysis on the upside or the downside only after this range is taken out.
Okay, all right, take that point. These stocks continue to be on our radar. We'll keep analyzing what's happening there. But thank you so much, Manish, for joining in with your thoughts and outlook on the chart patterns shown by individual names and the Nifty as well. Let's slip into a break. When we come back, we'll get in Reema Tendulkar, who will focus on the big AGR relief of Voda Idea, what it means for the company, and a lot more. Welcome back. You're still tuned into Halftime Report, and the big story that we're tracking is the relief that has come in from Vodafone Idea. The company has outlined a schedule for repaying its telecom dues. Rima is joining us with an explainer on the same. Rima.
Thanks so much for that. Indeed, Vodafone Idea has received formal communication from the Department of Telecommunication on its AGR dues repayment plan, and it offers a long-awaited cash flow relief, and it marks an important milestone for the telecom operator because it's been struggling under severe financial stress now for years. So here is the first big key takeaway, that cash flow relief is almost for nearly a decade. The repayment structure significantly eases the near-term pressure, and bulk of the payments come in after 10 years. So here's how the repayment schedule looks like. For the first 6 years, the company has to pay a maximum of 124 crore rupees every year. Then for the next 4 years, the company has to pay a maximum of 100 crore per year. It's only after that, that's FY36 onwards, the AGR dues will be spread over a period of 6 years. So basically, for the next decade, the annual payouts remain relatively modest, giving the company enough time to improve its financial performance. After 10 years, the AGR-related outgo could stand at 14 to 15,000 crore on an annual basis for a period of 6 years because the deferred payments will now kick in. The second important takeaway is that they have said that they will be forming a committee to reassess the AGR dues, and that decision will be final. The question is, will this open a door for a potential recalibration of AGR dues, because a committee is now going to be formed, though the timeline and outcome still remain uncertain. Now, when you look ahead to Vodafone Idea, I think the big trigger is this 25,000 crore of a bank fundraise. Now, what we've heard today, is that sufficient for the company to get that debt funding, or because we still don't have clarity on the overall AGR quantum with that committee still to be formed, will that bank funding get delayed? I think this is important because without the bank funding, the company's capex plan, network expansion plan remain constrained. Also, when you look ahead, AGR is only part of the problem. The company also has spectrum liabilities, and they're meaningful. They stand at 1.2 lakh crore, and the annual payments are going to rise sharply. So next year, that annual payment stands at about 6,000 crore rupees, and this will increase to 26,000 crore by FY29. Now, according to IFL, the company may need an equity infusion, some sort of an equity fundraise to meet these spectrum liabilities and obligations. Beyond that, we always say the tariff hikes is the big trigger for the entire industry. When will it come? How much will it come? And can Vodafone Idea really close the gap with Jio and Airtel when it comes to market share? It's been losing subscribers, 5G coverage, premium subscriber mix. The question is, will Vodafone Idea emerge as a competitive third private player? Now, the other stock, which is a beneficiary, is Indus Towers. Now, here, note that Indus Towers does not have any overdue receivables from Vodafone Idea. What Indus Towers benefits from is Vodafone Idea emerging stronger, its capex program and tower rollouts. Now, maybe the stock was sussing this because in the last 3 months, the stock went up 25%, Indus Towers. It's now about just 10% off from its all-time high level of 499. Back to you.
Okay, Rima, thank you so much for rounding it up for us in terms of now what it means for Vodafone Idea, the payments, how that will go through. And in terms of the funding that Rima has highlighted, that's going to be important for Vodafone Idea that comes in from the bank. So that happens or no, is something we'll watch out for. Vodafone Idea as well as Indus Towers both in focus today. But on that note, we're going to step into a very short break. We'll get you more on the markets and stock-specific action on the other side.
Welcome back. Joining us on the show now is Alcock. He's CEO De Beers Group to discuss the Indian diamond market. Al, hi, thank you so much for joining in. Well, I remember our conversation almost 6 months ago when you said that the Indian diamond market will double in the next 5 years. Well, we have seen a lot of things change in the last 6 months. Would you still reiterate that statement, or would you say a lot of changes in the global markets have come in and this perhaps would change too?
Yes, we're still on with that statement. So, you know, the last 6 months has been very turbulent from a geopolitical point of view. And across the world, we've seen a huge amount of change. But one thing that we've seen stay constant is the love affair between India and diamonds. We've seen very strong growth rates in terms of Indian diamond demand over the last 12 months. We've seen around about 11%. So that's the 4th year in a row of double-digit growth in India. And that means that we remain confident that India's position as a really important diamond market will remain and will grow and will double through to the end of the decade.
I'll come in on the diamond prices as well, whether it's about rough or retail, and then the diamond prices have continued to be stable, would you say, in the light of what gold and silver have done, and that in turn, has that been supportive?
Well, at a retail level, diamond prices have stayed very stable. So if you look at diamond prices in stores in India or indeed in the United States, over the last 5 years, they remained very stable. At a rough diamond level, we've seen declines in price. And of course, those have been exacerbated by global tariffs, and in particular by the tariffs between the United States and India, 50% tariffs. And of course, India is the most important place in the world for cutting and polishing diamonds. The United States is the most important place in the world for purchasing and buying diamonds. So those 50% tariffs have been challenging for the diamond industry and have had an effect on rough diamond prices over the course of the last year. We're confident that once the United States and India signs a trade deal, that we'll get a strong resurgence in the trade between India and the United States, and that will really open up the market once again for diamonds from India going to America, and really underpin the health of the industry globally.
Well, that trade agreement is something that all of us are waiting for between US and India. But also talk to us about your strategy for India. What is it that worked for you in 2025, and what are your plans in India now for 2026?
We're investing in India because it's got a 2,000-year love affair tradition of diamond jewelry. And we're investing in India because of the future. And we're seeing the GDP growth here translate into diamond demand growth. So we're investing in India. For us, that means investing in marketing. We've had a great partnership with the IPL. We've had a wonderful set of campaigns here in India. But also, we're investing in retail in India for the first time. And I'm here in Mumbai, where we're going to be opening our 5th new Forevermark store, a really premium store offering diamond jewelry to the Indian consumer. That started in Delhi in 2025, and we've got 5 stores now. By the end of this year, we'll have 25 stores. So we're investing in India across the board.
Al, you mentioned about lab-growns, and well, yes, Titan's foray into lab-grown clearly has been a talking point among industry. How are you reacting to that? How's De Beers reacting to this?
We have a very strong partnership with Titan, particularly with Tanish. We actually see things in a very similar way to them. We do see that there will be low-cost lab-grown diamonds sold in India to people who want cheap, fun, fashionable jewelry. That's great. But we also see this strong growth in natural diamond jewelry. And we share that belief with Tanish and other partners in India. We know that there's a really high sophistication of consumer in India. We know people are very sophisticated and clever when they go out to buy gold. That's matched when they go out to buy diamonds. So we're making sure that people understand the difference between lab-grown diamonds created over a few days and natural diamonds created over 1 billion years. And we believe that natural diamond growth will continue because people here treasure something natural, something unique, something rare, something that will mark the most important moments in their lives.
I just want to come back to your retail foray and growth, and why get into that space. Also, how are you looking at the online growth? How many total stores are you anticipating for Forevermark to have in India by the end of this calendar year?
So we've started in Delhi and Mumbai, and this week in Mumbai we'll be opening the largest diamond store we've ever had in De Beers, the Forevermark store here. But we also recognize that the tier 1 and tier 2 cities in India are growing even faster than Delhi and Mumbai. So we'll be expanding our stores across different cities across India. And of course, we'll be also expanding our online presence. So we can see growth across the board in retail in India. We are very confident in this country going forward.
In the growth in this country going forward on the diamond side, lab-grown diamond side. Manisha, that's a conversation we have almost every day discussing where that's going. But Al, as well as Manisha, thank you so much for joining us and taking us through that conversation. On that note, we're going to step into a very short break. We'll come back with more on the markets, more on the stock-specific action after the break. Welcome back to Halftime Report on CNBC TV18. Now it's time for a special segment, Quarter Se Quarter Tak, where we bring you earning expectations for each sector. Today, Rima is here to tell us about Q3 FY26 expectations for the IT sector. Over to you, Rima.
As the December quarter earnings season kicks off for Indian IT, expectations are fairly anchored because Q3 FY26, that's the December quarter, is generally a seasonally weak quarter. There are furloughs, holiday, year-end, client shutdowns. So let's now begin with the top line, the constant currency revenue growth expectations on a quarter-on-quarter basis. For large caps, it's going to be very modest, but mid caps is actually going to be much better. So this is what the CNBC TV18 poll throws up. It will begin with TCS. That's the first one to report numbers on 12th evening. A CNBC TV18 poll throws up a top line growth of about 0.5%. Then you've got HCLTech also on 12, and that is going to lead with a top line growth of nearly about 3%. And that is largely on the back of strength in its products business. For the other two, as you can see, it's a very low single-digit kind of a top-line performance. Now, mid-caps, once again, are expected to outgrow the large caps. And the two stocks that the investors are very keen on is Persistent and Coforge. And these two are likely to see about a 3.5% constant currency revenue growth. Now, at a broader level on the demand front, it's not positive, nor are there any negative surprise. The demand environment has not materially changed in the last 3 months, though JPM recently flagged off some improvement in the auto tech spends from the OEMs, which is positive for ER&D companies. But other than that, we haven't seen any sharp increase in discretionary spending. Cost takeout deals continue to dominate, and the AI discussions are active, but large monetization still remains very limited. Now moving on to the FY26 guidance. And I think the headline here is that the guidance is narrowing, but it's not upgrading. So Infosys guidance was about 2 to 3%. It could come to about 2.5 to 3%. For HCLTech, the guidance was 3 to 4%. It could come at 4 to 5%. And both these companies are likely to maintain their margins despite the INR tailwind, on the margin front. On margins, while the rupee depreciation, the FX helps, but margins are still likely to remain structurally range-bound. So here's how the currency moved in the quarter gone by. The USD-INR pair moved from 87.3 towards the end of Q2 to 89.1. And that is about 2% quarter-on-quarter rupee depreciation. And if you look at it on a year-on-year basis, it's about a 5.5% rupee depreciation. Yet, despite that, margins are still likely to remain range-bound in Q3 because some companies have wage hike, there is the furlough impact, and AI-led pricing pressure. I think the key question investors will ask and listen for is calendar year demand commentary, tech budgets. Are we finally seeing budgets improving, AI monetization clarity beyond pilots and a productivity talk, and discretionary spending recovery still remains elusive. Finally, let's put the stock price and the valuation in context. Now, the Nifty IT index did well in the October to December quarter. From 1st October to 31st December, the Nifty IT index was up 14%, outperforming the benchmark by nearly 4%. Despite this, the index is still underperforming. In the last 1 year, it's down close to about 12%, and this is the valuation. For large caps, as you can see, it's between the 20 to 24%, largely 24 times, largely within the long-term average. Mid-cap valuations are superior, but then they are growing faster in a softer demand cycle.
Okay, Rima, thank you so much for that. But as of now, the Nifty is trading at the day's lowest point. It is below 25,700 levels, now down 188, 190 points. Even the broader end of the market is seeing a bit more of a fall. But with that, it's a wrap on this edition of Halftime Report. Thank you so much for tuning in. Business Lunch takes the action forward.
Cool.
The markets continue to trade under pressure, though with intermittent bounces. The Nifty and the Sensex are near the lowest point of the day, down over 0.5% each. Real estate and private banks are the top losers. PSU banks, defense and IT stocks have gained. Mid-caps are relatively outperforming. All eyes on the US Supreme Court later this evening, as it is expected to deliver the ruling on the legality of Donald Trump's tariffs. Meanwhile, US Commerce Secretary claims that the US struck trade deals on a strict first mover clock, where early countries get better terms and later deals were priced higher. India, according to him, did not move within that window and was uncomfortable with a leader-to-leader call to close the deal. Shares of IEX seesaw in trade amidst the lack of clarity from the CERC on withdrawal of the market coupling order at a hearing at the Electricity Appellate Tribunal. The matter is now deferred to the 19th of January with no decision being made in the case. A big relief for Vodafone Idea. The company outlines a schedule for repaying its telecom dues, under which a portion of its AGR liabilities will be serviced at a maximum of 124 crore rupees a year over a 6-year period starting March of 2026. The stock, though, is flat after gaining as much as 8%. And SIP contributions hit a record high of 31,000 crore rupees, even as net inflows into equity mutual fund schemes declined 6% to just over 28,000 crore rupees in December, according to data released by AMFI. Gold ETF flows also surged to a multi-year high. Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I am Hormuz Fatakia. The bulls were looking to end the week on a high. Unfortunately, as of now, that is not turning out to be the case. Down for the 5th day running now for the index. Currently at the lowest point of the day, below the 25,700 mark, could not defend the 25,800 mark either, and the losses are continuing to extend. We did see a brief bounce at the start, at the initial few minutes of the trading session, but that was very, very quickly sold into. And the prime suspects of today's fall, ICICI Bank, this time after a 4-day winning streak and after ensuring that the Nifty losses earlier in the week were kept in check, it is ICICI Bank that is leading the Nifty lower now. And HDFC Bank continues to fall. HDFC Bank is now down 6.5% this week. It's turning out to be the worst week that the stock has seen since January of 2024. So that is the kind of fall that you're seeing on HDFC Bank. The stock has now lost over 1 lakh crore in market cap this week. Now, the other sectoral picture, if you see, the real estate stocks are the ones that are not doing well in today's session, be it the likes of Godrej Properties, be it the likes of DLF, all of them trading lower. The index is seeing a marginal recovery, still down 2%. Godrej Properties is down 5%. And of course, the other names, DLF down 2% as well. If you take a look at two stocks, earnings related, Elecon Engineering is one of them. That is down around 16% after its results. There was sharp pressure seen on the margins, and that is now at the lowest point of the day. And the other one being Ireda. You're counting down to earnings from that stock as well. The company had already come out with its business update, so we need to check for Ireda, down 2% ahead of its results. Now, the other major talking point just a few minutes earlier was the AMFI mutual fund numbers. The highlight of that was the SIP contributions, which have hit a record high of 31,000 crore rupees, even as net inflows have declined in the month of December. Sonal is here with a breakdown of the numbers. Sonal.
Well, yes, there is a decline in equity inflows, 6% on a month-on-month basis in the month of December. But do remember, we did see lower volumes in the last week of December as well. But yes, this is not a big number to worry about as well. They stay at the 28,000 crore mark. The big talking point has to be SIP inflows, which have come in at 31,002 crore rupees. Remember, from October to November, they were flat, but it is a big increase now. They've crossed the 30,000 crore mark in the month of December. The other big record has to be the inflows in gold ETFs above that 11,000 crore mark, around 11,648 crore. That just compares with around 3,700 crores that we saw in the month of November. This is because of that big surge that we saw in gold prices as well. And that is maybe the reason why multi-asset allocation funds also saw multi-year high inflows come by for them at around 7,400 crore rupees, because they do have a component of gold as an asset class as well, other than equity and debt. Now let's talk about the usual names, the large caps, the mid caps and the small caps. For large caps, it's largely flat on a month-on-month basis.
For mid caps and small caps, we did see a lot of volatility in the month of December, and that can be seen in the numbers, but it is not a worrying figure as far as the flows in the mid caps and both the small caps is concerned. Now we talk about the NFOs, because remember, we were seeing a slew of NFOs which flooded the markets in last couple of months. We did see 23 NFOs this time as well, but the money that they raised was around 4,074 crore rupees, but not a big contribution that came by for equity flows just from the NFO space. And if we talk about the sectoral theme as well, that was something which was buzzing of late, but that activity has come off quite a bit below the 1,000 crore mark. And we have been indicating that sectoral funds are for high-risk individuals, high-risk investors. So that activity has taken off on the lower side. So this is what the number looked like for the month of December. The biggest talking point, the SIP number, and of course, what the flows that we saw in gold ETFs as well this time.
Sonal, thank you for that update there. Gold ETFs hitting a multi-year high as well, as Sonal was pointing out. The other major talking point earlier this morning was Vodafone Idea, and after the stock gained as much as 8% after the company revealed to the exchanges that the DOT had communicated with them with regards to the AGR relief, the stock has given up all of those gains now and is trading absolutely flat. Reema is here with an explainer.
Thanks so much for that. Indeed, Vodafone Idea has received formal communication from the Department of Telecommunication on its AGR dues repayment plan, and it offers a long-awaited cash flow relief, and it marks an important milestone for the telecom operator because it's been struggling under severe financial stress now for years. So here is the first big key takeaway, that cash flow relief is almost for nearly a decade. The repayment structure significantly eases the near-term pressure, and bulk of the payments come in after 10 years. So here's how the repayment schedule looks like. For the first 6 years, the company has to pay a maximum of 124 crore rupees every year. Then for the next 4 years, the company has to pay a maximum of 100 crore per year. It's only after that, that's FY36 onwards, the AGR dues will be spread over a period of 6 years. So basically, for the next decade, the annual payouts remain relatively modest, giving the company enough time to, improve its financial performance. After 10 years, the AGR-related outgo could stand at 14 to 15,000 crore on an annual basis for a period of 6 years because the deferred payments will now kick in. The second important takeaway is that they have said that they will be forming a committee to reassess the AGR dues, and that decision will be final. The question is, will this open a door for a potential recalibration of AGR dues? Because a committee is now going to be formed, though the timeline and outcome still remain uncertain. Now, when you look ahead to Vodafone Idea, I think the big trigger is this 25,000 crore of a bank fundraise. Now, what we've heard today, is that sufficient for the company to get that debt funding? Or because we still don't have clarity on the overall AGR quantum with that committee still to be formed, will that bank funding get delayed? I think this is important because without the bank funding, the company's capex plan, network expansion plan remain constrained. Also, when you look ahead, AGR is only part of the problem. The company also has spectrum liabilities, and they're meaningful. They stand at 1.2 lakh crore, and the annual payments are going to rise sharply. So next year, that annual payment stands at about 6,000 crore rupees, and this will increase to 26,000 crore by FY29. Now, according to IFL, the company may need an equity infusion, some sort of an equity fundraise to meet these spectrum liabilities and obligations. Beyond that, we always say the tariff hikes is the big trigger for the entire industry. When will it come? How much will it come? And can Vodafone Idea really close the gap with Jio and Airtel when it comes to market share? It's been losing subscribers, 5G coverage, premium subscriber mix. The question is, will Vodafone Idea emerge as a competitive third private player? Now, the other stock, which is a beneficiary, is Indus Stars. Now, here, note that Indus Stars does not have any overdue receivables from Vodafone Idea. What Indus Stars benefits from is Vodafone Idea emerging stronger, its capex program and tower rollouts. Now, maybe the stock was sussing this because in the last 3 months, the stock went up 25%, Indus Stars. It's now about just 10% off from its all-time high level of 499. Back to you.
Rima, thank you for that update. Flat as flat can be is Vodafone Idea. What's not flat as flat can be is IEX, and the kind of seesaw that the stock has seen all through the day after gaining as much as 6%, then declining, now trading with losses of 5%. The overhang of that market coupling case continues as a new date now has been put in place. Ashmit is here with more on this. Ashmit, tell us what happened at the Electricity Tribunal hearing today.
Well, high voltage, high drama here as far as the APTEL is concerned. Bear in mind, the one key question that came to everyone's mind is whether or not the CERC will withdraw the coupling order. At the time, in the last hearing, the CERC lawyer had said that he will seek instructions from the CERC on whether there's any scope for withdrawal. We're given to understand after the day-long proceedings today that so far there's been no withdrawal of the coupling order by the CERC. Instead, what the CERC appears to be saying is that, look, this is now not an order, this is now a direction. The July coupling order has now been turned into a direction. CERC saying this is an administrative decision and that now the regulation process will begin and the exchanges need not fear, given as how there can be no implementation of the coupling mechanism without the regulations taking place. Now that is something that in fact the exchanges also came in on. The exchanges said that regulation making is fine, but even if that were to continue, the coupling order should be set aside, that there should be clarity that the coupling order is delinked from any regulation process that the CERC wants to undertake. Now that is a key question, whether or not the CERC will be allowed to continue with the regulation making, whether or not the coupling order will be set aside by the APTEL, and whether there's any linkage between the coupling order that was passed in 2025 and the regulation making that the CERC is now trying to do. So clearly, all bets are, all options are currently on the table. For now, the APTEL not passing any interim directions. The next hearing in this case, we understand, will be on January 19th. But in terms of key takeaways, no withdrawal yet as far as the coupling order is concerned by the CERC. And going forward, the CERC saying that there is no reason, there is no cause for concern. There can be no implementation without regulations, and regulations is something that is yet to begin by the CERC.
Ashmit, thank you for that update there. It's not over unless it's over. So 5% lower on IEX in today's session. Take a short break here on Business Lunch. Just before we do that, here's a quick note for our viewers. Get ready for CNBC TV18's all-new lineup. Starting today, incisive analysis, sharp commentary with CNBC TV18's brand new offerings. Watch our segment Cut the Balance Sheet with Manglam and Sonal Bhutra. Watch macro signals with Ritu Singh that isolate the macro forces which actually matter for the day. And finally, stay ahead of the curve with CNBC TV18's most trusted in-house technical experts.
Fly Emirates, fly better.
Welcome back. Now, a major catalyst that investors will be keeping an eye out for today is the Supreme Court of the US, who's going to be hearing the legality of US President Donald Trump's tariffs. This could have an impact on trade policy and the nation's fiscal situation. CNBC's Lorianne LaRocco has more on this.
We can be just hours or weeks away before the Supreme Court rules on the legality of the Trump tariffs, and importers now have to register on a new customs platform in order to be able to receive any type of refunds. Details on the new digital payment system were announced on January 2nd, and importers have until February 6th to register. If they don't, customs specialists tell CNBC importers could have delays in refunds. The new system is called ACE and was part of an executive order signed by President Trump back in March. It's designed to modernize the government payment system, which originally was manual. A decision by the Supreme Court on tariffs could come as early as Friday. CNBC has reported earlier importers have pushed back on President Trump's claim that the tariff payments would be messy because the tariff bills the importers have been paying are itemized. If the Supreme Court does rule the tariffs or part of the tariffs are illegal, the Court of International Trade has the legal authority to decide how the refunds are paid to U.S. importers.
Now, 2026 is shaping up to be a defining year for the global order, and according to Eurasia Group President Ian Bremmer, the single biggest risk is not China, Russia or artificial intelligence, but the US itself. Now, in an exclusive chat with CNBC-TV18, he spoke about the looming Supreme Court ruling on tariffs and Donald Trump's political agenda. Listen in.
The IEEPA clause, which is meant to be applied in a national emergency by the president, is clearly not the intention to be used against 90-plus countries for political purposes, against Lesotho. I mean, there's no national emergency in many of these cases. So I do think that the Supreme Court, at a minimum, is likely to constrain the use of IEEPA in some of these purposes. That doesn't mean that they will overturn everything. The Supreme Court is not going to give him a rubber stamp and say, you have all of this control, the president can do whatever he wants, even though most of the tariff powers are meant to reside in the hands of Congress, the legislature.
Ian Bremmer there in an exclusive chat with CNBC-TV18. Now, before we head into the break, just a quick heads up. If you are looking or thinking about where the real opportunities for 2026 lie, Market Forum, the alpha generators for 2026, is where that conversation begins. The alpha table awaits. Join CNBC-TV18 as we host the ultimate confluence of India's market movers. Tune in on the 13th of January, Tuesday, 4:30 p.m. onwards, only on CNBC-TV18. Welcome back. The U.S. Commerce Secretary Howard Lutnick, speaking on the All In podcast, has explained why the U.S.-India trade deal has hit a roadblock. Listen.
You did the deal with Europe. You did the deal with the UK. What's sort of out there that's still there? I think India's kind of still out there, although it seems like they are capitulating a little bit. I saw that they just bought a lot of liquefied petroleum gas from the United States in November. What are the big sort of hot button places that you want to...
I'll tell you a story about India. So if you remember, so I did the first deal, the UK deal. And we told the UK that they had to get it done by 2 Fridays from now. That was the date. That the train was going to leave the station by 2 Fridays, because I have a lot of other countries doing things. And, you know, if someone else is first, they're first. And President Trump does deals like a staircase. First stair gets the best deal. You can't get the best deal after the first guy went. Everyone says, I want the UK deal. I want the UK deal. The answer is no, they were first. They took the chance. They moved quickest. They're first. Second, up a stair.
So that sets the floor.
Right. And then the next one's got to be higher. And then the next one higher. And then the next one higher. The next one higher. So he does things that way because that way it incents you to come quickly to the table.
Right.
Right? You could have 3 countries who are the second deal. They all get done at the same time.
Right.
But, you know, if you want to wait and see how it goes, that's at your risk. So he does the UK deal. And they had to get it done by Friday. And Thursday afternoon, Keir Starmer's on the phone, the president. They do their deal Wednesday night. And on Thursday, we have a press conference and we announce it. Okay. So everybody asked the president, who do you think is next? And if you look back at the time, he talks about a variety of countries, but he names India a couple of times publicly. It's not like a big secret. And we were talking India, and we told India you had 3 Fridays.
You put them on a shot clock.
Well, they have to get it done because what happens is I have lots of other countries, and when those other countries do their deal,
the staircase goes up.
And right, and now the president, during all these deals, he would refer to me as the greatest table setter who ever lived. Okay, because you've never had anybody who is as successful as me as a businessman before, who's just the table setter. That's basically, you know. So, because what I would do is I would negotiate the contracts and set the whole deal up. But let's be clear, it's his deal.
Yeah.
Okay, he's the closer. He does the deal. So I said, you got to have Modi. It's all set up. You have to have Modi call the president. And they were uncomfortable doing it. So Modi didn't call.
Wow.
So that Friday left. In the middle of the next week, we did Indonesia, the Philippines, right? Vietnam. We announced a whole bunch of deals.
Malaysia in that period.
So we did these whole bunch of deals. So that's like
that staircase.
And they were and because we negotiated them and assumed India was going to be done before them, I had negotiated them at a higher rate. So now the problem is the deals came out at a higher rate.
Right.
And then India calls back and says, oh, okay, we're ready. I said, ready for what? You know, it was like 3 weeks later. I go, are you ready for the train that left the station 3 weeks ago? So what happened is they just, you know, sometimes there's that seesaw and people are on just the wrong side of the seesaw. You know, when I was young in business and I was a trader. So one of my first jobs was as a trader. And when I would start on the wrong side of the seesaw, you know, I'd buy and it would go down. And then I'd sell, it would go up, and then I'd buy, it would go down, and sell. Like when you're on the right side of the seesaw, you can't lose.
Yeah.
You know, you buy, it goes up, and then you sell it, it goes down, and you buy, it goes up, and you sell, it goes down, and you feel like you're the king.
Yeah.
But when you're on the wrong side of the seesaw, what I used to do is I used to put the phone down.
We take your leave on this edition of Business Lunch. We leave you with the index trying to find some support at that 25,650 mark at the lower side, still nearing the levels of 25,700 as we speak. Midcap Radar on the other side.
Good afternoon. Welcome to Midcap Radar live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me, as always, is Vivek Iyer. And Vivek, we are only seeing lower lows for the day. We started on a high, but since then, there's been a sharp fall from the highs of the day. 0.7% lower on the Nifty. We are below the 25,700 mark. Mid-caps are participating. And at every level, we are seeing more declining stocks versus advances.
That's right. Good afternoon, Sonal. If you recall, yesterday we were talking about how the Nifty was managing.
Yeah.
Go ahead and maintain the 25,900.
Correct.
And today we have slipped well below the 25,700. So it's been a very sharp fall that we've seen across just in the last two trading sessions. And a whole host of stocks in focus on the back of material news flow that we've been tracking. So a lot lined up on the show. Let's start off with the top headlines. Markets continue to trade under pressure with the Nifty and the Sensex down over 0.5% each. Real estate and private banks are the top losers. PSU banks, defense and IT stocks gain. Mid-caps fall too, but relatively outperform.
IEX is off almost 10% from highs but remains volatile. Aptel defers the hearing in the market coupling matter to January 19th with no decision made in the case.
Waaree Renewable trades lower after the company receives a revised LOA for a solar project with reduced capacity. The commercial value of the project has been reduced to 1,039 crore from that earlier 1,252 crore.
And shares of Petronet Energy trade higher as JP Morgan upgrades to overweight trading on the stock, citing improved earnings momentum on better volumes, lower tariff impairment costs, and 5% tariff escalation. Okay, all right, those are the top headlines, and we've been talking about the market move since morning as to how they have been reacting to uncertainty ahead of US Supreme Court judgment on the legality of tariffs implemented by the economy or by the country on other countries. The Nifty, which is down right now, has seen a mild recovery, but other than that, there are no green shoots, so to say, in the broader markets. We do have the mid-cap index, which is down 0.5%, and across the board, big cuts. Realty index, that was an underperformer last month as well, and today again.
Today again, Gordon's Properties bearing the brunt of the selling pressure. As far as the realty space is concerned, one particular stock that slipped to the day's lowest point is IEX. Remember, the hearing has now been deferred to January 19th. So the next court hearing at Aptel will take place at Jan 19th. That particular stock, had an intraday high of close to 160, now below the 140 mark. But it's a good time to welcome Heymen Kapadia, Technical Associate from DR Choksey FinServ, for a quick technical check on the market. Good afternoon, Heymen, and thank you so much for joining us. Well, what do you make of the markets at current level? It's been a one-way fall that we've seen from the higher levels that we discussed just last week.
A very good afternoon to you, Vivek. Thank you for having me on the show. It's always a pleasure. Last week, we'd seen a breakout come in above sort of 26,277. The VIX on the last day, the PCR on the last day went through the roof. That suggested some trouble around the corner, but nothing like this. Event-driven market, Vivek, frankly speaking, it's Hobson's choice, catch-22 situation. There's nothing you can sort of pinpoint. But yes, 25,700 and 26,300 was a range for the Nifty for a few weeks before the breakout happened and fizzled out. So right now we're at the cusp. The level is 25,669, and we're just over there, frankly speaking. So if 25,669 breaks, there could be a spot of trouble. Having said that, it's oversold at supports. A bounce, I think, cannot be ruled out, but it's not very tradable. The VIX is up, nothing happening. Stocks look good, don't go up. So it's a tardy market driven obviously by geopolitical tension. So it's better to stay away, honestly.
Oh, better to stay away. So do you have all the sell calls then?
Well, Sonal, that would have been the order of the day. But if you're down from 26,300 to 25,700, so we're 600 points gone in 5 days, almost at supports. I will prefer to be the devil's advocate and give a contra buy call, because I think a bounce cannot be ruled out. Selling now would be a bit dicey. So I have a couple of buy calls, Sonal. Firstly, a buy call on Asian Paints at 28.40, stop loss 27.90, target 29.40, above the 55-day exponential moving average. Oscillators like the MACD, RSI have given crossover buys. The stock is in an intermediate uptrend and has given a 5-week correction. So we are playing for a continuation of its move. Secondly, this is a completely contra call, Sonal. Avenue Supermarts, DMart has fallen off a cliff, 4,900 to 3,600. We're on the verge of giving an upward key reversal. Deeply oversold, third round of positive divergence, volume spike, levels hold, crossover buys. So we are playing for a recovery, not a rally. So buy on DMart at 37.90, stop loss 36.90, target 39.90. So
Well, thank you so much, Hemant. Yes, you're absolutely right. After the steep fall that DMart took post the quarterly update, yesterday saw a bit of a bounce back. Today, too, has recovered quite smartly from the day's lowest point. But it's now time to slip into a short break. But before we do that, here's a quick note for our viewers. Get ready for CNBC-TV18's all-new lineup starting today. Incisive analysis, sharp commentary with CNBC-TV18's brand new offerings. Watch our news segment, Cut the Balance Sheet with Mangalam and Sonal Bhutra. Watch Macro Signal with Ritu Singh that isolates the macro forces that actually matter for the day. And finally, stay ahead of the curve with CNBC TV18's most trusted in-house technical experts.
Welcome back. In a weak market like today's, there are few stocks which are bucking the trend, and Petronet LNG is one of them. Now, remember, last week we got a note indicating there could be some regulatory risk. Keeping that aside, JP Morgan has upgraded the stock to an overweight. They have a target price of 335 because they're bullish on the earnings momentum, which is expected to improve for the company going forward. Three reasons for earnings improvement. They'll see higher volumes because of the capacity expansion that would come by at the H terminal, which is 5 million tons per annum. There's an expectation of a tariff hike as well of around 5%. And third, their impairment costs are expected to go down because most of their capex has been done in the last couple of years. And all of this would lead to higher earnings for the company going forward. Yes, there are still some risks because there is renegotiation of tariffs at the Hague. The fear is it could be lower than what was anticipated earlier. There could be some regulatory risk. And second, the company had announced some capex with respect to their petchem plant, and the fear is it would leverage their balance sheet. This has been a concern for a while and impacting the valuations as well. So JP Morgan says this inconsistency or this issue could continue for a bit. There could be uncertainty, but keeping that aside, earnings definitely will improve from here on, and that is the reason they are upbeat on the stock. It is up 2% in a market where the mid-cap index is down 0.7%. So earnings recovery is something that the street and the brokerage likes definitely.
Absolutely right, and outperforming, like you said, in an otherwise very weak and wobbly market. Winnie also joins in. Winnie, you're tracking BHEL as well as Parmec, both of them buzzing on the back of order wins.
Absolutely, both of them buzzing on the back of order wins. BHEL, now they've received a 5,400 crore order, and this one Bharat Coal Gasification Chemicals, which is a joint venture with Coal India. BHEL is one of those promoters. They hold around 49% stake in the company, so it's a related party transaction. It's all at an arm's length price is what the notification also highlights for us. This project has to be completed within 42 months, and there's an OMN, that's Operation and Maintenance Services, that will also provide, they will be providing for a period of 5 years. So important one for BHEL over there. As of now, holding on to gains of almost 1-2%. Powermac, that they've also received an award, and they've been awarded a BESS order from West Bengal State Electricity Distribution Company. One is establishing 1 gigawatt of this BESS, and there's an additional green shoe option of another gigawatt. So totally, if green shoe option is included, then the value of that would be around 3,126 crores. Without the green shoe option, it's around 1,500 crores.
Well,
okay, all right. But Vinny, it's been a busy day otherwise as well. Elecon Engineering results, a big fall there.
Absolutely a big fall there. So numbers were not anything exciting, right? Because revenue was quite muted. EBITDA was down by around 23% as well. Margin saw contraction, 19.8% versus 26.9%. Impact of higher employee costs, change in product mix is something that impacted the overall margins of the company. Apart from that, the profits of the company also saw a decline of 33%. The transmission segment, that saw a very muted growth, and that contributes to more of their business. So that is why we're seeing overall a muted revenue growth, while other than that, material handling equipment, that side saw a good growth of around 21%. But because the main part of the business, that's the transmission side, that's seen a muted growth of 1%. Overall revenue growth also has been at 1%. Now, order book stands at around 1,372 crores. In terms of FY26 guidance, the company has highlighted that FY26 revenue guidance may be lower by up to around 5%, as well as in terms of adjusted EBITDA margins also may be lower by up to 2% as well. So that is one more point that comes in there. So a bit of an impact on that front as well in terms of guidance, a bit lower there. So that is why we'll keep an eye out on Elecon Engineering going forward. As of now, the stock is clearly under pressure.
Absolutely. Thank you so much, Vinny. A very busy evening as well for you. Back of so much news regarding capital goods, TRIL and Elecon Engineering all reacting to the results updates that have come by. But one particular stock that's doing quite well from the power pack, and that is NHPC, India's largest hydropower company. Today, we had a report coming in from CLSA. CLSA, remember, has an outperform rating on NHPC. It's a high conviction outperform that they hold. And the target price for NHPC for CLSA is 117 rupees. What is it that they say? They say that 2026 NHPC's capacity can increase by close to 64%. And they believe that with this 64% capacity growth, NHPC can go ahead and deliver close to 90% EPS growth in FY25 to FY27. Now, what they're saying is that there are three key catalysts for NHPC. The first one, they believe, will be the final tariff order regarding Parbati 2 project, which comprises close to 25% of the company's regulated equity. The second trigger, according to CLSA, is the full commissioning of the company's second largest project, which is the Subansiri Low Hydro project, by the fourth quarter of 2026. And lastly, they believe that the award of 4 hydro projects and 1 pump storage project in 2026 will improve the visibility of growth until FY25. So no wonder then, CLSA has had a long-term positive stance on NHPC. It's a high conviction outperform that they have, and the target price quite lofty at close to 117 rupees a share.
Okay, some of the green-looking stocks on street today. So NHPC is one of them. High conviction pick from CLSA. But with that, we'll do one thing. We'll slip into another break. As we do that and we head into this break for the segment, just a quick heads up, if you're thinking about where the real opportunities for 2026 lie, Market Forum, the Alpha Generators for 2026 is where that conversation begins. The Alpha table awaits. Join CNBC-TV18 as we host the ultimate confluence of India's market movers. Tune in on 13 Jan, Tuesday, 4:30 p.m. onwards, only on CNBC-TV18.
Welcome back to Midcap Radar. Well, Vodafone Idea is the stock in focus after the Department of Telecommunication communicated to the company with details of the AGR relief. Rima joins in with the key details.
Thanks so much for that. Indeed, Vodafone Idea has received formal communication from the Department of Telecommunication on its AGR dues repayment plan, and it offers a long-awaited cash flow relief, and it marks an important milestone for the telecom operator because it's been struggling under severe financial stress now for years. So here is the first big key takeaway, that cash flow relief is almost for nearly a decade. The repayment structure significantly eases the near-term pressure, and bulk of the payments come in after 10 years. So here's how the repayment schedule looks like. For the first 6 years, the company has to pay a maximum of 124 crore rupees every year. Then for the next 4 years, the company has to pay a maximum of 100 crore per year. It's only after that, that's FY36 onwards, the AGR dues will be spread over a period of 6 years. So basically, for the next decade, the annual payouts remain relatively modest, giving the company enough time to improve its financial performance. After 10 years, the AGR-related outgo could stand at 14 to 15,000 crore on an annual basis for a period of 6 years because the deferred payments will now kick in. The second important takeaway is that they have said that they will be forming a committee to reassess the AGR dues, and that decision will be final. The question is, will this open a door for a potential recalibration of AGR dues? Because a committee is now going to be formed, though the timeline and outcome still remain uncertain. Now, when you look ahead to Vodafone Idea, I think the big trigger is this 25,000 crore of a bank fundraise. Now, what we've heard today, is that sufficient for the company to get that debt funding? Or because we still don't have clarity on the overall AGR quantum with that committee still to be formed, will that bank funding get delayed? I think this is important because without the bank funding, the company's capex plan, network expansion plan remain constrained. Also, when you look ahead, AGR is only part of the problem. The company also has spectrum liabilities, and they're meaningful. They stand at 1.2 lakh crore, and the annual payments are going to rise sharply. So next year, that annual payment stands at about 6,000 crore rupees, and this will increase to 26,000 crore by FY29. Now, according to IFL, the company may need an equity infusion, some sort of an equity fundraise to meet these spectrum liabilities and obligations. Beyond that, we always say the tariff hikes is the big trigger for the entire industry. When will it come? How much will it come? And can Vodafone Idea really close the gap with Jio and Airtel when it comes to market share? It's been losing subscribers, 5G coverage, premium subscriber mix. The question is, will Vodafone Idea emerge as a competitive third private player? Now, the other stock, which is a beneficiary, is Indus Stars. Now, here note that Indus Stars does not have any overdue receivables from Vodafone Idea. What Indus Stars benefits from is Vodafone Idea emerging stronger, its capex program and tower rollouts. Now, maybe the stock was sussing this because in the last 3 months, the stock went up 25%, Indus Stars. It's now about just 10% off from its all-time high level of 499. Back to you.
All right, thank you so much, Rima, for joining us with those important details. Markets further lower at the day's low. It's an 0.8% cut on the Nifty, below that 25,680 mark as well. So keep tracking market moves for you. For now, we'll take your leave. Your stocks when we return.
Hello, good afternoon. You've tuned into Your Stocks, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much, as always, for tuning in. In terms of the market, again, today has been a day where we're seeing a fall coming in for the Nifty. This full week, we've seen the Nifty actually in the red. Today also, we are seeing sharper cuts coming in. It's below 25,700 as of now, the Nifty 50, 25,682 to be precise. Down almost 200 points in the trading session. Trading at the day's lowest point is what the Nifty 50 is doing right now. Look at the broader end of the market. That too is seeing a decline. Mid-cap is down 5 to 6% in the trading session as of now. That's also the day's lowest point. And the Nifty small cap, that's seeing a sharper cut coming in. It's down 1.4%. So clear pressure is coming in on the small cap space. And the advanced decline ratio, look at that. That is clearly in the favor of declines versus advances. Yesterday also we had seen them in the favor of declines. They tried making that crisscross, but that clearly didn't happen, and a wide gap between the advances and declines. More than 2,200 stocks on the decline side is what we're seeing as of now. IT, that's the one that's managing to hold on to some bit of a gain in the trading session today, so let's watch out for that. And PSU banks, that's where some bit of a green spot is coming in as of now in the trading session. But apart from that, everything is trading in the red. But let's get started with all your stock related queries, and to do just that, we have our experts for today, independent market expert Shaina Mukaddam, as well as Nirav Chedda of Nirmal Bang Securities, joining us to answer all those queries. Shaina as well as Nirav, good afternoon. Thank you so much as always for joining in. Nirav, great to have you on the show as well. Let me start with a technical check in terms of the market as well. Today we are below the 25,700 levels. What should we watch out for if we close at these levels, which we're seeing currently?
Yeah, hi Vinny, thank you for having me. Good to be back. See, from a Bank Nifty perspective, no doubt some important support levels have been broken. But very importantly, the data is suggesting at a possible reversal. The nearest support for Nifty on the futures is around 25,620. I believe one can look to buy Nifty at current levels, and on some declines, you can keep a stop loss of 25,600 for longs and expect a reversal up to the 26,000 odd levels in the next couple of days. Believe some good buying will come in over a period of time now. From next week onwards, probably in the second half as well. Even for Bank Nifty actually, if you see vis-a-vis the Nifty, it is still outperforming. In fact, it is near its all-time highs, only about 1,000 point down. But definitely believe Bank Nifty will continue to outperform going forward. Very good support area for Bank Nifty is around the 59,200 levels on the spot. Expect some reversal from current levels. A lot of stocks are showing, short covering action over a period of time. There's very less open interest in some of the banks. That does tell us they are under-owned, and follow-up selling is unlikely in some of these banks. So definitely go ahead and buy Bank Nifty at current levels on the futures as well. Also on dips, your stop loss would be around 59,000. Expect 60,200 to come in.
Sure. Okay, thanks for that, Nirav. But let's get started with the stock-related queries then. The first query for today coming in from Nandini, who's writing to us from Chennai. She's holding 50 shares of Bata India. Price is 1,420 rupees a share. Wants to know whether she should look to average at current levels, because currently it's at 920. Considering obviously the stock has not done anything since the last 2 years. Shaina, good afternoon. What's your view for Bata India?
Good afternoon, Vinny. Good afternoon, everybody. Bata India, see, the stock has been coming off, like it's a one-way down last 5 years. But even at current levels, valuations are not attractive. And if you see the last first half performance, the margins have taken a big hit. Yes, there is expectation that the second half may be better because of the GST cut that the government has given for products below 2,500, which most of Bata's products fall under. But at the same time, I would not suggest averaging or adding at current levels.
Okay, you wouldn't suggest averaging or adding at current levels. Nirav, what's your view for Bata India? Would you suggest averaging as an option, sell, or just continue to hold?
See, in terms of Bata India, as China said, 5 years of underperformance. But the silver lining is on the chart looks like it is making a bottom kind of a formation, and probably it can come down towards the 850, 860 odd zone, which is a very good support area. But there's also a demand zone. I definitely believe there is positive divergence on the longer term RSI, and there should be some reversal which can come in probably later off in this month or probably the next one, and from there it can go up towards 1200, 1250 odd level. So in terms of averaging, I believe this seems to be a right level to average, and probably as it goes lower up to the 860 odd zone, your stop loss should be 840.
Okay. Surely we'll keep an eye out on those levels over there. Let's move on then to the next query. Kishore is writing to us from Pune. He's holding 8,000 shares of Sri Renuka Sugar. Price is 40 rupees per share. Now it's at 25. Wants to know if there's any chance to reach the value at which it is purchased at, or should he average or just book out his losses? Shaina, what's your view coming in on Sri Renuka Sugar? Because a lot of, the news flows that come in from the government side do impact all these companies as well. Sri Renuka Sugar, what's your view here?
Yes, Vinny, and one of the news flow from the government, which I'm looking forward to, which may come and give a positive boost to the stock, is the increase in price of ethanol, which is there on the cards. And if it comes, yes, it will be positive for Sri Renuka because they are the largest distilleries in India. The other positive is that the parent company Wilmar owns 62%, and it's a global company. It has got good trading of agri products across the world. Having said that, these are only all the positives that are there. The negatives are much higher, actually, in my view. Also, they are making huge losses. We saw in the last quarter first how big losses, which has actually wiped out the net worth. So, and the debt is high. So this makes it a very risky stock. So I would classify it as a high risk stock. There is some movement coming up. It's a small cap, some movement. But if you're looking to average, then you have to keep a very strong stop loss. And I wouldn't suggest averaging for this risky stock, but it's up to the investor.
Okay, wouldn't suggest averaging for this stock. Nirav, what's your view for Sri Renuka Sugar? Average sell? What should the viewer do?
See, I am holding a different view here. See, I am looking at the technical charts. There was Renuka Sugar, which was before 2021, and then there's something which is after 2021. The volumes have changed a lot in the last 4 or 5 years. You've seen tremendous amount of volumes which have gone in. No doubt the stock went up from 6 to about 66 odd, and then it has come down again. But it is at a very good demand zone, which is around the 25, 22 odd zone, and also volumes have picked up again after a brief lull. So I believe this seems to be a good time to add the stock, but again from a near to medium term perspective, which I believe this stock can move from here to about 36 to 40 odd zones. So you can average some shares here and book out when 36 odd levels come in. You can keep a stop loss of about 22 for your longs.
Okay, can keep a stop loss of 22. 36 levels is around maybe what one could watch out for in the short to medium term. Different views coming in on the technical as well as the fundamental point of view. Hope that answers your query there. Let's move on then to the next query. We have Shankar, who's writing to us from Bangalore. He's holding 100 shares of Tata Capital. Price is 360 rupees per share. Wants to know if he should continue to hold or sell Tata Capital. Bought it at the levels at currently which it's trading at. Shaina, your view on this one?
Yeah, it is close to the IPO price also. And valuations, in my view, are not expensive if you compare it to the peers. Tata Sons, of course, holds 85% equity. So you could see some more offering coming from there over the medium to longer term. But at the same time, given the funds that they have raised, I would say that there is upside from here. And in terms of actual balance sheet performance, it has taken some bit of a hit because of the merger from Tata Motors subsidiary, the finance company. But I would believe that over the next 1 to 2 years, that also could improve. So I would say it's a long-term investment stock that you can hold.
Okay, long-term investment stock that you can continue to hold. Nirav, I know not much in terms of charts because obviously it's fairly recent in terms of a listing. But the viewer wants to know any sell target. Is that possible to give or suggest for them?
Yeah. So, whatever chart it is, there was a brief consolidation, and there was a breakout above that 335, 340 odd zones. And, according to this breakout, the target is coming out towards the 390, 395 odd zone. So, from a near-term point of view, another 10% is what the stock can move up to. I believe, again, I agree with China. This stock can go up from here, a very good pattern at this point of time. So definitely worth holding. And if it comes down, add some stock around 345. You can keep a stop loss of 340.
Okay. Thanks so much for that. So long-term view, it's a better story, though Nirav has given you some of these target prices that you could keep as well. But on that note, we're going to actually step into a very short break. But here's a quick note for our viewers. Get ready for CNBC TV18's all-new lineup starting today. Incisive analysis, sharp commentary with CNBC TV18's brand new offering. Watch our new segment, Cut the Balance Sheet, with Mangalam and Sonal Bhutra, as well as watch Macro Signals with Ritu Singh, that isolates the macro forces that actually matter for the day. And finally, stay ahead of the curve with CNBC TV18's most trusted in-house technical experts. Welcome back to Your Stocks on CNBC TV18. We still have with us our experts for today, Shaina Mukaddam as well as Nirav Chedda, to answer all your stock-related doubts. Next query for today is coming from Ganesh, who's writing to us from Bangalore. It's a more of an investment query. He wants to know if he can accumulate SBI, Maruti Suzuki as well as HDFC Bank, three stocks he's looking at for the long term for more than 5 years. Shaina, your view?
We don't have his full portfolio. So if these are the only three stocks that he's going to be looking to add, I would suggest instead of adding two banks like SBI and HDFC Bank, Take one of them. Let us assume I would prefer an SBI as of today for let's say the next 2 to 3 years. But even HDFC Bank, if you're choosing that as a good stock to hold in your portfolio, SBI, because valuations are very attractive, in terms of price to book, in terms of their net return ratios, those are very attractive. NPA is also pretty low, the net NPAs. Now, in terms of Maruti also, I believe they are becoming pretty aggressive in their EV launches. And if you look at a 5 year, if you're a long-term investor, 5 year, they're planning to double their capacity. So I would say Maruti, while slightly expensive in terms of valuation, you can add it at dips and hold it in your long-term portfolio. And I would say that so now the third stock, if he's got to add, I would say add something in metals. So here I would suggest something like a Hindustan Copper, where while we have seen some bit dip in copper prices, the LME prices, but at the same time, I think if you're looking at a 3 to 5 year horizon, that could be one more stock that you could add to your portfolio. So you have a mix of different sectors.
Yes, absolutely. This is if, this is the only ones he's holding. But yes, China has given her suggestions. A mix of portfolio in your portfolio also makes it better as well. Nirav, your view on any of the names, SBI, Maruti Suzuki and HDFC, all this for the long term?
See, on the charts, if you see, from a long-term perspective, I also hold the same view that, two banks shouldn't be in the same portfolio. As of now, the chart of SBI seems better. It is well placed and, above a breakout level while HDFC is consolidating. So there is good chance that SBI will move up from here, from a 2 to 5 year perspective. So you can accumulate that. And Maruti looks like, it's at the higher end. So don't buy everything, at one go. Probably start from today and, in the next few, months. Whenever it comes down, add more. So from a 5 year perspective, I like SBI and Maruti.
Okay, SBI and Maruti, that's a view there coming in even from Nirav. Let's move on then to the next query. We have Rekha who's writing to us from Riyadh and she wants to know if it's the right time to buy shares of VST Industries and hold it for a time period of 2 to 3 years. She is also already holding 300 shares of ITC at a price of 209. ITC Hotels, I beg your pardon. Yes, ITC Hotels is what she's holding at 209. Wants to know if she can add more of these shares, 700 more of the shares of ITC Hotel. Shaina, your view?
See, now VST and VST Industries and ITC are the same classification of sector. They both are in cigarettes. So, adding VST if you're already holding ITC doesn't make any sense. Even if you look at pure cigarette valuations for both of them, I think while VST looks optically cheaper, I think if you just take the cigarette valuations of both of them, they both are on similar.
Shaina, she's asked on ITC Hotels, not ITC. It's ITC Hotels. VST Industries and ITC Hotels now she's talking about.
Yeah, so VST Industries, I wouldn't suggest to add.
Okay.
And or a switch from ITC. I would prefer ITC over VST.
Okay.
And ITC Hotels, yes, if you want to see at current levels, selling ITC and getting into ITC Hotels, I don't think makes too much sense. But I personally am invested in all of them. So so I would say that yes, ITC Hotels is also good. They're expanding 13,000 room keys, which is going to go up further. But they are also have got very aggressive plans. But as of now, I would continue holding ITC because all the negative news has seen the stock correct such a lot. You could look to add ITC Hotels, no issues if you've got surplus funds.
Okay, can look to add ITC Hotels if you've got surplus funds. So that was also their doubt that should they add more ITC Hotels, then you could look to add that as well. But VST Industries, Shaina is saying avoid. Nirav, your view, VST Industries, ITC Hotels on the charts.
VST Industries has been consolidating in the same range from the last 6-7 years, from 2017 in fact. Only once there was a range breakout and then again it came within the range. So I don't think one should be buying this stock at this point of time. Don't see much upside coming in here very quickly as well. Whereas ITC Hotels, yes, after a brief upside, this has started to come down in the last 6 months or so, but it is coming to a very strong support zone of around 180 180 to 185 odd levels. Once it comes there, that is when you add more stocks at this at that point of time. And post that, I believe this can go up towards 225 to 30 odd levels, probably even higher, but that's a resistance zone. So yes, ITC hotels you can add at lower levels, but VST industries I would say avoid.
Okay, VST Industries avoid. ITC hotels can look to add. The Nirav has mentioned the levels over there as well. Next query, Mukundan is writing to us from Ooty. He's saying that his wife is holding 1,227 shares of BSC. Average price is 64 rupees per share, and he's holding 378 shares of BSC, and this is at a price of 372. So they are very, very long-term investors, clearly getting the benefit of long-term investing here. Should they continue to hold or book profit, Shaina?
Not really very long-term investors, Vinny. In 2021, 22, I had given this as my Diwali pick in a lot of channels, and I also personally had bought it at that time. So the average price that he has given is just over a four odd year, or maybe at best 5-year period. So valuations currently are a little bit on the higher side. I would say not little bit, it is expensive, but I would still say continue to hold, because we saw the first half, the numbers were, we had expected some bit of impact on the change in date of the expiry, but we did not see any impact of it. The profits are doubling on a 50% revenue increase. So I would say it would take 2 years, maybe 2-3 years for the valuations to start looking interesting, attractive. You have NSE also that is on the cards to list on the next 1 year. So I would say hold unless you need the money. There's no point in switching.
Point in switching there. Okay, and Nirav, what's your view for this one?
See, there is on the chart, as you've already discussed, this stock has really come up from 30 odd levels to about 3,000. But now there are signs of exhaustion on the charts. There's a negative divergence on the longer term chart as well. So I would believe that one can, look to book some, 20-25% profit at current levels. But other than that, this might take another 6 to 8 months of consolidation. Once it comes to 2,000, that is when you start to add again. But as of now, book some profits.
As of now, book some profits. Okay, next query, we have Balakrishna, who's writing to us from Udupi, holding 680 shares of SAIL, price is 125 rupees per share. Shaina, what should they be doing with SAIL?
Here again in metals, I would prefer the non-ferrous over ferrous.
Okay.
So I would say SAIL, while in terms of pure valuation, 1 year down the line, it's about 7-8 times EV to EBITDA. So it is not too expensive. But I would see the period of consolidation in current levels, time-wise stock correction to be there. Because if you saw the numbers, like, they are being impacted. They were impacted in the first half by a huge dip in the steel prices. The government has imposed, has given them the leeway of they have got, I think, support prices support duty that has been introduced, which is supporting a price increase in steel, domestic steel, which next year, FY27, could see an improvement. So I would say, I would still prefer Hindustan Copper over a SAIL.
Still prefer an Hindustan Copper over a SAIL. That's over there. But that was the last query for today. Shaina as well as Nirav, thank you so much for joining in and helping our viewers solve all those doubts that they have sent. Thanks so much for that. And viewers, before we just wind down, we have some update that's coming from Reuters. Sources saying that RBI has raised some objections to Bain Capital's plan to acquire a controlling stake in Manappuram Finance, and Bain Capital was actually exploring phased divestment in India's Tiger Capital to address the concerns of the Manappuram deal. But let's keep an eye on that. As of now, the stock is down 6% in trade. But with that, we'll wind down this edition of Your Stocks. Thank you so much for tuning in. Up next, you have Closing Bell to take you through the last hour of trade.
to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Now, it's a mixed picture, as we were just highlighting in the headline as well. The Hang Seng is flat as flat can be.
US equities are mixed. Actually, it's not so much price action once again from last night.
Well, the Aptel is all set for a hearing in the IEX case.
First rates starting to come through. The Nifty is absolutely flat.
We are in the middle of a raging global equity bull market.
Our main focus will be by increasing the underground production.
Their cash flow payouts on the AGR matter will be not more than 125 crores.
They were uncomfortable doing it. So Modi didn't call.
Well, markets are in a wait-and-watch mode. It is a dip if we talk about overall equity flows on a month-on-month basis.
Vodafone Idea has received formal communication from the Department of Telecommunication.
Well, high voltage, high drama here as far as the Aptel is concerned.
0.7% lower on the Nifty.
Well, that was the day so far. Hello and welcome to Closing Bell. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Reema Tendulkar. With me is Nigel D'Souza. Flat to begin trade and down 200 points as we're wrapping out the day and the week. 1 hour to go. But it's been a tough last two trading sessions. The Nifty is now at 25,650, a fall of more than 200 points. Sensex lower by 600 points. And look at that advanced decline ratio. Yesterday as well, I think nearly 1:5, and today 1:4 on that. 2,400 stocks in the red.
And yet another trading session, Reema, where you're not seeing even a 20-30 point bounce actually. You know, that's the kind of selling that you're seeing. Maybe a lot of nervousness getting into this weekend because of the big global cues.
But I mean, Europe is up. Asia didn't have a difficult session.
Right.
If I'm just checking the European rates, if that was the case, we wouldn't have about a 0.5% green on the European indices.
Yeah, I don't know whether the FIs are back with a bang because the net sell number goes on creeping up on a day-to-day basis. They're underweight on the Indian equities as it is, selling in the cash market and aggressively net short. Something's got to give. You know, at least some kind of a near-term bounce is what we need to see. Sustainability is going to be obviously questioned because now we're about 400 points away from the 20-day MA on the Nifty itself. And today the problem is even the Nifty Bank has broken the 20-day MA. That's a bit of an issue. So technically, a bit of a breakdown is what we are seeing, but a relief rally is what the hope is for.
Yeah, ICICI Bank, which was holding up the markets for the last 4 trading sessions, has cracked today. So that's down 2%, and it's putting pressure overall on the Nifty banking index, which is down nearly 500 points. And HDFC Bank, I think this would also be the 5th consecutive session, along with the Nifty, when HDFC Bank is weak. So HDFC Bank has lost 6% plus so far this week. Maybe to some extent, the street is disappointed with, when you hear the comments from the Commerce Secretary and why the deal didn't happen. Maybe there is some element of that over there. But let's also tell our viewers what's on the show today. 1 hour to go. Markets under deep pressure as geopolitical and trade worries persist. The Nifty is now given up 25,700. Most sectors except IT, energy slip. Broader markets fall in line with the frontliners. Shares of IEX under pressure as Aptel defers the market coupling hearing to the 19th of January. CERC also clarifies it is not proceeding with coupling without the regulation. Vodafone Idea was higher 10% at open, but has come off sharply even after it received the government's approval for repaying its AGR dues over an extended period of time. The stock has slipped 2.5%.
All right, how do you position yourself in the last hour of trade? Siddharth Rai Mangla of Stockbox Technologies joins us on the show with some closing strategies. Hi, Sid. Not looking too good, right? 5-5 actually for the Bears. They had a rocking week. Do you think some kind of a relief rally is what we could look forward to, or do you think we're going to slippy slide a little bit lower? Where does support come in at? That's important.
Hi, Nigel. Good afternoon. And see, Nigel, if we talk about Nifty, the manner in which this fall has come in the last 2 sessions, especially, it tells us that there is clearly some panic on the street right now. And also because we have not seen any substantial bounce back attempt on the index in the last 2 sessions. Now, on one hand, this is exactly where the next support for Nifty should be, 25,650, 25,625. But having said that, I would say it is much better to sit on the sidelines for now and not to go contrarian for a relief rally on the index even now, because the move from here will clearly be depending upon the global updates, which will be coming up, over the weekend. So it is much better, though we are around a very important support on the index, but it is still much better to be sitting on the sidelines for now and to wait for things to be more clearer, at least for the index.
Avoid the index, wait and see how this plays out. In any stocks on your radar, Siddharth?
Yeah, sure. Hi, Rima. See, two stocks. I think it is much better to keep a balanced approach in a market like this. So, one stock to buy and the other one to sell. First, the stock we should be buying here is NHPC. See, this stock has shown a lot of resilience in a market like this because even today the stock is positive. We saw a very big breakout in last week in this counter, and now I think the follow-up move can be seen in NHPC in the coming days. So NHPC can be bought right now. The spot is trading around 82.8, 82.9. We can buy it here. The stop loss will be at 78 and our targets being the first target 89 and the second target being 92. The second stock is, and this one we have to sell. The second stock is HAL. See, the initial opening in this counter was decent today, but suddenly we have seen a sharp correction from, the 45, 40, 45, 45 levels. A strong resistance was faced there. So I think a fresh downside momentum is beginning in this counter. So HAL we can go short on this one. Right now, the Jan futures are trading around 44.63, 44.65. We can short them here, and the stop loss will be at 44.90, 44.90, and our targets being the first target 44.20 and second target 4400.
Okay, all right. Thanks a lot, Sid, for that. Well, let's focus on IEX. The stock is down nearly around 5% as the hearing over, the market coupling case concluded with Aptel setting the next date for 19th of January. Ashmit joins us to give us an update on that front. Well, Ashmit, the street was hoping for some kind of relief for IEX. That wasn't to be. I think the stock is down close to around 8% now.
Well, indeed, a high voltage case. In fact, the one question that was hanging over today's hearing is whether or not there will be a withdrawal of the coupling order altogether. Bear in mind that just in the previous hearing, the counsel for the CERC had said that he'll go back to the commission and ask for clarity on whether there's any scope for withdrawal. Given after today's hearing, we're given to understand that there is no withdrawal of the coupling order, at least not as of right now. And going forward, what the CERC's position is that they will move forward with the framing of regulations, but the assurance that they've given is that there can be no implementation of the coupling mechanism without the regulations that have been framed, that are likely to be framed. This was in fact taken note of by Aptel as well. Aptel said that the understanding that they've been given by the CERC is that there can be no implementation of the coupling mechanism. The rules are yet to be framed, and until the framing of rules, there can be no implementation. That as far as regulations are concerned, that in itself is an independent process. And if the exchanges have an objection to the regulations and the way they've been framed, well, that's another objection, a fresh concern that can be raised at a later date by the exchanges, depending on how the regulations are framed. So clearly, some middle ground sought to be found by Aptel as far as this issue is concerned. But for now, the bigger takeaway being that after the indication given by the lawyer, by the commission last hearing, no withdrawal of the coupling order. Instead, the CERC has turned that order into a direction and saying that the CERC is eager to move forward with the framing of regulations. The next hearing in this case, we understand, will be on January 19th.
Okay, all right. Got that. Thanks a lot for that, Ashmit. So we have a date with Ashmit on IEX on January 19th. The street was hoping for the relief. They expected things to, get cleared today, but that wasn't to be. Gurmeet Chadha, managing partner and CIO at Complete Circle, joins us on the show. Hi, Gurmeet. Good afternoon. Good to see you win. First time we're chatting this year. So wishing you, team, family, rocking 2026. Not so rocking for the markets. In fact, it's been rocky for the markets, actually. What's your view on a stock like IEX and other exchanges as well?
Thanks, Nigel. See, I think till the time regulatory concerns are there, I think it's an avoid because, there was one view which said that if the market coupling gets delayed because there are a lot of practical challenges in implementing, especially the DAM segment, the market coupling thing, and it may continue to gain. It's an experienced management there. But looks like what has happened over the last couple of days, I think the regulator seems to be, which is CRC, seems to be clear. So avoid in my view. Although if you see last quarter, the numbers are pretty okay. The DAM volumes were up. Only the dip was in the renewable energy certificates, which saw a dip. Otherwise, operationally performance was decent. I did almost, I think, if I'm not wrong, 1,500 crore revenue. So the better exchanges, as you rightly said, I think the market exchanges, the capital market plays offer a better play. Something like even NSE and unlisted now trades at about 30 times. Then you have so much surge in commodities, which an increase in volume there. So I think the capital market plays are better. And as long as the regulatory overhang continues and legal recourse continues, I think it's an avoid.
Okay, what about Vodafone Idea, Gurmeet? I mean, the relief is quite significant. At least for the next 10 years, the company's outgo is going to be modest. They're talking about 124 crore for the next 6 years every year. Thereafter that, 100 crores for the next 4 years. So at least for the next 10 years, there is going to be significant cash flow relief. And initially, the stock reacted positively. It was up 10%. But now as we speak, the stock is down 2.5%. So can you explain what's going on in the market's mind to make sense of this move?
I think it may continue as a going concern, Veema, but look at the overall debt picture. I mean, so one, obviously, in terms of getting some relief on AGR is one. AGR would be 80,000 crores odd. The overall debt is upwards of 2 lakh crore. And they continue to lose consumers. In fact, they've lost more than 50% since the time the merger happened. I think 42, 43 crore, I think down to about 20 crores. So I really, it needs massive capital infusion. More than capital infusion, it needs a good strategic investor, and that will not come without equity dilution. That's my humble view. While the government is clear that it doesn't want a duopoly. So what it may be good from a debt holder's point of view. People are holding Vodafone bonds or banks who have exposure there, and it may allow them to raise more capital also. I don't think so. There is much, to be honest, from an equity shareholder point of view as far as long-term wealth creation is concerned. And I think look at last 5 years, people have missed Bharti Airtel, thinking that Vodafone at some point will turn around.
Yeah. And not to forget, the spectrum liabilities are also large. So AGR dues aside, Vodafone Idea has spectrum liabilities to the tune of 1.2 lakh crore, and those dues have to be paid. So I think for FY26, the spectrum liability, outgo is going to be 6,000 crore rupees, which goes up to 15,500 crore according to IFL by FY28. And further, in FY29, it stands at 26,000 crore rupees. So that liability has to be paid. And in the past, what the government had done is they had converted part of those dues into equity. But now they're already at 49%, so they can't do that. Yeah. So as, Gurmeet was also saying, and Balaji of IFL, that maybe they will have to raise some cash, equity funding. But the last FPO guys haven't made any money because that FPO happened at 11 rupees roughly. So what happens from here on is going to be crucial. But what about Industars? Industars is up 20-25% in the last 3 months, and it's now just 10% away from its all-time high level. Is that a viable play?
I think some of it has probably played out, Yuma, as you rightly said. So that was the concern. It's a going concern. It obviously benefits somebody like Industar. But as I said, telecom structurally should be played through Bharti. Maybe quasi play can be Jio. The ARPUs are likely to go up. I think there'll be some tariff hikes. It is generating 30-40,000 crores of free cash flow. So incremental debt keeps coming down. And incrementally what you pay for, let's say, next 5G, 6G, is lesser than what you have been paying. So capex intensity lower, more free cash flows, business more or less settled. I think that's a better, steady way to play. Less cyclicality in earnings. So we have Bharti as one of our top holdings as far as we are concerned.
All right, Gurmeet, what about from the frontline names? You have Shriram Finance post the deal. The stock went one way to more than 1,000 rupees. It's pulled back considerably now from the top. You have HDFC Bank as well. Last few trading sessions, there is some selling that's come about on HDFC Bank. So your view on both these two names in the banking and financial space?
So I'm actually a little surprised with some of the pressure which has come on HDFC because I think after merger, a long time, they've actually started doing double-digit growth. CASA seems to be building up. Issues on, the LCR seems to be behind. But, when you have a balance sheet of that size, which is 26-27 lakh crore, you cannot grow at 17-18%. And that's the reason you were valued at 4-5 times price to book. Now, if you grow at 12-14%, you will be valued more at what the current multiple is. So it's a steady large cap bank to be in. And financials are something where earnings are likely to be better. Maybe NIM should be a little flattish this quarter and may start improving from next quarter. But you are better off in something like a federal bank where there is fund infusion, valuation. Obviously now it has gone up, but there's a little bit more valuation comfort. Some of the NBFCs which will benefit from overall pickup in consumption, whether it's Shriram, whether it is Chola, whether it is some of the better rated ones like Poonawalla or Jio Finance. So we have Jio Finance, we have Federal Bank in the portfolio, and then we have the steady ones, which is ICICI and HDFC.
Overall, what's happened in the markets today? I mean, what is the complaint over the last 2 days?
Nothing new. I think it's related to the event of another tariff coming, and I think it's the same thing. Its market has been in a range. I think the bigger issue has been supply, both FIs and promoter supply. I think the promoter supply has obviously tapered off and will taper off as the sentiment is relatively weak. I think the FI supply is an issue. So if it's 3,000-4,000 crore a day with short position, you can't do really much. So I think we'll have to wait. I think budget could be a trigger. Probably today's judgment could be a trigger. My personal hunch is I think market looks very oversold to me. I know there are a lot of valuations and other stuff which has been given, but India seems to be an outlier, and I think looks like overdone to me. But market can remain irrational for much longer than we may think.
Was the sell-off in trend overdone, or is the sell-off overdone over the last 12 months, what we've seen? Because you've tracked it in the past, you've liked it. Is it still a part of your portfolio?
A very small part. So basically, as I said, same thing, which I said about banks. From 30% growth, you're down to 17-18%. You will not get the same multiple which you were getting. So a bit of a de-rating happening. And I think this is a price where the market is pricing in 15-20% growth. If they can demonstrate higher growth with better store openings, better unit economics, maybe it makes the case. But it will probably give you market returns if the growth is 15-18%. Don't see much downside from these levels.
But did you bring down your holding in trend over the last few months? You've been selling?
We started adding when it came sub 5,000 Rima in the portfolio. It could be, I think, less than 1.5% in the portfolio.
You added at 5,000?
Sub 5,000, yeah.
Okay, all right. Well, let's focus on another couple of stocks then. Gurmeet, stay with us. Petronet LNG. That stock is upbeat in trade, actually, one of the relative outperformers. This comes on the back of a JP Morgan's bullish note today. In fact, it's an upgrade. Let's go across to Sonal, who's here to give us all those details from that particular brokerage note. Sonal?
JP Morgan is bullish in Petronet LNG for a number of reasons, on the back of which they have upgraded the stock to an overweight, increased the target price as well to 335. The main reason is earnings momentum, which is expected to pick up because of three reasons. The first one, that they'll see a capacity expansion, because of which they'll see better volumes. Capacity expansion is expected at the Dahej plant of 5 million tons per annum, and also there's an additional hope of increase in tariffs at Dahej by 5%. So these two things will lead to better earnings for the company. The third reason is lower impairment now, that because maximum capex has been done, and that would lead to lower depreciation, lower impairment, which basically means lower expenses on the P&L. However, there are some risks. The potential renegotiation of the Dahej tariffs, which is undergoing. They had spoken about a big capex for their petchem plant, and that is something which could leverage their balance sheet, and that was something that the investors did not like so much. But JP Morgan says this has been going on for a while, and that will continue to be the case. But earnings upgrade or earnings uptick is something that makes them bullish on Petronet LNG, on the back of which the stock is on our radar today.
Thanks a lot. That explains why Petronet LNG is the one that's in fact doing better. Gurmeet, any view on this name?
Nigel, we are more comfortable with some of the developers in the energy sector and the power equipment systems like CG Power. We have Hind Rectifier in the portfolio, which is more making transformers for railways and now trying to diversify into PCBs and other segments. And I think we will have, maybe the budget will have it, or maybe outside the budget, we will have a new electricity bill, which will usher in more power reforms. So if you see in transmission now, which is the biggest bottleneck today, the government capex is almost 40-50%. The state capex is 35-40%. The private lines are hardly 7-8%. And this is because some changes need to be done, both on the commercial side, which something like a power grid enjoys, and also from reforms perspective. Just 3 discoms are are in the green, which is, I think, Gujarat, Karnataka, and Maharashtra, if I'm not wrong, or Tamil Nadu, one of them. So I think you will see more reforms, and that could lead to a bit of a re-rating in the entire sector. But as I said, we are focused more on power equipment and the developers as far as both renewable and non-renewable is concerned.
Got it. All right, Gurmeet, thanks a lot for that. Well, let's run you through all the big earnings that are coming in the next week. HCLTech, we have Infosys, HDFC AMC, HDFC Life, Big Boy, Reliance Industries, Wipro, Tech Mahindra. So my co-anchor Rima is going to be extremely busy in the coming week. Rima, enjoy the weekend.
Yeah, and following that, you've got, I think, ICICI Bank, and I think HDFC Bank is on the Saturday following that. So lots of big earnings coming up next week. We will slip into a break on that note. On the other side, Tushar Pradhan of Hexagon Partners will join in. Stay tuned.
Welcome back. Well, keep an eye out on some of those frontline Nifty names. Jio Financial, that's seen a big downtick. Shriram Finance, another stock that's taken a sharp downtick. And TCS is getting a little bit nervous ahead of its numbers. So I think, all those three big boys are seeing, a bit of pressure. On the flip side, Cupid actually, some protection out there now. That's in fact moved to the high point of the day. Cupid now up close to around 5% as we speak. But clearly something is worrying the investors of transformers and rectifiers. The stock yesterday was down 8%. Today it's down another 5% as we speak. Transformers and rectifiers comes up for you on the screen. Well, let's get in, I think, some some sound bites that we got earlier today. We were joined by Vikas Kumar Jain, India strategist and head of India research at CLSA. He gave us his outlook with regard to the markets, sectors and themes that he likes. Let's listen in.
Not expecting any fireworks. Relatively muted performance is likely in 2026. But the focus would be in areas where lower for longer rates, a big push towards consumption. We have our favored overweights are consumption, real estate, and IT. See, I think the setup that we have is perhaps we continue with the global bull market. And in that setup, there is no real requirement for us to, maybe the chances of sharper correction in India goes away. So we are in this gradual derating period where multiple keeps coming down, and that's where returns will be perhaps lagging earnings growth. High single digit could be a good case.
Okay, and let's get back to the other big story that's been plaguing the Indian markets for now close to a year, and that's on the India-US deal. Well, we got some interesting comments coming in from the US Commerce Secretary, Howard Lutnick, when he was speaking at a podcast, All-In podcast. And the assumption up until now was that maybe it was on account of disagreements on the policy side, agricultural issues. But maybe that is true, which is why India didn't come to the negotiation table immediately in the timeline given. But, there is another angle as well, which he sort of explained about the way Trump conducts his business, and it didn't agree with the way India wanted to do it, and that resulted in a bit of a policy misstep, perhaps. Listen in to, a snippet of that. Very interesting.
Everybody asked the president, who do you think is next? And if you look back at the time, he talks about a variety of countries, but he names India a couple of times publicly. It's not like a big secret. And we were talking India, and we told India you had 3 Fridays.
You put them on a shot clock.
Well, they have to get it done because what happens is I have lots of other countries, and when those other countries do their deal,
the staircase goes up.
And now the president, during all these deals, he would refer to me as the greatest table setter who ever lived. Okay, because you've never had anybody who is as successful as me as a businessman before, who's just the table setter. That's basically, so, because what I would do is I would negotiate the contracts and set the whole deal up. But let's be clear, it's his deal.
Yeah.
Okay, he's the closer, he does the deal. So I said, you got to have Modi. It's all set up. You have to have Modi call the president. They were uncomfortable doing it. So Modi didn't call.
Wow.
So that Friday left. In the middle of the next week, we did Indonesia, the Philippines, right? Vietnam. We announced a whole bunch of deals.
Malaysia in that period.
So we did these whole bunch of deals. So that's like...
that staircase.
And they were and because we negotiated them and assumed India was going to be done before them, I had negotiated them at a higher rate. So now the problem is the deals came out at a higher rate.
Right.
And then India calls back and says, oh, okay, we're ready. I said, ready for what?
Well, an insight into where the trade deals have been done by the United States. Tushar Pradhan, Director of Hexagon Partners, now joins in. Tushar, this podcast, this bite from Howard Lutnick is making all the headlines. What are your initial comments and what is your takeaway?
Well, I think everyone is kind of observant of what's happening. I don't think anyone needs my comment to add on that. I think we've been dealing with this trade uncertainty for quite some time, and I think that's been telling on the markets. That is what my focus is really on. And I think if at all over a longer period of time, it's a distraction. We all know that the story that India fundamentally has is really significantly multilateral and over a significantly long period of time. So in case there are some hiccups along the way, that could be due to either the trade situation, either any geopolitical situation that happens. I think these are things which are something that we all need to accept that they will happen. And I think I'm pretty constructive on the fact that given all of what is now under the table, we will progress towards some sort of an agreement in the coming weeks. So I'm still pretty hopeful in spite of what we may have done.
I'm with you, Tushar. But what's happening? Why are the market so nervous? You know, you can't. 2025 we underperformed, and we thought 2026 maybe, you know, things will look up, and hopefully they do turn out in favor of Indian markets. But the start has been very brittle for our markets. 5 trading sessions this week, all 5 were down. Broader markets, you know, stocks have fallen quite a bit as well. There is pressure. The FI sell number as well is perking up a little bit. Hopefully participation is not fully back and there is some reallocation by say Jan 15th and we see some flows. But what's going wrong? I mean, valuations are actually relatively better than maybe 18 months ago.
Yeah, I think you hit the right spot when you said valuations are reasonable. What tends to happen is if you look back on the year 2024, valuations were unreasonable. So essentially, there was a lot of euphoria, a lot of expectation in terms of earnings growth, which is likely to follow. And as a result, the market kind of traded at multiples which were significantly higher than average. Over the last year, we've kind of got tempered to the fact that we now believe that maybe the valuations are reasonable. But I think the way the markets goes, they kind of swing to the extremes on each end. So while we were extremely expensive some time back, we are reasonably valued today. There's no guarantee that we will not go slightly below average as the things move along. So I don't think that's anything surprising there itself. The market doesn't have to rationally follow where the earnings are. But I think if investors focus on the fact that 2 or 3 things are going in their favor, you've got possibly every multilateral agency upgrading India's GDP, not only for FY26, but well into 27. You've got earnings growth, which is really picking up. So you see the numbers going forward in this quarter and the quarter afterwards, and into the first 2 quarters of FY27. I think you'll see a significant impact of the capex, which is going to take place in the next few months or so. And as we see, it's already undergone some of it. And I think that is where the number will start showing. So over this period of time, if the PE derates, you're going to have a flat market. If it derates significantly, we will actually have a market which might even go down from it. But I think if the hint of earnings growth sustaining over the next few quarters and into the next year comes through, compared with whatever positive changes there might be on the sentiment, I think we've got a pretty good year coming ahead of me for us. And I think that's something which is pretty positive to expect from here on.
Domestic investors do seem to believe retail investors because the SIP inflows continue to be rock solid in the market, 31,000 crore in the month of December, and that is a new record. So at least they are keeping the faith in India and the fact that things will get better in 2026 versus 2025. So fresh money allocation, Tushar, where's it going?
I think there is something to be said for valuation adjustment across. So I think a little bit of rotation back into big banking. It already has seen a little bit of an uptick right now, but I think the valuation remains fairly attractive to me. If you look at capital goods, because on the back of possible private capex coming in pretty strong into the next few years, I think we will definitely be reallocating towards some of these plays. We also like consumer discretionary a lot, in the sense that the GST impact is not going to be just one quarter or 1 year, but I think it's a pretty significant reset for consumption as a broad category going forward. And I think we focus more on the discretionary consumption rather than the FMCG consumption. But I think over that period, I think the affordability factor, the continued increase in penetration for some of these discretionary products will be the focus for India going forward. So I think that's a very logical place to be. We also like some of these plays which are specialty chemicals, which have been a little bit under the cloud for almost a year or 2 now. But I think with crude coming down, I think the margin situation here may look pretty attractive, which was the cause for some of the problems in the past because these specialty chemicals could not hold on to the price. The margins came under pressure. But if raw materials were to supply you with some sort of a boost, then I think some of these companies which have tempered valuation increment also can be attractive for fresh investment allocations.
Tushar, in the discretionary pack, what did you say? The specialty chemicals I got, discretionary pack, what are you all drilling it down to? Autos or?
Specifically, nothing really apart from the fact that you have autos, which is a very large part of discretionary spend. We also find that there are a lot of appliances companies which have really underperformed last year for whatever reason. You can call it seasonality, you can call it fatigue, you can call it whatever. But I think with the GST cut coming in, we're probably going to see an uptick in some of the volumes going forward. One has to, of course, balance that with what valuations they play at. But we've seen the volumes pick up. We've seen the auto volumes come through. And I think the rest of the discretionary pack also will supply some numbers as we go into the first 2 quarters of the next year. So I would broadly look at it from an appliances / consumer discretionary, which kind of goes across the board. I would also include a little bit of construction equipment, tiles, the kind of home improvement sectors, which also kind of took a little bit of a back seat last year. I think those could also be looked at in fresh allocations.
Is there a commodity inflation risk, Tushar, in any of these consumer discretionary stocks? For instance, like a couple of days back, there was a bit of a scare, say, on Maruti's margins. And one of the factors could be the commodity rise that we've seen, especially quarter on quarter. I mean, is that a factor that you all are assessing in the estimates? And if yes, how significant will it be?
I think one of the largest industrial commodities that everybody focuses on is crude oil. And for whatever is happening, I think the tendency for these prices to go up is significantly, I would say, restricted. If at all global oil is going to possibly be a lot more in supply. The last few days, of course, Brent has gone up, but we were talking about significantly low prices from where we were talking about them 2 years ago, where crude was in at $80, etc., and threatening to go higher. We are now significantly lower than that. That, as an impact, creates a significantly lower cost structure across a wide range of companies because there are a lot of derivatives coming out of oil. So I think industrially, I think the margins are significantly in our favor when oil comes down. When it comes to metals and the other commodities that we are talking about, that's purely a play for the consumer demand for such products, as well as the kind of capacity that people have built over time. I think there as well, while there might be some marginal increases, there is significant capacity available across the mining sector. There have been investments as well globally across the board. As a result, I would think that I wouldn't bet on a commodity surge. Nothing as what we saw when China actually came into the market in a big way so many years ago. That kind of commodity super cycle is something which is really for the history books. But there might be cycles. And I think we might come in for a mildly up cycle going forward, but I don't feel commodities are headed very significantly higher.
Okay, so commodity is not headed significantly higher, so no per se big risk, structural cyclical risk to margins on the back of that. IT, could there be surprises? Most of the numbers will be out next week. Are you watching any particular stock?
Not particularly, simply for the fact that, big IT especially is fairly, homogeneous. There is no heterogeneity there. There is no significantly specific risk that we look at across, the bigger IT names. And I think most of them are very well researched. The kind of QOQ growth expectation is extremely low. And I think no big news are expected. I think the only play there is when valuations as a whole become more attractive as opposed to when they catch up. Nothing specific, but we are interested more in the smaller mid-cap areas where some of these companies come up with significantly higher specific offerings, which can really move the needle a little bit. Of course, valuations there are significantly more expensive than the large cap. So again, is there something to do right away? No, probably. But I think from a promise perspective, I think the mid and small cap IT sector looks a lot more interesting to look at, given the fact, of course, that there has been an overall derating across the sector. With the lower rupee-dollar equation, I think there are some extra gains to be made, especially for the smaller companies. The percentage yield could be more.
Tushar, great chatting with you. Indeed, the INR has depreciated 2% quarter on quarter for the Indian IT companies and about 5.5% on a year-on-year basis. And I was just looking at the mid-cap, small-cap IT companies, which have underperformed the Nifty IT in the last 1 year. So the Nifty IT in the last 1 year is down 12%. but a Birla Soft is down 20%, a Mastech is down 30%, Cyient and Oracle both down 35%. So these are some mid and small cap IT companies which have underperformed even the benchmark in the last 1 year. We'll wait for the numbers. For now, it's over to Nigel now. He's moved over to the F&O desk.
Well, disappointing trading session yet again, Reema. The Nifty is under pressure today, and the problem today is the Nifty Bank actually is not batting for the bulls. In fact, the Nifty Bank as well now is reaching those crucial technical marks. And the last time I checked, the Nifty Bank, in fact, was below the 20 DMA. So that's a bit of a problem pocket. And since we've seen a bit of a correction, the fear index actually has spiked up a little bit, but that's on a very, very low base. You remember, it's still at multi-month lows actually. The VIX still below that 11-odd mark. There is no optimism, which actually that can be a good thing because you're getting into the weekend with a couple of big cues. So if in case the best case scenario does play out, then you'll see a big spurt on Monday's trading session. For the time being, no sniff of any kind of pre-buying is what we are seeing. Looking at the options data, though the PCR is getting stretched on the downside. I made this point earlier today as well. It's at around 0.64 odd because the call writers are having a gala time. You look at the premium down 60 to around 70%. Whether you look at the 25,800 call, whether you look at the 25,700 call, both of them are seeing very, very aggressive writing. So just going by the data points, the 20 DMA, that becomes the important mark on the upside, but that's a good 300, 350 points away from current levels. So that's the resistance mark. While support, we are in that support zone, 25,500, 25,700. Just last month, in the middle of December, we went to this mark, and from there we did see a bit of a bounce. So we are pat in the middle out there. Manappuram Finance, well, there are fears that that deal that they did with Bain could be delayed. Which is a bit of an issue, and that's where the shorts are piling on out there in case the deal, the worst case scenario does play out there. IEX, there was optimism that we'll see some kind of a decisive verdict today, which will be in favor of the of the company. That as well hasn't happened. So that's why that stock saw some unwinding. Now it's seeing some fresh shots. But Nalco, at the start of today, I just mentioned that if commodities took a break yesterday, then probably you still assume that we're in a bull run. Then in fact, you'll see a bounce back. And that's precisely the way it's played out because that gap, the demand-supply gap on aluminium globally is continuing as of now. So maybe came in for a bout of profit taking yesterday. Well, that's resumed to its winning way. So no expectations going into the weekend on the options data. The PCR is stretched. That's the lone warrior that's giving you some hope of a bit of a short covering bounce.
Thank you very much for that. We will slip into a break. On the other side, we'll get you a few BTST calls from our technical experts. Stay tuned.
Welcome back. Well, very, very minor fight is what we're seeing from the lows as we speak. Hindalco has pulled back a little bit. That was trading with a cut of around 1%. Now it's down only 0.3%. Maybe a couple of other heavier names actually. HUL, that stock is fighting back a little bit. And, you know, HUL and HDFC Bank, they have a decent weight on the index. They are cutting their losses. So that explains why we're seeing a meager 30-40 point pullback from the low point of the day. And Dr. Reddy's as well has now moved into the green, courtesy the last 5 to around 6 minutes. That said, Siddharth Rai Mangla joins us, has said a weak trading session, but some kind of pullback, some cheers at least getting to the weekend. Tell us on the index, what should someone do if they were short, cover the position or carry it? And also if you could help us out with the trading call.
Yeah, sure. Hi, Nigel. See, Nigel, if somebody has an existing long position, short position on the index, they should definitely, they can definitely start exiting that position. And just like we discussed some half an hour ago, it's not a good time to be taking any fresh position in on the index on either of the two directions, because a lot will be folding out, over the weekend, and that will depend on which direction the index is going to be moving in over the next 1 week. So I don't think it's a good time to be taking any fresh long positions or short positions on the index. If anybody has an existing short position, they can definitely exit on the index.
Got it. All right. What about individual stocks?
Yeah, sure. Two stocks, just like I kept a balanced approach before, I have a balanced approach still. So two stocks, one we have to buy, the other one we have to sell. The first we have to buy is Asian Paints. See, Nigel, today's move in this counter is very interesting. We have seen an almost open low being made. The stock started running just from the level where it opened. So Asian Paints can be bought. It looks good. Right now, the spot is trading around 2824, 2825. It can be bought here. The stop loss will be at 2805, and our targets being the first target 2855, the second target 2870. The second stock is Jio Finance, and this one we have to short because the structure looks very weak. It had a very, very strong support around 290, 292, this range, but it has been broken down today, and I think this weakness can definitely extend further. So Jio Finance can be short. We can go short on this one. The January futures are trading around 288. We can short them. The stop loss will be at 299, and our targets being the first target 270, the second target being 265.
Got it. All right. Thanks a lot for that, Sid. Let's welcome Sudeep Bandyopadhyay, market expert who joins us on the show. Hi, Sudeep. Good afternoon. Good to see you in Manappuram Finance. That's the stock of the last 60 minutes. Fears that that deal could be delayed with Bain because RBI has made some observations. Optimists are saying actually they could sort out the issues and it will be a delay. It won't be that the deal is put off. At around 285, we know that it has valuation comfort. It's in a good cycle as well of gold financiers. Would you be a buyer?
Absolutely, Nigel. I think, what you mentioned last, the gold loan business is in a, secular upswing. I think, every company is talking about either getting into or increasing the gold loan book, because it's a secured lending product and the regulations have more or less stabilized. Now, Muthoot is on a different league, but Manappuram is also very well positioned on the gold loan business. They have a strong gold loan business with a great track record of years. Look, the deal, as far as the deal is concerned, I'm sure they will give the necessary clarification, do whatever needs to be done. But the deal eventually will get done, because what I understand is that the promoter is kind of willing to step back and hand over management to PE funds and professionals. So under the circumstances, the deal is a certainty. It's a matter of time before it gets done. And the valuation-wise, there is significant comfort. So yes, this kind of dips are an opportunity to buy into a gold loan company, which is going to change hand for the better.
Got it. Okay. All right. Sudeep, the other big mover is IEX. Street was hoping some relief, some kind of, positive trigger. It didn't come. The next date is January 19th. At around 135 rupees. What do you think?
Well, I think, you're absolutely right. Market expectation was that today it will be decided, and the kind of statement made by CERC lawyers, gave rise to that optimism. But unfortunately, it hasn't unfolded the way the market was expecting, and obviously there has been a correction in the share price. As far as IEX is concerned, I have been positive always, and I continue to maintain my positive view. Look, some form of market coupling will come, but I don't think the idea is to kind of disadvantage the exchanges in a significant manner. Idea is to encourage and ensure a healthy competition and healthy development of market. So the regulations, if they're properly formed, yes, there will be some challenges for IEX, but it should not be too bad. So some of these dips can be an opportunity to buy from a long-term perspective. It was quoting around 220 levels. From there, it has corrected, and now it's around 130, 140 levels. So to my mind, if somebody is trying to build a portfolio and are a little aggressive, it's worth buying at these levels.
Sudeep, stay on. Need to slip into a short break. We'll come back. 10 minutes to go to wrap up the trade. Welcome back. Avenue Supermart's third quarter numbers will be released tomorrow. Mangalam now joins in. Mangalam, recap the quarterly update that came through on Monday.
Well, it's pretty simple for Avenue Supermarts. We know the revenue growth for the company, and that's the standalone revenue growth. They've told us that it's 13% in terms of third quarter growth, 17,612 crores, which is lower than the 3-year CAGR, which is also lower than the number of stores that they've added, which implies a negative same-store sales growth. The stock has reacted to that as well. They've added 10 stores in the third quarter. That's something that we know as well. But my sense is that the realizations are possibly lower due to, the GST cuts that have come by. So, most of the consumable staple products have come down from 18% to 12 or rather 5% itself. So those price cuts are, reflecting in the realizations that we're seeing in the company sales this time around. Now, what the street expects on a consolidated basis is 8 to 9% EBITDA growth on a 13% revenue growth, which implies margin compression. At the same time, what we're expecting is about 250 to 300 crores additional in terms of this quarterly revenue coming in from DMart Ready. So those are two factors that are, unknown, and those are where the expectations are. 250 to 300 crore in terms of DMart Ready sales in the third quarter, and 8 to 9% EBITDA growth on a consolidated basis. Remember, consolidated business does include the likes of DMart Ready too. Key to track in the results: operating performance, the assortment mix, and more importantly, the outlook on store opening that the company has given, because the first 9 months, the only silver lining so far has been that store opening has been faster than analysts' expectations, and the company has been talking about more pace of expansion of stores as well. So if those things are met, then maybe after the correction, there could be some positive glimmers for the stock.
Actually, if you look at the market performance, the share price performance in the last 1 week, on Monday the stock fell following the quarterly update, the disappointment on the top line, the 13%. But after that, Tuesday to Friday, in a weak market, the stock went up. So week to date, it's actually up 2.2%. So it's already clinging on to those silver linings you were referring to. But let's talk about the other big headline that came through. SIP contributions hit a record high of 31,000 crore rupees, even as the net inflows into the equity mutual fund schemes declined in the month of December. Sonal joins in with the AMFI data.
Well, yes, there is a decline in equity inflows, 6% on a month-on-month basis in the month of December. But do remember, we did see lower volumes in the last week of December as well. But yes, this is not a big number to worry about as well. They stay at the 28,000 crore mark. The big talking point has to be SIP inflows, which have come in at 31,002 crore rupees. Remember, from October to November, they were flat, but it is a big increase now. They've crossed the 30,000 crore mark in the month of December. The other big record has to be the inflows in gold ETFs above that 11,000 crore mark, around 11,648 crore. That just compares with around 3,700 crores that we saw in the month of November. This is because of that big surge that we saw in gold prices as well. And that is maybe the reason why multi-asset allocation funds also saw multi-year high inflows come by for them at around 7,400 crore rupees, because they do have a component of gold as an asset class as well, other than equity and debt. Now let's talk about the usual names, the large caps, the mid caps and the small caps. For large caps, it's largely flat on a month-on-month basis. For mid caps and small caps, we did see a lot of volatility in the month of December, and that can be seen in the numbers, but it is not a worrying figure as far as the flows in the mid caps and both the small caps is concerned. Now we talk about the NFOs, because remember, we were seeing a slew of NFOs which flooded the markets in the last couple of months. We did see 23 NFOs this time as well, but the money that they raised was around 4,074 crore rupees, but not a big contribution that came by for equity flows just from the NFO space. And if we talk about the sectoral theme as well, that was something which was buzzing off late, but that activity has come off quite a bit below the 1,000 crore mark. And we have been indicating that sectoral funds are for high-risk individuals, high-risk investors. So that activity has taken off on the lower side. So this is what the number looked like for the month of December. The biggest talking point, the SIP number, and of course what the flows that we saw in gold ETFs as well this time.
Thank you for highlighting that. Sudhi, back to you. Avenue Supermarts, I'm sure you heard Mangalam. In the last 5 years, the stock has given a return of only 28%. So CAGR return is very muted. Where from here?
Well, I think to a great extent it depends on how the online business performs. It's a part of the consolidated numbers which are disclosed, and Mangalam also was alluding to that. So I would be very keen to see how DMart Ready is progressing. Look, we have to accept the fact that online and digital business is a reality, and we have to live with it. The competition from Blinkit, Zepto, Instamart, and the others is real. And DMart has to fight. They were a bit late in waking up to this reality, but they have now, and I'm pretty confident that over a period of time, they will be a formidable force to reckon with. Their location in hinterland also gives them an advantage vis-a-vis some of the other quick commerce players, and I'm sure they will do well, but we have to see the progress, how things are progressing. Of course, the outlook of what they're talking about, the future number of store opening will be very critical, because that's what is giving them the growth momentum. Of course, the GST reduction has probably led to the revenue numbers getting muted, but margin will be very, very closely tracked. We also want to see same-store sales growth, if at all there is some, and the management's forecast of that. Having said all that, I think I will be waiting and watching. I don't think I will recommend a buy yet on Avenue Supermarts.
Final question before we let you go, Sudeep. You have been bang on, with regard to the commodity rally. I recall you being positive on Vedanta, and the stock did very well. I think in 2 months it gave you 15% return or even more. Today as well, Nalco, the dip has got bought into, and it's holding rock solid. What's your view now, and what do you like from the metals pack? Vedanta was something you liked in the past.
Well, Nigel, I think, irrespective of the market volatility, a few days back, the metal prices have all come down. It did correct in India also. But the fact remains that there is a supply-demand gap. And that gap, as long as it remains, there has to be an upside as far as metal names are concerned. And that's pretty much what is getting played out. And this aluminium, the demand-supply gap is real. So we have to recognize that and keeping faith in the aluminium stocks. So whether you want to buy an Nalco or you want to play that through Vedanta is an individual investor's call. I would like to play it through Vedanta because it has got multiple other growth vectors, whether it's through Hindustan Zinc and the silver, whether it's through other metals where they have presence. And of course, which I've been talking about time and again, the value unlocking potential of the demerger. And I'm pretty confident that there will be significant deleveraging of the parent company balance sheet through sale of one or two of the demerged entity as far as Vedanta is concerned, and there will be a lot of value unlocking through that process as well.
All right, so the interesting one, there's another stock, Rain Industries, which is an aluminium ancillary, very complex business. But let's see whether that so-called aluminium ancillary can participate in that. Rain Industries last 1 month up more than 35%, but today it's a little under pressure. It's still down 1.5%. 42% of their business comes in from the aluminium vertical. Well, thanks, Sudeep, for joining in. We catch you next week and talk about stocks. But for the time being, let's do a quick wind down then of the markets. Another disappointing trading session. 5-5 for the Bears. They are going into the weekend celebrating this week. What didn't do well? Adani Enterprises was down. NTPC was down. ICICI Bank, well, that was batting quite well all through the week, but today it seems to have lost its form. So that stock came under pressure, which in turn pressured the Nifty Bank. And because of ICICI Bank dipping in trade, and you didn't have other stocks that did contribute, the Nifty Bank breached the 20-day MA today on a closing basis as well. Jio Financial, that stock was down close to around 2%, so that continued to see some selling. What did well? Tech actually did a little bit better. HCLTech was up close to around 0.9%. You had Infosys by the time we wound up that moved into the green. So you had tech that did well. Coforge as well was in the green. In a market that was down close to around 0.7%, you had the Nifty IT index that was up. Asian Paints was another stock that did pretty well. That was up close to around 2% in today's trading session. Commodity-related names, they bounced back today. Whether you're looking at the spike in the oil prices that you saw overnight, Oil India as well as ONGC, both of them ended in the green. Not the consumption basket, I'm talking about the oil and gas space. So both those two stocks did quite well. And Nalco as well did pop up close to around 4%. The casualties of the day was IEX. No relief came about. So those that expected that, they were disappointed. Stock went home with a cut of around 7%. And Manappuram Finance, that deal could be delayed as per what reports suggest. We'll try to get you further clarity on that front. Net, week trading session, Bears feeling on top. Well, on that note, we'll wrap up on this edition of Closing Bell. But you stay with us, I'm going to just go hop over onto the Editor's Roundtable. Plenty to discuss on that format.
Market snaps a two-week gaining streak amid geopolitical tension, posts its biggest weekly fall in 4 months. BSE-listed companies erase a market capitalization of more than 15 lakh crore this week. The Nifty slipped 2.5%. All indices post losses, with cuts going up to 6%. Hello and welcome to Editors Roundtable. I am Rima. With me are Nimesh and Nigel. And joining us here in the studio is Nimesh Chandan of Bajaj Finserv AMC. Hi guys, it was the first full week of 2026 and what a week, right? I mean, we ended last week with record highs and we're ending with a fall of 2.5%, 3% gone on the benchmark indices.
And nothing has changed, right? I mean, there is no big earnings disappointment or big news, so to speak. It's just the sentiment and so bad right now that, I think everyone is throwing in the towel. This week was really tough, not only for Nifty and for large cap, but even for the mid cap names, right? So. Tough start to the
But are you seeing people throwing in the towel? I mean, based on the price action over the last 2 days?
So definitely sentiment has got affected a lot this year. 2025 has been a very, very noisy year. Even if you've not seen net numbers at the end of the year, Nifty is up about 10% or so for the entire 2025. Not much fall in mid caps and small caps, I would say, at the end of it. But the sentiment has become quite sour. And it's because of the huge amount of decibels of noise that is coming in. If you see, compared to the last time we took a high at September 2024, the economic cycle is at a better footing. We are seeing improvement. The business or the profit cycle is improving. The credit cycle is also improving. We are seeing lower interest rates and plus higher liquidity in the market. The sentiment cycle is the one which is actually holding us back. And it's because of this noise that constantly keeps coming in. People are not changing their estimates, but people are reducing their valuation targets purely because there is uncertainty.
Riva, the other thing which has happened is, start of the year, there was a lot of expectation that the FIs will come back after selling so much for 3 years in a row. And that's not the case, right? Yesterday was a big number, visibly big number. But for the last few days, the sense I'm getting is that there is FI selling and some very large FI funds are selling the large cap names. So that impact is clearly visible now in the large cap stocks as well. But the fact that at the beginning of the year, the anticipation was maybe after so much of selling, there might not be large selling. That's not the case. And I guess that also changed the sentiment to some extent, has impacted the overall HNI and retail sentiment.
I think even this week, just building on to that point, every day you had one large cap that was selling off. HDFC Bank, Reliance Industries, Maruti Suzuki, on the day to Trent. So many accidents. Frontline names. So everyone took a chance all through the week and in fact ended low, which clearly dents sentiment. And talking about we wanted a quieter 2026. It's not like that, right? A lot of global leaders now are just hoping that they're sleeping in the right place and they are, waking up in the same bed. Unlike what happened to the Venezuela leader, they got picked up and taken out. But clearly this various ways of dissecting the news flow that's coming in for Trump. And you don't know what he's going to do next. But this trade deal, now it appears it's getting pushed back even more. I mean, we did a poll, Nimesh had done a poll with a lot of market experts, and the optimism is that in the first 3 months we'll get a deal. Which side are you leaning on that? I mean, I know it's like shooting in the dark, but what do you think?
So I've been actually expecting a deal soon, and from what I gather from what our government has been talking and what US has been talking, and I've been wrong on that. However, I always remind people that there are two things we need to remember. Global trade leads to better productivity, and that productivity is shared by those trading nations. Sure. So specializing in certain products or services helps you export cheaper, and that country actually benefits from that. And GDP is what? GDP is population into productivity. If your productivity is going up, GDP's economies are going up. So it's beneficial to both nations. So if US is putting tariffs and artificially reducing this trade, it affects US consumer also in terms of inflation. And that has started now affecting the popularity of the government there. On the other hand, when we look at India, the US trade, the trade deal, has actually impacted 0.3 to 0.5% of our GDP, less than 2% of our corporate profits. So again, the estimates are not changing. In fact, with rupee depreciation, our exports have become more competitive. I'm looking forward to January, where we'll probably sign our biggest trade deal with Europe. So these are the positives, but somehow in the market, the sentiment is so bad that people are not looking at the numbers.
But the sentiment will turn if the India-US trade deal...
Absolutely.
That is it. That's the only thing holding back the sentiment.
And probably
floodgates open.
Yes. Probably on that day, I'll be here again and telling you there's no change in Nifty EPS because of that.
Yeah.
But the Nifty will be up. because of the sentiment reviving. See, the country, at some section of economists, strategists are worried about the BOP situation. If a country can attract flows, then that situation is taken care of. Your country will take a re-rating upward because of that. So it's just that impact that is left. Maybe in budget, they may address it in some way.
So
Okay,
Nimesh,
let's hope earnings.
Just to take, Nimesh, your point on sentiment forward, you know, it's a classic example, right? Today was the biggest news for Vodafone Idea in terms of enough clarity on what the government is willing to give. For 10 years, the net amount that Vodafone has to pay is 500,
less than 1,200 crore.
I think 525
No, 124
right?
into 6 plus 100 into 4.
100 into 4.
So that totally is
But
about
125 is for not every year. For
every
6
year.
years.
Annually, per
maximum.
year, 124.
Okay. Still 1,200 crores.
Yeah,
I mean, that's very, very less compared to what the street was anticipating. Still, the stock ended at days low. What's your take on telecom, and especially after this news of clarity on what the AGR that Vodafone has to pay?
For telecom, we are positive. So we think there will be rate increases and ARPU increases in the country. And telecom companies will benefit. Ultimately, there are 3 companies, or right now there are 2.5 companies in a way on that. But see, positioning also matters these days a lot.
Sure.
When markets are moving in a narrow range and the sentiment is low, who owns a particular stock becomes as important as what is happening in the business in that.
Sure.
So the reactions, sometimes because of pre-positioning or some guy just deciding to sell the entire, say, basket of large stocks, affects the
But after the clarity, what the government has put out now and what Vodafone has put out, enough clarity now for Vodafone Idea to
from the
survive?
time, so this particular company that you're talking about, from the time it was at 9 rupees, there have been talks about this coming in. In fact, people are expecting more, I would say.
Oh.
So you're playing the core telecom name, the one that has different other businesses, or the half player?
Both. No, not both half player, but the 2 big players.
The two big players. Got it. All right. The half is not.
All right, let's talk
We
about...
have a tower business which actually plays the other.
Got that. Yeah, even I was going to ask. That's
The tower's done well, 20-25% in the last 3 months. So, I mean, some sentiment impact of this Vodafone Idea.
The risk reward was better there. It's not that the returns potential are higher, but the risk reward metrics was better.
Yeah. All right, Nimesh, take us through Q3 FY26 earnings upon us.
Well, Rima, the good part is that the expectations are very low. Having said that, even Q3 is going to be quite soft. It's been the same for the last 6 quarters, and I guess nothing is going to change in this quarter as well. So let me go to the wall and explain not only the overall numbers, but what to expect in the sectors as well. So as I said, there are expect no fireworks in Q3 as well. It's going to be as it is for the last 6 quarters, pretty much soft and sanguine. Expect a single-digit rise in both revenue as well as in profits, along with mild margin expansions as well. Kotak has put out a note, and they're expecting a Nifty EPS of 1,072 for FY26 and close to 1267 for FY27. So these are the numbers to watch out for from a valuation perspective. That's what Kotak has put out for Q3. So that's the overall. Now look at the individual sectors. The first sector I'm talking about is financials, and within that, basically the lenders. Expect a quiet quarter, no big negative surprises, but no big positive surprises as well. The credit card stress is going to be much lower for most of the banks. So that's basically for the lenders. Coming to the NBFCs now, that's going to report a very strong quarter largely. So the AUM growth for the vehicle finances and as well as for home financing companies are going to be 4 to 5%. So stable to better kind of numbers for NBFCs. The third is staples. This is where I guess there could be a big swing because of the GST. The demand can be improved to almost 7% YOY versus which was 4% in Q2. So big improvement there. Retail, the next big sector to watch out for. It's largely going to be subdued, X of jewelry as well as the cable and wire. These 2 businesses are likely to do well in Q3 as well. So that's for the retail sector. Auto, again, the volume growth is going to be quite strong, but there's going to be a fight between operating leverage benefit, which will offset by the lower gross margins because the commodity costs have gone up. So that's something to do with autos. IT, pretty much a flat, no big fireworks expected in IT as well for this quarter, especially for the large cap companies. Pharma could be quite interesting. The domestic sales are going to be strong, but the base US business is going to be quite flat. But for pharma, the big thing would be the generic Revlimid companies that might report weak numbers. So that's something to track as far as pharma is concerned. For cement, it's going to be a bit of weak in terms of there's going to be a EBITDA per ton, quarter contraction, except for Ultratech and JK Cement. So that's the view as far as cement is concerned. Energy is going to be another big sector to watch out for. People are talking about Reliance. Reliance OTC should benefit from higher GRMs, and overall for the OMCs, it's going to be quite mixed, with slight improvement in EBITDA is something which Street is expecting. So that's for the energy sector. Metal also, steel realizations and EBITDA per ton can decline quarter on quarter. For non-ferrous, it's going to be a good quarter, except for Novelis, which had a bit of an issue with the fire at one of the plants. So that's for the metal sector. Now is industrials. This is going to be quite interesting. For industrials, this is the only sector where you can see a growth. A 13% EBITDA growth versus the coverage of City versus 9% in Q2. So there's going to be actually a growth in EBITDA for industrial stocks. And the last is internet companies, basically the platform companies. Well, stocks have been down of late, but at least there could be a growth across most of these names. But the commentary is going to be quite interesting as far as the capex is concerned. So these are the few sectors which I spoke about. Now, Citi, every time puts out a very interesting note on the positive and negative surprises. Citi is expecting positive surprises in stocks like Maruti, HDFC Bank, Britannia in the consumer name, Polycab, as well as an Eternal. These are the 5 names where Citi expects a positive surprise in the Q3 earnings. In terms of negative surprises for Q3, Citi is expecting negative surprise from ABB, Ambuja Cements, L&T Mindtree, JSPL. These are the 4 names where they're expecting negative surprise as well. But in short, Q3 again is going to be soft, which has been the case for the last 6 odd quarters. But the expectations are so low that I don't think markets are going to react big time. Nimesh, your take on overall on the earnings, anything that you're watching out for, which can be a big negative or a positive surprise?
So this looks like to be a good quarter overall.
Yeah.
And while you were showing on the board, I checked out that some of the areas, like for example, pharmaceuticals, except Revlimid affected companies, industrials, FMCG, they are expected to give a better growth. Some because of the base effect also, that last year was not so great for some of them, so the base effect will also shine in. I think most importantly, while these numbers will be tracked closely, people will look for guidance for FY27.
Sure.
Like for automobile companies, like you mentioned Maruti here, expected to, or Suzuki here, given better results. I think people will want to hear that post this pent-up demand that came because of GST cuts and all, is it carrying through? So consumption companies, the guidance is very important as to what they are seeing next year. Anyway, we have moved valuations there. People are talking about FY27 valuations. FY27 growth expectations are high. It's about 16 to 17% from the brokerage report that you're talking about. I think most of the people are expecting between 14 and 17%. People look for confirmation of that. The one sector I still think that there could be a lot of skepticism based on geopolitics and all that could be the IT sector, where people are still worried about what Trump announces next on this. So maybe, and this is typically the season where they are a little bit soft. So rupee benefit, but overall a softer quarter for them, and worries on geopolitics can actually put.
Nimesh will ask you about IT, but I think Nima, you put out a piece on mid-cap.
Yeah, just to quickly run our viewers through what to expect this time around. Well, on the large cap space, expectations are well anchored. So expect very, very modest growth for TCS. That's the first one, up about 0.5%. Infosys flat growth. HCLTech will do better because they have a products business where they get higher margins and it's seasonally strong. Mid-caps again will outperform, and in that the ones that investors really like is Coforge and Persistent because it's done well, and their growth rate will be about 3.5% on a quarter-on-quarter basis. But I think particularly, what Street will watch is from TCS because they've shown renewed signs of aggression. In their December analyst meet, for the first time, they quantified the AI revenue at $1.5 billion. They spoke about data investments. So what more can they say on that? From HCLTech, for instance, they had also given an advanced AI revenue. In Q2, they said that it contributes $100 million. So you want to know when can it double? What is the growth rate? So, and will other companies also start giving you AI metrics? Right now, only TCS and HCLTech give you. The others don't. Will that happen? Also, Coforge did an Encora deal. So some analysts are saying, I think there will be pressure on other mid-caps to also announce some sort of a deals. But broadly, the Nifty IT index is down 12% in the last 1 year. In the last 1 year, when you look at the mid-caps, the outperformers are a Persistent, which has actually gone up 4%, and an Emphasis. The stocks, mid-caps, which have moved in line with the index are LTTS, Tata Elxsi, Zensar, even Coforge. Coforge was outperforming till the Encora deal, then it fell, so which is why it's an inline performer, and even a Tata Tech. But the stocks which have underperformed, even the Nifty IT index, and are down 25-30%, include a Birlasoft, Mastech, a Cyient, and the other one is Oracle. These are stocks which are down 20 to 35% in the last 1 year. So is there any sort of a contra play in IT? Expectations are well anchored this time around, but any stocks where there is a valuation mismatch one can play for?
Valuations are very attractive, especially in the large caps. If you see, many are trading at very mouth-watering dividend yields also. High cash flow generating businesses trading at
Like
dividend yield of
22
3% or 3.5%. So large cap companies, I think they need to give comfort to investors about growth visibility. I think that's where, and that's why the valuation of mid caps is higher. And some of them that you mentioned have actually got rewarded because of the high growth that they have been delivering. So I think for IT sector, growth is the most important number. See, at some point of time, the margin gains that you get because of rupee depreciation get passed on. Because some player will be aggressive in passing on and taking projects. And it's better actually that you use this margin that you're getting to create more revenue growth. So I think that's what investors will look for. Till now, many mid-cap companies have actually been delivering better growth. Large caps need to convince investors that this is the time that.
But within the IT basket, any preferences, either ER&D companies or mid-cap or large cap, any specific?
So in our portfolios, we are underweight IT.
Okay.
But our bigger underweight is in large caps. We have some mid-caps there. And the names are common, which are showing growth and all.
Okay, so betting on the mid-cap IT names which have shown growth in the past. Get into a break. We'll come back and continue our conversation with Mesh.
Welcome back. You're tuned in to Editors Roundtable. Well, Nimesh, we have spoken a lot about the equity markets, but I wanted your view on gold and how do you play that theme. But before coming to you on that, I just wanted to, tell our viewers one quick piece. You're clutching at straws, hoping for some kind of hope that this market's bounce back. We talk about the PCR, we talk about the options data, the VIX and the likes. And another ratio that we look at is the Nifty to gold. That is 1 Nifty and 1 gram of gold. And the last time I looked at it, it was below that 2-odd mark, which is actually the lower end of the range if I plot a wider time horizon. So the question is this the new normal where we see Nifty to gold ratio come down to around 2? That is 1 gram of gold is roughly around 13,850, 13,900, and Nifty is sub the 26,000 odd mark. So, I pulled out data for the last 20 years, and effectively, every year you have around 250 trading sessions. So approximately 5,000 trading sessions odd. Out of those 5,000 trading sessions, around 400 odd days, the Nifty actually has breached this 2 times, this Nifty to gold ratio. And more often than not, the returns post this 400 on these 400 occasions has been very positive. 6 months down the line, it's been positive, and 1 year down the line, it's been even more positive. With healthy returns, if you get this particular point, 13 to 20% is what history suggests. But if you just look at the ratio, Nifty to gold ratio, when it goes to 3, then the ratios are the returns are far more subdued. And in that case, then actually equity underperforms. So those numbers should come up for you. And out of these 5,000 trading sessions, close to around 70% of the time, the ratio has been above 3. in that case, the risk reward is not really favorable for equities. But since we are sub this 2-odd mark, I wanted your view. We're just trying to pull out some data points. Nifty to gold ratio at around 1.9. Is that the new normal? Or do you think, we'll again adjust ourselves? Because history suggests the Nifty normally does bounce back. So your take.
So I'm in the camp which says this will readjust back, where
So what
we will see Nifty
will go
outperform.
up or gold will fall? Something has to happen, right?
One of the two.
Okay, so let's split this two way. Sure. Actually, Nifty analysis is a little easier than gold.
Sure.
Because if you look at a 20-year movement in Nifty, these are approximate numbers until a few months back, that for 20 years, earnings in India have gone up by about 13.5% compounded, and Nifty has gone up by 13.5% compounded, approximately. It may be 13.67.
Correct.
Okay. So Nifty tracks earnings. Earnings in India, because of better economic growth and business growth, I see earnings continue to move up. Some years it will be high teens, some year it can be a high single digit kind of. But that means Nifty has a more steadier path up. Gold is a little difficult trade because it has more behavioral issues priced in, where you don't compare it with cost of gold mining or anything. You compare it with how fearful people are about the world, where there is uncertainty, geopolitical tensions. Gold is a safe haven.
Correct.
And second is, in the last few years, you have a new large buyer in gold, which is the central
banks.
Throughout the year, we monitored that. I mean, we looked at some quarter-on-quarter numbers. Last year, central banks were buyers between 14 to 28% of the total gold trade in the world. So very significant buyers there. Now, the question is whether going forward, these geopolitical tensions increase or reduce with what has happened in Venezuela and what is being talked about in Greenland.
Iran.
Now people are putting question mark on China making a move on Taiwan, right? So as geopolitical tensions climb, it is likely that gold also climbs. And maybe first quarter or maybe first half, we see this trouble, world being more troubled there, and we may see some spike in safe haven buying. On the other side, if we believe that dollar is also now, it has fallen about 10% from the time Trump took presidency and may not fall further and all that, that central banks may also withdraw a little bit or reduce their purchases. So I'm bullish on gold for the short term because of all the tensions that are there. But in a longer term or medium to long term, I'm more bullish on Nifty.
So then that ratio at around this 0.9 gives you a sense that equity over gold at these levels.
Absolutely.
Is that correct? Got that. Great.
All right, guys, it's been a tough week, and we're going to call it a wrap right now on, this week and Editors Roundtable. We're down 2.5%, 3%. So many individual stocks were down 6-7% this week. But next week, all eyes will be on earnings, and not just, the IT names across the board, all the large cap IT names, but even insurance companies will be reporting their numbers towards the end. Banking names will come out with their Q3 updates. So very important week coming up. Thank you for watching this show. Thank you, Nimesh, for joining us here in our studio. But stay with us. More news and updates on the other side.
Hello and welcome to Business 360. I'm Shriram Finance. The headlines that we're tracking for you this evening. The Sensex and the Nifty post the biggest weekly fall in 4 months. 15 lakh crore rupees in market cap wiped out in the last 5 sessions. All sectoral indices close in the red. US Commerce Secretary Howard Lutnick claims a trade deal with India did not happen because Prime Minister Modi did not call President Trump. Says India missed the train and countries that moved first got better terms. The United States Supreme Court is scheduled to pass a ruling on the legality of President Trump's sweeping tariffs. The order is likely to address whether the Trump administration can use provisions under the Emergency Economic Powers Act to levy tariffs. Shares of Indian Energy Exchange tumble amidst uncertainty over implementing market coupling rules. The Central Electricity Regulator reclassifies its order on market coupling as a direction before the appellate tribunal. This after SEBI alleged insider trading by CERC officials. Tribunal will now hear the case on the 19th of January. Vodafone Idea receives an official communication from the government on relief in the AGR case. Will pay 124 crore rupees annually for 6 years starting March 2026. Sources say banks will consider granting fresh loans right away. The government is likely to table a bill to amend the National Highways Act to make land acquisition easier. Sources say land parcels will be returned to original owners if it remains unused for 5 years. The amendments are likely in the upcoming budget session of Parliament. West Bengal Chief Minister Mamata Banerjee leads a rally in Kolkata a day after her dramatic showdown with the ED during searches at the premises linked to IPAC. The High Court adjourns hearing on the ED's plea seeking an FIR against Mamata, cites unmanageable crowd in the courtroom. TMC MPs including Derek O'Brien and Mahua Moitra detained after protests outside Home Minister Amit Shah's residence. Iran plunges into a total internet blackout as protests over the economy spread across the country. The Supreme Leader Ayatollah Khamenei denounces the protests, alleges US interference. At least 45 protesters have been killed by security forces in the last 2 weeks. Tensions rise in the US over President Trump's immigration crackdown. Border Patrol agents shot and wounded 2 people in Portland. This follows the fatal shooting of a woman in Minnesota on Wednesday, deepening the rift between state and federal officials. Elon Musk's AI tool Grok turns off the image generator option for most users and limits it to paying subscribers. This after widespread outcry over generation of sexually explicit images of users. Sources say the Indian government is unhappy with the response from Grok and is considering legal action. Well, all of that and more coming up for you, but let's start with the day's market action. The Sensex and the Nifty posting losses for the 4th straight session. In fact, all frontline indices have dropped nearly 1% each, with Realty being the biggest losing index. That's the Nifty for you, down almost 200 points, 600 cut there on the Sensex. The Nifty mid-cap down 470 and another 400 points gone there on the Nifty Bank. More than 35 Nifty stocks ended in the red today. But let's bring up the picture for the week. The market snapping its two-week gaining streak and posting its biggest weekly fall that we've seen in the last 4 months. 2.5% lower on the Nifty, 1.5% on the Nifty Bank, and the Nifty Mid-Cap Index 2.5% lower for the week. BSE listed companies have raised market cap of more than 15 lakh crore rupees this week. The Nifty slipping nearly 2.5%. All indices have reported cuts of up to 6%. Nigel joins us now to wrap up the market action. Nigel, it's been a tough and a very volatile week. What's the market anticipating as we look ahead?
Well, it was another weak trading session for the Indian markets. The Nifty registered the 5th straight session on a losing streak. The advanced decline ratio was very, very weak yet again. You had only 1 stock that was advancing, 4 stocks that were declining. And the problem is that now some of those technical levels as well are falling apart. The Nifty and the Nifty Bank, both of them breached the 20 DMA. However, what's giving you some kind of glimmer of hope is that the Nifty PCR has come down to around 0.63. That's another technical factor that you target. And normally, when you look at the Nifty PCR at around 0.6, 0.65 odd, when you look at that and it comes in this vicinity, traditionally we've seen a bit of a bounce. So the hope is that we do see that. In today's trading session, actually, the tech stocks ahead of their numbers. Well, you had some of these tech stocks that outperformed. HCLTech, Forge, both of them were up close to 100%. And commodity-related themes, they came for profit-taking yesterday, but they bounced back today. Nalco was strong all through the trading session. The street believes that demand-supply gap on aluminium will continue, keeping aluminium prices strong. So that's why that one was up. Oil India as well. We had the management organizers here on CNBC-TV18. They're talking about ramping up production, both on gas as well as on the oil verticals. So that stock as well was up close to 2%. And Hindustan Zinc did pull back some of its losses that we saw yesterday. However, there were some casualties from the broader markets as well. IEX, there was hope that the courts will give some kind of leeway, some kind of relief in today's hearing.
However, that didn't come about. The next date is Jan 19th. So that's why that stock, after bouncing up initially, that did sell off. And Manappuram Finance was the other casualty. That stock as well was down in trading session because unconfirmed reports coming in from Reuters suggested that maybe that deal with Bain has run into some rough water. So some clarifications are awaited on that front. Net expectations very low getting into the weekend. We have two big global events. One is the US court's verdict with regard to the tariffs and the US jobs report as well. So the markets going into the weekend with no expectations, if in case you get a bit of a positive trigger, and given that we're at an oversold level, the hope is that next week we see some kind of stability and then hopefully some kind of a bounce back.
Many thanks for joining us and staying with the markets. Inflows into equity mutual funds declined by 6% in December. That's as per the data released by industry body AMFI. Inflows in December coming in at about 28,000 crore rupees compared to nearly 30,000 crores in November. Inflows into gold ETFs surging nearly threefold to more than 11,600 crore rupees in December compared to under 4,000 crore rupees in November. And SIP flows, by the way, hitting another record high, crossing the 31,000 crore rupee mark for the first time. So even as equity mutual fund inflows decline, SIP inflows have remained steady. On to the energy markets, where crude oil prices are on track for a third straight week of gains. This amid fears of supply disruption given the prospects of Russia-related sanctions and a drone attack on a Russia-bound oil tanker near Turkey's coast in the Black Sea. Investors are now awaiting the outcome of President Trump's meeting with U.S. oil company executives on investments in Venezuela's oil sector. But the big story, U.S. Commerce Secretary Howard Lutnick claims that the trade deal between India and the U.S. did not happen because Prime Minister Modi did not call President Trump. Speaking on a U.S. podcast, Lutnick said, and I quote, "It is President Trump's deal. He is the closer. He does it. It's all set up. You have got to have Modi call the president." They, meaning India, were uncomfortable doing it. So Modi didn't call. End of quote. Lutnick's remarks have come days after President Trump claimed that Prime Minister Modi was not happy with him because of the high tariffs imposed on India. Here's Howard Lutnick.
Everybody asked the president, who do you think is next? And if you look back at the time, he talks about a variety of countries, but he names India a couple of times publicly. It's not like a big secret. And we were talking India, and we told India you had 3 Fridays.
You put them on a shot clock.
Well, they have to get it done because what happens is I have lots of other countries, and when those other countries do their deal,
the staircase goes up.
And now the president, during all these deals, he would refer to me as the greatest table setter who ever lived. Okay, because you've never had anybody who was as successful as me as a businessman before, who's just the table setter. That's basically, so, because what I would do is I would negotiate the contracts and set the whole deal up. But let's be clear, it's his deal.
Yeah.
Okay, he's the closer, he does the deal. So I said, you got to have Modi. It's all set up. You have to have Modi call the president. They were uncomfortable doing it. So Modi didn't call.
Wow.
So that Friday left. The middle of the next week, we did Indonesia, the Philippines, right? Vietnam. We announced a whole bunch of deals.
Malaysia in that period.
So we did these whole bunch of deals. So that's like...
that staircase.
And they were and because we negotiated them and assumed India was going to be done before them, I had negotiated them at a higher rate. So now the problem is the deals came out at a higher rate.
Right.
And then India calls back and says, oh, okay, we're ready. I said, ready for what?
Well, that is Howard Lutnick claiming that the US-India trade deal didn't go through because the Prime Minister did not call President Trump, and by the time that India was ready, the train, in his words, had left the station. Ian Bremmer, the president of the Eurasia Group, says there is less urgency within the Trump administration to seal a trade deal with India. Speaking exclusively to CNBC-TV18, Bremmer said the delay is all about India buying oil from Russia. However, he also said that the relationship with India is important to President Trump and the administration. Take a look.
Trump has sort of delayed and extended out these negotiations by adding terms in a couple of occasions now. And most recently, it's all about ensuring that the Indians cut off all of their purchasing of oil from Russia. The reason it's taken time is in part because it's just not that urgent. There's not a lot of trade between the United States and India. even if tariffs are really high, the impact on a very fast-growing Indian economy, expected some 8% in 2026, just isn't that great. You know, if you looked at the national security strategy from the U.S. a month ago, the Quad is in there as a priority of the U.S. The Americans continue to stand that up, including the military, the intelligence coordination. U.S.-India relations are important for a lot of key constituents of Trump. A lot of these tech companies that are driving the U.S. economy are investing a lot in India right now. They want this deal to get done. I'm not really particularly panicked about that statement.
Well, that's Ian Bremer. Now, it's a development that could have global implications. The U.S. Supreme Court is scheduled to pass a ruling on the legality of President Trump's sweeping tariffs. The order is likely to address whether the Trump administration can, in fact, use provisions under the Emergency Economic Powers Act to levy tariffs. Now, if the court rules that Trump's tariffs are illegal, importers can apply for refunds by the 6th of February. CNBC's Lorianne LaRocco joins us now with more.
We can be just hours or weeks away before the Supreme Court rules on the legality of the Trump tariffs, and importers now have to register on a new customs platform in order to be able to receive any type of refunds. Details on the new digital payment system were announced on January 2nd, and importers have until February 6th to register. If they don't, customs specialists tell CNBC importers could have delays in refunds. The new system is called ACE and was part of an executive order signed by President Trump back in March. It's designed to modernize the government payment system, which originally was manual. A decision by the Supreme Court on tariffs could come as early as Friday. CNBC has reported earlier importers have pushed back on President Trump's claim that the tariff payments would be messy because the tariff bills the importers have been paying are itemized. If the Supreme Court does rule the tariffs or part of the tariffs are illegal, the Court of International Trade has the legal authority to decide how the refunds are paid to U.S. importers.
And the tariff ruling is expected at 8:30 p.m. You can catch our special coverage from Washington, D.C. and Wall Street starting 7:30 p.m. White House economic advisor Kevin Hassett, veteran investor Mohammed El Arian, and many other experts will join us live to decode the verdict as and when the Supreme Court does decide to rule on the matter. Get the CNBC Edge 7:30 p.m. onwards. We will be tracking all the action live. Now, President Trump has acknowledged that his administration will have to choose between pursuing his ambition to take control of Greenland and keeping NATO intact. In an interview with the New York Times, Trump said that ownership of the Arctic island, a Danish autonomous territory, was, and I quote, psychologically needed for success. The president also maintained he did not feel answerable to international law, but is constrained only by his own conscience. Meanwhile, Denmark's defense ministry has said it will respond immediately to any foreign invasion without waiting for political clearance or formal orders. And days after Venezuelan leader Maduro's extraction in a pre-dawn raid, the U.S. Senate has advanced a resolution asking President Trump to seek the Congress's permission before engaging in any further hostilities in the Latin American nation. The resolution, the first notable pushback to Trump's expansionary ambitions, was introduced by Democratic Senator Tim Kaine. It was passed by a margin of 52 to 47, with 5 Republican senators breaking ranks to support the measure. Trump, in a post on Truth Social, said that the Republicans should be ashamed of the senators that just voted with the Democrats. Now, India's External Affairs Ministry has reacted to the threat from the U.S. of imposing 500% tariffs on countries that trade with Russia. The MEA spokesperson Randhir Jaiswal speaking just a short while ago, reacting to Lindsey Graham's bill. Take a look.
We are aware of the proposed bill, the bill that she referred to. We are closely following the developments around the bill. Our position on the larger question of energy sourcing is well known to you, and I have spoken about it on several occasions in the past as well. In this endeavor, we are guided by the evolving dynamics in the global market, as also the imperative to secure affordable energy for our 1.4 billion people through diverse sources to meet their energy security needs.
That is the MEA reacting to Lindsey Graham's proposed bill, which he said in its tweet could move as quickly as next week. Shares of Vodafone Idea rose in early trade after the company announced that it has received communication from the telecom department on the AGR dues. In an exchange filing, the company said AGR dues for the period between FY07 to FY19 will be frozen. The company will have to shell out a maximum of 124 crore rupees annually over the next 6 years. That is between March of 2026 to March of 2031. After that, the payment will be 100 crore rupees annually over 4 years, and that is between March of 2032 to March of 2035. The remaining dues will be spread over another 6 years from March 2036 to March 2041. This move has come more than a week after the cabinet had frozen AGR dues worth more than 87,000 crore rupees for the next 5 years. It also provided the company a 10-year time frame to pay the amount, so significant relief there coming in for Vodafone. The AGR overhang perhaps now put behind. And staying with Vodafone Idea receiving this much-needed relief, sources indicate that banks are now considering granting fresh loans to the company. Ritu joins us now with more details. Ritu, this has been a clear overhang for Vodafone Idea. How are banks likely to now view the company's position and its efforts to raise debt?
Well, after that AGR relief, the most critical cue for Vodafone Idea is going to be that 25,000 crore rupee bank loan and whether that now comes through. Remember, these debt-raising discussions with lenders have been stalled for months because of uncertainty over the company's AGR dues. But with that relief now coming in, and importantly, with some visibility on this cash flow relief for the next 10 years, our banking sources indicate that the process to release fresh funding for Vodafone is going to start right away. In fact, we understand that the SBI-led consortium of banks is more or less aligned on extending this fresh line of credit to Vodafone. But before they take the final proposal to their respective boards, they are going to await the last word from the DoT committee. But it is a green signal from lenders for now, and that should bring some much-needed relief for Vodafone in terms of the timeline. Once the process starts now, it may take up to 2 months for the funding to be released. Now, in terms of who the top lenders to Vodafone are, SBI, as we know, alone has an exposure, we understand, of more than 6,300 crore rupees, and that is followed by Punjab National Bank, almost 1,500 crore rupees, Axis Bank, IndusInd Bank, Canara Bank, IDBI Bank. These are some of the other large lenders that are involved as well. The total bank dues are around 11,000 crore rupees, and that includes both the term loans and the working capital loans across fund and non-fund-based exposures.
All right, many thanks for joining us. Now, another stock in focus, shares of Indian Energy Exchange declining in trade today amidst uncertainty over implementing the market coupling rules. The Electricity Appellate Tribunal sought clarity on the Central Electricity Regulator's withdrawal of the order. The CERC reclassified its order on market coupling as a direction and not as an order. This was just before the hearing. The regulator also maintained it will implement the order only after issuing regulations, adding that these regulations have not even passed the draft stage yet. The tribunal will hear the case on the 19th of January, so the uncertainty continues. We'll head into a break, but up next, West Bengal Chief Minister Mamata Banerjee leads a rally in Kolkata a day after a dramatic showdown with the ED during searches at premises linked to IPAC. That and more when we return. Well, let's revisit the big story. India's External Affairs Ministry is now responding to comments made by U.S. Commerce Secretary Howard Lutnick. The spokesperson, Randeep Jaiswal, said the way the status of the talks has been characterized in the statements is not accurate. Howard Lutnick had claimed a trade deal with India did not happen because Prime Minister Modi did not call President Trump. This was his response to CNBC TV18's Parikshit Luthra. Take a look.
We have seen the remarks. India and the United States were committed to negotiating a bilateral trade agreement with the US as far back as 13th of February last year, that is. Since then, two sides have held multiple rounds of negotiations to arrive at a balanced and mutually beneficial trade agreement. On several occasions, we have been close to a deal. The characterization of these discussions in the reported remarks is not accurate. We remain interested in a mutually beneficial trade deal between two complementary economies and look forward to concluding it. Incidentally, Prime Minister and President Trump have also spoken on phone on 8 occasions during 2025, covering different aspects of our wide-ranging partnership.
The characterization of Commerce Secretary Howard Lutnick's remarks is not accurate. That is the statement coming in from the MEA. Now, Elon Musk's AI tool Grok has turned off the image generator option for most users and limiting it to paying subscribers. This after widespread outcry over the generation of sexually explicit images of users. Meanwhile, sources tell CNBC TV18 that the Indian government is unhappy with the response from Grok and is in fact considering legal action. Ashmit joins us now with more. Legal trouble likely for XAI and Grok?
Well, it seems to be so, and especially bear in mind that it's just Friday of last week when the Indian government had in fact dispatched a letter to X whereby they had warned of such trends that are being noticed by the government, such instances, such user harm being caused, and subsequently had warned of action that may be taken by the government. Now, there was a report that was sought from X. X submitted that report, submitted their response by Wednesday of this week, but highly placed sources within the government, they tell us that they're not happy with what X had to say. X essentially had attributed blame to user-generated images, had said that in future, if there are any such instances taking place, X will not be shy of taking down such accounts. But these responses have not quite met the concerns that were raised by the Indian government. And to that end, we understand that MeitY is looking at various legal options. It is firming up a legal opinion as to what could be the legal steps that could be followed. And while Grok, of course, appears to be the trigger, the broader concern that the Indian government appears to have is that there are sexually explicit, obscene content online. And to that end, let's bear in mind that as the 2025 was fading out, they had come out with an advisory. And in that advisory aimed at social media companies, they had warned against hosting such obscene content, warning that it could potentially lead to either one, a loss of safe harbor protection to the social media company, or two, even criminal action under the BNS. So clearly, the government considering options, contemplating legal action against X.
All right, Ashmit, many thanks for joining us. The big political story, West Bengal Chief Minister Mamata Banerjee led a rally in Kolkata a day after her dramatic showdown with the ED during searches at the premises linked to IPAC. Meanwhile, the Kolkata High Court has adjourned the hearing on ED's plea seeking an FIR against Mamata, citing an unmanageable crowd in court. From Kolkata to Delhi, TMC MPs, including Derek O'Brien and Mahua Moitra, were detained while staging protests outside Home Minister Amit Shah's office. The lawmakers had gathered with placards criticising Shah a day after ED searches at the premises linked to IPAC, a consultancy firm handling Trinamool Congress's election strategy. And with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC TV18. Stay tuned. Plenty more coming up after this break.
Hello and welcome. You're watching Global Lens with me, Parikshit Luthra. Our top story tonight, 2026 is shaping up to be a tipping point year for the global order. According to the Top Risks 2026 report by Eurasia Group, the world is entering a phase of heightened instability driven by geopolitics, economic fragmentation and rapid technological change. Among the key risks flagged is artificial intelligence, where growing pressure to justify valuations is pushing companies towards socially dysfunctional business models. Next, China's deflation trap, raising the risk of global spillovers as imbalance between capacity and demand increases. Another major risk highlighted is quote-unquote overpowered. The report warns that China is tightening its grip over the electric and industrial technological stack, while the United States continues to bet heavily on fossil fuels. This power balance could reshape global supply chains, Russia's second front, with Moscow intensifying hybrid warfare against NATO, extending the conflict well beyond the Ukraine battlefield. But the report is clear. The single biggest risk in 2026 is the United States itself. It warns America is in the midst of a political revolution, with President Trump weakening institutional checks, politicizing the state and redefining how power is exercised. The implications are global. A more unpredictable Washington weakens alliances, unsettles markets, and accelerates more fragmented and conflict-prone world as well. Let's now get you the latest on US-Russia tensions. This could be another flashpoint, another risk point in 2026. US President Donald Trump backs the Russia sanctions bill, says Senator Lindsey Graham, who is speaking with other lawmakers to build consensus ahead of the vote. Graham slammed Russia, saying that the bill would give President Trump the power to penalize countries buying cheap Russian oil, giving the US leverage over China, India and Brazil. He expects the bill to be presented to the Senate as early as next week, aiming for a strong bipartisan vote. Here's what the bill does and why it matters for India. If passed, it gives the president the power to punish Russian officials who refuse peace talks with Ukraine. Any further invasion or subversion of Ukraine would also carry consequences. The bill allows the president to impose tariffs of 500% on Russia and 500% also on countries importing Russian uranium and petroleum products. Tariffs could be increased further if imports continue. Since India imports Russian oil, it could face the 500% tariff if the bill becomes a law. However, India's imports from Russia have already declined since last year's US sanctions. According to Kepler, India's Russian crude imports are projected at 1.3 million barrels per day in January, but stopping imports would require government action in India. The bill also allows the US to block visas of the Russian president, key military commanders, and anyone supplying defense items to Russia. Additionally, US authorities could freeze Russian financial institutions, assets, and ban the export or re-export of US-made energy products to Russia. Earlier this week, Graham said that India stopped buying Russian oil because of the imposition of tariffs, while Trump warned that tariffs could be raised very quickly.
If you're buying cheap Russian oil, keeping Putin's war machine going, we're trying to get the president the ability to make that a hard choice by tariffs. I really do believe that what he did with India is the chief reason India is now buying substantially less Russian oil. So I hope we pass this bill soon. And after this...
They wanted to make me happy, basically. He wanted to. Modi's a very good guy.
Yes.
He's a good guy. He knew I was not happy, and it was important to make me happy. They do trade. And we could raise tariffs on them very quickly, and it would be...
He's more afraid of that.
The White House has said that the US President Donald Trump and his team are actively discussing an offer to buy Greenland from Denmark. Speaking to reporters, White House Press Secretary Caroline Leavitt reiterated President Trump's view that the acquisition of the Arctic island would deter Russian and Chinese aggression in the region. This comes a day after the White House said that using the US Army to take Greenland is always an option.
President Donald Trump reasserted in the new year that the United States wants Greenland.
We need Greenland from a national security situation.
Trump said a newly appointed special envoy would lead the charge, drawing sharp criticism from Denmark and Greenland. Let's take a look at why Trump is interested in the vast Arctic territory. Greenland is strategically significant for the US military. The shortest route from Europe to North America runs through it. The US has said it wants to expand its existing military presence on the island. That includes placing radars to watch waters in the region used by Russian Navy vessels and nuclear submarines.
Right now, Greenland is covered with Russian and Chinese ships all over the place.
Shipping data show most Chinese and Russian activity in the Arctic is in waters near Russia. But more broadly, the Arctic is becoming more militarized, with NATO states, China and Russia all expanding activity there. The island is also rich in minerals, oil and natural gas, though development has been slow and mining has seen very limited US investment. Legally, Greenland is a territory of Denmark, which is a NATO member. In 2009, it was granted broad self-governing autonomy. That includes the right to declare independence from Denmark through a referendum. Polls show most of Greenland's 57,000 inhabitants back independence, but many of them also fear a hasty move for independence could leave them worse off and expose the island to the US. The US military has a permanent presence in an airbase in northwest Greenland. In 1951, the US and Denmark made an agreement. It gave the US the right to move around freely and construct military bases on the island as long as Denmark and Greenland are notified. Trump offered to buy the island during his first presidential term, a move Danish Prime Minister Mette Frederiksen called absurd. In late 2025, Trump named a special envoy to Greenland, Louisiana Governor Jeff Landry, who publicly backs the idea of the island becoming part of the US. Frederiksen has since said Denmark wants to continue being a good ally of the US, while also saying that Trump's threats should be taken seriously. In a joint statement pushing back on Trump, she and Greenland's Prime Minister Jens Frederik Nielsen said Greenland belongs to Greenlanders, saying, quote, "You cannot annex another country, not even with an argument about international security."
To discuss all this, I'm now joined by Ian Bremmer, President of the Eurasia Group. Thank you very much, Ian, for joining us. Let me begin by one of the top risks mentioned in your report, the political revolution of Donald Trump. How do you think 2026 will end up? Will it end up succeeding the political revolution of Trump and improving the dominance of America in the global order, or diminishing it?
In the near term, Trump's consolidation of power is leading to a number of wins for the United States. You just saw that in Venezuela, of course. You've seen it with the way that a lot of the trade negotiations have asymmetrically benefited the U.S. because the U.S. is the most powerful country. But even though the U.S. is the most powerful country, Donald Trump is not the most powerful leader. Xi Jinping is. And that's because Xi Jinping doesn't have term limits. He doesn't have checks and balances internally. He doesn't have an independent judiciary. He doesn't have a professionalized military that reports outside his structure. Trump has all of those limitations. And of course, the purpose of the political revolution is to end that. It is to ensure that the president is above the rule of law and that the U.S. political system can be weaponized against Trump's political enemies the way that he believes that it was weaponized against him in the Biden administration. So, I mean, the risk, of course, is that that process is continuing, and not just in 2026, but over the remainder of the Trump presidency. The other part of your question, though, was, will he be successful? I suspect he will fail. I'm not completely confident of that, but I think it's likely he will fail. There are three reasons that I think he'll fail in increasing order of importance. First is he's not very popular. He's likely to lose the House to the Democrats in November in midterm elections. And as a consequence of that, there are more Republicans that will start to think of him as a lame duck and will move away from him as president and the political revolution that he is supporting. Number two, more important and more likely, is that there still are important checks and balances that are stopping Trump in some of the acts that he is engaging in. The independent judiciary, which is likely to rule on constraining his trade powers, for example. The courts overturning the ability to send the National Guard into Chicago just in the last week. as I mentioned, the professionalized military, a federal system where governors and mayors are much more independent and have a lot of control over things like how elections are actually conducted. Very important in preventing a political revolution. And third, and most important, is that Trump lacks discipline. Trump has a great deal of policy incompetence, and he doesn't like to listen to his advisors because he's quite confident that he's right about everything. And if you want to be successful in a political revolution, you need to prioritize that. You don't focus on Greenland or Venezuela. You spend all of your time focusing on how do I destroy the Democrats who are my principal enemy. And that is not what Trump is particularly interested in or capable of doing.
Right. So, of course, you need some sort of policy continuity as well. Now, coming to the tariff wars, we saw tariff wars for the whole of 2025. Do you think tomorrow's court ruling on tariffs, on the legality of these tariffs, will be a check? Or do you think Trump still has toolkits in his bag which he could deploy to give legal effect to those tariffs? How do you see this war, tariff war in 2026?
I'm not a jurist, so I don't have the expertise to tell you how the Supreme Court is going to vote. But I can tell you that it is very clear that the IEEPA clause, which is meant to be applied in a national emergency by the president, is clearly not the intention to be used against 90-plus countries for political purposes, against Lesotho. I mean, there's no national emergency in many of these cases. So I do think that the Supreme Court, at a minimum, is likely to constrain the use of IEEPA in some of these purposes. That doesn't mean that they will overturn everything. They might not decide to rule on the entire scope of what Trump has engaged in. Doesn't mean they're going to claw back all of the revenue that has been collected. We'll see. But I do think that the Supreme Court is not going to give him a rubber stamp and say, you have all of this control. The president can do whatever he wants, even though most of the tariff powers are meant to reside in the hands of Congress, the legislature.
Right. 2026 and even 2025 is becoming more and more about oil wars. Trump has done that by going into Venezuela, arresting Maduro, and saying that we'll control the Venezuelan oil fields. He has seized a Russian tanker. He has given a green light to Lindsey Graham's bill, which would allow him to impose 500% tariffs on goods from countries like India because we buy Russian oil. How do you think this could trigger a geopolitical conflict with Russia, with China?
I think that oil prices are quite low right now, right? They're about $50 because there's not a lot of demand and there is a lot of supply. And that's even including almost 2 million barrels a day that OPEC members are keeping off the market. And with all the geopolitical conflict that we're seeing in the Middle East and Venezuela, Russia, Ukraine, it hasn't really changed that dynamic. So, I mean, the topics that you're discussing, you're right that they are all about the United States seeking to increase its influence as the world's most powerful petrostate, presently producing 13.5 million barrels a day, and perhaps nominally controlling in the future the world's largest oil-proven reserves in Venezuela and offshore Venezuela. But I don't think that that is causing an increase in conflict in the near term because there's lots of oil that's available. Trump has not said that he's going to cut off Venezuelan oil from China, and he clearly wants to work with the Chinese going forward. He's looking forward to his trip to Beijing and his meeting coming up with Xi Jinping because the Chinese are powerful and have the ability to check Trump's power in a way that the Venezuelans, for example, do not. Also, let's keep in mind that while the Americans are investing in oil and gas and coal, the Chinese are investing in batteries and wind and solar and nuclear and all of the supply chain for critical minerals to power that. And oil and gas and coal, these are 20th century technologies that are not getting materially cheaper over time. the post-carbon energy technologies, the prices are coming down steeply as the technology improves. So this is really a much smarter strategic bet by the Chinese to become an electro state as opposed to a petro state. That will particularly matter in powering and exporting artificial intelligence going forward.
Right. You've spoken about the Donroe Doctrine as well. What could this strong implementation of the Donroe Doctrine in Latin America lead to in 2026?
It's already leading to America telling the Venezuelans, you will do what we want or else, on oil, on drugs, on migrants, and potentially even on the future of governance in Venezuela, whether there'll be a transition from the existing regime, which is still in place with the exception of Maduro, to something that is more representative of the Venezuelan people. That is not going to be easy to do. And the United States is now a critical actor, perhaps the critical actor, in determining those outcomes. So suddenly this is becoming a real life issue, and the Americans will, have a big impact in what happens with that drug transit going forward. What happens with the migrants, 8 million migrants from Venezuela already, even more than we've seen from Syria. And of course, what happens in Venezuela will not stop in Venezuela. The Donroe Doctrine also will apply to other countries with governments that he is opposed to, that Marco Rubio is opposed to, Nicaragua, for example, Cuba, very consequentially, for example, as well as the demands that Trump is making that Greenland needs to be American under American, not Danish sovereignty. And this is, of course, the territory of a NATO ally, and Trump doesn't seem to care very much about that.
Absolutely. I'm going to take a short break on that note, Ian, but stay with us. We'll be right back. We want to discuss risks around China, around Russia and NATO, the Ukraine war, India-US trade deal. There's so much more to talk. We'll be taking a break and be right back. Welcome back to Global Lens. Ian Bremmer continues to be with us, and we're discussing the big global risks of 2026. Ian, India has been negotiating a trade deal with the United States. We still don't know whether Donald Trump will sign on it. Do you expect the president to use the threat of tariffs even more against India this year in 2026?
Well, we do see that Trump has sort of delayed and extended out these negotiations by adding terms in a couple of occasions now. And most recently, it's all about ensuring that the Indians cut off all of their purchasing of oil from Russia. And, you know, it's kind of interesting because while we look at the Ukraine case, and Trump has put a lot more pressure on the Ukrainians than on the Russians because they're weaker. He thinks they can capitulate, but he wants the war over, and he is putting some pressure on the Russians. And of course, Delhi has faced that very directly. I expect that notwithstanding all of these bumps in the road, that there is enough interest in both countries to ensure that this eventually gets done at some point this year. I think the reason it's taken time is in part because it's just not that urgent. There's not a lot of trade between the United States and India. Even if tariffs are really high, the impact on a very fast-growing Indian economy, expected some 8% in 2026, just isn't that great. So it's not like Canada or Mexico or the Europeans that really had to get this deal done right now. There's less urgency when it comes to the U.S. and India.
Right. The 500% tariffs, if they were to become a reality, what could possible triggers be as a result of that?
Triggers in terms of what? Upsetting both governments?
Triggers in terms of spoiling relations or maybe triggering conflicts geopolitically?
I don't think that so often, Trump makes these outlandish statements and they're meant to, really, he gets impatient. He wants an outcome and it leads to better negotiations. And that's what I think is going to happen here. This is really just Trump not happy that the soup is taking so long to be made, wondering why it is that he hasn't had a deal to announce. His advisors throwing India under the bus, saying, it's not my fault, boss, it's those Indians. They're very, very hard to work with, and they're making all these very unreasonable demands. And Trump is much more powerful, and he says, well, that's it. This is what I'm going to do. But I really don't think, if you looked at the national security strategy from the U.S. a month ago, the Quad is in there as a priority of the U.S. The Americans continue to stand that up, including the military, the intelligence coordination. U.S.-India relations are important for a lot of key constituents of Trump. A lot of these tech companies that are driving the U.S. economy are investing a lot in India right now. They want this deal to get done. I'm not really particularly panicked about that statement.
Right. I'd also go and talk to you about the China deflationary trap, which your report says will deepen in the year 2026. What's your outlook going to be on China, and how will the developments in China have a ripple effect on the global economy?
Well, they're kicking their own problems down the road, and it's a strong government, and they have the ability to do that. So, I mean, their willingness to engage in further stimulus is very incremental. It's not fundamentally fixing all of the corporate debt that is non-functional. It's not addressing the lack of consumer demand. And what it means is that the one part of China's economy that's driving all the growth is the extraordinary amount of export of cheap manufactured goods. That was $1 trillion surplus last year. It'll probably be higher this year. So the implications for other countries around the world is that China is essentially pushing their economic problems onto those countries. And that will limit some of the improved relations that China otherwise could expect to benefit from, because Trump is so much more unreliable and because the Chinese are driving such effective new technologies that these countries need.
Right. the risks for India in 2026 that you see?
I think India is in one of the better positions of countries out there in a G0 world. India has a reasonably stable relationship with the United States, though less than it has been in the past years, including with Trump. India is seen as a leader of the global South, and India also has quite strong relations with the non-US G7, the exception of Canada, though it's better than it was under Trudeau. And all of that with more stability between India and China that both Modi and Xi Jinping have been working on for the last year really helps India. And the reason all of this is happening is because India has now a strong leadership that's been in place and engaged in the same foreign policy, the same economic reforms, and the same geopolitical strategy for over a decade now. None of the European governments can say that. The Japanese can't say it. The Americans can't say it. The only other countries that can are the Gulf states and China, countries with scale. And those are countries that also are doing comparatively well in this environment. Not a surprise.
All right. Thank you very much, Ian Bremmer, for joining us with that very interesting and comprehensive worldview on what could happen in 2026, how India stands to gain or lose, and the possible flashpoints as well. Thanks once again for being with us. That's a wrap on another edition of Global Lens. Goodbye and thanks for watching.
Hello and welcome. You're watching News Center. I am Ashmat Kumar. Now, the face-off between the Enforcement Directorate and the Trinamool Congress has intensified. West Bengal Chief Minister and TMC Supremo Mamata Banerjee led a protest rally today against the Enforcement Directorate. This comes a day after the agency raided IPAC's office in Kolkata in connection with an alleged gold scam case. The TMC has termed the raid as politically motivated. In Delhi, 8 TMC MPs, including Mahua Moitra, Derek O'Brien and Kirti Azad, held a dharna outside Home Minister Amit Shah's office. They accused the centre of weaponizing investigative agencies to intimidate the opposition parties. Dramatic visuals emerged as Delhi police forcefully evicted and detained the MPs as they tried to enter the Kartavya Bhavan. Earlier, the TMC moved the Calcutta High Court alleging that the ED unlawfully seized confidential political data linked to preparations for the upcoming West Bengal elections. The party has sought a restraining order against any misuse or dissemination of the seized documents. This comes after the ED approached the High Court seeking a CBI probe against the Chief Minister, Mamata Banerjee. The agency alleges that Banerjee entered ABAC's chief Prateek Jain's residence during the raid, removed key documents and illegally interfered with a money laundering probe linked to the coal smuggling case. The High Court was scheduled to hear both the petitions today. However, the matter has been adjourned to January 14th following disorder in the courtroom.
आप लोग कल पूरा भारत ने देखा, कल बंगाल में देखा, कल पूरा भारत ने देखा ये कैसे दुरुपयोग करके ईडी का गृह मंत्रालय से कैसे दुरुपयोग करके उन्होंने दुरुपयोग करके हमारे पार्टी का जितना भी राजनीतिक स्ट्रेटेजिक इंफॉर्मेशन है वो चोरी करने के लिए ईडी को भेजा और ममता बनर्जी शेरनी है वो सीधा वहां जाके वो प्रोटेक्ट किया हमारे सामान को।
एक सीनियर पॉलिटिशियन, एक चीफ मिनिस्टर जो संविधान हाथ में रखते हुए ओथ लिया है, उनका इस तरीके से कार्रवाई सीधा संविधान के ऊपर हमला है। इन्वेस्टिगेशन एजेंसी अपने काम करेगा, लेकिन यहाँ सरकार चेंज होगा तो भारतीय जनता पार्टी का आने वाला सरकार सबके ऊपर कार्रवाई करेगा, स्पेसिफिक एफआईआर करेगा।
Well, joining us now to discuss this is with us Mr. P.K. Jain, retired IPS officer and former Additional Director General of Police and Advocate, and former Judge Mr. Bharat Chugh. Mr. Chugh, Mr. Jain, thank you so much for joining us. Mr. Jain, let me come across to you. A very interesting question of an ED investigation, ED search and seizure operations being underway, a constitutional position holder like a chief minister of a state coming to intervene and, as per the ED, interfere and obstruct this search and seizure operation. At the heart of it, of course, is the assembly elections not very far away in the state of West Bengal. So let me begin by asking that the concerns being raised by TMC is that this is a politically charged search and seizure operation, that the ED has been weaponized. Let me begin by asking, does the timing of this search and seizure raise questions or concerns about credibility of the ED's case into the Bengal coal scam case?
Good evening, Ashmit. Thank you very much for having me here. See, I would like to state that in this country, till the time we have one country, one nation, one election, elections keep on happening with a regularity. I think all the year round, some election or the other is always on, and the code of conduct and things like that are always there. Now, it is seen to be a future election which is going to come up in the coming few months. So there are a lot of hackers about it. I do not understand for once, why would a chief minister be required to go to an individual's house and harass the ED, file FIRs against them, take away important documents from that residence, stating that the confidential party information was being taken away? The confidential party information would be at the party headquarters or at best the functionaries of the senior functionaries of the party. Why would it be lying at a businessman's house? And the very fact that she has taken away this entire material and the way she has conducted herself is absolutely derogatory. I mean, I, as an ex-bureaucrat or as an ex-police officer, would just not vouch for it. I mean, she has committed an offense. And coming to think of it, I think it's a constitutional crisis that the CM has been actively preventing these central officials from performing their duty. And I think the government of India should take an action and impose president's rule, but they will not do it because of the political implications again. So that's why the matter is lying now in the court. Unfortunate, but that's a fact of life today, Ashmit.
Right. Let's take that across to Mr. Chugh as well. Mr. Chugh, I'm not sure if you can see the visuals that are running on our screens right now. Visuals, very dramatic visuals. Chief Minister at the location of this search and seizure operation being conducted. We're seeing voluminous documents being moved out. What do these visuals tell you? Is this on the face, prima facie, a case of obstruction, a crossing of Lakshman Rekha, so to speak?
Thanks, Ashmit, for that. I think, the one point that's very central to this is no matter how high you may be, you are not above the law. If there is an investigation, let alone by a central agency, done by any agency, any interference with that investigation is something that is an obstruction of justice. No matter who you are, you may be the chief minister, you may be any other high functionary, but you have no right to take law into your own hands in that sense. If the case is, and that is what I'm hearing, if the case is that this is an illegal search or a seizure, or this is a political witch hunt, or this is meant to take away political strategy and to raise or get an unfair advantage in the elections, and that is the motivation of this prosecution or investigation, then you have judicial remedies against it. That's point number one. So I don't think I can condone, or anyone who's a student of law can condone, somebody who's an individual showing up and obstructing or taking evidence or documents in their own possession. But be that as it may, there's another point that's very, very important, which is of number one, the draconian ways in which some central investigative agencies have acted. And these are not my words. Now, if you look at the PMLA, which is the law that governs the functioning of the Enforcement Directorate and how they conduct their investigations, you will see there are very little safeguards. And we've seen cases where the Central Investigative Agency, without obtaining any search warrant, without check and balance, without any form of safeguards, they have showed up at premises in the garb of investigation. They have taken away confidential documents. They have taken away crucial documents. In some cases, they have taken away computers and servers and machines, which have brought the business of many people to a grinding halt, the functioning of organizations to a grinding halt. So we also have to keep that in mind. Now, the reason for that is twofold. One is there are design problems in the PMLA itself. If you look at the world over, and Mr. Jain probably would agree with me, world over, most searches are conducted in the course of investigation after a warrant which has the approval of a judicial agency or a judge who satisfies himself or herself on the need of that search. What is to be sought to be recovered? What is this investigation about? Why are we doing it now? Is it a case where you can obtain these documents by a non-coercive process by asking the person to cooperate in the investigation? All of that is checked by a judicially trained mind, an independent mind, before somebody just shows up at somebody's residence. But unfortunately, under the law, you do not have that safeguard. The ED is given the power to conduct the search itself without those pre-judicial safeguards. And that, again, is a bit of a problem, whether in this case it was merited or warranted.
Mr. Chugh, if you can just hear us.
Yes.
If you can, I'll just interject there. There are broader concerns about the conduct of the ED, concerns about the PMLA as well. But that's for another date. For now, I just want, for the benefit of our viewers, to focus on this political case that we currently have on our hands. I just want to ask one follow-up question, that given the timing of this ED search and seizure operation, for an ED, for a central investigative agency to raid a political party or its consultancy firm ahead of the assembly elections, does that in any shape or form raise questions about perhaps propriety, questions of perhaps privilege that a party can claim in such a matter?
Absolutely. This needs to be justified in terms of the timing, in terms of how it is sought to be done. This is, and it is no secret that the central government and the agencies have also gone to court wanting to protect electoral bond secrecy. Wanting no political party at this crucial juncture would want their strategic points, their planning to come out to the public domain. If it goes into the hands of a competing political party in a heated election, that is an unfair advantage. So all of this has to be seen. And that is the reason I was making that point, that any independent judicial body has to supervise, oversee, and monitor this search before it happens, not after it happens. And that is going to take care of a lot of concerns in such matters.
Right. That's an interesting question that now the High Court will have to deliberate on. But while we're on the subject, let's go across to Mr. P.K. Jain as well. Mr. Jain, we're given to understand that under Section 17 of the PMLA, the ED has a very, very wide set of powers available to it in terms of search and seizure. And not only that, the courts historically have given a wide berth to the officers, allowing very, very limited room for removal of documents, of removal of evidence from such a site of a search and seizure operation. Does that put Mamata Banerjee front and center for some form of action under the PMLA if this is found to be a case of obstruction?
See, Ashwit, I would disagree with my fellow panelist, Mr. Chugh. So the reason is all the other acts in which the offense is cognizable, the investigating officer gets the power to arrest and search automatically under the law. Even in IPC, now the BNS, the same powers are there with the police officers. So there is nothing new that the ED has got in this case. The only thing in the case of ED is that when a person is arrested, the onus of proving not guilty is on the person rather than the agency. In other laws, in many other laws, not in all the laws, in many other laws, the onus of proving guilt is on the agency, investigating agency. In this case, the onus is on the accused or on the suspect, whatever it is. So there's no difference between other laws and ED, that PMLA, as far as the search and seizure is concerned. So the ED was within their right to conduct searches. ED was within their rights to seize property or incriminating documents, if at all that was the case. So I think I think this overseeing the operations of ED by a judicial authority, I think it is an overreach by the judiciary. I would not like to agree with Mr. Chok that it should be overseen by judiciary. It in any case goes to the judicial court. The person cannot be held in custody for more than 24 hours before he's produced.
We're running a
court. So what it is, I mean.
Right, Mr. Jain. We're running out of time. I'll just come to our panelists for a quick closing comment. Mr. Chugh, the argument that is being made by TMC MPs, we saw them today as well, dramatic visuals coming in from New Delhi. The question that they're raising is that, look, these are politically sensitive documents that are being taken over by the ED, may be possibly misused for the upcoming elections. Is that any protection that may be available to Mamata Banerjee, to TMC as they head into the hearing before the Calcutta High Court?
See, the fact that there is an impending election is not protection by itself, and it shouldn't be. The fact that this was a raid being conducted on an organization which was advising them on the political strategy is again not a protection. But there is enough and more circumstantial evidence for the court to be extremely skeptical and circumspect and ask tough questions to the ED on why these documents could not be, for example, photocopied, backupped, or sought in a non-coercive fashion. And only when there was non-cooperation from either this company or these individuals, then they could take this very, very coercive step. And these questions would be asked and hopefully answered in the court of law.
Right. Right. And one final comment from Mr. Jain. Mr. Jain, given that this is a face-off between a constitutional authority, the CM's chair, and the Enforcement Directorate, the central investigating agency, what is the way forward looking like? Does this have to be a CBI probe that will now have to deliberate on it? Does this have to then go to the doors of the Apex Court, the Supreme Court of India, for there to be some kind of neutrality?
Actually, the matter is already is now before the High Court. I'm sure the High Court will take a view on this. They've already deferred the matter till 14th of January. So apparently, they also see that there's nothing hurriedly, there's no hurried decision in this matter. They will deliberate on the subject and take a call on 14th. Let's see how the things turn in the in future. Ashmit.
Right, Mr. Jain, that's a contest that's set before the Calcutta High Court on January 14th. We'll, of course, be keeping an eye on that. I'd like to thank both of our panelists, Mr. Chugh, Mr. Jain, for joining us, sharing their perspective. With that, heading into a very short break, but don't go anywhere. With just a week to go for the BMC elections, we get you conversations with Shiv Sena UBT leader Aditya Thackeray and Deputy Chief Minister Eknath Shinde on the other side. Welcome back. After an agonizing wait of 4 years, Mumbai is gearing up for civic body elections. Voting is scheduled for the 15th of January. Infrastructure delivery, roads and urban governance are emerging as key campaign issues. In an exclusive conversation with my colleague Santya Gora, Maharashtra Deputy Chief Minister Eknath Shinde promised that Mumbai will be completely free of potholes with the completion of concretization by the end of 2026. However, Shiv Sena UBT leader Aditya Thackeray claimed that anyone claiming that the entire city can be concretized in a year or two is lying.
जब मैं मुख्यमंत्री बना तब मैं आपको बताता हूं कि पहले हमने काम हाथ में लिया पूरी मुंबई का कंक्रीटाइजेशन करना, डांबर के रोड को ख़त्म करना। ये 25-30-40 साल तक अभी कोई गड्ढा नहीं होगा। पॉटहोल फ्री मुंबई करना हमारा मकसद है।
सर लेकिन मुंबई पॉटहोल फ्री हुई नहीं है अभी।
कर रहे हैं ना, आप देखिए ना, आपके लोगों को भेजिए।
सर मैं खुद ट्रैवल करती हूँ। 2022 में जब आप मुख्यमंत्री बने थे, आपने कहा था कि 2024 तक, हाँ आपने कहा था कि 2024 तक पॉटहोल फ्री कर देंगे। जी
देखिए, मैं कभी भी जो कहता हूँ करता हूँ। अभी अगले 1 साल में आप लगभग ये मई में एक बड़ा पोर्शन कंप्लीट हो जाएगा, मई में, उसके दिसंबर तक पूरा कंप्लीट हो जाएगा। तो ये 1 साल के भीतर में मुंबई में आपको गड्ढा नहीं दिखेगा, ये मेरा वादा है।
2022 में आप मुख्यमंत्री बने थे, आपने कहा था कि 2024 तक सारी सड़कें जो हैं वो मुंबई की गड्ढा मुक्त हो जाएंगी। नहीं, देखिए कैसे एक ही साथ मुंबई को हम पूरी तरह मुंबई के सभी रास्ते शुरू नहीं कर सकते ट्रैफिक की वजह से, तो फेज वाइज हम कर रहे हैं। लेकिन हमने पूरी मुंबई के सड़कें जो है कंक्रीटाइज करने का निर्णय लिया है, उसका काम शुरू हो चुका है और वो लगभग काम कंप्लीट हो जाएगा। जो हम बोलते हैं वो करते हैं, ऐसे नहीं हम जो नहीं होने वाला नहीं बोलते हैं। इंफ्रास्ट्रक्चर को लेकर के आपकी युति का बड़ा जोर है, लेकिन जब ये पूरे इंफ्रास्ट्रक्चर के काम चलते हैं पूरे शहर में, हम जैसे जो आम मुंबई करते हैं, हमारे लिए बड़ी परेशानी का सबब होता है। ट्रैफिक जैम होते हैं, सुबह जिस रास्ते से निकलें शाम को वो रास्ता बंद हो जाता है। उसकी वजह से जो अब तो एयर क्वालिटी पे भी इतना पिछले कुछ सालों में असर देखने को मिल रहा है। तो इंफ्रास्ट्रक्चर बूस्ट ठीक है, समझ में आता है, थोड़ी बहुत परेशानी लोगों को होगी ये भी समझ में आता है, लेकिन आप रात में सो रहे हैं तो रात में कंस्ट्रक्शन के काम शुरू हो जाते हैं, तो मुंबई का कहा जाए और कितना इंतजार करें?
देखिए, अभी मुंबई में जितने कंस्ट्रक्शन के काम शुरू है उनको एक रूल्स के मुताबिक काम करना पड़ता है। पूरा कर्टन से उसको ढकना पड़ता है, उसको स्प्रिंकलर लगाना पड़ता है क्योंकि मिट्टी धूल ना उड़े, लोगों को तकलीफ ना हो।
पर उसके लिए बॉम्बे हाई कोर्ट ने कहा कि जब उनके पैनल ने चेक किया तो ये सब कुछ फॉलो नहीं करवाया था।
नहीं फॉलो नहीं कराया तो फॉलो बिल्कुल करना चाहिए और बिल्कुल करेंगे। अभी देखो AQI अभी मुंबई का बाकी शहरों से कम है। तो
मुंबईकरों को अब इन सब चीज़ों से मतलब ये जो सड़कें कंस्ट्रक्शन की वजह से खुदी हुई हैं पूरी तरीके से, रास्ते बंद हो जाते हैं, ट्रैफिक, इससे कम निजात मिलेगी?
थोड़ा अभी
कुछ थोड़ा टाइमलाइन हमें मालूम पड़ जाए सर।
नहीं, अगले 1 साल तक खत्म हो जाएगा सब, क्योंकि देखो कुछ अभी पाने के लिए थोड़ा तो सहन करना पड़ता है। अभी
सर ये थोड़ा बहुत ज्यादा हो गया मुंबई का।
अभी आप जब मुंबई में पूरे कंक्रीटाइजेशन हो जाएगा तो ये तकलीफ ही नहीं होगी, क्योंकि फिर बाद में रास्ता खोदना तो बिल्कुल बंद ही हो जाएगा।
सर एक और चीज़, मैं CAG रिपोर्ट के बारे में बात करना चाहूँगी। पिछले ही महीने CAG की रिपोर्ट जो है वो ऑडिट रिपोर्ट सामने आई थी। अब इसमें 2-3 चीज़ों के ऊपर मैं बात करना चाहूँगी। पहला, कोविड के टाइम पे जो बांधकाम मजदूर, कंस्ट्रक्शन वर्कर्स जो थे, उनके लिए उस वक्त की जो महाविकास अघाड़ी सरकार थी उनकी तरफ से चाहे वो मेडिकल कैंप हो या मिड डे मील स्कीम हो या फिर एक सहायता राशि हो, ये सारी स्कीम स्टार्ट की गई थी। सेफ्टी किट और एसेंशियल किट वगैरह का भी डिस्ट्रीब्यूशन। पर CAG की रिपोर्ट बता रही है कि इसमें धांधली हुई है। जैसे कि जो फिनेंशियल असिस्टेंस है वो राशि जो है वो एक ही अकाउंट में कई बार गई और ऐसा कई बार हुआ है। आप उस वक्त सरकार में थे और आप अर्बन डेवलपमेंट मिनिस्टर भी थे, आप बड़े नेताओं में से थे शिवसेना के, तो ये चीज, इसके बारे में आप क्या कहेंगे सर?
मैंने तो
क्या आप तक की बात कभी पहुंची या फिर?
नहीं, मैंने तो कई बार कहा है कि देखिए कोविड के समय में ऐसा ये धांधली करना, करप्शन करना, ये तो पाप है।
लेकिन सरकार आप ही की थी सर, आप ही की पार्टी की।
कारपोरेशन में हम लोग नहीं थे ना। कारपोरेशन में हम कोविड के टाइम हम नहीं थे
सर। 2022 में खत्म हुआ था
कारपोरेशन के टाइम हम नहीं थे।
नहीं सर, 2022 में BMC का टर्म खत्म हुआ था, ये 2020 की बात बता रही हूं।
नहीं 2020 में हम नहीं थे, वही तो कारपोरेशन में नहीं, सरकार में हम थे। सरकार में महाविकास आघाड़ी के सरकार में थे, हमारे महायुति के नहीं।
हाँ नहीं, महायुति नहीं थी लेकिन महाविकास आघाड़ी
तो वो आप उनका दोष हम पर मत थोपिए। जो जिसके लिए जिम्मेदार है उसको बिल्कुल उसके ऊपर ही जिम्मेदारी जानी चाहिए।
All I can promise is common sense in governance, sensitivity and sensibility in governance, and of course bringing good governance back again.
But what happened up to 2022? Now, who will take the responsibility? Because when I spoke to the deputy CM, he said, I have nothing to do with it.
No, he has selective memory because he doesn't...
You guys were, you know, undivided Shiv Sena, and you guys were there.
In terms of 2022, like I said, our holdings have shown what we have done. And I'm here the whole day to speak about what...
But do you take the responsibility of what's not...
Yes, because when you are taking credit for what has happened, you also take accountability for what has not happened and will be happening.
Okay. So Mumbai will become pothole free and
100%.
flood
But
free.
for that, you need these big contractor-friendly government mechanisms to go away and make it citizen-friendly again.
But let me talk about those 25 years as a Mumbaiker, and you know this question is from Mumbaikars. You rightly said that these elections are about sadak, nala, gadha.
Absolutely. The BMC is probably the only municipal corporation in the world to have gone beyond its primary duties of healthcare and education into super specialty ones. So in terms of education, we have 1,235 schools running free of cost, 3.5 lakh kids, 8 mediums of learning, digitization through tabs, virtual classrooms, co-curricular and extracurricular activities, for example, gender equality through football, sports, astronomy clubs, nature club, all of that. In terms of the roads, when we were in government, not all roads were with us. For example, the Western Express Highway, the Eastern Express Highway, the Eastern Freeway were always with the NHAI.
But 2014 onwards, you were with BJP in government.
Correct, let me come to that, right? We were constantly following up for the roads to be handed over to us. For example, BPT owns a lot of roads. In Mumbai, 16 agencies run Mumbai. If you look at the record of the BMC roads, look at Marine Drive, look at Pedder Road, look at a lot of eastern suburb roads also, or western suburb roads that are under the BMC, they have been concretized. Now there are two things to this. In a very, very candid manner, let me tell you, anyone who tells you all roads in a city like Mumbai, with a traffic density like Mumbai, can be concretized in the next 1 year or 2 years is lying to you.
But when we talk about two key things, first, flooding and waterlogging every year, every monsoon in Mumbai, there is no respite there, and potholes. So your opponents are claiming that they are going to make Mumbai pothole free. But my question is, in the last 25 years, such a long period of governance, you guys dominated BMC. Why couldn't you deliver on these two fronts?
Yes, waterlogging has been a major issue
every single year
historically for Mumbai. In the past 25 years, the Brimstone project brought about 6 pumping stations. Each pumping station has basically a huge pump that pumps out thousands of liters of water per second, which makes Mumbai, we had waterlogging when we started off for the first 2-3 days. With the Brimstone, it's come to a couple of hours where you have a cloudburst or anything beyond 400-500 mm per day. Now that is one. 2, we had also started doing rainwater holding tanks. So if you remember, there were 2 historic spots of waterlogging in Mumbai. One was Hind Mata, where the press would gather first, and the other was Milan Subway. In 2021...
For us, those spots have changed, by the way.
Exactly, right? In 2021...
No, but they're still spots.
In 2021, we made rainwater holding tanks there. We put flood-proof pumps there, flood-sucking out pumps there.
Right.
For the first 2 years, it did not flood. Very happy, elated. Chalo, our work has been successful. But of course, there's a process to it. Last year, in 2025, why did it flood? Because the BMC, under the BJP administrator, did not put fuel into the pumps and did not start the pumps on time.
But which years are you referring to? Because
last year.
No, of course. I have been doing this
we're
for the last...
2026 now, right? Yeah.
So, I have been doing this for the last 11 years. It floods every year.
Correct, but if you go 2021, 2022 and early 2023, it did not flood. Milan Subway did not flood. Hind Mata did not flood.
But the spots did change.
Yes, because you will always have new flooding spots whenever infrastructure work is going on. Okay. The Metro 3 work has put in so much of cement slurry into some of our nalas that they need to be broken.
So now, should you win?
We need to plan these things in a better way, right? Currently what has happened is the CM and the 2 DCMs do not have love for Mumbai. They're not Mumbaikars. They only want to loot the city. And this is the biggest problem.
Well, with that, it's a wrap on this edition of News Center. More news and updates will continue right here on CNBC-TV18.
Hello and welcome to the Budget Countdown. I'm Timsi Jaipuria. With less than 4 weeks left for the Union Budget, Ernst & Young has come out with a list of recommendations for the Finance Minister. The accounting giant has stressed on tax continuity and certainty. It has also called for stimulating private investments and incentivizing companies that generate employment opportunities. So what else is on their wish list? Let's ask the experts themselves. To take the discussion forward, I'm now joined by Pranav Saita and Saurabh Agarwal, tax partners at Ernst & Young. And straight away coming to Pranav first, because direct tax is something that has seen a lot of changes. We saw a new act coming in altogether. However, rules are still awaited. And when it comes to tax certainty, well, everyone has been talking about tax certainty. And what is it that you want the government to look at? What kind of certainty are you looking at when it comes to direct tax side? Because we've seen the regime becoming quite stable when it comes to corporate or the personal income tax side. So what kind of certainty is it that the industry is now looking at from the government?
Indeed, Timsi. So as you rightly said, the government has been doing a lot in terms of providing more certainty, clarity, reducing litigation, and so on. One of the steps that they have taken, therefore, is introducing the Income Tax Act, the new Income Tax Act 2025, which will go live from April 1 this year, 2026. And what we are hoping is that the government provides clear guidance on the transition provisions as we go ahead, clear set of rules and forms which are still awaited, and maybe some form of FAQs to ensure that when one moves from the current 1961 Act to the new 2025 Act, it happens in a seamless manner in terms of the transition. We are also looking at certain anomalies in the current Income Tax Act, which probably could be clarified. Like, for example, under the 61 Act also, demergers were tax neutral so long as they fulfilled certain conditions. So also in the 2025 Act, but there's some change in language which results in some form of confusion. Whether a fast-track demerger, which has been particularly promoted by the government in terms of its effort to enhance ease of doing business, whether that would qualify for tax neutrality, whether buyback of shares will entirely be regarded as deemed dividend, allowing no deduction for cost of acquisition to shareholders, whether employees receiving ESOPs, irrespective of whether they are in startups or in other companies, can defer the taxation to when the liquidity event happens, when they actually receive the monies on sale of the shares, and so on. So there are several points on which we are hoping to get some clarification, some certainty. Even in terms of acquirer of shares today, because of an anti-abuse provision that has been introduced, if shares are acquired, for example, at a price which is less than the fair value as per the prescribed rules under the income tax, then that shortfall, the price at which the shares have been acquired by a buyer and the prescribed fair value, that discount is deemed to be income in the hands of the buyer. Now, those prescribed rules are under the new Income Tax Act yet to be prescribed, but one is hoping that genuine
that's what I was,
Pranav,
I'll interrupt you there, because all of that you're talking about is actually parts of the rules which is expected any time. To be precise, already they were expected last calendar year, and now we are expecting them to come out shortly. So a lot of this, I believe, government is looking at and is considering as part of the rules, isn't it? Didn't you get that kind of a feedback from the government?
No, I'm not too sure they are considering that. We have represented, of course, and many of these require changes to the law. For example, the section 56 to 10 in the hands of buyer of shares, bona fide genuine transaction should not be covered, is required through an amendment to the law. Similarly, fast track demerger, a clarification or an amendment to the law by way of, clarifying that fast track demergers will also qualify for tax neutrality is required in the law, so that a demerger under 233, section 233 of the Companies Act should also become part of the relevant provision under the Income Tax Act for demerger. So many of these require actually amendments to the law as well. Some of them, of course, can come even through a clarification by way of a circular or a rule. But ideally, most of them will require an amendment to the law itself, which can happen best under the budget provisions.
Yes, as part of the finance bill. Coming to Saurabh now on the indirect tax side, customs dispute resolution is on your wish list, something which the industry has been demanding for quite some time. How would you place it on your wish list, and what is it that you are hearing back? What is the feelers that you're getting from the government? Saurabh, you're on mute.
I think, for the last 3 years, it has been on our wish list. And the reason being precisely, when you look at once the GST was rolled out in 2017, majority of the state VAT departments, they have come up with a dispute resolution or a so-called as amnesty or a settlement scheme, followed by which we have seen even under the GST law, some sort of a relief was given in order to bring down disputes last year. When we look at subsequently, even under the Income Tax Act, there was a Vivad Se Vishwas scheme which has come. But as far as the customs are concerned, it's long time since when lot of disputes are pending before various tribunals, before various courts. And many of these disputes are of a small number. And the way that this government has been looking at, the policymakers' thought process has been very clear that they want to bring in certainty of taxes. They want to bring down the number of disputes. And we have seen it happening by way of issuance of clarifications, by way of issuance of circulars, by way of amendment in laws as far as GST is concerned. But as far as customs is concerned, this has been a big time ask of the industry. And the way when we look at the focus is on making a self-reliant economy, promoting manufacturing. So at least as far as the past is concerned, I think some sort of dispute resolution for one-time settlement of disputes is something which industry has been watching out for. And we are also looking forward to hear from the...
And I must say, it is not just EY. Every industry chamber, every big four is asking that the industry is waiting for a dispute resolution mechanism, be it in indirect taxes or indirect taxes. So something that or across the sectors, every industry is asking for this. Coming back to Pranav again, on the TDS side, a lot of rationalization has happened on TDS. We saw some rationalization happening in the last budget also. What is it that you're now looking for on that front? Because that again features on the wish list of the industry.
Sure, Timsi, a very good question indeed. So on the TDS side, when it comes to particularly tax deducted source from payments made to residents, we have currently almost 37 different provisions for different types of payments and categories of payments.
for each of which there is a different rate of TDS, different threshold limits, and so on and so forth, making the law quite cumbersome. Given the way the government has been moving to simplify the law, make it clearer, our expectation is that they should have probably just 3 to 4 categories of TDS. One is, of course, TDS on salary payments, which is based on the slab rates of taxes. The other is a punitive rate, which is the highest rate for earnings from lotteries, gambling, and so on, which is 30% TDS. And then there could be maximum 1 or 2 rates for TDS, and all payments should be covered within these 1 or 2 categories, so that there is no dispute, uncertainty, ambiguity as regard which category a particular payment falls under, and the compliance also can significantly reduce. So both litigation and compliance reduces. Now again there, one of the points that we are looking at on is, in certain cases the TDS is as low as 0.1%, probably because at a time when they wanted to track certain transactions, it was important to deduct TDS at 0.1%, not so much as a tax collection mechanism, but to ensure the transaction is tracked by the tax authority.
That was only for reporting. That was only for a reporting mechanism.
Now, exactly right. Now what we are saying is, wherever a transaction is covered by GST, it is already being fully tracked, and therefore, at least for those cases, remove this 0.1% TDS, because it results in significant amount of compliance for corporates and for businesses. And that's therefore what our ask again is, an expectation.
But that mapping between GST and direct taxes has to be more robust in real-time basis. Only then that TDS provision can go, is what I personally feel. Because as you rightly said, a lot of these rates are only for reporting, not merely a tax collection tool. And that government has been talking about also very openly that these are only for reporting. So that's why it's just 0.1%.
And increasingly,
so something on that side is...
Sorry, Timsi. So increasingly the government
on that
has...
side, I feel...
The government has enhanced its digital agenda and is now tracking direct and indirect taxes pretty well. In fact, in many cases, the reconciliation that is sought for creates a lot of questions itself, which is a subject by itself. But yes, therefore, now a lot of tracking from a GST standpoint and reconciliation between direct and indirect taxes already started happening.
I'll stop you there and I'll go to Saurabh now on something that Finance Minister herself has spoken about. And she said that that will be her priority for the upcoming budget. That is custom tariff rationalization. Rationalization now on the custom side. We've seen GST rationalized. We've seen direct tax regimes rationalized. Customs is still waiting. And again, we saw some rationalization happening last year as well. We saw some tariff lines going and only a limited were kept. What sort of a rationalization can actually happen? Can government do that? Something on that, Saurabh.
So, Timsi, rate rationalization we have seen in GST, the government has been able to actually bring in that particular change, which was much sought of by the industry. When we look at the customs rate rationalization, I think the focus of this government has been around manufacturing. It's about Atmanirbhar. Not just Atmanirbhar, we are moving towards Bharat Par Nirbhar is what the focus of the government is. If that be the focus, while production-linked incentive schemes has been able to push the manufacturing agenda, what the industry today wants is that along with the production-linked incentive schemes, which have been rolled out in around 19 to 20 odd sectors, with the overall, you can say, revenue outlay of 2.8 lakhs to 2.9 lakh crores approximately, until financial 24-25, they have factored around 25,000 crore, which they'll be dispersing during this financial 25-26. I think the focus of the government should be to divide look into a particular sector, divide the material into finished goods, intermediaries, and raw material. The finished goods should be made subjected to a higher rate of duty, intermediaries in a medium rate of duty, and raw material at a lower rate of duty, assuming that the raw material is most tough to manufacture. Now, if that be the case, we have seen in the mobile phone industry, what has happened? Over a period of time, they increased the rate of duty on mobile phones in order to ensure that they develop a manufacturing into the country. And thereafter, once the manufacturing got evolved into the country, they brought down the rate of duty in order to ensure it is a level playing field
for a foreign manufacturer as well as an Indian manufacturer.
I'm sure Finance Minister is listening to this, and she's definitely wanting to give a level playing field to the industry, be it on the custom tariff side or on the PLI side, and especially on the direct tax side. Well, time for a short break, and many thanks. So those were some of the key highlights of the budget wish list of Ernst & Young. But yes, time for a short break. Coming up next, India Inc. urges the government to make special economic zones more lucrative. Call for relief on customs duty front, among others. A special discussion up next, right after the break. Welcome back. You're watching the Budget Countdown. A more lucrative SEZ ecosystem has been a constant ask of the industry. Under existing rules, domestic manufacturers can freely supply raw materials or inputs to the SEZ units. However, when they try to buy finished goods or semi-finished goods from SEZs, the transactions attract duties. Industry has sought changes to the current law, which would make it easier for the Indian manufacturers to buy goods from SEZ units. Well, joining us now to take this discussion forward is former Chairman CBIC Najib Shah and Anurag Sehgal, Principal at Pricewaterhouse. A very warm welcome. Let me begin with Anurag first and then come to Mr. Shah, because the industry is demanding that SEZs have been in talks and they are expecting the government to bring in some change, considering that they've seen a slew of FTAs being negotiated. There is a demand that SEZs should now be made more lucrative, continue their economic viability, where duties should be a little more relaxed or more attractive, if not reduced to nil, on direct selling within the country. Anurag, what is the ask, and why are you asking for this, or why is the industry asking for this, for that matter?
Thanks, Kinsey. And very rightly said, the industry is demanding easing of fiscal norms from SEZ for DTA transfer. And also rightly said that this is in the context of the slew of FTAs being signed for India. What industry realizes is the government of India is very clear on three policy objectives: Make in India, export from India, and deepening value addition and R&D in India. Now, for that, industry is wanting that SEZ should also be realizing their full potential. And to realize their full potential, what industry is asking is one of the earlier asks, which was there in the Desh Bill, the Desh Bill, which has not moved forward. And the ask was that when you transferred manufactured goods from the SEZs to the DTA, the duty, customs duty, should be paid only on the duty foregone amount on the goods which are sourced from abroad. Now, that is the ask which will bring SEZ units also back in the game from the perspective of domestic manufacturing for the domestic market. That is the ask of the industry. And clearly the ask of the industry is in the context of government's stated policies, which I just mentioned, Make in India, Atmanirbhar Bharat, deepening value addition in India. So clearly it is in that line what industry is asking from the government.
Coming to Mr. Shah on this demand, sir, do you think that this ask is actually valid? There is merit in this ask, and can government take that hit? Because SEZs were launched with the concept that they are only export-oriented.
Look, I think the purpose of an FTA is very different from why SEZs were instituted in the first place. FTAs seek to, cut down tariffs, eliminate tariffs, give access to market. But the fact of the matter remains that exporters under the FTA have not been doing exactly very well because of the challenges of infrastructure, logistics, etc. Here you have created a territory within your country which is said to be free from these constraints which have come in the way of exports. So SEZs have been created as little islands, oases within the country where none of these rules and regulations will apply because they get everything duty-free. Now, be it imports, be it any domestic procurement. That being so, the fact of the matter remains that whatever they produce or manufacture is primarily meant for export, and they've not been doing too badly. Last year, I just checked up their numbers. They have done around US dollars 172 billion. So they've not been doing badly. So they can supplement the FTAs in that the FTAs open the markets and the SEZs can exploit those markets by making export products competitive. So no, I do not agree with this ask of the industry that FTA imports, FTA domestic clearances should not be subject to duty merely because FTA imports are also having reduced tariffs.
Well, given this viewpoint from Mr. Shah, coming to you, Anurag, considering as Mr. Shah explained that they haven't done that badly. So the performance is decent enough, and that might nullify the ask that they need to be made more lucrative. So why do you want to continue, or why does the industry still want to push this particular demand when the performance is decent enough? I mean, 142 billion is not bad at all, to be fair.
Totally, Timsy, it is. I won't say that the performance of SEZs have been bad, but the context has changed. Context has evolved over the decades. The SEZs came into existence, and we have to realize that these are not special export units. These are special economic units. So when special economic zones are being talked about, the reality of economics, the reality of changes in the economics in the past couple of decades has to be taken into account. And one of the realities is that India is wanting to go higher up in the value chain, manufacture more and more, contribute to the domestic economy as well as the export sectors. And for that, why to restrict any of the section of the economy from the manufacturing competitiveness, which economy at scale brings, which SEZ brings. And that is the reason the industry is asking that, thank you, you allow us to export, but please allow us to process and supply to the domestic industry also at a reasonable cost. So the idea is to
I'll stop you there and also take you to the Desh Bill. The idea of Desh Bill was to replace the SEZ Act. And a lot of changes were proposed on somewhat similar lines, not on the duty side at least. But yes, when it comes to that, SEZs were an older concept. Now they need to be replaced with a new bill or a new act, to be precise, to make them more attractive, more viable. What is the difference that you are looking at from the draft of the Desh Bill that you want the government to consider now? Because Desh Bill was also a proposal in the union budget itself. However, it is still stuck, I agree.
So, Tingsy, from the industry perspective, if I can summarize Desh Bill, I would mention there are two basic premises on which Desh Bill was focused. A non-fiscal premise, wherein you had procedural and regulatory ease for the industry, and a fiscal premise, which allowed for manufacturing not only for exports but also for the domestic market. The argument which we are advocating now. Government is already showing the intent to carry out both the objectives, both the premises of the Desh Bill. If you notice, last year, mid-June, government carried out regulatory and procedural ease by amending some of SEZ rules. For example, for priority sectors like semiconductors and electronic components, the contiguous area requirement of 50 hectares was reduced to 10 hectares. So government is already inching towards, the procedural ease. If government goes towards fiscal ease also, I guess the intent of the Desh Bill will be met. So whether or not Desh Bill, which has been stuck, sees the light, the industry gets benefited, the intent gets materialized. And that is what industry is looking forward to contribute to Make in India.
Coming to Mr. Shah on this point, that a lot of the changes that are coming in or were brought in the SEZ Act, basically the land rule, because getting a contiguous land was a major issue for the industry, and that government also realizes, because part of its responsibility lies on the government also on land acquisition. So how would you counter the industry's view if you think that SEZs should continue the way they are?
Look, the purposes of why an SEZ created has not been obliterated. It's still been created as an economic zone, undoubtedly, as Anurag has mentioned, but with an aim to promote exports and, more importantly, to ensure there's a parity between goods which are brought in there and cleared into the domestic area and the goods which are manufactured within the domestic area. That's a key requirement, really, that there should be parity. Merely because I've got goods produced in the SEZ and it's going to be cleared in the domestic tariff area, I should not get the benefit of lesser tariffs, because you have been given a lot more benefits which the domestic industry is struggling to get. Better infrastructure, better facilities, lesser requirements of law, lesser procedural requirements. So you have got a whole host of benefits. Exploit that and compete with the domestic sector also on the same footing, not on a priority footing where you start getting lesser tariffs. So anyway, we'll see how this all pans out.
So that's very critical, that the taxman continues with the tax perspective and says that enough has been given from the government side, enough of benefits given, so why not then reap the... that is the interest that they were looking on, that is the revenue collection. So the taxman is not willing to let go the revenue that he looks at from these units if you are actually wanting to do the direct selling. Well, a tough ask and a tough call for the government is what it looks like, because if a former taxman continues with that view, I'm sure the current government would definitely have this view in its mind. And yes, they must be looking into your demands as well. And with that, it's a wrap on this special broadcast. Thank you for watching. Up next, a lot more on the other side. News continues here.
Hello and welcome to Business 360. I'm Shriram Finance. The headlines that we're tracking for you this evening. The Sensex and the Nifty post the biggest weekly fall in 4 months. 15 lakh crore rupees in market cap wiped out in the last 5 sessions. All sectoral indices close in the red. US Commerce Secretary Howard Lutnick claims a trade deal with India did not happen because Prime Minister Modi did not call President Trump. Says India missed the train and countries that moved first got better terms. The United States Supreme Court is scheduled to pass a ruling on the legality of President Trump's sweeping tariffs. The order is likely to address whether the Trump administration can use provisions under the Emergency Economic Powers Act to levy tariffs. Shares of Indian Energy Exchange tumble amidst uncertainty over implementing market coupling rules. The Central Electricity Regulator reclassifies its order on market coupling as a direction before the appellate tribunal. This after SEBI alleged insider trading by CERC officials. Tribunal will now hear the case on the 19th of January. Vodafone Idea receives an official communication from the government on relief in the AGR case. Will pay 124 crore rupees annually for 6 years starting March 2026. Sources say banks will consider granting fresh loans right away. The government is likely to table a bill to amend the National Highways Act to make land acquisition easier. Sources say land parcels will be returned to original owners if it remains unused for 5 years. The amendments are likely in the upcoming budget session of Parliament. West Bengal Chief Minister Mamata Banerjee leads a rally in Kolkata a day after her dramatic showdown with the ED during searches at the premises linked to IPAC. The High Court adjourns hearing on the ED's plea seeking an FIR against Mamata, cites unmanageable crowd in the courtroom. Iran plunges into a total internet blackout as protests over the economy spread across the country. The Supreme Leader Ayatollah Khamenei denounces the protests, alleges US interference. At least 45 protesters have been killed by security forces in the last 2 weeks. Tensions rise in the US over President Trump's immigration crackdown. Border Patrol agents shot and wounded 2 people in Portland. This follows the fatal shooting of a woman in Minnesota on Wednesday, deepening the rift between state and federal officials. Elon Musk's AI tool Grok turns off the image generator option for most users and limits it to paying subscribers. This after widespread outcry over generation of sexually explicit images of users. Sources say the Indian government is unhappy with the response from Grok and is considering legal action. Well, all of that and more coming up for you, but let's start with the day's market action. The Sensex and the Nifty posting losses for the 4th straight session. In fact, all frontline indices have dropped nearly 1% each, with Realty being the biggest losing index. That's the Nifty for you, down almost 200 points, 600 cut there on the Sensex. The Nifty mid-cap down 470 and another 400 points gone there on the Nifty Bank. More than 35 Nifty stocks ended in the red today. But let's bring up the picture for the week. The market snapping its 2-week gaining streak and posting its biggest weekly fall that we've seen in the last 4 months. 2.5% lower on the Nifty, 1.5% on the Nifty Bank, and the Nifty Mid-Cap Index 2.5% lower for the week. BSE listed companies have raised market cap of more than 15 lakh crore rupees this week. The Nifty slipping nearly 2.5%. All indices have reported cuts of up to 6%. Nigel joins us now to wrap up the market action. Nigel, it's been a tough and a very volatile week. What's the market anticipating as we look ahead?
Well, it was another weak trading session for the Indian markets. The Nifty registered the 5th straight session on a losing streak. The advance decline ratio was very, very weak yet again. You had only 1 stock that was advancing, 4 stocks that were declining. And the problem is that now some of those technical levels as well are falling apart. The Nifty and the Nifty Bank, both of them breached the 20 DMA. However, what's giving you some kind of glimmer of hope is that the Nifty PCR has come down to around 0.63. That's another technical factor that you target. And normally, when you look at the Nifty PCR at around 0.6, 0.65 odd, when you look at that and it comes in this vicinity, traditionally we've seen a bit of a bounce. So the hope is that we do see that. In today's trading session, actually, the tech stocks ahead of their numbers. Well, you had some of these tech stocks that outperformed. HCLTech, Forge, both of them were up close to 100%. And commodity-related themes, they came for profit-taking yesterday, but they bounced back today. Nalco was strong all through the trading session. The street believes that demand-supply gap on aluminium will continue, keeping aluminium prices strong. So that's why that one was up. Oil India as well. We had the management talking to us here on CNBC-TV18. They're talking about ramping up production, both on gas as well as on the oil verticals. So that stock as well was up close to 2%. And Hindustan Zinc did pull back some of its losses that we saw yesterday. However, there were some casualties from the broader markets as well. IEX, there was hope that the courts will give some kind of leeway, some kind of relief in today's hearing. However, that didn't come about. The next date is Jan 19th. So that's where that stock, after bouncing up initially, that did sell off. And Manappuram Finance was the other casualty. That stock as well was down in trading session because unconfirmed reports coming in from Reuters suggested that maybe that deal with BIN has run into some rough water. So some clarifications are awaited on that front. Net expectations very low getting into the weekend. We have two big global events. One is the US court's verdict with regard to the tariffs and the US jobs report as well. So the markets going into the weekend with no expectations, if in case you get a bit of a positive trigger, and given that we're at an oversold level, the hope is that next week we see some kind of stability and then hopefully some kind of a bounce back.
Many thanks for joining us and staying with the markets. Inflows into equity mutual funds declined by 6% in December. That's as per the data released by industry body AMFI. Inflows in December coming in at about 28,000 crore rupees compared to nearly 30,000 crores in November. Inflows into gold ETFs surging nearly threefold to more than 11,600 crore rupees in December compared to under 4,000 crore rupees in November. And SIP flows, by the way, hitting another record high, crossing the 31,000 crore rupee mark for the first time. So even as equity mutual fund inflows decline, SIP inflows have remained steady. On to the energy markets, where crude oil prices are on track for a third straight week of gains. This amid fears of supply disruption given the prospects of Russia-related sanctions and a drone attack on a Russia-bound oil tanker near Turkey's coast in the Black Sea. Investors are now awaiting the outcome of President Trump's meeting with U.S. oil company executives on investments in Venezuela's oil sector. But the big story, U.S. Commerce Secretary Howard Lutnick claims that the trade deal between India and the U.S. did not happen because Prime Minister Modi did not call President Trump. Speaking on a U.S. podcast, Lutnick said, and I quote, "It is President Trump's deal. He is the closer. He does it. It's all set up. You have got to have Modi call the president." They, meaning India, were uncomfortable doing it. So Modi didn't call, end of quote. Lutnick's remarks have come days after President Trump claimed that Prime Minister Modi was not happy with him because of the high tariffs imposed on India. Here's Howard Lutnick.
Everybody asked the president, who do you think is next? And if you look back at the time, he talks about a variety of countries, but he names India a couple of times publicly. It's not like a big secret. And we were talking India, and we told India you had 3 Fridays.
You put them on a shot clock.
Well, they have to get it done because what happens is I have lots of other countries, and when those other countries do their deal,
the staircase goes up.
And now the president, during all these deals, he would refer to me as the greatest table setter who ever lived. Okay, because you've never had anybody who was as successful as me as a businessman before, who's just the table setter. That's basically, so, because what I would do is I would negotiate the contracts and set the whole deal up. But let's be clear, it's his deal.
Yeah.
Okay, he's the closer, he does the deal. So I said, you got to have Modi, it's all set up, you have to have Modi call the president. They were uncomfortable doing it. So Modi didn't call.
Wow.
So that Friday left. In the middle of the next week, we did Indonesia, the Philippines, right? Vietnam. We announced a whole bunch of deals.
Malaysia in that period.
So we did these whole bunch of deals. So that's like
that staircase.
And they were and because we negotiated them and assumed India was going to be done before them, I had negotiated them at a higher rate. So now the problem is the deals came out at a higher rate.
Right.
And then India calls back and says, oh, okay, we're ready. I said, ready for what?
Well, that is Howard Lutnick claiming that the US-India trade deal didn't go through because the Prime Minister did not call President Trump, and by the time that India was ready, the train, in his words, had left the station. Ian Bremmer, the president of the Eurasia Group, says there is less urgency within the Trump administration to seal a trade deal with India. Speaking exclusively to CNBC-TV18, Bremmer said the delay is all about India buying oil from Russia. However, he also said that the relationship with India is important to President Trump and the administration. Take a look.
Trump has sort of delayed and extended out these negotiations by adding terms in a couple of occasions now. And most recently, it's all about ensuring that the Indians cut off all of their purchasing of oil from Russia. The reason it's taken time is in part because it's just not that urgent. There's not a lot of trade between the United States and India even if tariffs are really high, the impact on a very fast-growing Indian economy, expected some 8% in 2026, just isn't that great. You know, if you looked at the national security strategy from the U.S. a month ago, the Quad is in there as a priority of the U.S. The Americans continue to stand that up, including the military, the intelligence coordination. U.S.-India relations are important for a lot of key constituents of Trump. A lot of these tech companies that are driving the U.S. economy are investing a lot in India right now. They want this deal to get done. I'm not really particularly panicked about that statement.
Well, that's Ian Bremer. Now, it's a development that could have global implications. The U.S. Supreme Court is scheduled to pass a ruling on the legality of President Trump's sweeping tariffs. The order is likely to address whether the Trump administration can, in fact, use provisions under the Emergency Economic Powers Act to levy tariffs. Now, if the court rules that Trump's tariffs are illegal, importers can apply for refunds by the 6th of February. CNBC's Lorianne LaRocco joins us now with more.
We can be just hours or weeks away before the Supreme Court rules on the legality of the Trump tariffs, and importers now have to register on a new customs platform in order to be able to receive any type of refunds. Details on the new digital payment system were announced on January 2nd, and importers have until February 6th to register. If they don't, customs specialists tell CNBC importers could have delays in refunds. The new system is called ACE and was part of an executive order signed by President Trump back in March. It's designed to modernize the government payment system, which originally was manual. A decision by the Supreme Court on tariffs could come as early as Friday. CNBC has reported earlier importers have pushed back on President Trump's claim that the tariff payments would be messy because the tariff bills the importers have been paying are itemized. If the Supreme Court does rule the tariffs or part of the tariffs are illegal, the Court of International Trade has the legal authority to decide how the refunds are paid to U.S. importers.
And the tariff ruling is expected at 8:30 p.m. You can catch our special coverage from Washington, D.C. and Wall Street starting 7:30 p.m. White House economic advisor Kevin Hassett, veteran investor Mohammed El Arian, and many other experts will join us live to decode the verdict as and when the Supreme Court does decide to rule on the matter. Get the CNBC Edge 7:30 p.m. onwards. We will be tracking all the action live. Now, President Trump has acknowledged that his administration will have to choose between pursuing his ambition to take control of Greenland and keeping NATO intact. In an interview with the New York Times, Trump said that ownership of the Arctic island, a Danish autonomous territory, was, and I quote, psychologically needed for success. The president also maintained he did not feel answerable to international law, but is constrained only by his own conscience. Meanwhile, Denmark's defense ministry has said it will respond immediately to any foreign invasion without waiting for political clearance or formal orders. And days after Venezuelan leader Maduro's extraction in a pre-dawn raid, the U.S. Senate has advanced a resolution asking President Trump to seek the Congress's permission before engaging in any further hostilities in the Latin American nation. The resolution, the first notable pushback to Trump's expansionary ambitions, was introduced by Democratic Senator Tim Kaine. It was passed by a margin of 52 to 47, with 5 Republican senators breaking ranks to support the measure. Trump, in a post on Truth Social, said that the Republicans should be ashamed of the senators that just voted with the Democrats. Now, India's External Affairs Ministry has reacted to the threat from the U.S. of imposing 500% tariffs on countries that trade with Russia. The MEA spokesperson Randhir Jaiswal speaking just a short while ago, reacting to Lindsey Graham's bill. Take a look.
We are aware of the proposed bill, the bill that she referred to. We are closely following the developments around the bill. Our position on the larger question of energy sourcing is well known to you, and I have spoken about it on several occasions in the past as well. In this endeavor, we are guided by the evolving dynamics in the global market, as also the imperative to secure affordable energy for our 1.4 billion people through diverse sources to meet their energy security needs.
That is the MEA reacting to Lindsey Graham's proposed bill, which he said in its tweet could move as quickly as next week. Shares of Vodafone Idea rose in early trade after the company announced that it has received communication from the telecom department on the AGR dues. In an exchange filing, the company said AGR dues for the period between FY07 to FY19 will be frozen. The company will have to shell out a maximum of 124 crore rupees annually over the next 6 years. That is between March of 2026 to March of 2031. After that, the payment will be 100 crore rupees annually over 4 years, and that is between March of 2032 to March of 2035. The remaining dues will be spread over another 6 years from March 2036 to March 2041. This move has come more than a week after the cabinet had frozen AGR dues worth more than 87,000 crore rupees for the next 5 years. It also provided the company a 10-year time frame to pay the amount, so significant relief there coming in for Vodafone, the AGR overhang perhaps now put behind. And staying with Vodafone Idea receiving this much-needed relief, sources indicate that banks are now considering granting fresh loans to the company. Ritu joins us now with more details. Ritu, this has been a clear overhang for Vodafone Idea. How are banks likely to now view the company's position and its efforts to raise debt?
Well, after that AGR relief, the most critical cue for Vodafone Idea is going to be that 25,000 crore rupee bank loan and whether that now comes through. Remember, these debt-raising discussions with lenders have been stalled for months because of uncertainty over the company's AGR dues. But with that relief now coming in, and importantly, with some visibility on this cash flow relief for the next 10 years, our banking sources indicate that the process to release fresh funding for Vodafone is going to start right away. In fact, we understand that the SBI-led consortium of banks is more or less aligned on extending this fresh line of credit to Vodafone. But before they take the final proposal to their respective boards, they are going to await the last word from the DoT committee. But it is a green signal from lenders for now, and that should bring some much-needed relief for Vodafone in terms of the timeline. Once the process starts now, it may take up to 2 months for the funding to be released. Now, in terms of who the top lenders to Vodafone are, SBI, as we know, alone has an exposure, we understand, of more than 6,300 crore rupees, and that is followed by Punjab National Bank, almost 1,500 crore rupees, Axis Bank, IndusInd Bank, Canara Bank, IDBI Bank. These are some of the other large lenders that are involved as well. The total bank dues are around 11,000 crore rupees, and that includes both the term loans and the working capital loans across fund and non-fund-based exposures.
All right, many thanks for joining us. Now, another stock in focus, shares of Indian Energy Exchange declining in trade today amidst uncertainty over implementing the market coupling rules. The Electricity Appellate Tribunal sought clarity on the Central Electricity Regulator's withdrawal of the order. The CERC reclassified its order on market coupling as a direction and not as an order. This was just before the hearing. The regulator also maintained it will implement the order only after issuing regulations, adding that these regulations have not even passed the draft stage yet. The tribunal will hear the case on the 19th of January, so the uncertainty continues. We'll head into a break, but up next, West Bengal Chief Minister Mamata Banerjee leads a rally in Kolkata a day after a dramatic showdown with the ED during searches at premises linked to IPAC. That and more when we return. Well, let's revisit the big story. India's External Affairs Ministry is now responding to comments made by U.S. Commerce Secretary Howard Lutnick. The spokesperson, Randeep Jaiswal, said the way the status of the talks has been characterized in the statements is not accurate. Howard Lutnick had claimed a trade deal with India did not happen because Prime Minister Modi did not call President Trump. This was his response to CNBC-TV18's Parikshit Luthra. Take a look.
We have seen the remarks. India and the United States were committed to negotiating a bilateral trade agreement with the US as far back as 13th of February last year, that is. Since then, two sides have held multiple rounds of negotiations to arrive at a balanced and mutually beneficial trade agreement. On several occasions, we have been close to a deal. The characterization of these discussions in the reported remarks is not accurate. We remain interested in a mutually beneficial trade deal between two complementary economies and look forward to concluding it. Incidentally, Prime Minister and President Trump have also spoken on phone on 8 occasions during 2025, covering different aspects of our wide-ranging partnership.
The characterization of Commerce Secretary Howard Lutnick's remarks is not accurate. That is the statement coming in from the MEA. Now, Elon Musk's AI tool Grok has turned off the image generator option for most users and limiting it to paying subscribers. This after widespread outcry over the generation of sexually explicit images of users. Meanwhile, sources tell CNBC-TV18 that the Indian government is unhappy with the response from Grok and is in fact considering legal action. Ashmit joins us now with more legal trouble likely for XAI and Grok?
Well, it seems to be so, and especially bear in mind that it's just Friday of last week when the Indian government had in fact dispatched a letter to X whereby they had warned of such trends that are being noticed by the government, such instances, such user harm being caused, and subsequently had warned of action that may be taken by the government. Now, there was a report that was sought from X. X submitted that report, submitted their response by Wednesday of this week, but highly placed sources within the government, they tell us that they're not happy with what X had to say. X essentially had attributed blame to user-generated images, had said that in future, if there are any such instances taking place, X will not be shy of taking down such accounts. But these responses have not quite met the concerns that were raised by the Indian government. And to that end, we understand that MeitY is looking at various legal options. It is firming up a legal opinion as to what could be the legal steps that could be followed. And while Grok, of course, appears to be the trigger, the broader concern that the Indian government appears to have is that there are sexually explicit, obscene content online. And to that end, let's bear in mind that as the 2025 was fading out, they had come out with an advisory. And in that advisory aimed at social media companies, they had warned against hosting such obscene content, warning that it could potentially lead to either one, a loss of safe harbor protection to the social media company, or two, even criminal action under the BNS. So clearly, the government considering options, contemplating legal action against X.
All right, Ashmit, many thanks for joining us. The big political story, West Bengal Chief Minister Mamata Banerjee led a rally in Kolkata a day after her dramatic showdown with the ED during searches at the premises linked to IPAC. Meanwhile, the Kolkata High Court has adjourned the hearing on ED's plea seeking an FIR against Mamata, citing an unmanageable crowd in court. From Kolkata to Delhi, TMC MPs, including Derek O'Brien and Mahua Moitra, were detained while staging protests outside Home Minister Amit Shah's office. The lawmakers had gathered with placards criticizing Shah a day after ED searches at the premises linked to IPAC, a consultancy firm handling Trinamool Congress's election strategy. And with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC-TV18. Stay tuned. Plenty more coming up after this break.
and welcome to Startup Street. I'm Ritu Singh, and with me is my colleague Shruti Mishra from the Mumbai studio. Here are the top headlines from the startup space. E-commerce platform Myntra unveils a zero-commission model for all new homegrown direct-to-consumer partner brands that are joining its marketplace. The model is going to help brands seeking to expand their digital presence beyond their own social media channels and website.
Fintech Skydo secures final authorization from Reserve Bank of India for cross-border payments. It's among the first few cross-border fintechs to secure this license. A move will help deepen its product offerings and expand coverage across traditional trade corridors.
Deep tech startup Aeon Space Labs develops India's lightest multi-spectral Earth imaging payload Mira, set for launch aboard ISRO's Polar Satellite Launch Vehicle on the 12th of January. It will enable near real-time in-orbit processing of Earth observation data while significantly lowering data download costs.
AI platform for interior design studios Project Studio raises undisclosed amount from Modular Capital with participation from V-Founder Circle, EvolveX and Tharper Innovate. The funds will be used to enhance AI capabilities, boost India presence and support international expansion.
And Elon Musk's AI tool Grok turns off the image generator option for most users and limits it to paying subscribers. This after widespread outcry over the generation of sexually explicit images of users. Sources say the Indian government is unhappy with the response so far from Grok and is considering legal action.
Well, those are the headlines we've been tracking for you this evening on What's Brewing Today. India's beauty boom is colliding with a new consumer reality. People want results, not complicated, time-consuming routines. Antinom, a performance-led beauty brand built for fast-moving women, has raised 28 crore rupees in a seed round led by Fireside Ventures with existing investors V3 Ventures and Rucum Capital, both doubling down just months after the launch. The brand claims it is big on multifunctional, climate-tailored products that simplify routines without compromising results and plans to roll out up to 7 category-creating launches this year. Joining me now is the founder and CEO of Antinom, Aparna Saxena. Aparna, welcome to Startup Street. You describe Antinom as an intentional beauty brand for fast-moving women. Who is this woman? What does her daily beauty routine look like today versus what you wanted to become, Aparna?
Thanks for having me. So this woman that we describe is the modern Indian urban woman, and her schedule is now overbooked. She is commuting, she is a professional, she's working, she has a social life, she's taking care of her kids. And the over-fragmented beauty market is actually not catering to her lifestyle.
Okay.
So Antinom comes in and kind of does that.
All right. Antinom's core promise, Aparna, is condensing multiple steps into one product. How challenging is that from an R&D perspective, especially in a market as diverse as India? Also, climate-tailored beauty is a big theme in your pitch. How central is this to your overall product strategy?
No, absolutely. So actually building for Indian climate is very hard. As you know, there are different climates in Bombay versus Delhi, Bangalore, and all pan-India. So really what we do is spend a lot of time real-world testing with our community of women who utilize these products on a day-to-day basis. Climate-tailored beauty is not just a marketing angle for us. It's an actual product architecture. So we blend ingredients in a way that actually caters to the Indian climate and assists these women from going from point A to point B.
All right, Aparna, you're planning to launch up to 7 category-creating products this year. Give us a sense of what's coming and the gaps you're trying to solve.
Yeah, absolutely. So category creation is something that's embedded in us because we are trying to challenge the norms, as our name suggests. The first few products I can in fact show you. I have them right in front of me. This is a utility bottle that can be attached to any bag. And in fact, it's a shower in a bottle called Shower in Seconds, made with lactic acid and no alcohol. Women can carry it anytime, anywhere, and use it anywhere, also intimate areas. So this one is catering to them so that they can go from point A to point B very seamlessly and don't have to spend that added time getting ready.
Okay.
Similarly, we're going to touch different points and problems that they face on a day-to-day basis.
All right, you've raised a seed round and are seeing double-digit repeat rates month on month. What's driving that repeat behavior, Aparna? And also walk us through your price points and overall pricing strategy.
Yeah, no, absolutely. I think the pivotal thing for us is the fact that these are utility-centric products. So in fact, the packaging actually helps the formulation. And that's prevalent with all the products that we have. So we didn't go with the bottles that look alike. We went with, okay, how would the user actually use it? So visible utility mixed with high usage frequency, which is that these are day-to-day products and not for special occasions. These are things that women will have on an everyday basis. I think that's what's bringing back customers to us. And our price point is anywhere between $8.99 to $11.99.
Okay.
Keeping the promise that we actually combine 5 to 6 products into one.
All right. You're scaling, Aparna, both D2C and offline. How many offline touch points are you eyeing, and which channel is actually giving you faster learning and stronger unit economics right now?
Fantastic question. So for offline, we will do that very selectively, high cluster points with corporations or women where women commute. And that's something that we've thought about, but we haven't entered yet. But the quickest learnings we are getting is from our D2C website, because user feedback and turnaround time is super fast, and we're able to engage with our customers. In fact, our Instagram page is very highly active because we speak directly to working and busy women of India who relate to our content and are able to understand these use cases which nobody had solved for before.
Okay, let's talk about India's beauty and personal care market. It is projected to hit $30 billion by 2027. Where does Antinom see its biggest opportunity? And in a crowded space dominated by global giants and influencer-led brands, how do you build a defensible brand without getting lost in the noise?
No, absolutely. The way I see the $30 billion market opportunity is not by volume, it's by behavior shift. Consumers are becoming increasingly time conscious and value driven, which means that they are looking for time-saving products. So in fact, that's how we get them. That behavior shift we capture as a first mover. And because our products are easy to explain and utility-centric, I think we'll stand out in the long run. The multifunctionality also making it a super value-driven decision for the customer.
All right, take us through your growth targets, Aparna, for the future in terms of revenue and expansion plans. Like you mentioned earlier, there are 7 category launch that are lined up for the year. How soon?
So we've been in market since July. We've already catered to 22,000 customers.
Okay.
We anticipate that this number only grows further to 200,000, 300,000 in the coming year with our expansion into 7 SKUs. I think for us, however, we remain true to the brand's voice that we will be multifunctional, utility-centric, climate of India, and will give instant results. So we'll deepen our understanding in that and spend the raised amount that we just did into expanding it very thoughtfully and selectively. So I think the next year is really important to us to win that trust with the customer and kind of enter every pain point and solve for every pain point that they have during their day.
And in terms of revenue, is there a target?
There is no specific target because we are very, very specific as to how many pain points we want to solve. But from this point onwards, at least a 5 to 10x is what I anticipate.
All right. On that note, it's time for me to wrap up our conversation. Many thanks, Aparna, for joining us on Startup Street, and wish you the very best with Antinom.
Thank you so much.
All right, Shruti, thanks very much for taking us through that. But let's move on to Arrowhead, which is a voice AI platform that's building human-like sales agents for the financial services sector. They've raised $3 million in a seed funding round that was led by Stellaris, with participation from angel investors as well. Now, this company, it enables banks, NBFCs, fintechs in India and globally replicate their top-performing sales agent behavior at scale through this ultra-human voice AI bot to deliver conversations. Now, currently, they operate across India and Southeast Asia, serve more than 50 customers across the BFSI spectrum, and this funding is going to be used to strengthen their core AI models, expand technology, and go-to-market team. So let's go across to Devyani Gupta, who's the co-founder and CEO of Arrowhead, for more on their plans ahead. Devyani, welcome to Startup Street. Thanks for your time here. Tell us about the $3 million funding that you've got. It's your seed funding round. In terms of priority, break it down for us. What goes where?
Yeah, thank you so much for having me. So essentially, we raised this $3 million funding for us to focus on 2 main things. One is scaling our team, so scaling across tech and GTM for us to be able to cater to more customers in a much better way. And number 2, for us to be able to continue building proprietary technology to build even higher converting bots than we are today.
Well, Devyani, it's an interesting concept. You're replicating what humans can do with AI. Some of us are worried about that, but the business has already seen a 5 times jump in annual recurring revenues between August and October. Currently, where are you at? Will this run rate continue? How do you think you'll exit the coming year?
Yeah, they're seeing a very strong demand and growth in India. Every bank and BFC that we're working with, it seems like they want this technology yesterday, which is great for our business. We're seeing this continue to grow. We're working with some of the largest enterprises, like you mentioned, Bank of Baroda Cards, Aditya Birla Capital, Paytm, and many more. And we're only seeing this increase further. So increase across customers, but even within customers. Today, most customers are deploying maybe less than 10% of their volume on voice AI, which they're hoping to increase to 80% plus within the next year.
I see. Well, let me then ask you in this way. What is going to drive revenue growth more? I mean, is it the higher wallet share from your existing clients, which is across the BFSI spectrum, or new additions, you think, newer areas and beyond BFSI as well? Because sales agents are required everywhere. I wonder, why not insurance? Why not other spaces?
Yeah, no, insurance is actually a key space we're working in. So to answer your first question, it's definitely going to come from both. Existing customers, we're expanding very rapidly. We've actually already had customers use us for 100% of their sales calls. One customer where we did health insurance sales up to 20-minute calls without customers knowing they're talking to a bot, where we increased conversions by 45% for them. So they replaced 100% of their human team with our bot. So within existing customers, but then again with new customers as well. So on a monthly basis, we're getting dozens of new clients expressing interest in working with us and using our bots. So we're continuing to grow there as well.
So these dozens of new clients that you're getting, you say on a monthly basis, at what pace is this expected to grow? I mean, there are only so many players in the market, unless, of course, you count the smaller NBFCs and the newer fintechs that are coming in. How large can the base grow? And hence my question, aren't you looking to diversify outside of banks and fintechs?
Yeah, so actually within banking, the interesting thing is that one of the benefits of using voice AI is that you're not just replacing the volume that you have today. Because with voice AI, you have no cap on volumes, you can actually increase the volumes even more. So as an example, for one of the use cases we're doing, their human agents today were only calling their bottom of the funnel drop off in their app journey. So people who drop off at the payments page, we today with the bot are also calling their top of the funnel drop offs. So people that drop off at the sign in page, which is about 30x the volume, and they didn't even have human bandwidth to cater to that. So the market size itself is expanding with the potential of voice AI because you don't have any volume capacity limit. So we're actually very bullish on BFSI specifically as a sector, starting with India and expanding across Asia and the Middle East as well.
Okay, speaking of those markets you mentioned, India and Southeast Asia, where you're live with about 50 customers at the moment, which geography or any particular segment is growing the fastest for you today? And, in future, are you looking at, again, geographical expansion into other markets?
Yes, definitely. So India is where we're seeing very, very rapid growth. India is definitely an early adopter in this space. I think the reason for that being that this is much more cost effective. India is a very cost conscious country. If you're able to reduce costs of your calling by 2/3 and maintain the same top line, if not increase it, it becomes a no-brainer for most companies. So India is moving very quickly on this. We're seeing Middle East and Southeast Asia coming up right after that. So our plans are to expand to that later this year as well.
Well, speaking of cost, Devyani, I mean, enterprise AI can also be pretty capital intensive. How long does this $3 million last you? And when do you think you'll have to come to the market again?
So we are looking to come back into the market actually later this year based on the milestones we're expecting to hit in our revenue. There is a lot of capital required to be able to train better models, to be able to build more proprietary technology, and hence build higher converting bots. So that is our goal. Although the capital will last us longer, we believe we can go to market sooner based on the revenue milestones we're targeting to achieve.
Okay, let's end with that target then. Your press release says this market is a $3 billion market and the penetration is less than $50 million. How much of this market do you think you can grab for your company?
So our vision as Arrowhead over the next couple of years is to be the largest and best voice AI company for BFSI across the world. So we're looking to be the market leader in this. And I think we already have strong tailwinds to show that can happen. In India, we're already seeing that. So that is our path to success over the next few years.
And we wish you the best with that, Devyani. Thank you so much for your time here today, and we'll continue to track your journey very closely here. Thanks very much.
Thank you so much.
Well, thank you, Ritu, for that. It's time for us to head into a short break. Coming up next, Alia Bhatt's fashion brand Edamama has expanded into personal care with a new range of baby care products. The founder shares how the brand's strategy is carving out a competitive edge in the kids' fashion wear space. Stay tuned.
Welcome back. You're watching Startup Straight. Now, Alia Bhatt's brand, Edamama, has expanded into personal care with a range of baby care products as well. In a conversation with my colleague Shilpa Ranipeta, Alia Bhatt explains the company's strategy behind the move in this fiercely competitive children's care market. And she also talks about the brand's next phase of growth and her other investments as well. Take a look.
So Edamama's strategy from the very beginning, even when we started with our clothing, was to build a brand where the idea of a sustainable clothing brand or a conscious clothing brand didn't have to feel boring and muted and mundane and didn't have to seem extremely inaccessible in terms of its price points.
Right.
So similarly for personal care, our endeavor was to bring in the color. So if you see the packaging is full of color, stick to our principle, which is conscious, clean, toxin, free, harsh chemical free, dermat approved, pediatrician approved, all those things that you would look for in a personal care brand, but also keep the price points very accessible.
It's a very crowded space. You have some very established brands also, very big conglomerates also doing this. So, what prompted this particular expansion?
Absolutely agree. It's a crowded space, it's high competition, but I believe in the product and I really think it's a strong product. Personal care is one of the largest categories and verticals that we had to build within the brand. So this was actually my first sort of big project when the Reliance partnership sort of came into play. This was the first thing that we worked on. So it's been 2 years. Even I want to be completely transparent. Our packaging, we are a sustainable brand, but our packaging is plastic. Why it's plastic, I need to even explain that.
Right, please do.
Because we realize, so it's a virgin food grade recyclable plastic. It's not recycled plastic.
But talking about the company, help us understand how large or how's the growth been, and how much of an expansion has come in ever since the Reliance deal also has happened. So what's your footprint like as we talk about today?
So we started off as a D2C brand, and with Reliance's presence, we have now 5 EBOs, and by the end of this year, we will have 6 more. So a total of 11 EBOs across the country. For us to go from D2C to retail was essential because we always have had the dream that Edamama should be an experience-led brand. And we did feel that our presence in key malls and key spaces were very important. For now, we are in Mumbai, Noida, Hyderabad, Bangalore, but we do plan on diversifying, and that has been the huge, contribution for Reliance. Because number one, of course, their distribution chain is large. From amping up the supply chain, also understanding different verticals from our toy range now becoming more and more, robust. It's accessories as well, and personal care being a huge category.
Right. What about more verticals? Because there's a lot of baby accessories, and there's a lot more that is there.
We're already doing baby accessories.
Okay.
In a controlled sort of way. But because I was talking a little bit about animals, I also see that being a huge vertical as well.
Okay. You think you'll move into pet care?
Yeah.
Okay,
That's
interesting. Interesting. So Edamama will be a child care and pet care brand.
Yeah, because some people who don't have children have pets.
Of course, and they're as good as children. They are children for them.
Yes, absolutely.
Fair
and
enough.
you can have children and pets at the same time and want to care for both of them, of course.
Okay,
like I do.
Interesting. So how big is the brand? Is that something you'd be able to share with us in terms of because as a business channel, we try to understand how the brand is growing, how big is the business?
So I always stay away from talking about numbers, but growth you would see just in terms of the product range increasing and our verticals increasing. We're able to move and put one steady foot in front of one another because of the response that we're seeing from the consumer.
Looking at your investment portfolio also, we see a lot of celebrities also looking at health and wellness now. Is that something that you want to get into?
Well, never say never. But I think for now, in terms of personal care, my involvement, my interest has only been building it under Edamama.
Okay. Well. Any recent investments that you've bet on that you're very happy, proud about, that has really taken off?
Super Bottoms is one of them. Pool, I'm so proud of as for the brand also, the way it's doing, it's just flying off the shelf. So I think for me, the investment market again has to feel very as personal as a brand building would?
Well, that was Alia Bhatt on a recently launched range of baby care products. It's the time of the week when we bring you a wrap-up on the key startup deals signed over the past week. This week, 16 startup deals worth $108 million were signed as per Venture Intelligence. Some top deals include fitness startup Culfit's $50 million fundraise, followed by health fintech startup Even securing $20 million. Industrial AI startup Spectre.ai, space tech startup Take Me to Space, and e-commerce enabler Nitro Commerce also raised funds this week. And with that, it's a wrap on this edition of Startup Street. For more news and updates coming up on the other side. Good evening. Thanks very much for joining us on India Business Hour. I'm Shriram Finance. The top stories that we're tracking for you this evening. The Sensex and the Nifty post the biggest weekly fall in 4 months. 15 lakh crore rupees in market capitalization wiped out in the last 5 sessions. All sectoral indices close in the red. Inflows into equity mutual funds declined 6% in December, but investments into gold ETFs rise threefold. SIP inflows hit another record high, crossing 31,000 crore rupees in a month. US Commerce Secretary Howard Lutnick claims a trade deal with India did not happen because Prime Minister Modi did not call President Trump. India's External Affairs Ministry says the characterization of the talks in the statements is not accurate. Adds Prime Minister Modi spoke to President Trump on 8 occasions in 2025. The U.S. Supreme Court is scheduled to pass a ruling on the legality of President Trump's sweeping tariffs. The order is likely to address whether the Trump administration can use provisions under the Emergency Economic Powers Act to levy tariffs. Vodafone Idea receives an official communication from the government on relief in the AGR case. Will pay 124 crore rupees annually for 6 years, starting March 2026. Sources say banks will consider granting fresh loans right away. Shares of Indian Energy Exchange tumble amidst uncertainty over implementing market coupling rules. The Central Electricity Regulator reclassifies its order on market coupling as a direction before the appellate tribunal. This after SEBI alleged insider trading by CERC officials. The tribunal will hear the case on the 19th of January. The government is likely to table a bill to amend the National Highways Act to make land acquisition easier. Sources say land parcels will be returned to original owners if it remains unused for 5 years. The amendments are likely in the upcoming budget session of Parliament. West Bengal's Chief Minister Mamata Banerjee leads a protest rally in Kolkata, claims the Enforcement Directorate raids on IPAC are aimed at stealing their political strategy ahead of the elections. The High Court adjourns the hearing on ED's plea seeking an FIR against Mamata, cites unmanageable crowd in the courtroom. Iran plunges into a total internet blackout as protests over the economy spread across the country. The Supreme Leader Ayatollah Khamenei denounces the protests and alleges US interference. At least 45 protesters have been killed by security forces in the last 2 weeks. Tensions rise in the United States over President Trump's immigration crackdown. Border Patrol agents shot and wounded 2 people in Portland. This follows the fatal shooting of a woman in Minnesota on Wednesday, deepening the rift between state and federal officials. Elon Musk's AI tool Grok turns off the image generator option for most users and limits it to paying subscribers. This after the widespread outcry over generation of sexually explicit images of users. Sources say the Indian government is unhappy with the response from Grok and is considering legal action. All of that and more coming up for you in just a bit, but let's start with the day's market action. The Sensex and the Nifty posting losses for the 4th straight session. In fact, all frontline indices dropping by nearly 1% each, with Realty being the biggest losing index. More than 35 Nifty stocks closed in the red today. But let's bring up the picture for the week, because the market snapped its 2-week gaining streak and posted its biggest weekly fall that we've seen in 4 months. In fact, BSE-listed companies have raised market cap of more than 15 lakh crore rupees in this week. The Nifty slipped nearly 2.5%, while all indices reported losses with cuts up to 6%. So that's the data for the week and for the day. But let's talk about the data into mutual funds. Inflows into equity mutual funds declined by 6% in December. This as per the data released by the industry body AMFI. Inflows in December stood at just over 28,000 crores compared to nearly 30,000 crore rupees in November. Inflows into gold ETFs surging up nearly threefold to more than 11,600 crore rupees for December, compared to just under 4,000 crore rupees in November. That typically is on account of the fact that we've seen gold prices surging. SIP inflows hitting another record high, though, crossing the 31,000 crore rupee mark for the first time. So SIP flows continue to be very strong. So even as equity mutual fund flows have declined, we are continuing to see that steady inflow into SIPs. But into the energy markets now, where crude oil prices on track for a 3rd straight week of gains. This amid fears of supply disruption given the prospects of Russia-related sanctions and a drone attack on a Russia-bound oil tanker near Turkey's coast in the Black Sea. Investors now waiting for the outcome of President Trump's meeting with U.S. oil company executives on investments in Venezuela's oil sector. As we've been reporting, it's not as if oil companies are going to be turning on the tap immediately. They will want clarity on what the situation is going to be and perhaps some guarantees as well. Now, the big story. U.S. Commerce Secretary Howard Lutnick claims that the trade deal between India and the U.S. did not happen because Prime Minister Modi did not call President Trump. Now, speaking on a U.S. podcast, Lutnick said, and I quote, "It is President Trump's deal. He's the closer. He does it. It's all set up. You've got to have Modi call the president. India was uncomfortable doing it, so Modi didn't call." End of quote. Now, Lutnick's remarks have come days after President Trump claimed that Prime Minister Modi was not that happy with him because of the high tariffs imposed on India. Here's the U.S. Commerce Secretary Howard Lutnick on what went wrong with the India-U.S. trade deal.
Everybody asked the president, who do you think is next? And if you look back at the time. He talks about a variety of countries, but he names India a couple of times publicly. It's not like a big secret. And we were talking India, and we told India you had 3 Fridays.
You put them on a shot clock.
Well, they have to get it done because what happens is I have lots of other countries, and when those other countries do their deal,
the staircase goes up.
And now the president, during all these deals, he would refer to me as the greatest table setter who ever lived. Okay, because you've never had anybody who was as successful as me as a businessman before, who's just the table setter. That's basically, so, because what I would do is I would negotiate the contracts and set the whole deal up. But let's be clear, it's his deal.
Yeah.
Okay, he's the closer, he does the deal. So I said, you got to have Modi. It's all set up. You have to have Modi call the president. They were uncomfortable doing it. So Modi didn't call.
Wow.
So that Friday left. In the middle of the next week, we did Indonesia, the Philippines, right? Vietnam. We announced a whole bunch of deals.
Malaysia in that period.
So we did these whole bunch of deals. So that's like
that staircase.
And they were and because we negotiated them and assumed India was going to be done before them, I had negotiated them at a higher rate. So now the problem is the deals came out at a higher rate.
Right.
And then India calls back and says, oh, okay, we're ready. I said, ready for what?
Commerce Secretary Howard Lutnick on what went wrong between the India-US trade deal. Now, India's External Affairs Ministry says, and I quote, the characterization of the talks in the statement is not accurate. The External Affairs Ministry spokesperson Randeep Jaiswal said Prime Minister Modi and President Trump spoke on 8 occasions in 2025. Take a look.
Sir, could you give us a status of the India-US trade deal in light of the US Commerce Secretary's latest statement, where he has gone on to say that the trade deal that was negotiated and agreed upon with India earlier does not exist on paper anymore. And he said the deal did not happen because the Prime Minister, Narendra Modi, did not call President Trump.
We have seen the remarks. India and the United States were committed to negotiating a bilateral trade agreement with the US as far back as 13th of February last year, that is. Since then, two sides have held multiple rounds of negotiations to arrive at a balanced and mutually beneficial trade agreement. On several occasions, we have been close to a deal. The characterization of these discussions in the reported remarks is not accurate. We remain interested in a mutually beneficial trade deal between two complementary economies and look forward to concluding it. Incidentally, Prime Minister and President Trump have also spoken on phone on 8 occasions during 2025, covering different aspects of our wide-ranging partnership.
Well, that is the External Affairs Ministry spokesperson commenting on the statements that have come in from US Commerce Secretary Howard Lutnick. Ian Bremmer, the president of Eurasia Group, says there is less urgency within the Trump administration to seal a trade deal with India. Speaking exclusively to CNBC-TV18, Bremmer said the delay is all about India buying oil from Russia. However, he did add that the relationship with India is important to President Trump and the administration. Take a look.
Trump has sort of delayed and extended out these negotiations by adding terms in a couple of occasions now. And most recently, it's all about ensuring that the Indians cut off all of their purchasing of oil from Russia. The reason it's taken time is in part because it's just not that urgent. There's not a lot of trade between the United States and India. Even if tariffs are really high, the impact on a very fast-growing Indian economy, expected some 8% in 2026, just isn't that great. You know, if you looked at the national security strategy from the U.S. a month ago, the Quad is in there as a priority of the U.S. The Americans continue to stand that up, including the military, the intelligence coordination. U.S.-India relations are important for a lot of key constituents of Trump. A lot of these tech companies that are driving the U.S. economy are investing a lot in India right now. They want this deal to get done. I'm not really particularly panicked about that statement.
That's Ian Bremer. Now, it's a development that could have global implications. The U.S. Supreme Court is scheduled to pass a ruling on the legality of President Trump's sweeping tariffs. The order is likely to address whether the Trump administration can use provisions under the Emergency Economic Powers Act to levy tariffs. Now, if the court rules that Trump's tariffs are illegal, importers can apply for refunds by the 6th of February. While the markets across the world wait with bated breath for the U.S. top court's ruling, we at CNBC-TV18 will bring you all the biggest voices, expert analysis. White House advisor Kevin Hassett, Allianz chief economic advisor Mohammed El Arian, and many others will share their views. We will also focus on the India impact of the tariff ruling. Mark Linscott of the US-India Strategic Partnership Forum and former ambassador to the United States, Arun Singh, will speak to us on the Supreme Court ruling. It is expected around 8:30, and of course the live coverage will be on here on CNBC-TV18. Now, President Trump has acknowledged that his administration will have to choose between pursuing his ambition to take control of Greenland and keeping NATO intact. In an interview with the New York Times, Trump said that ownership of the Arctic island, a Danish autonomous territory, was, and I quote, psychologically needed for success. The president also maintained that he did not feel answerable to international law, but is constrained only by his own conscience. Meanwhile, Denmark's defense ministry has said it will respond immediately to any foreign invasion without waiting for political clearance or formal orders. Days after Venezuelan leader Maduro's extraction in a pre-drawn raid, President Trump has ruled out a second wave of strikes. This after Venezuela released 5 political prisoners and promised to release more. The U.S. Senate has advanced a resolution asking President Trump to seek the Congress's permission before engaging in further hostilities in the Latin American nation. The resolution, the first notable pushback to Trump's expansionary ambitions, was introduced by Democratic Senator Tim Kaine. It was passed by a margin of 52 to 47, with 5 Republican senators breaking ranks to support the measure. In a social media post, President Trump said Republicans should be ashamed of the senators who voted with the Democrats. And a U.S. Border Patrol agent have shot 2 and wounded a man and a woman in a vehicle in Portland in Oregon. The Homeland Security Department has said the shots were fired after the driver attempted to run over the Border Patrol agents. The department also claimed that the man and the women were Venezuelan nationals with alleged links to highly prominent criminal gangs. This comes a day after federal agents shot and killed a 37-year-old woman during an immigration crackdown in Minnesota. In international news, it's day 12 of the massive anti-government protests across Iran amidst growing concerns over economic hardship in the country. Demonstrators have taken to the streets, chanting slogans against the Islamic Republic's leadership. An internet monitoring group has reported a nationwide blackout across the country. At least 34 protesters and 4 security personnel have been killed during the unrest. President Trump has repeated his threat to strike Iran very hard if government forces kill protesters. Iran's Supreme Leader Ayatollah Ali Khamenei has maintained that the Islamic Republic would not back down despite protests. Back home, shares of Vodafone Idea rose in early trade after the company announced that it has received communication from the telecom department on its AGR dues. Now, in an exchange filing, the company said AGR dues for the period between FY07 to FY19 will be frozen. The company will have to shell out a maximum of 124 crore rupees annually. That's over the next 6 years. That's between 2026 to March 2031. Now, after that payment, it will be 100 crore rupees annually. That's for a period of 4 years. That's between March 2032 to March 2035. And the remaining dues will be spread over another 6 years from March 2036 to March 2041. Now, this move has come more than a week after the cabinet had frozen AGR dues worth more than 87,000 crore rupees for the next 5 years. It's also provided the company a 10-year time frame to pay the amount. So this big overhang over Vodafone Idea probably behind it, at least for now, and the relief coming in is quite significant for the company. So staying with Vodafone Idea, after this much-needed relief that it has received, sources indicate that banks are now considering granting fresh loans to the company. Ritu joins us now with more details. Ritu, the company has been on the lookout for funds. With this relief coming in, will banks be less averse to loaning?
Well, after that EGR relief, the most critical cue for Vodafone Idea is going to be that 25,000 crore rupee bank loan and whether that now comes through. Remember, these debt-raising discussions with lenders have been stalled for months because of uncertainty over the company's AGR dues. But with that relief now coming in, and importantly, with some visibility on this cash flow relief for the next 10 years, our banking sources indicate that the process to release fresh funding for Vodafone is going to start right away. In fact, we understand that the SBI-led consortium of banks is more or less aligned on extending this fresh line of credit to Vodafone. But before they take the final proposal to their respective boards, they are going to await the last word from the DoT committee. But it is a green signal from lenders for now, and that should bring some much-needed relief for Vodafone in terms of the timeline. Once the process starts now, it may take up to 2 months for the funding to be released. Now, in terms of who the top lenders to Vodafone are, SBI, as we know, alone has an exposure, we understand, of more than 6,300 crore rupees, and that is followed by Punjab National Bank, almost 1,500 crore rupees, Axis Bank, IndusInd Bank, Canara Bank, IDBI Bank. These are some of the other large lenders that are involved as well. The total bank dues are around 11,000 crore rupees, and that includes both the term loans and the working capital loans across fund and non-fund-based exposures.
All right, Ritu, many thanks for joining us. Now, shares of Indian Energy Exchange declined in trade today amidst uncertainty over implementing the market coupling rules. Now, the Electricity Appellate Tribunal sought clarity on the Central Electricity Regulator's withdrawal of the order. The CERC reclassified its order on market coupling as a direction and not an order. Just before the hearing, the regulator also maintained it will implement the order only after issuing regulations. It added that these regulations have even not passed the draft stage yet. The tribunal will now take up the matter on the 19th of January, so the uncertainty continues. The government is likely to introduce amendments to the National Highways Act in the budget session. Sources say the centre may propose changes to the land acquisition rules under the Act. Shivani joins us now with more details. Shivani, what are your sources telling you?
Well, yes, sources tell CNBC-TV18 that amendments to the National Highways Act 1956 are likely to be tabled in the upcoming budget session in what could be a significant push to speed up highway and infrastructure development in the country. The proposed changes focus on land acquisition under the NHAI framework, an area that has long been a major bottleneck for road projects across the country. According to sources, the amendment aims to ease land procurement, reduce disputes, and bring more clarity to the acquisition process, helping cut delays that have stalled several highway projects. One of the key proposals under the consideration is that land acquired for highways but remaining unused could be returned to the original landowners after a period of 5 years. The draft law also looks to introduce clear time limits for challenging compensation, a move aimed to avoiding prolonged litigation that often holds up execution on the ground. Overall, the amendment is being seen as a crucial reform to unlock stuck projects, accelerate highway construction, and ensure faster rollout of the government's infrastructure pipeline at a time when road building remains central to the broader growth and capex push. Back to you.
All right, Shivani, many thanks for joining us. In fact, speaking of the budget session of Parliament will begin on the 28th of January and the first phase will conclude on the 13th of February. Then there will be a recess. Parliament will reassemble on the 9th of March and the second phase will conclude on the 2nd of April. The budget is likely on the 1st of February, which is a Sunday. So the budget session dates have been announced. The budget date has not been made official just yet, but we are given to understand that they will stick with the 1st of February. Well, we will head into a break, but up next, Elon Musk's AI tool Grok turns off the image generator option for most users, limits it to paying subscribers. That and more when we return. West Bengal Chief Minister Mamata Banerjee led a rally in Kolkata a day after a dramatic showdown with the ED during searches at the premises linked to IPAC. Meanwhile, the Calcutta High Court adjourned the hearing on ED's plea seeking an FIR against Banerjee, citing an unmanageable crowd in the courtroom. And from Kolkata to Delhi, TMC MPs including Derek O'Brien and Mahua Moitra were detained while staging protests outside Home Minister Amit Shah's office. The lawmakers gathered with placards criticising Shah a day after ED searches at premises linked to IPAC, a consultancy firm handling Trinamool Congress's election strategy. Maharashtra's Chief Minister and BJP leader Devendra Fadnavis slamming the local leadership in Vidarbha for entering into an alliance that included Asauddin Owaisi's party AIMIM. The alliance was forged after the BJP failed to secure clear majority in the 35-member municipal council. Fadnavis said while the alliance was unacceptable, the BJP did not know that AIMIM was a part of it. The party has since withdrawn from the alliance.
MIM से alliance करना गलत है, ये हमको मंजूर भी नहीं है। आकोट करके एक बहुत छोटी सी जगह है, वहाँ की एक नगर पालिका 17,000 वोटर जहाँ पर है, वहाँ हमारा नगराध्यक्ष चुनकर आया बीजेपी का, और नीचे में जो है हमारा कोई मेजॉरिटी नहीं थी। तो अभी महाराष्ट्र में ये होता है कि आप पोस्ट पोल रजिस्ट्रेशन कर सकते हो साथ में आकर, तो उस प्रकार से हमने एनसीपी के साथ किया। तब हमको ये पता नहीं था कि एनसीपी ने ऑलरेडी एमआईएम के साथ अलायंस किया हुआ है। तो जैसे ही एनसीपी के साथ हमारा अलायंस हुआ, टेक्निकली ये एमआईएम वाले भी हमारे पार्टनर बन गए।
Well, that is Maharashtra Chief Minister Devendra Fadnavis on the civic elections. Elon Musk's AI tool Grok has turned off the image generator option for most users and has now limited it to paying subscribers. This after widespread outcry over generation of sexually explicit images of users. Meanwhile, sources tell CNBC-TV18 that the Indian government is unhappy with the response from Grok and is considering legal action. In fact, number 10 in the UK pretty much suggesting the same. Ashmit Kumar joins us now with more details. Ashmit, the government contemplating legal action?
Well, it seems to be so, and especially bear in mind that it's just Friday of last week when the Indian government had in fact dispatched a letter to X whereby they had warned of such trends that are being noticed by the government, such instances, such user harm being caused, and subsequently had warned of action that may be taken by the government. Now, there was a report that was sought from X. X submitted that report, submitted their response by Wednesday of this week, but highly placed sources within the government, they tell us that they're not happy with what X had to say. X essentially had attributed blame to user-generated images, had said that in future, if there are any such instances taking place, X will not be shy of taking down such accounts. But these responses have not quite met the concerns that were raised by the Indian government. And to that end, we understand that MeitY is looking at various legal options. It is firming up a legal opinion as to what could be the legal steps that could be followed. And while Grok, of course, appears to be the trigger, the broader concern that the Indian government appears to have is that there are sexually explicit, obscene content online. And to that end, let's bear in mind that as the 2025 was fading out, they had come out with an advisory. And in that advisory aimed at social media companies, they had warned against hosting such obscene content, warning that it could potentially lead to either one, a loss of safe harbor protection to the social media company, or two, even criminal action under the BNS. So clearly, the government considering options, contemplating legal action against X.
Many thanks, Ashmit. Now, Facebook's parent company Meta has signed agreements with 3 nuclear power companies, this in a bid to secure necessary resources for its AI ambition. The arrangement with these companies are for Meta's supercluster computing system. The system is being built at a data center in Ohio. No financial terms have been disclosed. General Motors will take a $6 billion charge to unwind some of its EV investments. This as demand has slowed after the Trump administration revoked policies that were intended to boost EV adoption. Most of the write-down is related to payout to suppliers who planned for higher production volumes before the market turned. The automaker also warned of further write-downs this year. This comes weeks after Ford Motor took a $19.5 billion write-down on its EV investments. Well, with that, it is time for us to wrap up this edition of India Business Hour. Thanks very much for watching. The news will continue right here on CNBC-TV18. Do remember, we are going to be live with the verdict coming in from the US Supreme Court. Will they hold the Trump tariffs to be legal, or will there be a change? All the commentary, the analysis, the insights live from Wall Street. Get the CNBC Global Edge. Big faces coming up for you shortly.
Let's talk money.
Hello and welcome to Let's Talk Money. I'm your host, Surabhi Upadhyay. Gold, silver, copper, aluminum. Now, when we investors think about our portfolio, we rarely think about metals as a real asset class. At best, most of us have some exposure to gold, and many a times, even that is not a scientific, well thought out portfolio allocation. It's something that we perhaps have at home, or some jewelry that we add on here or there, or maybe an ETF that we invest in. But now, having seen a 60% run in the price of gold in the last 1 year, a near 150% surge in silver, and over 50% rally in copper in just the last 1 year, many investors are suffering from FOMO, the fear of missing out. But FOMO investing is not a strategy, which is why this week we are going to do a full classroom on the metals melt-up. Yes, that's what I call it, the metals melt-up of 2025, which is still continuing, by the way, in 2026. So what is driving this massive price spiral? What is the outlook on gold, silver, and other industrial metals in the coming months and years? And then we ask the experts if there is still some merit in investing in these metals as an asset class. Joining me on the show are Peter Mungwaya, CEO of Trading.com, Mrin Agrawal, who's a financial educator and director of FinSafe India, and Kunal Shah, Vice President, Head of Commodities Research at Nirmal Bang. Thank you so much, ladies and gentlemen, for joining in. As you heard in my opening remarks, this is a classroom because this is for the actual retail level investors out there who are watching all these headlines and wondering what happened. Gold and silver have moved like small cap stocks, right? And so here we are. So first of all, thank you very much for joining in. Maybe I can get opening thoughts, Peter, from you first, and then let's hear from Kunal in terms of what really has happened. 50% to 150% price rise. Peter?
Absolutely, Shriram. Pleasure to join you. And I tell you what, if you would have rolled this show back 12 months and we were sitting here, no one would have believed what you have just said as far as that intro. I don't think Jim Rogers wouldn't have believed it.
Yeah.
Because every market analyst was saying possibly you might get 3,500 out of gold. You may touch 3,750 as a long shot. And silver, yeah, all right, let's go to $40. Well, we've touched $84 for silver, as we know. They're the numbers on the chart. I mean, it's just extraordinary. And the overall momentum and appetite, I think, from retail traders, central banks, and the paper market has just been absolutely game on. So I feel as though that will continue very much into 2026, Surabhi, and I'm not expecting any of that heat to come out of the market anytime soon. So that's my observations, and I think strap yourself in. It's going to be one wild year.
All right. So, it's going to be interesting. It has been interesting, probably will be. But Kunal, your thoughts? The thing is, now we know that silver has wide uses as an industrial metal. It's used in data centers. It's used in, electronics. It's used in electric vehicles. That all is known. It's been known for years. So what changed in the last few months?
Okay, it's a very good question, and I just like to. It all started last year with one fact that people realize that with every year going by, US is going to find very difficult to service its debt, because at the start of the year, the US interest rate stood at 4.5%, and their total debt was standing at $37 trillion. So they had to service this debt with the 4.5% interest rate. So that was never going to be possible every year whenever they have to service this debt at a higher interest rate. So the main reason, the main ground for this rally was the rising debt of US at an alarming pace. So the way US debt from 2021, the way it has been every year, $1.5–2 trillion, $1.5–2 trillion, that was absolutely unsustainable. Second, fear of crash of US dollar because of the rising debt level. The way their debt was soaring, so everyone was fearful. What if dollar, loses its value by 10–15% going forward? Or what if the dollar crashes, So that was the starting point, when people started to buy commodities. Third thing, most important, we are living in a multipolar world. We are no longer in a globalization economy. Earlier, in globalization economy, there was a transfer of goods and services to all economies. Now, we are going back towards the protectionism. So everyone is bothering about securing their own supply, okay? Because of the tariff era, which was started by Mr. Donald Trump. So now everyone wants to have a hard asset in their portfolio because the paper currencies are seen losing its value. And when the paper currency are seen losing its value, and that is dollar, in fact, everyone wanted to be in commodities. So that's where the bull run started in 2025. So post-COVID, the fourth reason, there was no incremental growth in the supply of any of these commodities, what we are talking about. May it be copper, may it be silver, may it be gold. So the supply side was weak from last 4 years. There was no major supply side growth which has come in all of these metals, the price of which have rallied, okay? And now we are talking about the new age demand, which was not there 5 years back, which is the data center demand, battery storage, electronic vehicle, the way the transitions of EV taking place. So it all combined and led to this humongous rally in a price of all these commodities. So you take precious metals, you take base metals, you take even for that metal, even in last 2 months, even the ferrous metals have started to catch up,
Yep.
So all commodities have been moving up, not because the demand was so strong or the supply, but because everyone wanted to be in commodities because of the hard asset. Everyone wanted to own a bit of
something tangible,
because,
something that can be an alternate to the dollar, like you're saying. So it really started from there.
And if you see what has been going on from last 4 days, what we are seeing from the Fed chairman, from the Walmart, from everyone now is accepting crypto, and crypto is now becoming a reality, where the Fed is saying that we are going to regulate this. This is going to stay. This is alternative payment system. This is a simultaneous monetary system. So they know eventually there is going to be a collapse in the dollar. The debt level every year, if it is rising at $1.5–2 trillion, dollar is going to collapse one fine day.
So Kunal, for the sake of financial market stability worldwide, let's hope we don't get to that point, the collapse of the dollar, because that will be like Armageddon. But I take your point. I mean, largely there's a lot of fear about what's happening with the US policy, and the way these US tariffs also shaped up over the course of the year. So that's led to heightened interest. Mrin, I want to come to you, and we'll go through each of these metals one by one in a minute. But Mrin, I'm sure over the last couple of months, the last year, you work with investors widely. I'm sure you got a lot of these questions thrown at you. Should I buy crypto? Should I buy gold, silver? Anything beyond Indian equities? Because Indian equities, anyway, were among the worst performers of the last year.
Yes, absolutely. And I think, there's been a lot of trend chasing. And in fact, even now, there are so many investors after the 150% return. The most common question right now is that should one buy silver, or, should one get into copper right now? And of course, we know that it's not easy to get into copper investments in India, right? So, but there's a lot of interest from investors. But I would still say, Surabhi, that a lot of it is driven by FOMO, and a lot of people are really trying to play the catch up, having missed out the rally probably last year.
And that is why this conversation is extremely important, because obviously we here and viewers of this show, Let's Talk Money, would know that FOMO is not a strategy. We never believe in it. None of our experts ever advise it. It needs to be far more scientific. So Mrin, bear with us. I'm going to ask the commodity experts to go through each of these metals one by one, and then we'll come back to the investing strategy in a minute. But let's take it from the top, gentlemen. So let's talk about gold. So the triggers have been, sort of captured by Kunal earlier, the fear around US policy, what's happening with US interest rates. The question is, can gold still keep rising despite a 60% rally last year? Peter, why do you think so?
Yes, I do believe so. Building on, and Surabhi, building on what Kunal mentioned, I mean, you could discuss this all day as far as the framework, what are the key drivers and the metrics associated. I do believe if you're looking at far as central bank buying, appetite as far as retail traders, paper market and physical acquisition, yes, I do believe that gold is in its early stages of a bull market. And when I say that, it's not unusual when you see these hyperdrive events that they take a long protracted time to grow. And the overall theme at the moment, I think, is certainly bullish, and that will continue. I look into 26 as a year that you would have to think very closely. If you don't have it in a portfolio or you don't have physical, now's the time to probably say, yes, I want to be a part of it, because the momentum and I think the attraction will be fairly solid going into the first half of the year. I'm tipping by the end of this month around about 47,500, so up about $300 from where it is at the moment. And there is no way that it is not Main Street news, because people are talking about it from 15 years of age all the way through to 90. Male and female, everyone is talking about it globally, and I think that that's very much on everyone's radar.
Okay, so that's a full thumbs up to gold from Peter. Kunal, come in on this. A lot of the targets that I saw, like I said, I think UBS, JP Morgan, Bank of America, a lot of these big global banks, they are calling for 5,000, which is actually not too far away from where we are. But what is your own call? Can one still get onto the gold bandwagon despite the rally?
See, the fundamental of gold is bullish, and a lot of these fundamentals are already priced in. So after the 65-70% rally, what we've seen in gold futures, I think a lot of fundamentals are in the price right now.